Hello friends, so welcome to this CMA INTER paper number 11 Financial Management Marathon. In this marathon, we are going to cover roughly around 90% of your entire CMA Financial Management syllabus, and everything I have given, like summary notes I have given, handwritten summary notes here. Okay, everything you can just go through, and I have also given all the important questions for examination, which you need to refer the day before examination. Everything I have given here. So two different PDFs will be available. One of the summary notes, okay, and the PDF of the questions, which I have put there. So both the PDFs will be freely available in our website. You can create a login and just download the PDF. Now, this marathon will run for approximately 11 to 12 hours. That is what we have planned. Okay, more or less some minor changes will be there here and there maybe, but I am expecting it to be for 11 hours. I don't know exact number of hours here, but I expect more or less 11 to 12 hours will be the time period, so that you can revise the entire syllabus within the 1 or 2 days before examination. Okay, you'll be comfortably able to revise the thing. So with this material in hand, you don't need to refer any other material, okay, of any other sources. This is far more sufficient. Apart from the concepts, see, few concepts we could not cover in this, like cash flow statement, which will be covered in the accounts, normal routine, fund flow statement, cash flow statement, which you have studied. So all the core aspects of the finance has been covered. That is why I told you 90% of the syllabus. And theory, some portion of the theory would not be covered. That you can manage. That is not an issue. And this you don't need to refer for these concepts. You don't need to refer any other material. Be confident. Okay, 100% quality is assured. Don't worry. Okay, so without wasting any time, let's get started. And if you believe that it creates value, okay, please share it among your friends. Say, let's quickly get started. Okay, with chapter number 1, Fundamentals of Financial Management. So let us start discussing the first chapter, that is Fundamentals of Financial Management. See, initially we will go slowly. Thereafter, we'll pick up the pace. Okay, see, in this chapter, we have two segments, that is time value of money and risk and return concept. This risk and return concepts detailedly discussed in your CMA final portfolio management chapter. We have just basics of that, and few formulas we will learn. If there is any question, we'll discuss those questions also. Otherwise, we will move on. See, first segment, take time value of money. See, today's money, what is the concept of time value of money? Today's money is more valuable than tomorrow's money, which means the earlier the receipt of the cash flow, it will be more valuable. Which means if you receive money today, it will be more valuable than the money which you are going to receive after 1 year. Says today you are receiving 1,000 rupees. After 1 year, okay, today you are receiving 1,000 rupees. After 1 year also you are going to receive 1,000 rupees. Which one will be more valuable? Today's money will be more valuable. Okay, now see, in finance, okay, you cannot simply add the money cash flows of different time frames. For example, see, I'll tell you an example. Here 200 is there. This 200, 300 plus 400, 700 plus 900. Can you say the value of these three, okay, is 900? No. For accounting purpose, you just add it simply. But for our subject, what you should do? You should discount and bring it to present value terms. There are two methods. For example, you can bring the future cash flows to present value. This is called as discounting. The technique is called as discounting. Bringing in a future cash flows to present value terms. Okay, see here, you bring the year 1, 2, 3 to today's term, year 0 term. This is called as discounting. And if you take the cash flows to a future date, it is called as compounding. See, you're taking the current year's cash flows to the future date, which means you take the year 0 cash flow to year 3 end, third year end, then first year cash flow to third year end, second year cash flow to third year end. This is called as compounding. Are you all understanding? So discounting, what we are going to learn now, discounting and compounding for different types of cash flows. See, first, there are 4 streams of cash flow: single cash flow, annuity cash flow, perpetuity cash flow or perpetual cash flow, or multiple and even cash flow. What do you mean by single cash flow? Very simple. If you want to receive, okay, 1 lakh rupee, if you are going to receive 1 lakh rupees after a period of 1 year or 2 years, only once. This is called as single cash flow. Are you all understanding? What is annuity cash flow? The annuity cash flow is like EMI. Say year 1 to 3, this is cash flow. Year 1 to 3, you are going to receive 1 lakh rupees. And see, year 1 to 3, you are going to receive 1 lakh rupees. Year 1 to 3, you are going to receive. Now tell me, children. Now, every year you are going to receive 1 lakh, 1 lakh, 1 lakh, which means 1 lakh at the end of year 1, another 1 lakh at the end of year 2, another 1 lakh at the end of year 3. The value, total value will not be 3 lakhs. You need to discount and bring it to present value terms. Are you all understanding how to do discounting and all? We are going to learn. Okay, initially I'll discuss briefly. Thereafter we will move on quickly. See, then we have perpetual cash flow, irredeemable bonds. The cash flows from irredeemable bond is an example for perpetual bond. Okay, now what is this perpetual cash flow? Now, every year you will receive the cash flow, same cash flow every year till infinity. You are going to receive the cash flow. This is called as perpetual cash flow. Now, what is the formula for? Okay, anyway, we'll learn later. Multiple and even cash flow. What is the fourth cash flow? Multiple and even cash flow. See, first year you receive 1 lakh rupees. Second year cash flow. Year 1 you receive 1 lakh. Year 2 you receive 3 lakhs. Year 3 you receive some 2 lakhs. Like that every year different amount you are going to receive. This is called as multiple uneven cash flow. Now, how to find out discounting and compounding? How to discount these different types of cash flows and compound these different types of cash flow. This is what we are going to learn in time value of money. Okay, once we discuss the concept, thereafter we have some question answers to discuss from your module. I have selected some important questions from each and every concept. Okay, first we'll discuss concept, then question answers. Concept, question answers. This is the way we are going to proceed. So, how to find out present value of single cash flow? Present value of single cash flow is nothing but, okay, see, how to find out? Now, very simple. Use the compound interest formula. Future value is equal to present value 1 plus r raised to the power n. This is the compound interest formula. You would have studied it. So the present value is nothing but principal. So maturity value is equal to principal into 1 plus r raised to the power n. Hence, now you need to find out single cash flow. What is the present value? So this is what you need to find out. So present value is equal to future value divided by 1 plus r raised to the power n. Are you all understanding? Or simply future value into, okay, 1 divided by 1 plus r raised to the power n. Both will give you the same answer. If you take your calculator, okay, how to use the calculator, I'll briefly explain. What you would have known. Okay, if you know already these concepts, just skip it. But for new learners, I'm just, okay, making sure that these concepts are thorough, because every chapter we are going to use this discounting and compounding. See, what you should do, use your calculator. 10%. If your discount rate is 10%, 3 years is the time period, and the cash flow to be received is 1 lakh. Assume this is the case. So what you should do, 1 divided by 1.1, because 10%, 1 plus r, 1.1. If it is 12%, it will become 1.12. So 1 divided by 1.1 is equal to, press 3 times. This will give you the present value factor, okay, for third year. So which means 0.7513. Got na? This you multiply with 1 lakh. Okay, you will get the present value of single cash flow. Are you all understanding? Now, 75,130 or something. So which means 1 lakh rupees you are going to receive at the end of third year. The value is not 1 lakh today, just 75,130. Okay, which means after 3 years you are going to receive the 1 lakh. Anyway, now this is about single cash flow. So present value of single cash flow is nothing but future value divided by 1 plus r raised to the power n. Annuity cash flow. Now, every year you are going to receive 1 lakh, 1 lakh, 1 lakh, 1 lakh. Na? So what you should do, very simple. I have here year cash flow. Assume this is annuity. So year 1 to 3, you are going to receive 1 lakh every year. What is the value? 3 lakh will be the value. No, it will not be 3 lakh. So what you should do, here same cash flow you are going to receive year 1 to 3. Na? So use annuity factor, where the cash flow is going to be same and it is going to continue for some number of years. What you should apply? You should apply present value annuity factor. How to find out present value annuity factor? Different ways are there. Calculator shortcut I will tell you. That is what you will frequently use. Very simple. Okay, what you should do? This 1 divided by 1.1. Assume the discount rate is 10% and this is for 3 years you are going to receive 1 lakh. Na? Up 1 divided by 1.1, that will be same. Is equal to 3 times you press is equal to, na? How much you are getting? 0.7513. But this is present value factor. What you should do, you have pressed is equal to 3 times. Now press GT in your calculator. Okay, have a calculator with GT, very easy. So press GT, you will get 2.486. This is called as present value annuity factor. Mostly will be given in the question paper itself. Okay, you can use that number. If nothing given, you should be able to calculate. Okay, you should be able to comfortably calculate. So 1 lakh into this 1 lakh annuity cash flow into 2.486. How much it is? 2,48,600. Some amount you are getting now. So which means 1 lakh, what is the interpretation? 1 lakh rupees at the end of received at the end of year 1, year 2, year 3. Okay, the total present value of this is not 3 lakhs, is only 2,48,600. Are you all understanding? Now, next, okay, come to present value of perpetual cash flow. Present value of perpetual cash flow is nothing but cash flow divided by R, which means whatever is the cash flow, assume you are going to receive 1 lakh forever. Okay, and the interest rate is 10%. So 1 lakh divided by R, not 10%. What is the interest rate? Okay, discounting rate is 10%, which will give you 10 lakh. Are you all understanding? Which means 10 lakh rupees today, if you receive, okay, fully, it is as good as receiving 1 lakh, 1 lakh, 1 lakh till infinity. Okay, this I've discussed many times in class. I'm not going to discuss in detail. I'm just brushing through the concepts and moving on. Are you all comfortable? Next, multiple uneven cash flow. This is very simple. The capital budgeting question and all, you will use only multiple uneven cash flow. Very simple. Multiple uneven cash flow. How was multiple uneven cash flow? See, year 1 you have some different amount. Year 2 you will receive some different amount. Year 3 you receive some amount. What you should, how to discount all these cash flow? Very simple. Use the respective year's discounting rate to the respective cash flow and find out the total. Are you all understanding? So first year discounting rate, 1 divided by 1.1 is equal to press 1 time. Whatever the discounting factor, you multiply the first year cash flow. Like this, you multiply the respective year's cash flow and find out the total. This is what you do in capital budgeting, right? Next, compounding of different cash flows. Okay, this we are going to learn now. Compounding. What do you mean by compounding? Now, discounting, now you remove the interest and bring the future value to present value, right? If you add the interest to the principal portion, you will take the principal to the maturity value. This is called a future value. This is called as compounding. Okay, now single cash flow. How to compound a single cash flow? Nothing great. Okay, apply the compound interest formula. Future value is equal to present value 1 plus r raised to the power n. Simply you will get the value. So there you divide it by 1 plus r raised to the power. Here you multiply with 1 plus r raised to the power n. We are going to do sufficient questions. Everything will be clear. Next, annuity cash flow. Okay, see, a shortcut is there for compounding annuity cash flow. I'll tell you what it is. Present value annuity factor divided by present value factor. See, here we are compounding, actually finding out the future value. For finding out the future value, the formula, what is the formula? Present value annuity factor divided by present value factor. You will get the, okay, shortcut formula. Example, I will discuss the illustration at that time. Everything will be clear. Next, how to find out the maturity value of the multiple uneven cash flow? Very simple. Okay, create reinvestment table. Create reinvestment table. Okay, calculate for each. See, I'll just show you. Year cash flow is there. Assume year 1 you are receiving 1 lakh. Year 2 you are receiving 2 lakh. Year 3 you are receiving 3 lakh. How to find out future value of these cash flows? Nah, very simple. The year 1 you are receiving 1 lakh. Nah, what you should do? You should reinvest at the same rate. Okay, that the assumption is that the implying rate will continue forever. Are you all understanding? Which means 10% rate, if you are using, it will compound by the same 10%. Up 1 lakh rupees you deposited, it will be compounding at the same rate. So 1 lakh rupees you will receive at the end of the year 1. How many years pending? 2 years pending. Okay, total 3 years. First year end you receive the cash flow. How many years balance is there to deposit? I go to the bank and deposit. Same at the rate of 10% for the balance 2 years. Are you all understanding? So this 1 lakh, what I will do? I will deposit now 1.1 raised to the power 2. Like that I will deposit and compound. Are you all understanding? This 2 lakh rupees which you are receiving at the end of the year 2, you will compound for 2 years, 1 more year, just 1 more year, because already 2 years gone. So 1 more year spending into 1.1. Then last, the value is present value, okay, is same 3 lakh rupees. So everything, if you total, you will get the future value. Are you all understanding? We have a question, you will understand. See, create reinvestment table and, okay, calculate for each cash flow and add total future value at the last year end. For example, 8,000 received first year end will be reinvested for 4 years if total time period is 5 years. So 5 years total time period, first year end you are receiving some amount, okay, balance you invest for 4 more years. Okay, in time value of money calculation, if question is asking to find out value using semi-annual compounding, okay, convert the data to semi-annual period and solve. This is very important. Time value of money, assume the compounding is to be done for 6 months. So what you should do? You should convert everything. R is 10%, assume. Convert it to 6 months. So R will become 5%. N is there in a time period. Earlier you have 5 years. 5 years compounded semi-annually means convert this into 10 periods or 10 semi-annual periods. So raised to the power n, the n will be 10. Are you all understanding what I'm trying to say? Okay. And the interest will be there. Annual interest will be there. Convert into semi-annual. For example, interest is 10%. Now the capital assume is 1 lakh. So 1 lakh into 10%, 10,000 was the annual interest. Okay. But now if you convert it, it will become 5,000. Okay, for every 6 months. Like this, you convert the cash flow, you convert the rate, discounting rate, and you convert the time period. That will be sufficient. Are you all comfortable? Shall I move on? Okay, let us do a few questions, then we will have absolute clarity. And there is a small concept called as doubling period and CAGR. That also we'll discuss and then move on to the question answer. See, doubling period now, very simple. Okay, this is approximate method and not accurate. It's just random approximate method and not perfectly accurate method. In this case, what I should do now, very simple. Okay, the rule of 72, there is a rule of 72 and 69. This is very simple. What do you do? How many years it will take? What is the understanding? How many years it will take for my money to double? Upper randomly, this is not accurate. Anyways, I'm just giving you the caveat. It's not accurate. It's just approximate. So 72 divided by R, if you the rate of return, which means the rate of interest. Assume the bank is giving you 8% interest. Okay, if the bank is giving you 8% interest, what is the understanding? 72 divided by 8, if you do, take your calculator, 72 divided by 8, how much? 9. Approximately, it will take 9 years for me, for my investment to double. If you put 100 rupees in your bank at 8% interest rate, approximately it will take 9 years to get 200 rupees out of it. Are you all understanding? This is a basic understanding, very simple and straightforward. Next, concept of CAGR. Okay, CAGR also, very simple concept only. Okay, but if randomly used in exam paper, you should be comfortable, you should be able to link the situation. See, very simple. What is CAGR? Now, apply the compound interest formula, nothing great. Okay, in the compound interest formula, the future value is equal to present value 1 plus R raised to the power n, or maturity value is equal to, okay, principal into 1 plus R raised to the power n. Here, the R is only, it is called as CAGR. Are you all comfortable? How to find out R? See, I rearrange it. 1 plus R raised to the power n is equal to future value divided by present value. Okay, 1 plus R is equal to nth root of future value divided by present value, or R is equal to simply nth root of, okay, future value. What is that? Nth root of future value divided by present value minus 1. Are you all comfortable? Okay, now we have done all the time value of money related concepts. So let us discuss the questions related to time value of money. Shall we? Okay. Say, take illustration number 1. If a person invests 1,50,000 in an investment which pays 12% at the rate of interest, what will be the future value of the invested amount at the end of 10 years? See, after reading the question, you have to identify what are they asking really. So this is single cash flow, which means today, this is first a single cash flow. Okay, now you want to find out the future value, present value, or future value. The question is regarding future value, which means a person is investing 1,50,000 today. Okay, after 10 years, what is going to receive at the end of the 10th year? Or after 10 years, what is the maturity value is going to receive? Interest rate is 12% per annum. So just use this formula. Future value is equal to present value 1 plus R raised to the power n. This is not discounting, this is compounding. Okay, single cash flow compounding. So future value is equal to 1,50,000 into 1 plus R 1.12 raised to the power n, 10 is given. Okay, so future value is 4,65,900. Are you all understanding? Now, Apex Limited, take question of illustration number 4. Okay, Apex Limited has an obligation to redeem 50 crore bond 6 years hence. How much should the company deposit annually in a sinking fund account wherein it earns 12% interest to accumulate 50 crore in 6 years time? Very, very good question. See, this question mark it as important. Why this is important, I'll tell you. Okay, see what happens here. Okay, it has an obligation to redeem 60 crore bond. It has issued a bond wherein the redemption value is 50 crore and the maturity period is 6 years, which means this company has to pay back the 50 crore after a period of 6 years, which means at the end of the 6th year, I need a 50 crore money. How much should the company deposit annually in a sinking fund wherein it accounts 12% interest to accumulate 50 crore in 6 years time, which means this is first of all, which cash flow? Single cash flow, annuity cash flow, multiple uneven cash flow, annuity cash flow. Why? Because every year you are going to receive, I don't know what is I'm going to deposit, but you are going to deposit some same amount of money every year. Are you all understanding? That is only you need to calculate. That amount only you need to calculate. Are you all understanding? For example, year 1, 2, 3, 4, 5, 6 years is there, and you need to deposit some number that I am going to calculate. Are you all understanding? Okay, some same amount, the amount will be same. Every year, same amount you should be depositing annually, so that the future value compounds and maturity value become 50 crore. Are you all understanding? Now, interest rate is given as 12%. So, future value factor 12%. What is this? This is nothing but future value annuity factor. How to find out future value annuity factor? Are you all understanding? Now, here, see, I told you how to find out this cash flow. You need to find out. Actually, you need to find out present value. Okay, future value is given as 50 crore. So, future value cash flow is given as 50 crore. You need to find out, okay, the what is the amount to be deposited, present value of this annuity cash flow. You need to find out. So, what is that? I told you, present value annuity factor divided by present value factor. This formula you should use and find out, because this is not multiple and even cash flow. This is annuity cash flow. Now, see what I should do now. The present value and this amount. Okay, for a present value annuity factor, what is this present value annuity factor? You tell me. 1 divided by 1.12. Okay, 1 divided by 1.12 raised to the power n 6 years. This will give me present value annuity factor for this, correct? So, present value annuity 1 divided by 1.12 is equal to 6 times you present GT. You get a 4.111. Are you understanding? Divided by present value factor 1 divided by 1.12. 1, 2, 3, 4, 5, 6. How much is that? 0.5066. If you do this, you will get how much? 4.111 divided by 0.5066. 8.114. Are you all understanding? This is the future value factor. Now, see, you have to find out the present value. Future value given as 50 crore. So, what you should do? 50 crore, this is given in the numerator, divided by 8.114. I am getting, they are writing 115, rounding off, but more or less same. Are you all comfortable? So, what is the understanding? 61,61,429 you need to deposit, okay, for 6 years, so that the maturity value becomes, okay, how much? 50 crore at the end of see, this is, I think there is a mistake here. See, 61 lakhs, I will just show you. 50 crore is how much? 50, okay, 5,000 lakhs divided by 8.15 as well. See, how much is the amount? 616 lakhs 14,295. So, this amount is 6.161 crore. Are you all understanding? This is not 61 lakhs of a printing mistake. Error is there. You can verify that. 6.161 crore, which means for 6 years, if you deposit 6.161, it will be nearly 36 crore now. So 36 crore around the principal portion you deposit to realize 50 crore at the end of the 5th year. Very, very important question. Okay, next. See here, this is a example for CAGR. This is example for CAGR. I am briefly discussing. See, what is that? X Limited has had revenues of 100 crore in 2010, in which it increased to 1000 crore in 2020, which means 100 crore was the amount in 2010. This became in 2020 how much? 1000 crore. 10 times it increased. Are you all understanding? What is the time period? 10 years. In 10 years it increased by 10 times. Very simple. Future value is equal to 1000 crore. Present value 100 crore. Apply the formula. Find out the R. That is what is CAGR. I told you. So what is that? R is equal to nth root of 10 years later has appreciated. Now nth root. That is what they have done like this. So nth root of, okay, 10th root of 1000 future value divided by present value 100 minus 1. Okay, if you solve it, you will get 26%. Are you all comfortable? This is what they have done. Simple, apply the formula. Okay, now one more question is there regarding future value, time value of money. Yes, thereafter we will move on to the risk return profile. See, a person is required to pay annual payments of 8,000 in his deposit account that pays 10% interest per year. Find out the future value of annuity at the end of 5th year. Again, same type of question, but here present value is given. You need to find out the future value. In the earlier question, they had given the 50 crore future value. What is your requirement? Target amount. Okay, how much I need to deposit every year? Present value you need to find out. You found out. Here they have given that every year you will deposit 8,000, 8,000, 8,000. That is given in the question. But you will find out the maturity value. You tell me this is annuity cash flow. Yes, annuity cash flow. But here what, see, you cannot simply add this. Why? Because, okay, it is something to be treated like multiple uneven cash flow, which means first year you are receiving 8. Why? The reason is that you can only deposit for balance 4 years now. The first year 8,000 which you are receiving at the end of the first year, at the end of year, clearly given at the end of first year. Even if they are not given the end of first year, now you should assume that it is received at the end of, unless otherwise stated it is received in the beginning. You will not assume any cash flow to be received at the beginning. Now, at the end of first year you are receiving 8,000. Now, how many years you can deposit this amount? Only for 4 years. The second year cash flow you can deposit only for 3 years. So there is the distinction. Okay, you cannot deposit everything for 5 years. Are you understanding? So 8,000, you deposit balance 4 years is there na? Compound it for 4 years future value factor. This 1.464, how they got na? Very simple. 1.1, the 10%, what is the rate of interest? 10%. So 1.1, how many years you can deposit? 4 years. Up to 1.1 raised to the power 4 is nothing but 1.46. Let us check it. 1.1 into 1.1 into 1.1 into 1.1, 1.4641. Are you all understanding this? How they got? So this is for 4 years you can deposit 1.1 raised to the power 4. This is for 3 years you can deposit 1.1 raised to the power 3. This is for 2 years 1.1 raised to the power 2. This is 1.1 simply, and this is 1. Are you all understanding? Into 1. Okay, present value factor. This is term of the deposit. Don't get confused. This is 1 term of the deposit. Are you all understanding? So this is 8,000 into 1. Present future value factor is 1, 8,000. This, like this, you get the future values for each cash flows. Then total it, you will get 48,841. Are you all understanding? Alternative formula also you can use. I don't want you to use the formula. Okay, simply because, okay, you may remember the formula, you may not remember the formula. That's why I don't want to confuse you. Are you all comfortable? Like this, you can open a table. Easily you can find out the future value. Shall we proceed to the next area? Okay, risk and return profile. Shall we discuss this? Now we will see the risk return angle. See, yearly return, first step is find out yearly return, which means every year how much the stock, share or any other instrument is earning me the return. So here equity, here portfolio we are discussing. So equity shares are being discussed. So P1, price at the end of year 1 minus P0. What is the formula for it? Find out yearly return. P1 minus P0 plus D1 divided by P0. Now, what is this P1? Market price at the end of year 1 minus the year beginning price P0, na price today. Okay, if you are calculating return for 1 year, first year, which means the price at the end of first year minus price at the end, price today. This will give you the capital gains. This is nothing but capital gain which you earn. See, very simple. Today you invest in share which cost 100 rupees. Okay, tomorrow the share became 150 rupees, which means this 100 to 150, the capital appreciation is there, na? This is 50 rupees. Are you all understanding? So this is capital gain plus dividend. So if you invest in share, you will have share appreciation and you will have some dividend also. Dividend will be paid by the company. The share will appreciate in the market. Are you all understanding? So you will aim to, the two sources of return is nothing but dividend and the capital gain. This is what you earn divided by P0. What is the capital you invested? You initially put 100 rupees na? Okay, you put 100 rupees, it became 150. So 50 rupees the capital gain. Apart from that, assume 2 rupees dividend received for the first year. Okay, that also will consider. So total return will be 50 plus 2, 52 divided by 100. Are you all understanding? Like this, you need to understand. P1 minus P0 plus D1 divided by P0. Now, you have compute, this is for computing every year. Now, second year, if you want to compute the return, how to compute? P2 minus P1 plus D2 divided by P1. Like this, you need to compute yearly return. When you have computed the yearly return, then, okay, you need to, if someone asks you how much the security is giving, how much the Reliance Limited share is giving you return, okay, you cannot take extremes. So for example, 1 year it may give 20%. My other year it may give minus 15%, which means it can vary. Yes, it may be varying. So what you should do when you find out the return, expected return, what is expected in the next year mean, you will analyze the past data and find out the average, or you try to predict the share price in the future, probability based prediction, and okay, try to find out what is the share price will be, or your return from the share. Are you understanding? Which means Return means average return, mean return. Return means mean return. You cannot expect extremes for the future years. You will analyze either you will analyze the past data or you will give some future probability. Okay, prediction based analysis. You predict the share price, then you will calculate what is the expected return, mean return. So yearly return you know how to compute, right? After that, the return which you are trying to expect from the share, okay, is nothing but mean return or expected return, average return. Are you all comfortable? How to find out? Two method is there. Using past data, you analyze the past data and find out the average. This is I call it a simple average. You will use, okay, past 10 years data given. What you will do? Simply total the return. Okay, assume total return comes to 30% return for the past 10 years and divided by 30 up to 3% for every year. This was the basic understanding, simple average. Okay, very simple. Summation of all the returns for the past 10 years, summation of the returns divided by n. If you do this, you will get the average return, simple average return. This is one way. When years is given, when number of years given, past data given, you will analyze and find out the mean return, simple mean. When they give you probability, when the question is with probability, this is scenario based, probability based analysis. Now what you should do, apply the probability, respective probability. So for first year, what is the P1 into return 1? First year probability, apply to the first year probability, not first year probability, the probability for the return 1, which means 4 type of return is given. The company may give you return of 10%, 20% or 30% or 15%. In this case, respective probability you apply for respective return, then multiply it with total it, you will get the weighted average return. Are you all understanding? Probability weighted return, nothing new. We'll do one question, everything will be clarified. Here I have given simple average. What should be done? Total return for 5 years divided by 5. This 5 is nothing but n. It may be 10 years, it may be 3 years. Okay. When respective probability is given, what you should do? When probability is given, what you should do? Okay. First year probability into return 1, probability 2 into return 2, probability 3 into return 3. Like this, you will find out the total of the probability weighted return. Are you all understanding? Now, come to the risk. This is all about return. Okay, now risk angle, you need to understand how to measure the risk. Okay, how to measure the risk. What is risk? You need to understand. See, return is what the security will give. What is the variability in return? Okay, is nothing but the risk of the instrument. Very simple. Reliance Limited share is giving me 20% this year. Assume Reliance share is giving me 20% return. If this 20% is certain or uncertain, every year will it give you same 20%? It may vary, it may vary. That is what is deviation. Okay, if the return is not certain for every year, which means it may vary up and down, the variability in return is what I call it as risk, volatility. Okay, I call it as risk. Now, this risk is nothing but deviation from the mean. I computed mean on an average. What is the value I computed? The deviation from the mean is what I call it as variability of the return. Are you all comfortable? Okay, that is now. Here also two situations possible: without probability, with probability. So two situations: without probability and with probability. Without probability, now what is the formula for standard deviation? See, the risk is measured by standard deviation. Okay, it is also measured by coefficient of variation and all. But anyway, here first that we are going to learn. Risk is generally measured in standard deviation. This will be question in the later concept. I'll discuss that. But here it is measured as standard deviation. So what is the formula for standard deviation? Okay, if you take standard deviation as a measure of risk, it is nothing but when probability is not given. Okay, when number of years given, I told you now without probability. Now what you should do? Square root of summation of x minus x bar the whole square divided by n. Okay, when probability is given, what is the formula? Okay, square root of summation of probability into x minus x bar the whole square. That's it. There will be no n because okay, number of years will not be given now. So here some textbooks here, if you see one of the question in your institute module, they have taken n minus 1. That is also possible. N okay, it depends on observation. If number of observation is too many, what you can do is use n minus 1. If number of observations is very less, now you can use the n. Are you all understanding? Anyway, this is you can use n minus 1 as well as n. You can use n minus 1 since institute has used n minus 1 in your material. You can use the n minus 1. Are you all comfortable? Okay, now this is all about risk of the portfolio. Now, return of the portfolio. See, this is risk and return of the individual securities which we learned now. Now we are going to learn return of the portfolio. The portfolio means group group of assets. Okay, anyway, CMA final, I don't know why this topic is given in the intermediate syllabus, because CMA final, portfolio management order, introduction is only given in here. Right. So anyway, there is given in the syllabus. I need to discuss briefly. So now individual securities risk and return we discussed. Now portfolio return only given, not risk. Okay, portfolio risk is a complicated area we are going to learn final level. Inter-level, return of the portfolio they have given. Return of the portfolio is nothing but weighted average return of the individual securities inside the portfolio. What is the definition? Return of portfolio is nothing but weighted average return of the individual securities inside the portfolio. So assume there are only two securities inside the portfolio. So what is the weight of security? Which means Reliance Limited, you invested 40%, and okay, this is Reliance Limited, and Tata Limited, you invested for 60% of your money. You had 100 rupees, you invested 40 rupees in Reliance, 60 rupees in Tata. So what is the weight? Here 0.4 is the weight. Here 0.6 is the weight. Are you understanding? Weighted average return. Now, if Reliance Limited is giving you 15% return, Tata Limited is giving you 20% return, what will be the overall return of the portfolio? 0.4 into 15%, 40% into 50%, plus 0.6 into 20%, which is 12%. Okay, here 0.4 into 50%, 6%. So 18% will be the overall weighted average return of the portfolio. Are you all comfortable? This is how we need to complete the portfolio return. Next, okay, we will do some question, and then we will move on to two more small concept: coefficient of variation, and you have beta calculation. Two formulas given, no questions as such given in your module, but still I am discussing question may be coined. Okay, now shall we do questions regarding return of the portfolio? See. So take illustration number 12. Okay, the current market price of share is 600 and investor buys 100 shares. After 1 year, he sells these shares as a price of 720. So he bought at 600, and from 600 it became 720, and also receives a dividend of 30 rupees, and 30 rupees will be the dividend. So what is the overall number here? See, 600, from 600 it became 720. Now 120 is the capital gain, plus 30 rupees is the dividend. So 150 is the, okay, P1 minus P0 120 plus D1 divided by P0. What was the share price initially you invested at? 600. Okay, so which means very simple. Investor buys 100 shares. Anyway, this, okay, will be the return in the numerator 120 plus 30. Okay, into how many shares are there? 100 shares. Are you all understanding? So 100 shares you should equate. And initial investment, of course, this is C. Per share basis, if we compute, you will get the initial investment amount. So what is the amount? 120 plus 30. Can you use the calculator? 150 divided by 600. How much is that? 25%. Are you all understanding? See, here in this question, they have calculated on total basis. Very simple. See, 120 plus 30, 150 is the total return from one share. Into how many shares are there? What is it? 100 shares into 100. They have done this into 100. Return also 100 divided by, okay, what is that? 600 into 100. Like this. If numerator also you multiply with 100, denominator multiply with 100. Per share basis also you can be found out. No need to find out a total basis. Are you all understanding? So in the per share basis, this is nothing but P1 minus P0 plus D1 divided by P0. This way you will get the solution. 25% is the return from the share. Next question. Shall we move on to the next question? Second. Question number 14 is there. Now, before going to question number 14, see, we will move on to question number, I'll come back to the question number 14 because that is regarding coefficient of variation. Take this question, question number 16. This is more relevant here. Question number 16. See, stock price and dividend history of X Limited are given below. 2018, the share price is this much, dividend per share is this much. 2019, okay, closing share price is given, dividend per share given, which is closing share price. Now, very simple here. You start from 2018, right? This is 2018. Assume you are standing at 2018, 19, 20, 3, 4, 5, 6, 7 years data given, which means when you want to compute so return, okay, this is from 19, 20, 21, 22, 23, 24. Actually, this is 6 years data. Why I'll tell you? Because to give the opening price, the previous year closing will be the opening price. So, for example, 2019 opening price will be 312. Are you all understanding? So, what is the return for 2019? Like this, you need to compute 389 minus 312 divided by, okay, 312. This is the opening amount, and the numerator plus dividend amount of how much? Okay, here you have to take 6.75. That is what you need to take. Let us just verify this, what they have taken, because see, here, yes, exactly. Computation of annual rates of return for every year you need to compute now. So for 2019, they have taken closing price, opening price is 312, and then the dividend is 6.75, annual rate of return 7%. How this 7% came now? Very simple. 389 minus 312 plus 6.75 should be the number. I think they have taken 6.75. Let us verify. It should be 6.75 because 2019 years dividend you need to take anyway. Sometimes what happened, dividend received in the dividend announced in the previous year, they will assume it to be received in the current year. That also they have taken assumption. But to be very clear, see, 389 minus 389, how much is the number? 77 plus 0.75 divided by 312. How much is the number? 26.84. The annual rate of return is 7%. What is that? Okay, here the solution has error. To be honest, the solution has error. How we should compute now is totally wrong. 7% will never be the annual rate of return. Why I tell you? Because okay, they have given some formula. This is not even correct. Okay, you should understand like this. See how to compute return. I'll just show you the correct solution here. What it should be done now. You should compute. Okay, let's see. 389 minus 312, okay, plus this is dividend, because dividend, this is not dividend per share, this is not yield. So actually speaking, you should take 6.75 respective year's dividend divided by, okay, P0. What is that? 312. Like this you need to compute for year 2019. So 389 minus 312 plus 6.75 divided by 312. How much is that? 26.84. Are you all understanding? The return will be 26.84 for the 2019. Next, take 2020. Okay, I am showing you the correct solution. Next step they have done correctly, but this step it seems to be wrong. These are all the return numbers which they have given now. It is totally wrong. Okay, totally wrong. Why? Because you see, this year if you see, from share price, you see the logic here. From share, okay, 389 is there now in 2019. From there, the share price fell to 234. 389 to 234, right? It should be negative return, but there is no mention of negative return, is still positive. No way it can be positive. Are you all understanding? So it should be negative. So 26.84 is the return for 2019. 2020, let's compute. What is that? P1 means 234. Okay, let's say 234 minus 389. This will be negative plus 4.6, the dividend D2, okay, dividend divided by P1, which is 389. 389. Okay, 234 minus 389 plus 4.6 divided by 389. So how much? Minus 38.66 percentage. Minus 0.386 means minus 38.66 percentage. Are you all understanding? Okay, all this number are wrong. Okay, anyway, understand that these 6 years, they have computed the 6 years correctly, but wrongly computed the return. 6 years is fine. Out of the 7 years data given, 6 years only you need to compute. For opening balances, this 2018 is given. All these numbers are wrong. Okay, you can recompute and verify. Are you all understanding? Now, next, I'm proceeding because the solution itself is wrong. So many mistakes are there in your institute module. Again, I'm saying whenever I'm finding some mistakes, I'll just tell you. But this is wrong. Okay, actual number is wrong. The methodology is correct, but the finding number is wrong. Okay, they've given some formula. This is wrong. It should be P1 minus P0 plus D1 divided by if you see the institute module itself, they have given correctly. Okay, in the institute module itself, they have given P1 minus P0 plus D1 divided by price. Okay, P0, opening price. Anyway, this is absolutely wrong. So total annual return comes to how much? You compute the total return, 26.84 minus 38.36, like that you will plus or minus total, find out the total divided by n, divided by number of the 6 years. Okay, you will get the average. Now, after getting the average, what you should do, the next step seems to be correct. Okay, see the calculation of variance or standard deviation. So what you should do, 18, 19, 20, 21, 22, 23. Okay, here also it should not be 18, 19, 20. This should be 19. So many mistakes are there. See here. Here 18 is given for opening balance. Are you all understanding? So actually 19, 20, 21, 22, 22, 23, 24. Like this 6 years should be there. Anyway, what they have done now, 18 to 23 they have considered, which is absolutely not correct. Okay, because here itself they themselves have contradicted. Yeah, 2018, if you notice, 2018 they have given us nil return. 2019 return is 7%. That is correct. Okay, this will be nil return open balance. Anyway, here you need to do 6 years return. So many mistakes are there. Anyway, I don't want to discuss a lot. See here. Okay. Here you will get annual return. This annual return which you get, you put it here. No issue. Okay. The correct number you can verify. Then divided by 6, you will find out the average return. Here they have found out 5.27. If average return you have found out. Now next column. Okay. RM, which is the average return. I call it as, okay, X bar. This is X bar. And this is X minus X bar, the X bar. This is X minus X bar. And this column is X minus X bar, the whole square. The formula you can understand. Okay, now this is actual return, this is mean return. That is why it is same in all the cases. Then X minus X bar, they have done 7 minus 5.27, 1.73. This is correct. Okay, if you do this, the total should be 0. Anyway, you can find out that is, and you need to square it up, then take a square root of 9.2. Okay, divided by this n number will be there. Okay, here n minus 1 they have taken. I told you now n also can be taken and n minus 1 can be taken. Here 6 minus 1, n is 6. 6 minus 1 they have taken. Okay, 1.84 is the variance. And then if you square root it, you will get 1.35 standard deviation. Are you all understanding? Oh, anyway, this I wanted to discuss. Anyway, mistake was there in question. Hence, I couldn't discuss fully. See, in this question also, see, this with probability they have given. Okay, expected rate of return with probability. I told you now. See, probability given now, weighted average return, portfolio return. When you want to compute, okay, you want to compute weighted average probability given for respective return. Now, very simple. 18% rate of return in growth phase. Up 18 into 0.25, 4.5. 11 into 0.25, 2.75, 1 into 0.25, 0.25, minus 5 into 0.25, minus 1.25. If you total it, you will get the mean return, which means mean return when you are computing with probability, you will compute like this. Are you all comfortable? Without probability, okay, we computed in the first step. Okay, you saw now without probability. See, this is with probability. Without probability, okay, this is yearly return. Then this is the example for computing first step mean return. Here you have computed average return. So this is risk. First step for computing risk is mean return. This simple average mean return, total of this return divided by 6. When probability is not given, you will do the simple average. When probability is given, probability weighted average you will do like this example. Okay, this example, this is about return. Now risk, they have not given example when probability is given. This is without probability. I'll just check it whether they have given without with probability or not given. No issue. Are you all understanding? All these have been given. All the illustration I have discussed here. Okay. Yes. Question number 16 discussed. Illustration number 14 is pending. What is this concept? I'll briefly explain. Then I'll explain the issue. See here. Let's take the concept here. Yes, coefficient of variation. Now we are moving on to a new concept, that is coefficient of variation. Till now, we discussed that standard deviation is a measure of risk. Standard deviation is measure of risk. Okay, it may not be true every case. Okay, we cannot use standard deviation on a standalone basis for everything. For example, I'll give you a classic example here. Assume, okay, let's take this example. See, I'll write it here itself. See, there are two people coming out of, assume CMA Intermediate Financial Management examination. They just now wrote the examination. Two people are there, A and B, 2 persons are there. Now I go and ask A, what is your expected marks? Expected marks and mean marks. What do you mean by expected mark? Mean mark, average mark. How much you expect? Okay. He says that I expect, okay, around 60 marks. I expect around 60 marks. And what is the standard deviation? Are you all understanding? X bar means mean, average. Okay, the variation, standard deviation means deviation. How many marks you expect it can go below or above? How much is the standard deviation? I'm asking person A, the first person. Okay, which means it may go above 60, it may go below 60, exactly 60, it will never happen. He says My marks may be 60, but my standard deviation is 8. 8 marks is my standard deviation, which means the marks may become 52 or it may even become 68. I don't know exactly what will happen, but I expect the deviation of 8 marks from the mean. Are you all understanding? Now I go to the B person. Okay, then he says, see, he is expecting a deviation of 8 marks. It is too risky. He is expecting a lot of deviation. B says, whenever I compute the marks, okay, exactly only 2 marks deviation will be there. Only 2 marks deviation will be there. I'm mostly perfect in counting. My standard deviation is only 2 marks. Okay, I am less risky. He is saying, claiming. I go and ask him one more question. What is your expected marks now? He says, my expected marks is 15 marks. How many marks? Only 15 marks. Are you all understanding what I'm trying to say? Now, prima facie, if you see these two persons, which one will seem risky? The A will be seem risky because of a higher standard deviation. Standard deviation is a measure of risk. Higher the standard deviation, more risk. Lower the standard deviation, less risk. I go to this person and ask 8 marks, 8 marks standard deviation. Okay, he is not sure. There is so much uncertainty. It can go up and down by 8 marks. It is very risky. You will feel. Are you all understanding? But the problem with B is that he may have low standard deviation, but the mean itself is low. With 15 marks, what is the difference? If you get 17 marks also, you will fail. Even if you get 13 marks, you will fail. So there is no, a specific, reason to tell that this is superior, B is superior. Are you all understanding? One line summary is that standard deviation on a standalone basis itself is not good measure of risk. You should also consider from how much mean it deviates. Deviation alone you should not see. From what mean it deviates is also important. That is called as coefficient of variation. See, what is the formula for coefficient of variation? Coefficient of variation is nothing but standard deviation divided by mean. Are you all understanding what does this mean? Okay, here, see, for every one return, every 1% return, what is the standard? See, for every 1% return, what is the standard deviation risk of it? We will measure using coefficient of variation. Are you all comfortable? For example, in this case, take illustration number 14. Consider two securities A and B whose normal probability distribution of 1 year returns have been following characteristics. Have the following characteristic. Expected return 0.08 means 8%. This is 0.24 means 24%. This is the expected return, mean return X bar. Next, standard deviation is given 6%, 8%. Okay, on a standalone basis without considering coefficient of variation, this may seem riskier because it is having 8% standard deviation, higher standard deviation. But if you analyze, if you find out the coefficient of variation, 6% divided by 8%, 0.75, and 8% divided by 24%, okay, you will get 33.33, which means this is 8% deviation, but around a higher mean. This is 6% deviation from just the 8% mean, too risky. Are you all understanding? So this is coefficient of variation. Hence, using coefficient of variation, which is more risky? A should be more risky. See the solution from the above information. It is found the standard deviation of security B is larger than the security A. So security B is riskier investment opportunity with standard deviation as risk measurement tool. However, relative to the size of the expected return, mean return, security A has a greater variation. So security A is higher risky, more risky than security B. This is the understanding. So shall we proceed? Okay, this is all about illustration 14, and I discussed all about this risk and return, and one more discussion is pending regarding beta, which I will discuss here. Okay, see here. See. Yes. Now, required rate of return of the portfolio, KE of the portfolio I given here. Okay, you can go through. I have given here KE is equal to RF plus beta into RM minus RF. Okay, this is just a given institute modulo they have given, hence I have given. So what is the KE of the portfolio? Okay, individual KE we are going to learn in cost of capital, no issue. RF plus beta into beta of the portfolio into RM minus RF. Next, what is the formula for beta? See, for beta, they have given only formula. Okay, I am also giving just discussing the formula. Deep discussions, I have not made anything regarding this because they have taken something basics from portfolio management CMA final. I am also discussing briefly. Okay, beta is equal to covariance of security and market. S and M means security and market. S as well as M. S comma M. okay, divided by sigma m square, sigma square m, which is standard sigma m square na variance of the market. M means market, variance of the market. Sigma square na variance. Sigma means standard deviation. Sigma square na variance. Okay, I told you. So beta is nothing but what is the formula for beta? Covariance of S and M divided by sigma m square. Okay, sigma m square is variance of market return. Next, okay, here we have covariance of security and market. This is given. What is the covariance I have given here? Okay, next, see. Beta, one more formula is there. Okay, altogether 6 formulas are there for beta, which you are going to learn in CMA final. 3 beta formula is given in your CMA inter. Okay, later, first formula already we discussed, covariance of S and M divided by sigma m square. The second formula they have given, that formula and this formula is one and same. Okay, second formula is what? Correlation of S and M. This is A and M given, which is to be A in a security A. It also can be referred as M. S. Correlation of S and M into sigma S into sigma M divided by sigma M square. Are you all comfortable? These 2 formulas are given, and one more formula regarding beta, change in security return divided by change in market return, which I will discuss in cost of capital. Are you all comfortable? Okay, I don't want to go deep into this discussion. Really speaking, this formula is derived from see, this formula is derived from correlation formula. Correlation is equal to, actually speaking, correlation is there na. This okay, from the correlation formula only this is derived. Anyway, I don't want to discuss derivation and all. Okay, understand that this, the numerator is there na. See, sigma A into sigma M into correlation of A and M is there na. This is nothing but your first covariance of S and M. That expansion of covariance only they have given this. Are you all comfortable? Okay, anyway, I'm not discussing all these things here. This is the formula you can go through. Shall we move on to the next chapter? Now we will discuss the important chapter, financing decision. Okay, now we are entering into core intermediate syllabus. See, first, in the financing decision, we have 3 segments. What I'm going to do, I'll tell you. First, there is leverage segment, okay, which I'm going to discuss now. Then EBIT-EPS analysis or capital structure planning, which we are discussing, which we will discuss later. EBIT-EPS analysis. Then there is capital structure theories, NI approach, NOI approach, traditional approach and Modigliani-Miller approach. 4 theories, okay, we will study under capital structure theories. These are the 3 segments which you are going to cover under financing decision here in this chapter. Okay, this is financing decision, one segment of the chapter. Your material, they have given cost of capital as separate chapter. Cost of capital also comes under financing chapter. Okay, financing decision, which you are going to cover. Are you understanding? So what we are going to do, first we will discuss leverages. Then we will discuss EBIT-EPS analysis. Thereafter, we will discuss cost of capital, and then we will come back to capital structure theory. Are you all comfortable? Because capital structure theories, to understand the theories, you need to have the basic of cost of capital. We will finish the cost of capital, then we will come back to capital structure theory. Shall we start with leverages? Okay, now, see, before understanding the leverages, you need to understand the income statement first, what we are going to use throughout our subject from now on. Income statement. Okay, this is something similar to marginal costing income statement, which you would have studied in management accounting. Okay, see, sales. First line item is sales minus variable cost will give you contribution minus fixed cost will give you EBIT. This EBIT is nothing but operating profit. Is also called as operating profit. Till this EBIT, okay, you would have studied in costing. Till this EBIT, you would have already studied in cost sheet when you prepare. Okay, cost sheet and income statement. The last line item of the costing subject ends at EBIT. Are you all understanding? From there, we will continue. Okay, in financial management. What is that? Next, interest minus interest will give you EBT. Minus tax will give you EAT or PAT. Minus preference dividend. Okay, will give you earnings available for shareholders. Okay, divided by number of shares. If you do, you will get EPS. Are you all understanding? Furthermore, actually speaking, see, furthermore, you have EPS na into PE ratio. If you do, you will get next step as MPS. That also, okay, you can note down, because anyway, we will do question at that time, you will understand. So EPS is what the company is earning, earnings per share, which the profit, net profit per share. Okay, and PE ratio na, how many times the earnings, the price is available in the market, the share is available in the market. That is into PE ratio. If you multiply the EPS into PE ratio, you will get the market price per share. Are you all comfortable? Now, this is all about leverages income statement. Now we have leverages formula, 3 types of leverage. One is operating leverage, okay, financial leverage and combined leverage. Now see here. Formula for leverages. First, I'll discuss the formula, then I will discuss the logic. Are you all comfortable now? First, take operating leverage. What is the formula for operating leverage? Contribution divided by EBIT. Two formulas are there for each and every leverage. So, operating leverage, what are the two formulas? Contribution divided by EBIT. Next formula, what is the next formula? Percentage change in EBIT divided by percentage change in sales. Next, financial leverage, what is the formula? EBIT divided by EBIT minus I. Next, second formula for financial leverage, percentage change in EPS divided by percentage change in EBIT. Last, for combined leverage, what is the formula? First formula for combined leverage, okay, contribution divided by EBIT minus I. Next, percentage change in EPS divided by percentage change in sales. Now, what do you mean by leverage? I'll tell you what you mean by first operating leverage. See, very simple. Operating leverage, you have the income statement now. You already studied this income statement now. Operating leverage links, okay, operating leverage links sales with EBIT. Are you all understanding? Operating leverage links sales and EBIT. It tries to find out what is the change in EBIT. Okay, it tries to find out the sensitivity of the EBIT with respect to the sales of the company. If my sales changes by 1%, if my sales increase by 1%, what will be the impact on EBIT? What will be the impact on EBIT? How much EBIT in percentage terms will change is what is known as operating leverage. Are you all comfortable? For every 1% increase in my, see, I can write it like this. Okay, for every 1% change in sales, what will be the impact in EBIT? How much percentage the EBIT will increase? This is what is captured by operating leverage. Are you all comfortable? Operating leverage, sales and EBIT. That you should remember. Are you all understanding? So, sales and EBIT, this is OL, operating leverage. Like this, you can remember. Next, okay, financial leverage links this EBIT, okay, links this, what is that? EBIT with EPS. EPS, where is the EPS? EPS. Are you all understanding? Okay, this is what financial leverage is, which means, now I'm just rubbing it. Now see what happens. For every 1% change in, EBIT, what is the percentage change in EPS? What is the percentage change in EPS is what is captured by financial leverage. Are you all understanding? If EBIT change, assume question they will give it. If EBIT you got, see, financial leverage you got it as 1.5. What is the meaning of it? See, if 1% change in EBIT, there will be 1.5% increase in EPS. Okay, downside or upside, it will be 1.5%, 1.5 times the change. For example, if EBIT changes by 10%, what will be the change in EPS? EPS will change by 15%, 1.5 into 10%, because for every 1%, this is 1.5. So 10%, what is the change? 15%. Are you all comfortable? Okay, this is how you need to compute leverage. Next, this is financial leverage. Combined leverage combines, okay, sales, combined leverage combines sales and EPS. Are you all comfortable? Okay, where is the EPS? EPS here. It links sales and EPS, which means for every 1% change in sales, okay, how much is the 1% change in sales? How much percentage the EPS will change? EPS or net profit will of the company will change. This is what is called as combined leverage. This is what is captured by combined leverage. Are you all comfortable with all the three leverages? Okay, briefly, this is revision session. I don't want to discuss in detail anything. This is the basic interpretation of the leverages. Okay, now one more adjustments I'll discuss. What are all the adjustments? Then we will move on to question answer. These are all the formulas and concept initially I'm discussing. Thereafter, we'll move on to question and we will solve 1 or 2 questions, 3 or 4 questions in this regard. Absolute clarity will be there. Shall I? Okay, see, next is margin of safety. There is a concept called as margin of safety. Okay, you would have studied in costing. Now, what is the relationship in with regards to margin of safety in the leverage chapter? Very simple. Where question mentions margin of safety, okay, sometimes they may give margin of safety number as adjustment. which means margin of safety is nothing but see, operating leverage, degree of operating leverage. I'll show you. Degree of operating leverage. OL and DOL means degree of operating leverage is nothing but, okay, 1 by MOS, 1 by margin of safety, derivation and all given in your study mat itself. I don't want to discuss here, time waste here by discussing the derivation, but understand that where margin of safety given in the question directly in the leverage question, you should understand that it is 1 by operating leverage, 1 by operating leverage. Are you all understanding? Or margin of safety, which means operating leverage is 1 by MOS, 1 by MOS. That is to be noted. Okay, hence I have given. Now, next, what I have given now, if preference shares are given in the question, if the preference shares is given in the question, EBIT formula will undergo change, not the operating leverage. Because, see, leverage formula will undergo a change, not the operating leverage, only financial leverage and combined leverage will change. Are you all understanding? Very simple. See, operating leverage links sales and EBIT. So there is no question of financial, no question of preference shares, because preference dividend is paid after tax, before before EBIT, after tax. Are you all understanding? So interest will be there. Thereafter only you pay preference dividend. So it will not impact the operating leverage. Are you all comfortable? Operating leverage formula will be same. What is the formula? Contribution divided by EBIT. No change in that. But financial leverage formula will undergo change. What is the original formula I told you? EBIT divided by EBIT minus I. Agreed? Numerator will not change. EBIT numerator will be same. Denominator, okay, where preference dividend is there, what you should do? Okay, you will reduce the interest from EBIT minus I minus preference dividend divided by 1 minus T. See, 1 minus T is nothing but before tax number. I told you, when you want to convert a post-tax number to pre-tax number, what you should do? Divide it by 1 minus T. If you want to convert a pre-tax number to post-tax number, you should multiply with 1 minus T. Are you all comfortable? Anyway, here you need to reduce, subtract preference dividend divided by 1 minus T. Up EBIT divided by EBIT minus I minus preference dividend divided by 1 minus T. This will be your formula for financial leverage. Okay, only the preference dividend divided by 1 minus T before tax preference dividend you should reduce, adjust from EBIT in the denominator. Are you all comfortable? Now, that is what I have told you here, pre-tax preference dividend. Anyway, we have question there, you may have clarity. I don't know whether they have given the adjustment question given as adjustment. Let us see. But I am telling you, if at all they ask you, you should adjust. Okay, you should know how to adjust. Now, combined leverage formula also will change, because financial leverage formula is changing. Combined leverage is nothing but operating leverage into financial leverage. There is one more formula for combined leverage. Okay, combined leverage is equal to operating leverage into financial leverage. This formula is there. If financial leverage changes, then combined leverage also will change. That is why we are changing here. So combined leverage is equal to contribution divided by EBIT minus I minus preference dividend divided by 1 minus T. Okay, all the things will remain same. What is the formula for combined leverage? Contribution divided by EBIT minus I. We studied there, correct? Now it will undergo change. The new formula is contribution divided by EBIT minus I minus preference dividend divided by 1 minus T. Are you all understanding? Now, next concept, financial break-even point, I'll discuss after discussing 1 or 2 questions. Shall we discuss one question here? Okay, leverages, one simple question we'll discuss and move on. See. Okay, I'll come back to that. One question is pending regarding money market, which I will discuss later. Okay, 2 questions are there. I put it here. That's money market. Anyway, take question number 11 for discussion. This is a leverage question. Okay, question number 11. The ABC Limited has the following balance sheet and income statement information. Balance sheet given, equity capital, 10% debt, retained earnings, current liability, net fixed assets and current assets given. Okay, this is income statement given, sales given, operating expenses including 60,000 depreciation given, EBIT less interest, earnings before tax, taxes, earnings after tax. First, preference dividend given or not given? Not given, no issue. Okay, straightforward question. Now, determine the degree of operating leverage, financial leverage and combined leverages at the current sales level if all operating expenses other than depreciation are variable cost. Anyway, no issue. What is the formula for degree of operating leverage? Very simple. 3,40,000 is your sales. Agreed? Okay, sales minus variable cost. Now, what they have given here, you see in the income statement which we discussed, sales minus variable cost will give you contribution. You need to find out what is the formula for operating leverage. Contribution divided by EBIT. Agreed? EBIT given in the question as 2,20,000, no issue. Straight away you can take it as denominator. Contribution you need to find out because you cannot say 3,40,000 minus 1,20,000 because it has some fixed cost of 60,000 depreciation cost. Which means remove the depreciation cost. What is the balance? 60,000. That is the variable portion. They have already told you. So sales minus variable cost. How much is that? Okay, 2,80,000. 2,80,000 divided by 2,20,000. 1.27. Like this, you need to find out operating leverage. Next, come to financial leverage. Financial leverage is what? EBIT divided by EBIT minus I. Here, since there is no preference dividend, we don't need to adjust it. So what is it? See, EBIT is how much? 2,20,000. EBIT minus interest is how much? 60,000. 2,20,000 minus 60,000, 1,60,000. So 2,20,000 divided by 1,60,000, 1.37. Combined leverage, operating leverage into financial leverage. See, combined leverage, you can also apply the formula contribution divided by EBIT minus I, or simply you can use operating leverage into financial leverage. You will get combined leverage. Here also contribution. What was the contribution? 2,80,000 was the contribution divided by what is the EBIT minus I? 1,60,000. It should you should get 1.75. 2,80,000 divided by 1,60,000. How much is that? 1.75. Are you all understanding? You can either use this formula, or you can use operating leverage into financial leverage. You will get the combined leverage. Shall I proceed? Okay, next part. I'm moving on to the next part. That is why I wanted to predominantly discuss the question. See. Take question number part B here. If total assets remain at the same level, assets remain same, but sales increased by 20%, decreased by 20%, what will be the earnings per share in the new situation? See, they may ask, this is a sensitivity question. Leverage combines various things, correct? You while you solve leverages question, carefully observe what is the influencing factor and influenced factor they are asking. What is the adjustment? See, they are asking what will happen to earnings per share if the EPS increased by 20%. You are comfortable? Which means EPS increased by 20%. Now, what will be the impact on EPS? They want to find out the connection between sales and EPS. What leverage you should take? Combined leverage. I told you, combined leverage connects sales with EPS. So, every 1% change in sales, what will be the impact in EPS? This is found out by combined leverage. See, sales and I'll just summarize it here. One second. See, sales and EBIT. This is operating leverage, which connects sales and EBIT. EBIT and EPS. This is established by financial leverage. Sales and EPS. The impact of sales and a change in sales in EPS, this will be captured by combined leverage. Very simple. A starting point of operating leverage is sales. Ending point of financial leverage is EPS. So from top line to bottom line, okay, what is connecting here? Combined leverage. Are you all comfortable? Now they are effectively want us to compute combined leverage. Already we have computed. How much is the combined leverage? 1.75. What is the understanding? Already we know the interpretation. For every 1% change in sales, there will be 1.75% increase. So sales increased by 1%. There will be 1.75 increase in EPS. This is what is combined leverage. We already know that. What they are asking, 20% if sales. So 1% 1.75. 20% sales increase 20 into 1.75. How much EPS will increase? 20 into 1.75. How much is that? 35%. Are you all comfortable? So if sales increase by 1%, EPS will change by 1.75. 20% means 20 into 1.75, 35%. This is what is given. Okay, now they have calculated this. Anyway, see, earnings per share for the new sales level. They have shown the entire number and proved the theory. Are you all comfortable? Increase or decrease? But really speaking, see, 4,08,000. Again, 4,08,000. This is what you need to compute in percentage terms. Okay, see, sales there 3,40,000 is given. Okay, if it increases by 20%, 3,40,000 into 20%. What is that? 68,000. Are you all comfortable? So 68,000. Okay. You will add 68,000 plus 2 lakh. What is the number? Sales number 3,40,000. 3,40,000. That 4,08,000. So what they have done now? Effectively, they have increased. This column is for increased by 20% sales, and this is decreased by 20%, which means 3,40,000 into 80%. Okay, 2,72,000. Are you all comfortable? This is increased, this is decreased. Like this, they have found out, and they have found out EPS is 1.75, 0.84. Are you all understanding? Original EPS. What was the original EPS? I'll just prove you. Original EPS was how much? We prepared income statement. Net profit after tax is 1,04,000. Agreed. So this is net profit after tax is 1,04,000. 1,04,000 divided by number of shares is how much? 80,000. So original, how much was that? 1,04,000 divided by 80,000. Original EPS was 1.3. Are you all understanding? Remember this. Original EPS was 1.3. Okay, EPS was 1.3. Original EPS. It became 1.75. Okay, the difference is what? 35%. We compute now very simply. 1.3 into 135%. How much is that? 1.75. Are you all understanding? They have shown the entire computation. We have used the shortcut combined leverage formula and even found out the percentage change. We have found out the percentage change. They are asking us to compute they have computed the EPS level. Are you all comfortable? See here. What is the question asking really? What will be the earnings per share? Yes, they want earnings per share. It can be calculated using two methods. Original earnings per share you can compute and increase in percentage terms. And in the new, or you can just show the total income statement. Very simple. I'll just explain what they have done. That is correct because they have shown in this method. Now I will explain in this method. Very simple. Sales volume at present 3,40,000. If it increases by 20%, 3,40,000 into 120%, 4,08,000. Okay. Sales decreased by 20%. 3,40,000 into 80%, you will get 2,72,000. Are you all understanding? Decrease and increase, two situation. This is see. This is situation number 1. Okay. This is situation number 1. Sales increases by 20%. Situation 2 decreases by 20%. Are you all comfortable? Two situations given. Now, variable will cost is there. It varies with the volume. It varies with the volume means it will reduce. Here also it will reduce. Are you all understanding? But fixed cost will never change. Depreciation was a fixed cost. Now it will remain same at 60,000 irrespective of the volume of the business. Next, EBIT is there 2,76,000, 1,64,000 revised EBIT. Interest will also be same. Why? Because they have saying asset base will be same. Upon the debt capital will be same. They have already told you. So 60,000 and 60,000. Okay, EBIT, you got revised EBIT. You will get the revised EBIT. Then reduce the taxation, earnings after tax, divided by number of shares 80,000, 8,10,000. Okay, face value having 10 share, rupee 10. So total number of shares is 80,000. Divided, you will get the EPS. Are you all comfortable? Shall we move on to the next area? Next question. Next question also I will discuss here. Question number 12. See, a firm sales, variable cost and fixed cost amount. This is sales amount, variable cost and fixed cost giving respectively. So this is sales, this is variable cost, this is fixed cost. It has borrowed 45 lakhs. What is the debt amount? 45 lakhs at 9% and the equity capital is 55 lakhs. What is the firm's ROI, return on investment? Does it have favorable financial leverage? See, first step, what is the return on investment? What is the formula for return on investment? You would have studied in ratio analysis chapter. EBIT divided by investment amount. EBIT divided by invested capital. Total capital, debt capital and equity capital you will consider. So what is the EBIT? EBIT is nothing but sales minus variable cost will give you contribution minus fixed cost will give you EBIT. What is the number? 27 lakhs. So 27 lakhs is the EBIT divided by what is the capital base. See, debt capital is 45 lakhs, equity capital 55 plus 45 plus 55. How much is the total? 100. So 27 lakhs divided by 100 lakhs. How much is the value? 27%. Return on investment is 27%. Step number 1 over. Are you all comfortable? Next, does it have a favorable financial leverage? Next, see, what is the understanding? Yes, the firm has favorable financial leverage as its ROI is less than interest on debt. How to understand what is, okay, see, they have given this slide, favorable financial leverage. What is the understanding? Very simple. See, the return on investment, which you are return on the total capital which you are earning now, is it okay able to service the debt providers? Is what is the question under discussion. Are you all comfortable? Very simple. The company has how much EBIT? Okay, the company has how much CE? Okay, what is the company's ROI? 27%. Okay, the EBIT is 27 lakhs. This EBIT is earned on a capital base of 100 lakhs, which means 27% is the return on investment. So the return on investment means what the company is able to generate with the capital. Are you all understanding? The total return which the company is able to generate is 27%. And the debt capital is what? Interest rate on debt. How much interest we need to pay? Only 9%. Which means the company, if it is able to generate a more return than the return it needs to pay to the debt providers, okay, then it is called a favorable financial leverage. Are you all understanding? You are taking debt, and if you are earning less than the debt cost, then you will have unfavorable financial leverage. Are you all comfortable? Now this is favorable financial leverage because your ROI is more than cost of debt, or your interest on debt, that is cost of debt. Next, okay, part C. If the firm belongs to an industry where asset turnover is 3, does it have high or low asset turnover? First, we need to compute, see what they've asked. If the industry asset turnover, you need to compare to the industry standards. Industry asset turnover ratio is 3. What is your asset turnover ratio? You need to find out. If it is more than industry, very good. If it is less than industry standard, the standard is not met. Are you all comfortable? Higher the asset turnover ratio, better the value. Because see, what is asset turnover ratio? Turnover divided by total assets. How, okay, efficiently you are able to generate the sales from the asset base. This is what is captured by asset turnover ratio, which means this company is able to generate a turnover of how much? Sales of how much? 75 lakhs. What is the capital base? 100 lakhs, which means what is the at present asset turnover ratio? 0.75. That is what is given. Are you all comfortable? Asset turnover ratio for this company is 0.75. Industry standard is 3, which means all the other company are able to generate 3 times the sales, 3 times the asset of the company, 3 times the sales, which will be 3 times the assets of the company. But our company is only able to generate 0.75 times the asset base, which means the sales is lower, okay, for the given level of assets. So this is lower than the industry average, which means it is not favorable. Next, point number D, what is given? Question number D, what is given? What are the operating, financial and combined leverage of the firm? This you already know. Okay, easy computation. Shall we do? See, operating leverage, contribution divided by EBIT. Contribution only written as sales minus variable cost. 75 minus 42 divided by 27 lakhs, 1.22. Financial leverage, EBIT divided by EBIT minus interest. Just apply the formula. You will get one financial leverage 1.18. 1.22 into 1.18. You will get 1.44 as the combined leverage. Are you all comfortable? Alternative O into C. They have given 2 alternatives here. Sales minus variable cost. Contribution divided by EBIT minus I. They have computed 1.44, or operating leverage into financial leverage. You can also compute as 1.44. Are you all comfortable? Next, part E. Okay, don't think I'm rushing because I want to save time. Question answer you can easily solve. Understanding the concept, you are doing the revision and not the detailed regular lecture. So I need to quickly move on. Are you all listening? Okay, this itself will cross 8 or 9 hours, I believe. Let us see. Now, last E point. If the sales drop to 50 lakhs, what will be the new EBIT? Here also, you tell me, children. If the sales drop to 50%, what will be the EBIT? They are asking the sensitivity of the EBIT with regards to sales. So what they are trying to connect? Sales and EBIT. What is the leverage you need to consider? Operating leverage. Operating leverage will connect sales with EBIT. I have given here you see here I have given where is that? See, can you see the sales and EBIT? Okay, you take operating leverage. Operating leverage already we found out. What was that? 1.12 or some number we found out Yes, 1.22 operating leverage, which means for every 1% change, it will be changing by 1.22. Now, anyway, that we can verify here. What is the sales? See, current sales level is 75 lakhs. I think current sales level is 75 lakhs. Okay, what is sales drop to 50 lakhs? Now, if sales reduce to 50 lakhs, okay, what happens? Prepare income statement. Sales level 50 lakhs. Variable cost will also change. Why? Because, see, here, variable cost will change with regards to sales. Variable cost will change. Okay. So it will change with regards to the, what do you say? The volume of the business. If sales is 50 lakhs, okay, the variable cost will also change. Now, we need to find out how much it will change. You will need to find out the original variable cost ratio. See, I will just show you. Initially, you had how much variable cost? 42 lakhs. Correct? The variable cost is how much? 42 lakhs. How much is the total sales value? 75 lakhs. So 42 lakhs divided, what is the variable cost ratio? You would have already studied in costing. I don't need to tell you. Variable cost ratio is how much? Variable cost divided by sales. How much is that? 42 divided by 75 lakhs. 42 divided by 7, that 56%. 0.56 now, 56%. So VCR. And balance amount is what? 44% is called as PV ratio. You already know the relationship. 1 minus variable cost ratio will give you PV ratio. 1 minus PV ratio will give you variable cost ratio. Are you all comfortable now? See here. Yes, here. Sales revenue is 50 lakhs minus variable cost ratio 56%. So 50 lakhs is the revised sales. Into 56%, you will get 28 lakhs as variable cost minus fixed cost 6 lakhs you will reduce. You will get the EBIT as 16 lakhs. Are you all comfortable? Okay, EBIT at sales level of this much. They have asked EBIT. Yes. What is, if sales drop, what will be the new EBIT? This 16 lakhs can also be computed using operating leverage formula. What is the operating leverage? 1.22. If sales dropped to 50 lakhs, now first we need to understand the percentage. From 75 lakhs, what is the 25 divided by 75? How much is that? 33.33%. If 33 sales drops to 33.33%, okay, what will be the impact on the EBIT level is what they're asking. Are you all comfortable? Okay, 1.22 times it will drop. So 33.33 into 1.22 percentage drop. Now 40.66 percentage it will drop. So earlier, what was the EBIT? Earlier, the EBIT was how much? 27 lakhs. 27 lakhs. Okay, you will be having drop of 40.66 percentage. 27 into, okay, 60 points. So 59.44 percentage, roughly 16.04. Okay, rounding of 16 lakhs. Are you all comfortable? Both ways also you can compute. This is the best way. You just write down the revised sales, prepare an income statement, find out the EBIT level. Are you all comfortable? Shall we move on to the last segment? Okay, the last part, they've asked at what level will the EBIT of the firm will be equal to 0. Very simple. See, here you need to understand that you would have studied in costing the break-even point. Okay, the break-even point you would have studied is nothing but fixed cost divided by profit volume ratio or CV ratio, contribution volume ratio, or simply PV ratio. Okay, fixed cost divided by PV ratio. Now, see, in this case, here they are not asking if the change. See, there are two. I'll just show you here. There are two break-even point here. One is operating break-even point. Operating break-even point, which you studied in the costing. Okay. Operating break-even point is nothing but sales level at which EBIT is 0. EBIT is 0. No profit, no loss, which you colloquially use, but that is not a correct interpretation. Actually speaking, sales level at which EBIT is equal to 0, it was you studied in costing break-even point. In the financial management subject, we are going to study financial break-even point is nothing but EBIT level at which EPS is 0. EPS is 0. Are you all understanding? Now, this financial break-even point connects EBIT with EPS. Are you all understanding? Now, in this question, unique question, if they asked what is the what is the level of sales? I assume the printing mistake. At what level of sales? Okay, EBIT of the firm will be equal to 0. EBIT of the firm will be equal to 0. Combined leverage you will use, or simply they have used a different technique. They have used a formula. Okay, this formula derived from the underlying concept only. Very simple. They are asking us to find out the impact of sales in EBIT. Now, this cannot be told as break even at which, okay, it will be 0. if they ask at what sales level EBIT is 0, you can use the fixed cost divided by contribution per unit. That formula you can use in the operating break-even point. You can find out what is the level of sales. But here, what they are asking to find out the EBT to become 0, earnings before taxes, not earnings before interest and taxes, which means you should also consider the interest impact. What is the formula? Very simple, I'll tell you. Fixed cost, operating fixed cost will be there here. Depreciation is an example of operating fixed cost. Like this, financial fixed cost is interest. Debt, you pay interest, that is called as financial fixed cost. Now in the formula itself, what is the formula you use? Fixed cost divided by PV ratio. Like this you use to find out the break-even point. Now what do you do? Fixed cost numerator, you also consider the fixed financial cost. Fixed financial cost, which means originally what was the fixed cost? Tell me, what is the fixed cost? Okay, 6 lakhs. Financial cost, interest, how much is the interest? 4.05 lakhs, 4 lakhs 5,000. You see the original interest, see here in this question. What is the debt capital? 45 lakhs. 45 lakhs into 9% you apply. 4.05 or 4 lakh 5,000 you will get. Are you all comfortable? So this along with the 6 lakhs you add it. So you get 10 lakh 5,000. This 10 lakh 5,000 divided by, what is that? PV ratio. You need to find out PV ratio. PV ratio is what? Contribution divided by sales. How much is that? Contribution 33 lakhs. Okay, because 75 lakhs minus variable cost 42 lakhs. Contribution is nothing but sales minus variable cost. This 33 divided by 75, if you do it, you will get how much? Okay, 44%. So 44%, if you divide it 10 lakh 5,000 divided by 44%, how much you are getting? Okay, 22 lakhs 84,090, 84,091 rounding off. Okay, this is what is the sales level, which means at this sales level, EBT, earnings before taxes, will be 0. Shall we verify this? They have also given the verification. Okay, sales 22,84,091. Variable cost 56% of it, because already we computed variable cost ratio. If 44% is the contribution ratio, variable cost ratio will be 56%, 4 lakhs 79,091 minus fixed operating cost 6 lakhs minus financial cost, how much? 4 lakh 5,000. Okay, if you reduce the fixed cost this alone, you will get EBIT. Okay, if you reduce further 4 lakh 5,000, you will get EBT as 0. Are you all comfortable? Okay, this is how you need to find out the solution. Okay, next question, which is regarding EBIT-EPS analysis. But before that, we need to understand the financial break-even point concept. Okay, here I will discuss financial break-even point. Then we will discuss those 1 or 2 questions. So first we will discuss financial break-even point. Then I will also discuss the indifference point concept. Then we will do 1 or 2 questions regarding which is combining financial break-even point as well as indifference point. Okay. Now we will study the concept of financial break-even point. See, what is this financial break-even point? I will discuss. First, there are 2 break-even points. In the costing, you would have studied the normal break-even point. Correct? Just now we discussed fixed cost divided by PV ratio. Okay, we discussed that. What is the understanding? What is this costing BEP? Very simple. This is nothing but sales level at which EBIT is 0. EBIT, which is operating profit. EBIT is also known as operating profit. Operating profit will be 0, which means I make no loss, no gain with respect to operating profit. This is sales level. Sales level, at what level of sales my EBIT will become 0. At least I need to make this much sales to earn 0 profit, okay, to break even. This is what is the operating break-even point, which we learned in the costing subject. Now in the financial management subject, we are learning something called as financial FBEP, financial break-even point. What is this? Very simple. This is EBIT level. This is EBIT level at which EPS is equal to 0. At which EPS is 0. Very simple terms. How much sales you need to earn to make operating profit as 0 is what we learn in costing. Here, how much operating profit you need to earn so that earnings available for equity shareholders, which is EPS belongs to whom? Earnings belongs to shareholders. Are you all understanding? EPS belongs to equity shareholders, which means how much overall operating profit I need to generate so that the profit belongs to equity shareholders becomes zero. At least I earn zero profit to the break even the equity shareholders. This is what is financial break even point. Are you all understanding? Here I have given the notes. Okay. Can you go through? It is the EBIT level at which EPS is zero, zero profit to equity shareholders. Now, all equity company. Now, FBEP, what is the formula for FBEP? Okay, it depends. It depends on various capital structure. Okay, so the FBEP formula depends on various capital. Very simple. A company is an all equity company. A company is a first all equity company. In this case, what will be the FBEP if the company is having no debt in the capital structure? FBEP will be zero. Are you all understanding? Why? Because there is no debt involved. Yeah, only one capital provider, equity holder. So whatever I earn in the business, it belongs to equity shareholders. So I will break even as soon as EBIT even 1 rupee. Now I will cross the FBEP. Are you all understanding? So FBEP is nothing but zero. I need to earn even 1 rupee EBIT. Now it will break even. Next. Debt plus equity, which means the company has debt as well as equity, but only debt and equity, no preference shares. What is the second option? This is the first option, all equity company. Second option, I have debt in my capital structure. I have equity in my capital structure. Let's say debentures, bonds or debentures and equity shares, but no preference shares. But no preference shares, only debt, no preference shares. See, what is my FBEP? FBEP is nothing but interest. The interest value is there now. That is the FBEP. So I will be the FBEP. Interest amount will be the FBEP. Next, debt is there in the capital structure as well as equity as well as preference. All the three capital is there. In this case, what will be my EBIT? Now, very simple. FBEP. Now, FBEP is equal to I plus PD divided by 1 minus T. It is actually not clear. Okay, no, I'll just write it over 1 minus T. Okay, this is nothing but PD divided by 1 minus T. So I plus preference dividend divided by 1 minus T. See, something divided by 1 minus T, I told you pre-tax preference dividend. So assume preference dividend is 70,000. Tax rate is 30%. So 70,000 divided by 30%, 1 lakh. Pre-tax preference dividend will be considered. Are you all understanding? Because preference dividend is a number arrived at after paying the dividend. You pay preference dividend before paying tax, after paying tax, after paying tax. So you should pre-tax it. You should consider the before tax preference. So FBEP is nothing but interest plus preference dividend into divided by 1 minus T. Now, in costing, we studied, operating BEP, which is sales level at which EBIT is zero. Here we study financial break-even point. EBIT level at which EPS is zero. Are you all understanding? Now, I will also discuss the second segment, EBIT-EPS analysis. Indifference point I will discuss till then we will do some questions so that we'll have absolute clarity. I don't want to do only questions regarding to financial break-even point. Why? Because we'll discuss a comprehensive question which will cover all the aspects. Shall we? Okay, now in the second segment, now we are going to learn EBIT-EPS analysis. EBIT-EPS analysis, optimum capital structure planning. Optimum capital structure planning. Now, see, in this segment, EBIT-EPS analysis, what we are going to learn is the question will give you various financial plan. Just now I told now some various financial plans means very simple how to structure my capital. Sometimes a company may be all equity company. It may want to debt how much it can take debt 30-70 debt equity ratio, maybe 30% debt 70% equity, 70% debt 30% equity. Various possibilities is there na. So what you should do in this EBIT-EPS analysis, very simple income statement which we learned in the introduction to leverages, the same income statement you will prepare and you will select that plan whichever is having highest EPS. Because see, very simple, as a shareholder, ultimately I run business for the shareholders, equity shareholders, owners of the business, need profit. So whichever plans gives the owners the highest profit, I will select that plan. You are understanding? So first understanding, various financial plans will be given, in the question for selecting best plan. And best plan you will select that plan in which EPS is highest. See, this is not clear. One second, I'll just show you. That plan you will select whichever is having highest EPS. Are you all understanding? This is highest plan. EPS is highest. It's not clear because of the coloring issue. Anyway, best plan is the plan in which EPS is highest. Are you all comfortable? Okay. Now, one important issue is that this is normal. You understand that there is no need for further discussion. EPS, now you prepare income statement. Sales minus variable cost will give you contribution minus fixed cost, EBIT minus interest, EBIT minus, okay, taxes, EAT. Then you have preference shares minus preference dividend. Then earnings available for equity shareholders divided by number of shares will give you EPS. I told you, apart from that, into PE ratio given in the question, you will go up to MPS, because ultimately shareholders, okay, see, wealth is more important than earnings. Okay, wealth is more important than earnings. What the company earn is important, but ultimately what the company is valued at the market, in the market, is more important. Are you all understanding? So what I told you, if PE ratio is given in the question, very simple, if PE ratio is given in the question, see, here I have put a note, very, very important note. Can you see this? Okay. If PE ratio is given in the question, okay, or MPS per share is given in the question, assume, because sometimes they may give MPS, sometimes they may give PE ratio to find out MPS. In that questions, in that case, select that plan whichever gives you highest MPS and not till EPS. You have to go till MPS. We'll do one question, you will have absolute clarity. Just concept alone I'm discussing. Because wealth maximization is ultimate goal of the company, and not just a profit maximization. EPS, earnings per share. Earnings per share, how much the company is earning. What is earnings per share? Net profit divided by total net profit after tax divided by number of shares. This is what the company is earning. But what is MPS, market price per share? This is what is the market. The investors are giving, okay, valuing the company in the market. Are you all understanding? So very simple. If PE ratio given in the income statement, don't stop okay till EPS. What do you do then as the next step? EPS, then multiply with PV ratio, you will get the MPS. So simple. PE ratio is equal to what? MPS divided by EPS, or simply MPS is equal to EPS into PE. EPS into PE ratio. Okay, both the formulas I have given. Are you all understanding till now? Okay, so the question, if you ask you various plan and select the best plan, see whether the question is mentioning regarding PE ratio. See, anything is given regarding PE ratio. If PE ratio is given, prepare the normal income statement till EPS. Then don't select the plan whichever is giving you highest EPS. Select that plan. Go in, multiply with PE ratio. Select that plan whichever gives you highest MPS. If PE ratio or MPS data are not given, simply do the income statement. Find out the highest EPS plan. Okay, that plan you will select. Are you all having the clarity? Now we will move on to concept of indifference point. This is very, very important because it will connect all the above concept with the financial break-even point also. Are you all comfortable? Now see, I'll discuss this. Now, concept of indifference point. Now, what do you mean by indifference point? Indifference point is the level of EBIT. Again, it is level of EBIT only. Indifference point is also EBIT. Okay, financial break-even point also is EBIT. Now, what is indifference point? This is the level of EBIT. Various plans will be given now. This is the level of EBIT at which, okay, the two financial alternative plans will give you same EPS. This is the level of EBIT, okay, at which EPS will be same under two different financial plans. Very simple. If question mentions you gives you two financial plans, you prepare an income statement. EBIT will be same for both the companies because this is capital structure planning now. Okay, if you change the capital, it will not alter the operating profit of the business. Are you understanding? Business lens, what is the profit you are earning from the business? It will not change just because you change the capital structure. Are you comfortable? So what I say is, EBIT will be same. But at the given level of EBIT, EPS will be different EPS now. Will give you both plan, will give you two different plan, will give you two different EPS. What they say, indifference point is the EBIT level at which both the EPS will be equal. Both the EPS will be equal. Now, this indifference point, you will find out with regards to two plans only. Suppose if question mentions you three plans, it gives you three plans. Now, what you should do? You say, for example, if the question is giving you three financial plan, plan 1, A, B and C. In this case, what you should do? You should compare A and B first. Then find out whether there is any IDP, indifference point between 2 points. You cannot compare 3 and find out the IDP. Are you understanding? Equation you need to solve. I'll just explain. You need to take A and B and try to find out whether there is any indifference point. Okay, indifference point may be there, may not be there. Sometimes it will be indeterminate. Okay, there will be no indifference point. I'll explain all these things. Then you compare B and C and find out whether there is any indifference point between these two alternatives, these two financial plans. Then you compare A and C, then you find out indifference point, if any, between them. Are you understanding? Thereafter, okay, after finding indifference point, we will also try to find out which plan is the superior plan, which plan we should select. Are you all understanding? Now, step by step, I will explain little bit. You may feel complicated, but once we do the question answer, you will have absolute clarity. Don't worry. Okay. Now, either first plan. Okay. First, how to find out, compute the EBIT. We need to find out now. See, what is this? We need to compute the IDP now. Indifference plan. See, assume this is plan 1. Let's say this is plan 1. Let's say this is plan 1. This is plan 2. Are you all understanding? Two plans are there now. Now there is formula given. Don't worry, you don't even need to do using formula. I'll just explain briefly. See, I will assume that preference dividend is given. If preference dividend not given, no issue. This preference dividend you will cancel. If it is given, you will consider it. Are you all understanding? What is the formula? EBIT will be same. That is why EBIT 1 and 2 they have not given. EBIT will be same. You need to equate. Ultimately, the EPS, what is the goal of this IDP? Indifference point. Like EPS should be same. So equate it. First plan, what is that EBIT? What do you do? Minus interest. You will get EBT na. That is what I have done. EBIT minus interest. But interest of plan 1. Because first plan may be having a higher interest rate, second plan having different interest amount. Appo EBIT minus I1, okay, you do it, you will get EBT of plan 1. Mine into 1 minus T, into 1 minus T is nothing but after tax. Okay, taking a pre-tax number to post-tax number, you should multiply with 1 minus T. Very simple, yeah, 100 rupees you have. Tax rate is 30%. Okay. Tax rate is 30%. Now, simply 100 minus 30% if you want to apply, how will you apply? Tell me children, what? Minus 30. Okay, 30% into 100, you will get 70 rupees. This you can also do it in an alternative way, multiply with 1 minus T. So, 100 is there into 1 minus T in a tax rate is 30%. 1 minus 0.3 is how much? 0.7. So, 100 into 0.7, how much? 70 rupees. Are you all comfortable? Both will give you same number. To put it simply, if you multiply some number with 1 minus T, you will arrive at a post-tax number. Pre-tax number, if you multiply with 1 minus T, you will arrive at post-tax number. Post-tax number given, if you divide it by 1 minus T, you will arrive at pre-tax number. Very simple. Yeah, 70 rupees we found out post-tax now. 70 rupees divided by 1 minus 0.3 is what? 1 minus 0.3. What is that? 70 divided by 0.7. You will get 100 rupees. Are you all comfortable? Okay, this is how you need to do. That's why I already discussed now. Anyway, now, see, what you need to do here. See, now you have EBT na, minus 1 minus tax. You will get EBIT, earnings after tax. This is what I have done here in the formula into 1 minus T. This is, are you all understanding? So EBIT minus I1 into 1 minus T minus preference dividend 1. If this plan has any preference dividend, you will consider that. That also you will reduce because you will get earnings available for equity shareholders. This is earnings available for equity shareholders. This divided by number of shares, if you do, you will get EPS under plan 1. That is what is there. Numerator, if you reduce the preference dividend, the numerator is nothing but earnings available for shareholders. Okay, EAS 1. This is for plan 1. EAS 1 means plan 1. EAS divided by number of shares in plan 1. That also will change. That is why N1. N1 means number of shares outstanding in plan 1. So EPS 1 divided by N1, number of shares outstanding. EAS divided by number of shares outstanding, you will get EPS of plan 1. This is nothing but EPS of plan 1. This you will equate it to EPS of plan 2. Now same way EBIT of plan 2 will be same. EBIT will be same. So that is there. Minus I2, interest of plan 2 into 1 minus T, post-tax EBT EAT, then minus preference dividend 2, which means second plan, whatever is the preference dividend you will consider, divided by N2, number of shares in plan 2, equated to both of this, you will get EPS of 1 is equal to EPS of 2. Are you all understanding? Now, all the other details will be given in the question. EBIT you will find out. You will assume EBIT to be X. By taking EBIT X, you solve the equation, you will get the EBIT level, X level. Now assume the X you got after solving, you got to the 8,000. 8,000 is nothing but EBIT. At 8,000, EPS under both the plans will be equal. Both the plans will be equal. That is what I have given here. Can you see this? Let me just show you here. Okay, let me just put this off so that you will have clarity. Now, EBIT will be same under both the options. Okay, I1 is equal to interest of plan 1, PD1 is equal to preference dividend of plan 1, if any. If preference dividend is not given, no issue, you just cut it off. EBIT minus I1 into 1 minus T, that's all you need to equate. Plan 2 also you need to equate. Are you all comfortable? Now, same way I2, PD2 and N2 are for plan 2. Also can be solved using income statement by just filling it up. Income statement also you can solve. How you can solve using income statement? Very simple. I'll just show you. Okay, what you need to do now? See, you just need to prepare the income statement wherein EBIT you will assume as X. EBIT is equal to X. So what you do? Prepare EBIT X minus I will be there. Okay, interest amount, say 40,000 is the interest. So X minus 40,000. You will get this as X minus 40,000. This is what EBIT. Minus tax at 50%. So 50% tax, if you reduce it, you will get what? X, 0.5x minus 20,000. Like this you can solve. Are you all comfortable what I am trying to say? Divided by number of shares. Okay, say 20,000 is the number of shares. This number you will equate it to other number, solve it, algebra equation, I don't need to teach you, you will get the X value. This is nothing but EBIT, indifference point. At that EBIT, cross verify whether EPS under both the option is same. If you're getting same, you are getting the correct indifference point. You can also rework and verify. Shall I? See, I'll move on to the next discussion. Decision making using EBIT. See. Sir, what is the use of this EBIT? Why we need to compute this EBIT level, which means indifference point, but that is nothing but EBIT. Now, this indifference point, what is the importance of this indifference point? We need to understand. Very simple. The calculated EBIT, what is the importance? See, if EBIT, your target EBIT, if the company's IDP comes to 8,000 rupees. What is IDP? Indifference point, you calculated, it came to 8,000 rupees. Okay, which means at 8,000 rupees, both the plan will give you same EPS. That is the interpretation. Assume your proposed EBIT or your projected EBIT of the company is say more than this 8,000. Say it can be 16,000. Yes, it can be 16,000 or it can be say 4,000, which means it can be more than indifference point. EBIT can even be less than indifference point. Agreed? Now it can be even more or less than indifference point. What is the beauty of this discussion? If EBIT level, you are projecting that your company may earn operating profit more than the indifference point, which plan you should select? You should select that plan, okay, whichever is having higher financial break-even point. Very, very, very important. Higher leverage or financial break-even point. Whichever plan is having higher debt, to put it simply, whichever plan is having higher debt, it will have more financial break-even point. That plan you should select. How to compute this financial break-even point I already discussed. All equity company, 3 option I gave you. All equity company, 0 is the financial break-even point. Only debt is involved, no preference shares. Now what is the financial break-even point formula? I. If preference share is also there, I plus PD divided by 1 minus T. Like this you compute it. Already you know how to compute financial break-even point. That you will take and consider the decision making process. Are you all understanding? If you earn a higher EBIT, if you are expected to earn a higher EBIT than IDP, indifference point, select that plan whichever is having highest financial break-even point. Are you all comfortable? Now, next, if your EBIT is exactly IDP, indifference point, that is why it is indifference. Both the plan will be equal. Both the plan will be equal. Okay, it will be indifferent. Either you select plan 1, plan 2, no difference will be there. Next, if your target EBIT, if the proposed EBIT is less than the indifference point, which means the EBIT is 8,000, You are see the IDP, the indifference point in our example. Now I told you indifference point is how much? 8,000, but you are expected to earn only 4,000 EBIT. In this case, you are expected to earn less than the IDP, EBIT of less than IDP. In this case, which plan should be selected? You should not select the plan whichever is having higher leverage. You should select a plan whichever is having lowest financial break-even point. Whichever is having lowest financial break-even point. Okay. Through illustration, example, we will understand this fully. Okay. Now, see this chart. What happens, you see, this is EBIT level. This is EPS. Okay, as and when EBIT increases, EPS will increase. For any plan, EPS will keep on increasing. But the beauty is, see, this is assume low EBIT plan, low FBEP plan, and this is high FBEP plan. What happens is, the higher FBEP plan initially goes below. Can you see this? This will travel higher than this point. Okay, can you see this? But it will intersect this point is IDP. But beyond a point, what will happen? The higher financial break-even point will earn you higher EPS. This is the EPS now. Y-axis is EPS. It will start earning higher EPS, okay, due to its leverage benefit. That is why leverage is double-edged sword. Leverage, what happens? If you include the debt in the capital structure, if your EBIT is higher, if your business is flourishing, you will generate a higher EPS. You will generate a higher EPS. But if the sales is down, okay, then you will be adversely impacted. That is why debt is problematic. Are you all understanding this? Even if you don't understand the chart, don't worry. Okay, this is high. This is a plan one. Say this is plan one. This is nothing but plan one having lower FBEP. Lower FBEP. Because FBEP is nothing but EBIT, lower level. This is a plan two having higher FBEP. Which plan you will select? See, if your EBIT level is coming here in between. Are you all understanding? Okay. Sometimes it may be more than this EBIT. Higher IDP is this. This is IDP. Okay. If your EBIT is below IDP, you will select plan 1. If your EBIT, okay, the projected EBIT is more than this point, indifference point. Are you all understanding? You will select plan 2. Are you all comfortable? Okay. Anyway, with example, we will understand. Okay. 2 questions we will do in this regard. And then quickly move on to the next chapter, that is cost of capital. See, illustration number 13 is given. 1 second. All the illustration before this we solved. Yes, we already solved illustration number. Yes, these 2 illustrations solved. 11 and 12 we solved. Now we will move on to 13. Okay. Selection of different plans. EBIT-EPS analysis concept will be there. Financial break-even point will be there. Also, indifference point will be there. Okay, very, very, very important question. Very, very important 3-star question. Are you all comfortable? Now, Excel Limited is considering 3 financial plans. The key information are as follows. Total funds to be raised is 2 lakhs. Total funds to be raised. How much capital is to be raised? 2 lakh is to be raised. Financial plans are available. 3 different alternatives. Financial plan A is 100% equity, which means all equity company. FBEP will be 0. FBEP is equal to 0. We already discussed that. Plan B is having 50% equity, 50% debt. Are you all comfortable? Which means half borrowing, half the capital is borrowing, which means 2 lakh is the total capital required. Now, 1 lakh will be the borrowing, okay, debt, and balance will be equity. Balance equity will be owner's funds, capital. Are you all comfortable? This is 2 lakhs is there, not total funds required. This is the second plan. Third plan, 50% equity, preference share is also given. 50% preference shares, which means 1 lakh debt will not be there. 1 lakh equity and 1 lakh preference shares. Okay. Now, cost of debt is 8%. Cost of preference shares is 8%, which means you will pay 8% of preference dividend out of the preference capital, and you will pay 8% as debt interest from the debt capital. Tax rate is 35%. Equity shares of the face value 10 each will be issued at a premium of 10 per share. And see, issued at premium of 10 per share. Now 10 is the face value. Assume face value is 10 plus premium of 10, which means equity shares will be issued at 20 rupees in total. Are you all comfortable? The price at which issue price of the equity shares is 10 plus 10, because 10 rupee face value plus premium of 10. Next, expected EBIT. EBIT level expected of the company is 80,000. Are you all comfortable? 80,000 is what is the company is expecting. I told you the expected EBIT is more than indifference point. All this I discussed now. The company is expected to earn a profit of 80,000. EBIT of 80,000. Now, determine for each plan EPS and financial break-even point. First, one by one, we will move on. Very, very important questions. So slowly we will discuss. Thereafter, we'll move on to part 2. First, part 1. See, first earnings per share. Now, prepare an income statement independently. You have 2 plans given now, 3 plans given now. So for all the 3 plans, this is for plan 1, plan A, all equity, no interest. Interest is 0. Are you all understanding? This is plan B, debt plus equity. Okay, this is all equity. Plan A. Plan C is what? Preference plus equity. Okay, this is plan C. Are you all comfortable? Now we will see all the plan. Equity, all equity plan, no interest will be there. EBIT is given as 80,000. EBIT 80,000 will be same for all the plan, because I told you na, in the entire discussion, EBIT will be same. Okay, capital structure will not affect the operating profit, business profit, it will not affect the business profit. Are you all understanding? Next, EBIT is there. What is the EBIT? EBIT 80,000, 72,000 and 80,000. Are you all comfortable? Minus taxes. Okay, here 8,000, sorry, the second case in plan B, 8,000 interest will be reduced. Why? 8,000 interest, how do you got? See, 8% is the debt capital, debt interest rate. 2 lakhs was the capital, debt 1 lakh, equity 50-50 na, 1 lakh will be the equity. 1 lakh into 8%, total 8,000 is the interest. Are you all understanding? So 80,000 minus 8,000, you will get 72,000. EBT, here 80,000 because preference will be after tax dividend will be paid. So no issue. EBT will be 80, 72 and 80. Taxation 35% if you reduce, you will get EAT. From that, dividend on preference shares for all equity company will be nil. Debt will be nil. This 8,000 will be applied on 1 lakh capital. Are you all comfortable? So 1 lakh into 8% preference share capital. Once again, just let me check how much is that. Yes, preference shares also 8%. Hence it is 8,000. Okay, if preference share given 12%, you will write 12,000 here. Are you all comfortable? Next, earnings for equity shareholder divided by number of share, you will get EPS. Now, number of shares is there. Number of shares you need to compute. First plan, you tell me all equity plan. What is the number of shares? See, in the examination, you prepare a separate working note showing number of shares. Number of shares. You need to compute for plan 1, plan 2, plan 3. All equity company, you tell me. See, here, number of shares you need to compute. How to compute number of shares? Very simple. What is the amount you require? 2 lakhs. If you issue, raise 2 lakhs, at what price you can raise? Issue price of 20. 2 lakhs divided by 20. How much is the number of shares? 10,000. Are you all comfortable? This they have given us 10,000. Next, plan 2. Plan B, which is debt as well as equity plan. What is the number of shares outstanding? Very simple. 1 lakh debt required, 1 lakh only equity capital. So 1 lakh equity capital, if you raise at 20 rupees, you will get 5,000 shares is to be issued. Next, same 1 lakh. Okay, if you divide it by 20, you will get the 5,000. Okay, in the debt equity plus preference share option. Now, compute the EPS. 52,000 divided by 10,000, 46,800 divided by 5,000, 44,000 divided by 5,000. You will get the respective EPS. Are you all understanding? Now, which plan is best plan? Normally, you have not computed anything else. Tell me which plan is the best plan. P ratio given in the question or not given? Not given. So, whichever plan gives you highest EPS, you will select that plan. Which plan is giving you highest EPS? Plan B, debt plus equity will give you highest EPS. Now, first segment, they have computed EPS. This you keep in mind. Then they have asked us to compute the financial break-even point. Financial break-even point. For all equity company, what will be the financial break-even point? 0. I already told you. First option. So plan A, financial break-even point will be 0. See, FBEP for plan 1, A, all equity, plan B, C. Plan A, it is 0. Plan B is what? Debt, interest is there, but no preference share is there. What is the formula? I will be the formula. I will be the FBEP. So I is how much? 8,000 will be the FBEP. Are you all comfortable? Plan C, what is the FBEP? Preference share is there. So what is the FBEP formula? I plus, okay, what is that? Preference dividend divided by 1 minus T. Before tax, preference dividend should be added. What is interest rate? 8,000. Preference dividend is also 8,000, but you should not add 8,000 before tax number you should add, right? Are you all comfortable? So here, yes, sorry, plan B, yes, plan B, plan C, sorry, plan C, I wrongly said, because plan C only preference shares and equity shares. There is no interest. So this interest will not be considered. Simply preference dividend divided by 1 minus T, interest 1 minus T, pre-tax preference dividend. 8,000 is the preference dividend. Tax rate is what? What is the tax rate in this question? 35%, if I'm not wrong. Yes, so 65% divided by 1 minus T, no, 65%. So 8,000 divided by 65%. How much is that? 12,308. 12,308. So this is 12,308. FBEP for plan C. Are you all comfortable? Now, this is what they have asked in the first segment. Now, shall we read out the second part of the question? Okay, see. Indicate if any of the plan dominate and compute the EBIT range among the plan for indifference. See, this question has some interpretation issue. I'll tell you what they want to compute, what they want to ask, okay, and what they have given as solution is different. But we will find out what is the correct interpretation. I'll tell you what is the understanding, because the CMA Institute module, a lot of mistakes are there all over the module. Okay, each and every chapter has a lot of mistakes. Okay, in the regular batch I covered a lot of mistakes I have quoted, but still, everything cannot be discussed in this marathon. So what I will do is that I will quote few mistakes here and there. You need to adjust this as per the conceptual discussion. See what happens here. Plan, see which plan will be dominating. Now, eventually they want us to compute which plan is superior, which plan is the best plan. Since they have not asked you regarding anything regarding P ratio or MPS, we will consider that plan whichever is giving you highest EPS. But this may change, okay, with regards to the financial break-even point. Okay, that I will link it to financial break-even point and discuss the conclusion. Are you all comfortable? So anyway, next, compute the EBIT range among the plans for indifference. Very simple. Among the plan, EBIT indifference point they want you to compute. So for 3 plans is there given in the question. I told you already that indifference point, okay, what you should do now, you should see 3 plan is there. Plan, one second, plan A, B and C. Here for plan A, B, C, you cannot find out indifference point for all the 3 plans cumulatively. I already told you. So plan A and B, one combo. Then B and C, another combo. Then you have A and C, another combo. 3 different combination, okay, of plans can be made. You need to find out if there is any IDP between A and B, B and C, and A and C. Are you all comfortable? Thereafter, for the given level of EBIT, we will select that plan, whichever is having the best option. And shall we discuss? First, A and B, they have taken the indifference point among various financial plans. That is how they have solved it. But the question framing and the solution will be somewhat, and there is anomaly, but I will tell you how to understand the question, what they really wanted to communicate. See, first they want you to find out the indifference point among A and B. We will compute. X, they assume the EBIT as X into 1 minus T. Why? There is no A, there is all equity plan, no, what is that? Interest. So directly they have jumped to tax. No interest is there. So what is the formula? EBIT minus I into 1 minus T. Like this we discuss now. Where there is no interest, you will simply do EBIT into 1 minus T. EBIT into 1 minus T. Why? No interest is not there. All equity company. You will directly jump into EBIT into 1 minus T divided by N1, number of shares of 1. This is EPS 1 is equal to X minus I. This is not 1 pa. This is I. X minus I into 1 minus T. X minus X na EBIT minus I into 1 minus T divided by N2, number of shares outstanding in the plan 2, will give you EPS 2. Are you all comfortable? Now if you solve the equation, I don't want to get into solving the equation. You can solve it. 0.65x divided by 10,000 is equal to X minus 8,000 into 0.65. 0.65 65% tax rate. Okay, 1 minus T is only 0.65 divided by 5,000. Here plan A 10,000 shares are outstanding. Plan B number of shares is 5,000. If you equate it, you will get X as 16,000. At 16,000 EBIT, what is the interpretation? At 16,000 EBIT, current EBIT is 80,000. If you see the plan, current EBIT, we prepared an income statement. Now current EBIT is 80,000. If my EBIT is 16,000, okay, plan A and B, EPS will be 0. EPS will be EPS will be equal. I should not say 0, it's wrong. EPS will be equal. This is what is indifference point. Are you all understanding? FBEP, EPS will be 0. Here, EPS you will get some EPS, but at some EPS will be same. Suppose if it is plan A is 1.33, now here also you will get 1.33 as EPS. Are you all comfortable? Now, next. Like this, we'll find out the indifference point between B and C. Next in a B and C. B again, it is a debt plan B and plan C. X minus T into 1 minus T. Why? Because there is no preference dividend. So simply you will use it. Here we have preference dividend. I put the formula as PD. They have put as DP. Dividend of preference shares. Anyway, both are same. X into 1 minus T. Why? Because no interest, so I will be vanishing where no I. So X minus T into 1 minus T is divided by N1 is equal to X into 1 minus T minus DP divided by N2. If you solve the equation, you will never find out the X. You will never find out the X. Sir, what is this? You are told we found, if we solve, we will get X. Not necessary. Not necessary. That see, in the example I told you, two different point which intercepts. Sometimes what happened, if you see in the graph, sometimes one plan will be going like this, sometimes one plan will be going like this, and one plan will be going like this. These two plans will never intercept each other. Are you all understanding? There will be no interception. Okay, it will be moving parallelly. Are you all understanding? Which will never intersect, which means we will never have any indifference point between two plans. That is also possible. That is also possible. Thus, indifference point between plan B and C is indeterminate. Indeterminate. So B and C, you will never be able to find the indifference point. Why? Because you cannot solve the equation. X, C, 0.65x minus 0.56. Okay, 0x is equal to some number. You will never able to solve the equation. Hence, it is indeterminate. Next, A and C. Okay, if you find out the IDP between A and C, X into 1 minus T, okay, is divided by N1. If you solve the equation, same question, I don't want to again and again solve. Okay, again and again discuss. Same thing, you will find out 24,000 IDP 615. If you solve the equation, you will get 24,615 as IDP. So very simple. Plan A and B as IDP of how much? 16,000. Plan B and C, no indifference point. Plan A and C, 24,615. Are you all comfortable? Now comes the last discussion. That is, which plan is superior? Which plan is superior? Very simple. There is interpretation involved. It depends on the EBIT. See, if our EBIT, say for example, this is plan A and B. I'll just write the IDP level. Plan A and B, B and C is indeterminable. A and C is how much? 24,650. Okay, here it is 16,000. Are you all comfortable? Now what they say, if you are having plan A and B and A and C, if you see in plan A and C, okay, this is plan A and B. Now note the point. What is the important adjustment? Very simple. Now our EBIT level you need to see. What is our EBIT level? 80,000 is our EBIT level. That you keep in mind. Now our EBIT level is 80,000 which is more than these numbers. Are you all comfortable? EBIT is more than the IDP level. Which plan we should select? We should select that plan whichever gives you highest, whichever is having highest financial break-even point. Whichever is giving highest financial break-even point. Agreed? Which plan is having highest financial break-even point? Plan C is having highest financial break-even point of 12,308. Plan B is only 8,000. But the problem is that, you see what is the problem? Okay, in plan C, it is having highest financial break-even point. But see, what happens is, the EPS of this plan is lower. If you see the EPS is only 8.8. 8.8. Are you all understanding what is happening? But plan B EPS is higher. 9.36 is the highest EPS. Now, I will divide the discussion into two parts. The question actually is incomplete. See, as per the EPS, you should select plan B. As per the EPS, you should select plan B. Okay. And as per the indifference point also, if you see this, what happens really? I will tell you. See, plan A is inferior to plan B. Plan A is inferior to plan B. Agreed? Plan B and C, if you see, there is no indifference point available. So we cannot find out whichever is having, 80,000 EBIT level, which plan can be selected. Now we cannot find out. Agreed? For that, what you need to do now, if you compare B and C, okay, if IDP is indeterminate, what is the interpretation level now? At all level, whichever plan is having highest EPS, that plan will be superior. Are you all understanding? Why? Because there is no intercept. See, if the point is intersecting, which means at some level this will be higher, beyond that this point will be higher. Okay, like this we can divide it. But where the indifference point is indeterminable, what is the understanding? The graph will look like this one, which means one plan, this is plan B now. I can write it like this, plan B. Plan B, this point is plan, this line is plan C, which means plan B will always be dominating the plan A higher than at all levels of EBIT. Plan B will be giving a higher EPS. Are you all understanding? When this will happen? When our indifference point is indeterminate. It is not determinable, which means a plan which is having higher EPS will always be higher, giving you higher EPS level at all EBIT level. That's why if you compare the plan B and C, you will get B as superior. It is having a higher EPS. And if suppose B is having, if suppose there is an indifference point, then in that case, what may happen? Now, you may say at some point, till some point, C will be superior. After that, B will be superior. But since there is no indifference point in this case, B will always dominate C. So A and B, if you compare, B is superior. C and B, if you compare, B is superior. Hence, B is the dominating plan. B is the best plan available. Are you all understanding? And it coincides with the highest EPS. So plan B dominates plan C as the financial break-even point is lower. See, this is the wrong reasoning. This is what I wanted to communicate. Plan B dominates plan C, but the reasoning is wrong. FBEP lower. Okay, it is not correct, yeah, because EBIT is higher than indifference point. This is not the correct interpretation. Their conclusion is correct, but the interpretation is wrong. This is the mistake. Okay, they want to communicate something else, but they wrote something else. Are you all understanding? It should be like this. Since the IDP is indifference between B and C, and B EPS of plan B is higher, at all times it will be higher than C, hence plan B is superior. Like this, they need to give the conclusion. Anyway, that is, they have missed it. Anyway, I have explained it. Shall we move on? Okay, a lot of time spent in this question. Let's take the last illustration number 17. I think I put this illustration because, okay, we have MPS in the share sold at 33.33. MPS of the shares is given, market price is given. I told you to prepare an income statement where MPS is given. You will prepare P ratio, multiply the EPS. Okay, you will not stop till EPS. You will go beyond it, multiply with PV ratio, find out market price. Whichever gives you highest MPS, you will select that plan. I think this 100 lakhs and debt plan, 59.8 you will select. Anyway, this you need to understand. Anyway, we will solve the question. Thereafter, we will proceed. See. Take question number 17. We will discuss the question. I just briefly showed you what is the reason for selecting this question. So illustration 17, the XYZ company plans to expand assets by 50%. Okay. To finance the expansion, it is choosing between a straight 6% debt issue and equity issue, which means either debt or equity. I think two plans are there. And only two plans, I think. Sales level, different sales level. Okay. Debt and equity, two different options. Then its current balance sheet and income statements are shown below. Okay. Balance sheet given, income statement given. Balance sheet 5% debt 4 lakhs, equity share 10 each of capital of 10 lakhs. Then there is total assets 20 lakhs. Okay, no breakup given, simply given. Next, income statement, sales given, total cost excluding interest. Anyway, we will not consider this cost. Separately, we will consider interest on debt 20,000. Okay, then EBT, taxes, net income, everything is given. This they have arrived at 4%, 4 lakh into 5%. That's how they have arrived at the interest. Next, if company finances the proposed expansion with debt, the rate on the incremental debt will be 6% and the price to earnings ratio of the equity shares will be 10. If the expansion is financed by equity, the new shares can be sold at 33.33. Okay, and the price to earnings ratio of all the outstanding equity shares will remain 12. Are you understanding? Which means, okay, this is very, very important. Okay, the here, when you see this, see, if company finances the proposed expansion with debt, okay, which means the rate of incremental debt will be 6%. Point number one. Existing rate, if you see, of debt is 5% only interest rate. Okay, but if you finance the additional capital with debt, the debt will cost you 6% interest. Apart from that, and the price to earnings ratio of the shares will be 10. Very simple. PE ratio is a measure of risk. Okay, I discuss all this in regular lecture, but listen what I'm saying. If you understand, well and good. If you don't understand, no issue. See, PE ratio is a measure of risk. Okay, higher the investors feel that the company is risky, they will be ready to pay less PE ratio for a stock. So, for example, there is two company, Reliance and Tata. Let's say Reliance Limited is there, Tata is there. Okay, if investors feel that okay, Ambani is more risky than Tata, what will happen? Reliance is more risky, na? They will pay ready to pay 12 times PE. Sorry, they will pay less PE. Okay, and they will pay 10 times the price. Okay, say Reliance Limited is there, PE ratio will be 10. Assume here PE ratio may be 12, which means the company, this is high risk company, this is low risk company. Put it simply, the company which the investors feel risky, na, this share is risky, na, they will be ready to pay less price or more price or less price. PE ratio will be less. Okay, if you see, this is risk, this is risk. If the company is more risky, PE ratio will be less. If the company is less risky, the PE ratio will be more. Are you all understanding? Now, what they say, if you keep on adding debt, okay, if the company borrows more and more, the PE ratio will be reduced to 10. That is what has happened to PE ratio. And if expansion is financed by equity, the new shares can be sold at 33.33 and the price to earnings ratio of all outstanding equity shares will remain. Well, are you all understanding? So this is if expand by equity, the equity share, okay, the shares outstanding equity to P ratio will be 12 and the MPS will be 33.33. Shares can be sold at, can be issued at, the new equity shares can be issued at 33.33. It can be raised at market price of 33.33. Are you all comfortable? Now what they're asking, assuming that net income before interest on EBIT is 10% on sales, calculate EPS at assumed sales of 20 lakhs, 40 lakhs, 80 lakhs, 100 lakhs under the alternative forms of financing. See, what happened is, in this question, to put it simply, in this question, there are two options, which means here I can show it. Two expansion plan, debt, equity. Okay, and this expansion plan, what they ask, for different sales level, they've asked us to compute the income statement, which means for 20 lakh sales, this is sales level. For 20 lakh sales, you have 40 lakh sales, 80 lakh sales, and 100 lakh sales. Four different sales are available now. For 20 lakhs also debt option, equity option. 40 lakhs also debt option, equity option. Like this, they need you to prepare 8 different situation income statement. Are you all comfortable? Like this, you need to prepare debt, equity, debt and equity. Prepare the income statement, find out the total EPS. That is the first stage of the discussion. Thereafter, this question has EPS, P ratio given in the question. So what you should do ideally, you should go till MPS and then compare the different alternatives and select the best plan, which means in which the EPS is highest. Select that plan, whichever gives you, MPS is highest. Are you all comfortable what I'm trying to say? Now, let us try to understand this. Okay, we will go to the next part later. First, we will try to understand this. Sales level given 20 lakhs, 40 lakhs, 80 lakhs, and 100 lakhs. Debt to equity, debt, equity, debt, equity, debt, equity. That's it. Now, EBIT is stable at 2 lakhs. How they found out 2 lakhs? Very simple. 10% on sales. What is the sales at present? Sales is 60 lakhs. Okay, but what they say now? Yes, sales at present is 60 lakhs, but what they say, in this 60 lakh may fluctuate next year, it may become 20 lakhs, 40 lakh, 80 lakhs or 100 lakhs. That's what they're asking in the question. 4 different sales is given now. Apo EBIT will change, will remain same, will change. 10% of 20 lakhs is 2 lakhs, 10% of 40 lakhs 4 lakhs, 10% of 80 lakhs 8 lakhs, and so on. Are you all comfortable? See here, that's why EBIT is 10%. In these two options, 2 lakh is the EBIT, 10% of 20 lakhs. 10% of 40 lakhs, 4 lakh, 4 lakh. Debt equity, both EBIT will be same irrespective of the debt capital structure. 80 lakhs EBIT will be 8 lakhs and 8 lakhs. For 100 lakhs also, 10 lakhs and 10 lakhs will be same under debt and equity. Are you all comfortable? Shall I proceed? Next, interest. Interest you need to compute. How you compute interest? Very simple. Debt, fully debt or equity. So fully 2 lakhs will be there. 2 lakhs debt can be raised at 6%. What they are asking? See, the company plans to expand the asset by 50%, means existing, what is the asset base? 20 lakhs. It wants to expand it by 50%, means 10 lakhs additionally it wants to take from finance. Okay, it needs to finance 10 more lakhs. This 10 lakhs, okay, for this, it is coming up with debt issue. Now 6% is the interest rate. I'll just show you what happens. Existing, it has debt of how much? 4 lakhs. For this 4 lakhs, it pays interest at 5%. How much is that? 20,000. That is the existing interest. You already know that. New financing, option is 10 lakhs. For this amount, how much? Okay, I can raise this at 6%. 6% interest to be paid now. So 10 lakh into 6%, 60,000 is the interest amount. Are you all understanding? Under debt option, what is the total interest? 20,000 plus 60,000, 80,000 will be total interest. For equity option, this 10 lakh will be raised entirely through equity. No 60,000 interest will not be paid. Only 20,000 will be paid. Are you all understanding? For any level of sales, total interest will be 80,000 and the interest, okay, will not depend on sales. Agreed. So 80,000 will be the total sales, total interest for debt option. For equity option, 20,000 will be the interest. Now see what happens. 80,000 is the debt option. Equity option, 20,000 is the interest. Now same for 40 lakhs, 80, 20, 80, 20. Like this, it will continue. Next, earnings before tax, you will find out. Then taxes at 35%, you will get the EAT, earnings after tax, divided by number of shares. Number of shares also you need to carefully calculate. Why? Because only two working note will be there in capital structure. One is number of shares, other is the interest calculation. If at all there is preference dividend, you will calculate that also. Like this, 3 working note can be done. Here in EP, see number of shares, how to compute? Very simple. Existing number of shares first, you see for option 1, what is the existing number of shares? If you see the balance sheet, 10 lakh capital, 10, which means 1 lakh is the existing, equity shares. In the debt option, there is no equity is being issued now. So total shares will be, number of shares will be 1 lakh. No change. Are you all understanding? If you want to if you want to raise the new funds through equity option, it will change. So existing 1 lakh shares is there. New amount of how much? 10 lakh is to be raised. This 10 lakh can be raised at what price? 10 lakhs can be raised at what? They have given 33.33 divided by 33.33. How much you are getting? 30,000, 003, rounding of issue. It should be 30,000. Are you all understanding? 33. Okay, if you raise at this point, what is the new number of shares? 30,000 shares. So new 30,000 shares will be issued at what price? 33.33 given in the question itself. So existing 1 lakh share plus 30,000 shares. Total how much? 1 lakh 30,000 shares. Are you all understanding? This will be the total number of shares under equity option. So 1 lakh, 1 lakh 30, 1 lakh, 1 lakh 30, 1 lakh, 1 lakh 30. Debt and equity. For any level of sales, it will be same. So you will find out EPS under a different option. No issue. Next, you will stop with EPS. P ratio given. P ratio given. So you need to compute MPS also. Are you all understanding? Now, P ratio given, what they say, if you use debt option, P ratio will drop to 10. If you use equity, P ratio will be 12. So 10, 12, 10, 12, like this, debt and equity, varying level of sales. Okay, that doesn't change the P ratio, but varying level of debt and equity will give you different, okay, option. Are you all comfortable? Shall I proceed to the next area? Now, MPS, last step. What is the last step? MPS, EPS into 10. So EPS into P ratio. Here also EPS into P ratio. You will get the MPS and highest MPS. The plan which is having highest NPS you will select, which means sales level of 100 lakhs, debt issue, which means here in this question, sir, what is this? Oh, I can't understand the interpretation. Very simple. If you are expecting the company to have 20 lakh sales, then all equity issue is better. If you are expecting the company to earn 40 lakh sales, okay, then also all equity issue is better. If you are expecting your sales to be 80 lakhs, Okay, both alternatives are equal. You can either issue equity, you can either issue debt, but your sales is exceeding 100, which means 100 lakhs is your sales now. Then obviously taking debt will be an ideal option. This they have given here. Any in debt financing, number of equity shares outstanding. Okay, that is working note. The answer will depend on the expected level of sales. Okay, what which plan is better now? It depends on expected level of sales. If sales level is 40 lakhs, equity form of financing should be employed. Sales level of 80 lakhs now, it will be indifferent, and sales of 100 lakhs now, debt financing will be different. You're understanding? Okay, this is all about the chapter. Financing decision. EBA, so we have done leverages segment, then EBIT-EPS analysis segment, then two more segments are there. Okay, separate chapter, cost of capital is there, given a separate chapter, but I will consider as one more segment of the capital, the financing plan. So you have capital, cost of capital, then we will finish with capital structure theories. With this, we will do the financing decision fully. Now we will take up cost of capital, because before discussing the capital structure theories, you need to understand cost of capital. Shall we discuss cost of capital? See here in the notes I have given segment 3 capital structure theories, but anyway we will discuss and then we will come back to capital structure theories. I'll just forward it. Shall we discuss cost of capital? Okay, see. Now, what do you mean by cost of capital? Capital providers expect return for their money. See, business is run by money. So initially you will raise money, then you will invest in assets, then you will generate the profits, then you return back the profits to the fund providers. This is a business cycle. Now what happens? When you raise money, we take money from the capital, it will never be free. Okay, all forms of capital. In our subject, capital means not only equity capital, all forms of capital is included. Now, whenever the fund providers are giving you money, they will expect some return from this fund. Okay, they will not give you money for free. The return, the expected return for the investors, from the investors angle, will give you the cost from the company's angle. Are you all understanding? The expected return, the investors will expect return for the fund provided now. That if expressed in some percentage terms, I call it as cost of capital. Here I have given. See, their expectation of what? Investors' expectation, the capital providers' expectation, which means if the debt providers are giving us 100 lakh capital, okay, assume they are expecting 9%. Now, this 9% will become our cost of capital. Some adjustment have to be done. Anyway, we are going to learn. Are you understanding? So, the investor's expectation, if quantified in percentage terms, is called as cost of capital. Or, to put it simply, it is nothing but a minimum required rate of return the company should earn to service its fund providers. The minimum rate of return the company should earn to service the fund providers. If I take debt, if I take 100 lakh as debt, at least I need to give them 9%. Is called as cost of debt. Are you all understanding? So this is what is cost of capital. Basic understanding. We'll move on. Okay, see, fund can be raised through following 4 sources. Broadly 4 sources. I'm just illustrating. So debt, preference shares, equity, and retained earnings. This is what we are going to learn in this chapter. What is the cost of debt? What is cost of preference shares? How much I need to pay to equity shareholders? What is the cost of equity shares? And then what is the cost of retained earnings? First, in this segment, in this chapter, first segment, what we will do is that how to compute specific cost of capital. Like, how to compute the cost of debt, how to compute cost of equity, how to compute specific cost of capital, cost of preference shares, cost of retained earnings. This we will find out. Thereafter, at the end of the chapter, we'll find out what is the overall cost of the capital of the company, which means the company will only issue debt, preference shares, or equity shares, or it may issue all these instruments, there will be always a mix, right? So we need to find out what is the cost, overall cost of the company, weighted average cost of capital. That we will find out at the end of the discussion. Are you understanding? Now quickly we will move on to cost of debt. Let's discuss cost of debt. See, cost of debt is famously denoted by KD. KD means cost of debt. See, first you need to understand there is a formula. I'll explain the logic of the formula. Then we will do questions. Then we will move on to each and every capital. So first we are discussing cost of debt now. I will explain cost of debt formula and the concept. Thereafter, we will do questions regarding cost of debt. Then we will move to cost of preference shares, questions related to preference shares, then equity related to equity. Like this, we will move on. Last, we will see WACC concept. Shall we? Okay, see. Now, cost of debt. Okay, I can classify this cost of debt into 2. Irredeemable debt. Irredeemable debts cost. Then I will find out redeemable debts cost. What is the redeemable debts cost? See, first, let us take irredeemable debt first. Very simple and straightforward. Interest into 1 minus T divided by net proceeds. Interest into I means interest. Interest into 1 minus T divided by net proceeds. Now, see, if I take borrowings, assume I'm taking borrowing 100 lakhs. Okay. If I'm taking borrowing, I need to pay interest. Now, that interest will be the cost for the company. The interest will be the cost of debt. Are you all understanding? If I raise the funds through borrowing, I have to pay them interest. The interest will be the cost. But sir, I understand I is the cost. What is this 1 minus T? Why is we, taking after tax interest? Why is that? Very simple. Interest will give you tax shield. Interest will give you something called as tax shield or tax benefit. Put it simply, what happens, you need to see 100 lakhs is my EBIT. Assume 100 lakhs is my operating profit. General terms, let us EBIT or operating profit. 100 lakhs I'm earning. Simple terms, the profit I'm earning. Now, if you have 30 lakhs interest, okay, debt, leave it debt percentage and all, leave it 30 lakhs, assume is the interest. If I have interest of 30 lakhs, what will happen? Okay, since the interest in the P&L, you are debiting the interest now. Because of this debit, okay, the profit which you compute after the interest, okay, which, what you compute in the profit after tax, you compute in the P&L, interest you will consider, na? So it will be, deducted to arrive at the profit after tax. What will happen? The 30 lakhs, if you reduce from 100 lakhs before tax profit, net profit comes to 70 lakhs. This only on this 70 lakhs, you need to pay tax. Are you all understanding? So only on 70 lakhs, I need to pay tax, not on 100 lakhs. Agreed? Because why is this happening? Because of the presence of interest in the your capital structure, which means if you pay interest of 30 lakhs, you have to only pay tax on 70 lakhs. About 70 lakhs into, suppose the tax rate is 30%. 70 lakhs into 30%. 2.1 lakhs, or what is that? 21 lakhs, sorry. 21 lakhs. Let's say you will be paying 21 lakhs into 30% is equal to how much? 21 lakhs will be the tax amount. If interest is there, assume no interest is there, what will happen? 100 lakhs is the profit. No interest, you have not borrowed anything. Up 100 lakhs minus 30 lakhs, profit will be, okay, tax you have to pay 30 lakhs. 30 lakhs will be into 30%. 30 lakhs will be the tax. To put it simply, if you have interest, you have to pay. If you don't have interest, see, if you have interest, how much you need to pay tax? 21 lakhs. If you don't have interest, how much you need to pay? 30 lakhs. What is the differential amount? 9 lakhs. You are saving tax now. What is this really 9 lakhs now? Very simple. 30 lakhs is the interest amount. On that tax rate is 30%. 30 lakhs into 30%. 9 lakhs, which is the tax on the interest portion. Okay, you are saving, which means interest is really protecting you, okay, from paying a higher tax. It is giving you a tax shield. Are you all understanding? For the company, if the company is debiting interest on its P&L, real cost is not really interest. Okay, it is saving the tax outflow. Savings of outflow is deemed inflow. Hence, I will pay, assume the company is having interest of 100. 30% tax rate. Now, I pay 100 rupees interest, but I save back 30 rupees. Okay, effectively, I only pay 100 minus 30, 70 rupees, which means my cost should be interest, post-tax interest should be my cost for the company. The cost of capital chapter, the entire chapter you should see from the point of company. Okay, in the final syllabus, we will see chapter called as fixed income security, equity valuation. All that we will see from the angle of the investors, the fund providers. Are you understanding? Here, for the company, the tax benefit is there for whom? If the company Reliance Limited issues a debenture, who will pay the interest? Reliance Limited will pay the interest. For Reliance Limited P&L, if you see, interest will be giving the tax shield. Are you all understanding? So interest into 1 minus T divided by net proceeds. So I understand that what interest into 1 minus T. What is this net proceeds? Net proceeds is very simple. You see, net proceeds is the net amount the company will be receiving after the issue. Very simple. The company's face value, the share. See, 1 second, I'll use this to illustrate here. Now we are going to discuss what is the net proceeds. See, here, if you see that the company issue, the face value of the share, the company is issuing new share. Now the face value is 100. And the company is issuing this at 10% discount, which means 90 rupees it will issue at. Correct? Apart from that, when you go to the listing, in the market, it has to pay something called as flotation charges, flotation cost, brokerage cost, issue related expenses. I call it as issue related expenses. That will applied on the amount raised, which means 90 rupees you are raising. Now, on that 90, you will apply the flotation cost. Assume the flotation cost may be given in rupees terms or may be given in percentage. Assume it is given as rupee, it is given as 10 rupee. So 10 rupee, now 90 minus 10, 80 will be the net proceeds the company will be receiving. The company will be receiving net cash of 80 rupees. Even though it has face value of 100, 10% discount, now 90 rupees. From this discounted price, you need to again reduce the flotation cost. Are you all understanding? Case number 1. Case 2, assume the company face value is same as 100. Company issues for a premium of 10 rupees, which means plus premium. Premium means you should add the premium. Are you all understanding? So how much will be the net amount? 110. The issue price will be 110. Okay, it will issue. And again, here flotation cost will be there. You will be applying this flotation cost to 110 or 100. If given in percentage terms, you should always apply you should always apply on 110. Are you all understanding? Apply on 110. Say 2% is the flotation cost. What you should do? 2% into 110. Okay, how much is that? 2.2. Are you all understanding? This is again cost. So company will be receiving net of cost 110 minus 2.2. How much is that? 107.8. Are you all understanding? This will become the net proceeds. All this I have given notes. Don't worry. Everything I have given. Okay, see here. Can you see this? See, this is the formula. Here I have explained. Below that, here I have explained here. N is a maturity value. Okay, this is fine. NP, net proceeds, okay, is nothing but face value minus discount. If the share is being issued at discount, you will reduce the discount. If it is for premium, now add the premium. Then reduce the flotation cost. Flotation cost in rupees, no issue. You reduce from 90 or reduce from 100, you will get the ultimately same amount. But the issue arises when the flotation cost is given in percentage terms. Every adjustment I have given you as notes. Okay, flotation cost is given in percentage terms should apply on value arrived at after deducting discount or adding premium and not on the face value alone. The flotation cost must be applied on the if given in percentage terms, must be applied on net amount and not the total cost. Are you understanding? Face value you should not apply. If see whether there is any discount or premium. If it is issued at face value, then apply on the face value. Else, you consider this. Are you all understanding this? Point number 1. Point number 2, okay, if market price is given on the debenture, if market price is given and all the other details are given now, okay, market price is superior, that should be considered as issue price. Point number 1. Apart from that, the flotation cost is there, brokerage cost or flotation cost, that should be applied on the market price. That should be applied from the market price to arrive at the net proceeds. Are you all comfortable? So 2 points are there. First, point number 1, flotation cost given. What you should do? Generally, you should adjust the discount or premium. Thereafter, you will apply it on adjusted number. Okay, if given in percentage terms. If market price is given, always market price you should consider that is the superior. We have a question. I'll show you. From that, there only you should apply the adjust the flotation cost. Are you all understanding? Now, this is about convertible debt. I'll come back to convertible debt later. See here. Now, this is all about irredeemable debt. Shall we move on to cost of capital redeemable debt? What is the formula for irredeemable debt? I into 1 minus T divided by net proceeds. The net proceeds, I into 1 minus T, everything will remain same. For redeemable debt, only changes. There is formula. Okay, you need to remember. Okay, this is also approximate method of redeemable debt. Accurate method is nothing but IRR method you need to use. Okay, you need to equate bond in cash inflows to outflows. At what rate it is equal interpolation method you will use find out IRR, which you use in capital budgeting IRR. Ditto same. But okay, IRR method is fine. But generally redeemable debt you use the approximate method only. Nowhere they have used IRR and found out. Even for finding WACC they have used only approximate method. Right. What is the formula? I into 1 minus T plus RV minus NP divided by N, the whole divided by RV plus NP divided by 2. Sir, why is this big formula for redeemable debt? Why is not for irredeemable debt? Very simple. Irredeemable debt, the debt whereby the capital will not be redeemed is called as, where the capital will not be redeemed, that type of debt is called as irredeemable debt. Redeemable debt, where the company will redeem the capital, which means it will be issued, okay, And apart from interest, the company will also pay the capital portion, which means when there is irredeemable debt, the company will have to pay interest fine. But apart from that, capital gain or loss will also be there for the investors. Are you all understanding? Which means it will be net proceeds will be initially while issuing it. Okay, it will be issued at net proceeds. Thereafter, the company will be redemption value will be there. Na company will redeem na the differential amount. Okay, is called as capital gain or loss. Assume initially issued at face value on par, no flotation cost, issued at 100 par. Redemption at 110, which means there will be capital gain or loss. For the investor, it will be gain. Okay, for the company, it will be loss. Yeah, it is, you see, it is getting 100 rupees while getting the capital, raising the capital, but it needs to pay 110, which means higher rate it needs to pay. Yeah, this is okay. Anyway, there, so capital loss will be there for the company. Are you all understanding? Assume the net proceeds is 110, company issues at premium, and redemption value is a discount, then also capital loss. Company assume, third case, like company assume it is issuing at discount and redeeming at premium. Are you all understanding? Okay. Now, all the scenarios possible. If there is capital gain for the investor, then it will be capital loss for the company. If there is capital loss for the investors, which means capital gain for the company. Are you all understanding? It means issued at par, redeemed at discount, capital gain for the company. It needs to pay lesser amount. Na? This RV minus NP. RV means redemption value minus NP, na, net proceeds, already you studied. This differential amount is capital gain or loss. But this gain or loss, okay, in redeemable preference shares will be happening for only 1 year. For many years, which means the term of the debt you should consider. Na, this capital gain is earned only for 1 year over a period of time, over a period of maturity of the debt. So that is why you should divide it. You should amortize. This is nothing but amortized capital gain. This portion is what? Amortized capital gain. RV minus NP divided by N. Okay, interest plus 1 minus T plus RV minus NP divided by N. The whole divided by average price, which is nothing but redemption value plus net proceeds divided by 2. Simple average they have taken. Okay, you will get the approximate value. Are you all understanding? Deep understanding, you will understand the fixed income security chapter of the CMA final or CA final. There you will understand. Now see, here I have given clearly approximate method. Use IRR method to do interpolation, get the exact value. Anyway, if only asked in question you need to do, otherwise approximate method is sufficient. N, RV and net proceeds, everything we have discussed. Flotation calls also discuss. Can we move on to convertible debt? Okay, I'll just discuss this convertible debt. Then we will discuss two or three questions regarding cost of debt, and we'll move on to cost of preference shares. Shall we see? What do you mean by convertible debt? See, there are three instruments in the market. One is equity shares. Then there is pure debt. I call it as pure debt without having conversion option. Then there is convertible debt. Convertible debt are those instruments, okay, while issuing it will be convertible bonds or debentures, but later on it will give an option for the bondholders to convert it into equity shares. Are you all understanding? What may happen? It's something, okay, it is an option, embedded option. So it is something similar to your ESOP. Have you all seen the ESOP? Okay, company will provide the ESOP, which means the share you can exercise it and later convert into equity shares and realize the value. Are you all understanding? So the option, it will be given to exercise, to convert. Convertible bond, generally the debt will be issued with a conversion option. Now here, what is the issue? Now I'll tell you what will happen. When convertible bond regarding question is given, okay, issue price will be the net proceeds. While issuing, they will be issuing at market price. Whatever market price of the convertible bond will be the net proceeds. That is not an issue. Net proceeds is not the issue. They will give in the question. But the problem is redemption value. Sir, what I should take as redemption? What is the formula for redeemable bond? It is like redeemable debenture only. Convertible redeemable debenture. See, it should be treated on par with redeemable debentures. Why? Because it is ultimately getting converted or it is getting redeemed. If you don't convert, you will get redeemed. It will not be infinite years, right? You should either convert it or you can get it redeemed as bond itself. Two options possible. Now, what they say, even if you get it converted, okay, redemption value you should take as equity shares value. Okay, conversion value. I call it as conversion value. Very simple terms, I'll explain. See, net proceeds, assume 100 rupees the bond is being issued. Okay, 100 rupees bond is being issued. Okay. For every one bond, 2 shares are being issued. For every one bond, 2 shares are being issued. At present, the share price is 40 rupees. At present, the share price is 40 rupees. So what is the, if you convert today, you will get only, shares value will be only 80 worth. 2 shares into 80, 2 shares into 40, value will be 80. A bond value is 100. I will not convert today. I'm better to hold the bond itself. But what will happen? After 3 years, the share price is, they will give you adjustment, like share price is expected to be 120. One share's value is expected to be 120. In that case, one share's value is 120. You tell me, children, what will be the value of 2 shares into 2 is equal to 240, na? Which means today bond value is 100. If you convert it, you will get after 3 years 240. Will you convert? Yes, I will convert. Yes, I will convert, na? Therefore, what this is called as conversion value. What is 240 called as? Conversion value. Conversion value is nothing but, okay, expected share price into, this is after 3 years only you will convert, na? So expected share price into number of shares per bond, number of shares per debenture is called as total conversion value. If this conversion value, okay, is more than cash value means, okay, if you don't convert, if that is the value of the debenture, which means if no conversion option is exercised, debenture will be redeemed at 100 rupees, debenture will be redeemed at par. If suppose that is given, which means you tell me, friends, in case of convertible debt, conversion value is more than cash value? Yes. If conversion value more than cash value, the investor will convert, will not convert, will be converting. Upper redemption value will be the conversion value. I will replace the redemption value. RV formula is there, na? I will replace it with conversion value. Simply I will replace it. See here, what is the formula? Upper C. Then see here I have given here. Don't worry, here I have given. Then it means it will be converted by the share debt holders, and hence conversion value should be taken as redemption value. We are going to see the question. Just remember these adjustments. I'll show you how I discuss this relevant. Are you all understanding? So simple here. Wherever redemption value given and no convertible bond, plain bond, then use as such redemption value, use it. But wherever convertible bond is question is being asked, there calculate the conversion value and check whether the maturity date that on the maturity date the conversion value is more than cash value. Convert it. Okay, the bondholders are expected to convert, na? But the conversion value will become the redemption value. Replace it with redemption value. Then it means it will be converted. Hence, conversion value should be the redemption value. Conversion, what is that? Okay, conversion value. What is the conversion value? Number of equity shares for each debenture. In our case, 2 shares. For every one debenture, 2 shares will be issued. I showed you example, na? Next, into expected share price at maturity. That is 120. Not today. When you are going to convert on the date of maturity, okay, there will be some exercise, vesting period. Just like in your ESOP, you have vesting period, na? Like that you will be, okay, only converting after a few years. On that date, what is the expected price? Today's share price you should not consider. The 40 rupees is wrong. Are you all understanding? You should take this much amount. Are you all having the clarity? Shall I move on? Okay. Next, see, cost of preference shares we will learn. Anyway, we will do questions regarding convertible bond, regarding debentures. Okay, see. Now, first we will discuss the irredeemable debentures, then we will move on to redeemable debentures. Shall we? Now we will discuss the illustrations here. Illustration number 2. 5 years ago, KPM Limited issued 12% irredeemable debentures of 105, a 5 premium to their par value of 100. The current market price of these debentures is 95. Okay, if the company pays corporate tax at the rate of 35 percentage, what is its current cost of debenture capital? Are you all understanding? Now, this is the question that is being asked. Now, tell me, children, first, market price is given or not given? Yes, market price is given. So, when market price is given, while computing the net proceeds, flotation cost given? Not given. So, you see, irredeemable debentures at 105, 5% premium to the, see, 105 is the issue price, 5 rupees premium they have issued. This is the issue price. But net proceeds, you have to take 105 if no market price is given. But when market price of 95 is given, what you should be taking? 95 you will take. Are you all understanding? Already I told you. This is about net profit. So what is the interest? 12% is the interest. See, In the 12% you apply on face value. Interest will always be applied on face value. It doesn't matter at what market price you raise the capital. Interest you should pay. The company should pay interest, 12% interest. At what rate? Face value of 100, which means 12 rupees you need to pay interest. Are you all understanding? So 12 rupees with the interest, 1 minus T, now 1 minus 0.35, 35% is the tax rate, divided by net proceeds, 95. If you solve this, you will get 8.1%. Are you all comfortable? Okay, I assume that there are so many questions in which the answer is wrong, which means that sometimes the question computation is wrong, sometimes interpretation is wrong. So many mistakes I have come across. So I am just on the face value, I'm taking the number and discussing, because I don't have time to verify each and every question here. But when I conducted regular batch using the material, I came across a lot of mistakes you need to change. Okay, so this is 8 point, the computation at all, you need to verify and tell me whether it is same. Okay, 8.21, I assume it is correct. Next, take this question, redeemable debentures. This question about redeemable debentures. Okay, that one was redeemable. This is redeemable. ABC Limited issued 5,000, okay, 12% debentures at 100 each. This is the face value. If you say 100 each, it means that its par value is 100. Face value. Each at premium of 10%. 100 premium of 10% na 110, agreed. And on 1/4/2018 to be matured on 1/4/2023, which means okay, 18, 19, 20, 21, 22, 23. 5 years is the maturity period. The N is equal to 5 years. That you need to remember. The debentures will be redeemed on maturity. Okay, redeemable debenture. Compute the cost of debentures. Assume 35% tax rate. Very simple na. Interest into 1 minus T. Interest take as 12%. Okay, 12 into 1 minus 0.35 plus RV. What is the redemption value? See, if question doesn't mention anything about redemption value, in this question, if you see, is there anything mentioned about redemption value? Not mentioned. If nothing is mentioned, redemption value, you will always assume to be par. It is, the instrument is redeemed at par, which means 100 is the redemption value. 100 minus, what is the issue price? 110. Net proceeds will become 110 because no flotation cost and no market price is also given. 110 will be taken. So 100 minus 110, which means for company there is a capital loss. Why? Because issued at 110, being company for company, it will be, what is that? Yes, see, the company will have to pay additional. What is the company doing now? Initially, it will take 100, which means it will receive 100. But while redeeming, it will receive, sorry, 110. It will receive 110 while paying. What is the redemption value? What is the redemption value? Only 100. Are you all understanding? Only 100 is the redemption value. Correct? Yes. So redemption value is 100. Here what happens? RV minus SV divided by what? N. N is how much? 5 years. See, tell me what happens. 100 minus 110, minus 10. Correct? But this is over a period of N. Number of years is how much? 5. So minus 2. This number minus 2. 12 into, see, 12 into 5%. That's 7.8 minus 2. 5.8. Okay, then you have 5.8 divided by 105. Are you all understanding? 100 plus 110 divided by 2. If you do, average price is 105. So 5.8 divided by 105, you will get 5.52%. Here, see, the basic observation is that in this case, what happens? Interest, the company has to pay the cost. Okay, from the company's angle, the interest will become the cost. But here there is, company is making a capital gain. Company is making a capital gain. The capital gain is reducing the interest cost. That is why you need to see here. If you see the 12 rupees into 1 minus 0.35, this is the interest portion. Correct? This is 7.8. Correct? Minus 100 into 100 minus 110 is minus 10. Okay, this is not, yes, minus 10. This is plus. Okay. So the plus minus becomes minus. So divided by N5. So 7.8 minus 2. This minus 2 is the amortized capital gain. Okay, the capital gain for the company, it is being reduced from the cost. Are you understanding? If the investor, for investor, this 7.8 become the income and the 2 rupees is the capital gain or loss, because investor initially invested how much? 110 rupees, but he is getting back how much? Only 100 rupees. Are you all understanding? So this is all about all the angles I have discussed. Formula, simply you can apply and find out the solution. Are you all understanding? If you are getting confused, don't worry, just apply the formula, you'll get the cost of redeemable debt. Next, illustration number 6. I have given one more question. Why I have given? Maybe convertible debt. Let us see. Okay. Okay. Rima & Co has issued 12% debenture of face value of 100 for 10 lakhs. the debenture is expected to be sold at 5% discount. It will also involve a flotation cost 5 per debenture. See, in this question, luckily you have flotation cost in rupees and not in percentage terms. But I really wanted a question which asks you in percentage. This percentage should be applied on the net amount, which means 100 is the face value, 5% discount, now minus 5, 95 will be the discounted price. From here, suppose 3% is the flotation cost. Now, the 3% should be applied on 95 and not on 100. Are you all understanding? But luckily in this question, 5 rupees is given. So, flotation cost, reduce it, 5 rupees. Net proceeds is how much? 90 rupees is the net proceeds. For computing the net proceeds, I have given one more thing. The debentures are redeemable at a premium of 5% after 10 years, which means 105 is the redemption value. See here, I have given. Okay, redemption value is 105 because 5% of 100 plus 5%. Then net proceeds becomes 5% of 100, 95 minus 5, 90 per debenture. Are you all having the clarity? This just given you for understanding. Last illustration, which is regarding convertible debt. Very, very important understand. Now, see, RR Limited issued 10,000 12% debentures of 100 each with a maturity period of 5 years. At maturity, the debenture holders will have the option to convert the debentures into equity shares of the company in the ratio 1:10, which means for one bond or debenture, for every one debt instrument, 10 equity shares are being issued. So that is 1:10. The current market price of the equity shares is 14 each, and historically, the growth rate of the shares are 5% per annum. Compute the cost of debentures assuming 35% stock tax. See, there are a few adjustments involved. One by one, we will try to understand. What is the cash value of debenture? Debenture is issued for 100, which means if nothing, if you don't convert this into equity shares, ultimately you will be getting this redemption value of 100. The company will pay you 100, right? But if you convert, this is called as cash value of debentures, which is 100. Okay. Now, you need to, verify with the conversion option. Agreed? If conversion value is more than the cash price, which means the investor will convert the debentures at the end of the maturity period, right? So what is the conversion value? I need to see first for one debenture, how many shares are being issued? 10 shares are being issued. Now the 10 shares into share price you need to take. The share price you need to find out. See, conversion value. What is the conversion value? Conversion ratio into share price. For every one bond or debenture, how many shares are being issued? 10 shares into share price. But this share price should be today's share price or maturity date share price. Maturity date share price, which means you don't know what will be the share price today, but they have given the growth rate. This is the important adjustment. See what they have given. Current market price of the share. Can you see this? I check it with highlighter. 1 second. I just see. This is highlighter. Yes, this is the highlighter. Once just increase the too big. The current price of equity shares is 14 each given. So which means 14 each is the current price means. Now I need to take the share price at maturity, not the current price. So what is the share price? What is the price of the share which should prevail at the end of the maturity period? We need to find out. For that only they have given 5% growth rate, which means what is the maturity period? 5 years. So today share price is 14 into, you need to compound it at the rate of 5%. Okay, present value to future value we need to take. So future value should be present value 1 plus r raised to the power n, 1 plus 0.05 raised to the power 5. Are you all understanding? So 14 into 1.05 raised to the power 5, you will get 17.868. 17 share price as 17.868 into 10. This will give you the conversion value. This 178.68 is the conversion value, is greater than the what is that plain value which is that cash value. So conversion value is more than cash value. Investor will be expected to convert the debt into bond into debenture into equity shares. So 178.68 will be your redemption value. Moral of the story 178.68 will be the redemption value. Okay, apply the formula. All the other things will remain same. Interest into 1 minus t. Okay, 12% interest is given in the question. Yes, 12% convertible debt is given. So interest into 1 minus t. plus RV minus SV. Redemption value will be 178.68 minus, okay, net proceeds is 100 because initially you raised it at 100 divided by N, the whole divided by RV plus NP, net proceeds divided by 2. You will get 16.89 as cost of debt. All comfortable? Okay, next we will discuss the preference share and then we do illustration number 9. Okay, see how to find out cost of preference shares. Same way, cost of preference shares, okay, you need to find out cost of irredeemable preference shares, cost of redeemable preference shares. Same way you found out the cost of debt and preference, cost of irredeemable debt as well as redeemable debt. Here also in preference shares also you have cost of irredeemable preference shares, cost of redeemable preference shares. But in each of the two types of preference shares, you have without dividend tax and dividend tax. See, what is this with tax and without tax? I'll explain briefly. See, this is irredeemable. First, let us discuss irredeemable preference shares. Here also, if no dividend tax is involved, what is this dividend tax? This is dividend distribution tax, which is actually abolished in your Income Tax Act, which already abolished in the Finance Act 2020 or 21. It was gone. It is nowhere there in current, IT Act, but it was earlier there. Hence, your study material, finance study material, they have not updated this issue. They are still considering the dividend distribution tax. Actually, it is outdated provision. Okay, dividend distribution tax is not at all there, but still they have shown you computation without dividend how to compute the cost of preference shares, and with dividend how to compute cost of preference shares. Let us compute. See, irredeemable preference shares, if there is no preference tax, if there is no preference dividend tax, which means, see, what is this now? Very simple. The DDT, dividend distribution tax, earlier when the company issues a preference shares, okay, when the company pays a preference dividend, it needs to pay something called as DDT on the dividends, preference, okay, dividend distribution tax on dividends. Hence, what will happen? This dividend tax is there, na? The tax will also be included. This will be additional charge, which means company has to pay dividend. Apart from dividend, it also has to pay the tax. It has two obligations: one to pay dividend and to pay tax. So tax effect also should be effectively the cost. See, why tax it has to pay? Only because it pays dividend, na? So effectively, the cost of preference shares should also include the tax effect. Should also include the tax amount. That is what is, okay, will happen. For company, it will be additional cost. The tax will be additional cost, increasing the cost. No. Now, no dividend tax. If no tax is there, what you should do? Preference dividend divided by net proceeds. Preference dividend divided by net proceeds. No other adjustment. Sir, in case of debt, I did I into 1 minus t divided by net proceeds. Fine, net proceeds denominator is same, but numerator I into 1 minus t is vanished. Why it is? Na? Very simple. Yeah. Preference dividend, if company pays preference dividend, there will be no tax shield. Tax shield is only available for debt. See, the preference dividend is a after tax number. Okay, in the income statement, you will be paid, it will be paid out of the profits, which is derived after tax, before tax. It will be paid out of the profits after considering the tax effect, not before considering the tax effect. Are you all understanding? So preference dividend is just an appropriation. It's just an appropriation and not the charge. It is not a charge to the P&L. Are you all understanding? It will not reduce the tax effect. So preference dividend, no tax effect, divided by net proceeds. Irredeemable preference shares, when no tax is involved. When tax is there, what you should do? Preference dividend is there, you should compound it, the tax amount. You should compound it. You should additionally add the tax effect to the dividend, which means apart from dividend, you should add the tax effect also. Very simple. Now what happens? I'll discuss a question also, will be clear. Very simple. I'll give you an example. The dividend tax is a complicated. See, I'll give you what happens now in the company. Tax rate will be there. Assume it is 30%. Okay, surcharge will be there, which will be paid on top of the tax. The health and education cess, okay, education cess will be there. The cess will be paid on tax plus surcharge. Are you all understanding what I'm trying to say? Okay, correct. So very simple, which means effectively what happens, there is 3 tax involved, na? Everything will be getting compounded. So let's take for an example, 100 rupees is the preference dividend you paid out. Now the tax effect, how much you will pay tax? You will pay 30 rupees, you will pay the tax. Surcharge you will pay, na? How much you will pay surcharge? Surcharge will be applied on tax. Assume 10%, na? 3 rupees surcharge you will pay. Agreed. Apart from that, health and education cess you will pay, na? 4%. On what you will pay? Tax and surcharge you need to pay. So 33 into 4%, assume 33 into 4%, assume what is that? 1.32. Health and education says 1.32%, assume it is 4%, 1.32 rupees. So total comes to how much? 134.32 rupees. Are you all understanding what is happening? So this is the preference dividend, this is the tax effect. This tax effect, instead of applying everything, each and everything separately, you can cumulatively apply all the tax. You can club it, all the tax effect you can club. How you should club? Already income tax you would have studied, but still I'm just explaining. 30% is there, na? Take 30%. Okay, what is the tax rate? You take 30 or 50, whatever is the tax rate. Into surcharge you will apply on this 30 on top of it, right? So into 110%, compound it with 10%. Then education says you will apply on both of these numbers, I compound it into 104%. Okay, you will apply. Are you understanding? If this is the base plus 4% on tax plus surcharge, so 30 into 110% into 104%, you will get 34.32%. This you can directly apply to 100 rupees preference dividend. Up 100 rupees, if you apply 34.32, okay, add it, how much you will get? 134.32. That is what we have got here. Are you all understanding what is happening? So here in the formula, what is the formula for irredeemable preference shares cost of capital when tax effect is given, when tax rate is given? Preference dividend into 1 plus dt. dt means, okay, the dividend distribution tax. Okay, that tax will include all the tax, which means tax plus surcharge plus education institute, education, health and education. So see, so dt means here what I should take, which rate I should take, 30% or 10% or 4% or 34.32%, 34.32%. So 1 plus 0.3432, okay, 1.3432 into preference dividend, 100 into 1, okay, 134.32 will get divided by net proceeds. If you do, you'll arrive at the cost of preference shares with tax. Are you all understanding? Now question answer will do at that time, you will have absolute clarity. Anyway, we will proceed to redeemable preference shares, then we will discuss the question answer. Okay, see, redeemable preference shares also has two things: no tax, without tax, and with tax. Without tax, again, you already know that without tax, you will add a tax effect. You will not at all add tax effect. You will not add tax effect. Simply redeemable debentures was there, formula for redeemable debentures, something similar to that. Preference dividend 1 minus t I will not be having. Why? Because no tax effect. No tax benefit from the preference dividend. So PD plus RV minus NP divided by N, the whole divided by RV plus NP divided by 2. Everything will be same. Only 1 minus T is not there. Logic also I explained. 1 minus T you will include in case of debt because it will give you tax shield. Here there is no tax shield for preference shares, so no 1 minus T. Next, with the tax, now what you should do? Preference dividend 1 plus tax. Here you will add. Are you all understanding where you should add the tax effect? Preference dividend is there, this amount should be compounded with the tax effect. Balance, all the thing will be same. All the remaining things will be same, which means RV minus NP divided by RV minus NP divided by N, the whole divided by RV plus NP divided by 2. All the things will remain same except for the tax effect. So preference dividend wherever is there, you should add 1 plus T. Don't mistake this. This is not, see, this is DT or the dividend distribution tax effect. Are you all comfortable that you should do? Now we will do one question, two questions regarding this, I believe. See, illustration number 9 is there, then illustration number 10 is there. Thereafter we'll move on to equity cost. Okay, now see illustration number 9. BP Limited issued 60,000 12% redeemable preference shares of 100 each at a premium of 5 each. Redeemable after 10 years at a premium of 10 each. So redeemable after 10 years at a premium of 10 each. Again, issued at 105. This is net proceeds will be 105. Flotation cost is there, of course. So you will reduce the 3 rupees given in rupees. So reduce it. 102 is the net proceeds today. Then redemption value. What is the redemption value? Redemption value is 100, but redeemed at premium, which means 10. 110 will be the redemption value. Are you all comfortable? So let us try to do this calculation of cost of preference shares. Preference dividend is 100 into 60,000 shares into 12. See, there are two ways of solving. Either you compute on the total basis, they have computed preference dividend. This is not at all required in my opinion. In my opinion, okay, whatever cost you compute on per share basis, it will be ditto same for overall cost of overall cost. Are you all understanding? Which means if you compute the total preference dividend and apply it in the formula, you will get the same value. So which means ideally For every 100 rupees, see, you already know that preference dividend rate, just like your interest, will be applied on what? On the face value. On the face value, now 100 will be the face value. Now you will apply this 12% on 100, which means 12, okay, is the preference dividend rate. Agreed? Are you all understanding? So this rate directly you can take as 12% preference dividend rate. You don't need to compute what is the real preference dividend. 12 into face value of the preference dividend, number of preference shares issued, total comes to 7,20,000. Okay, I will explain why it is like this. 12 you will apply here with tax or without tax. Ignoring dividend tax. Okay, ignoring dividend tax. So 12 plus, okay, this is redeemable preference share. So RV minus NP, all the thing I will consider. Redemption value, what is the redemption value? I have already considered here. What is that? 110. 110 minus net proceeds, how much? 102 divided by N. Okay, N is 5 years, or what is the 10 years? So it is even for simple. Divided by 110 plus 102. What is that? 110 plus 102. How much is that? 212. Okay. 212 divided by 2, 106. So 212 divided by 2, 106. So 12 plus, this is the number we are getting. So let's say 110, 8 by 10. What is that? 0.8. So 12.8 I'm getting as 12.8 divided by 106. Please do 12.8 divided by 106. Are you all getting 12.08? Yes, I am getting 12.08. Same number, 12.08. What I did versus what institute shows you, both are one and same. I am saying, are you all comfortable? Why? See what they do. They have computed total preference dividend. 100 is the face value of dividend into 60,000 preference shares issued into 12% preference dividend. Total preference dividend comes to 7,20,000. Flotation cost also for one share. We see. You can either solve by solve by using the numbers which is applicable for one number of share, one share, single share, or you can multiply it 60,000, get every number converted to 60,000 shares. Okay. Now, for example, flotation cost is there for per share is 3 rupees. So 60,000 shares. Now, what is the total flotation cost? 1,80,000. Total net proceeds what? 105 into 60,000. Okay, minus total flotation cost of 1,80,000, you will get 61,000. 61 lakhs 20,000. This 61 lakhs 20,000 na, if you divide it by 60,000, you will get 102. This is nothing but net proceeds per share. Are you all comfortable? Okay, redemption value 66 lakhs divided by this, you will get 110. Okay, you can either do it per share basis or on a total basis. Cost of, okay, they have done on total basis. They have found out the same 12.08%. You can go through. Okay, you will get the same number. I have shown you on a per share basis. You will get the same number. Next. And some students ask me doubt regarding the same issue. Even total basis I have to do, but never do some adjustments regarding taking total value, then some regarding taking per share on a per share basis. You should not do that. For example, I'll show you total preference dividend. You take a 7,20,000, and you should not take. Okay, let me take the flotation cost per share. That you should not either do entire thing using 60,000 shares, or on a per share basis you compute the all of these things. Okay. Now, next illustration number 10. YCO Limited issues 10,000 12% preference shares of 100 each at a premium of 10%, but redeemable at a premium of 20% after 5 years. The company pays underwriting commission of 5%. Okay, very good question, because at last we have found out a question where they have asked you the brokerage cost or underwriting issue related expenses in percentage terms, flotation cost in percentage terms. Now, if tax on dividend is given 12.5%, surcharge is 2.5%, education cess is 3%, calculate the preference shares capital with tax. So this is redeemable preference shares with tax. Very good question. Mark it as important. This always you should practice the day before examination. Okay. Now, how to compute? Very simple. You have preference dividend. Preference dividend, total, we will do it in per share basis. Simply we will get the answer why we should do the total basis. Now, so preference dividend rate is what? 12%. So simply take 12 plus, okay, 12. Okay, you have tax now. With tax now, what you should do? Okay, you should multiply it with 1 minus t. 1 plus t. 1 plus dt. Now, 1 plus dt. Now, what is the tax rate? Tax rate is 10% is the, what is that? If tax on dividend 12.5%, 12.5% is the tax. What I told you to compound. Can you take 12.5% of DT a 0.125? No, you should not take. This is just a tax. Apart from that, surcharge is there. Into how much surcharge? 2.5. 2 point. Now, how to compound it? 1 or 2.5%. I told you now, this will be 100. On this 2.5%, now 1 or 2.5% into education cess is 3%. Now 1 or 3%. Are you all So let me compute 12.5 into, see this you should not write percentage, this is 12.5, even though in percentage you are computing total, not 12.5 into 102.5% into 103. How much is that? 13.186968. 13.98 percentage. Okay, I'm getting a now 12 into 1 plus t na 1.1319. Okay, 13196 plus RV minus NP, that you already know. Redemption value. What is the redemption value? Tell me. Redeemable at a premium of 20% after 5 years. 120%. What is the premium? See, so very simple. Now, first issue here, we will first find out net proceeds. Net proceeds, what is the net? 100 is the face value. Face value is 100. Next step, what? Premium at 10%, add premium. I told you, if premium add, discount reduce. What is the premium? 10%, 10 rupees. Agreed? 10% should be applied on face value. This you got 110. Now you should add or reduce the flotation cost. Flotation cost you should reduce. Correct. Now, this flotation cost you will, okay, what you should do? Tell me. You should reduce. You will apply the 5% on 110, 100. This is the important adjustment. You should apply on 110 and not 100. Are you understanding? So 110 into 5%. How much is that? 5.5. This is the flotation cost. You reduce it. You're getting 104.5. Are you all getting net proceeds as 104.5? Okay, what they have done? Yes, 104.5. Are you all understanding net proceeds? Now, redemption value, again, we need to compute. How much is that? Okay, redeemable at a premium of 20%. That's simply straightforward. 100 face value, premium 20%. Okay, how much is that? 20 rupees. 120 is the redemption value. RV minus SV. Now, 120 minus 104.5 divided by 120 plus 105.5. If you apply the formula, here they have done. Are you all seeing? 0.193. See here, 13.1969. Whatever we computed there, 1968, rounding of 69, they have rounded off. No issue. That is the same. Are you all comfortable? 14.86% is the cost of preference share. Shall we move on to the cost of equity? Yeah. Now we will learn cost of equity. Now we will discuss cost of equity. See, the cost of equity, we have different models to find out the K. That is the peculiarity here. So first, let us discuss constant earnings model. What is this constant earnings model? See, first, all these KE formulas are derived actually from the valuation formula. For example, if you want to value an equity share, what is the value of equity share? This is written as MPS, okay, or simply V0. MPS or V0, value of the share is nothing but present value of the future cash flows. Value of any asset as per discounted cash flow method is nothing but present value of future cash flows. What is the, see, if you are buying equity shares, what is the benefit derived from equity shares? Okay, you are going to receive dividend and you are going to receive share appreciation. Okay, this is, see, for if you keep on holding the shares for 20 years, whatever dividend you receive, this is the cash flow, okay, received from the shares. Or say earnings or dividend, there are different models. So let us take earnings model first. So if you are taking earnings model, earnings means net profit. So if you own shares of the company, ownership rights, it will give you ownership rights. If you buy the shares of the company, okay, suppose you are buying Reliance Limited shares. What will be the benefit derived from the share? What is the value of the share? The value of the share is nothing but the net profits or earnings, okay, which is earned by the company for the next foreseeable future. Okay, present value of perpetual cash flow here we will use because, okay, equity instrument is a perpetual instrument because you, okay, till the closure of the company, the cash flows will continue and you never know now. So assumption is that perpetual, it is nothing but perpetual cash flow. We will call equity as perpetual instrument. So present value of future cash flows. Now, future cash flows is what earnings assume here. In this case, future benefits. Benefits means earnings. Earnings model, the any benefits will be earnings. So present value of future EPS divided by KE, discounted at cost of equity, required rate of return of the investor. So value of any asset is nothing but present value of the future cash flows discounted at required rate of return of the investors. Here I am investing in equity shares or bond, equity shares, debenture or equity shares, equity shares. When you discount the equity cash flows, you should take discounting rate as KE. Okay, very simple. The perpetual cash flow, time value of money, simple concept only. Present value of perpetual cash flow is what? Cash flow divided by R. This cash flow is nothing but earnings. If you buy ownership in the business, Okay, what will you earn? EPS you will earn. That is the numerator, and denominator you will discount it using KE, the R, okay, rate of return, required rate of return of the equity holders. You should discount the equity cash flows. So cash flow divided by R is nothing. So that only, okay, became EPS divided by KE. Are you all understanding? So fair market price, this is MPS, na? Fair market price is equal to EPS by KE. Hence, the KE is equal to what? EPS divided by MPS. Are you all understanding? This is what is constant earnings model. KE as per constant earnings model, okay, is nothing but EPS divided by MPS. We already know that, okay. See, in the remarks I have given here, we already know that P ratio is equal to MPS by EPS. P ratio is equal to MPS by EPS. Hence, okay, here it is EPS by MPS, right? So it is 1 by P ratio. Are you understanding? So KE can also be found out like 1 by P ratio. Two formulas are there, EPS divided by MPS. Okay, P ratio, what is the connection between P ratio and KE? Okay, if KE given in the question, you should assume that P ratio is nothing but 1 by KE, or okay, K is equal to 1 by P ratio. Are you all comfortable? Next, constant constant dividend model. Next model is what? Constant dividend model. Okay, one, I'll just, what is this constant dividend model? Na? See, very simple. I told you present value of future cash flows. Present value of future cash. What is value of any asset? Value of any asset is nothing but present value of future cash flows. What is present value of future benefits derived at discounted at required rate of return? Now, I told you in the earnings model, what they did, they took earnings as the net profit as the benefit derived from the shares. Okay. Now, there is another way to compute the benefit, that is dividend based model. In dividend based model, what they say, see, anyway, earnings is going to be distributed. So current earnings, if you earn today 100 rupees, now company will distribute anyway in the coming years, it will be distributed as profit. Agreed. So when you value using dividend is the benefit derived from the business. So what you should say, what they do now, value of business is equal to value of equity shares is equal to, I should say, present value of future dividend divided by KE, which means this constant dividend model. This is also called as constant dividend model. Okay, future cash flows I consider as dividend. Dividend I discount using KE. Okay, discount using KE. Present value of perpetual cash flow. The cash flow I take it as dividend, and R, the required rate of return for the equity holders, denominator I take it as KE. The present value of perpetual cash flow only become D divided by KE. This is called as constant dividend model. Why? Because the assumption is the dividend which you receive with the first year, second year, third year, fourth year, everything will be constant, which means D0 is equal to D1 is equal to D2 is equal to D3. Like this, the dividend amount which you are receiving from the company will be same throughout the year. Okay, throughout the future years. This is the assumption. This is called as dividend, constant dividend model. Okay, what is the P0, na V0, P0 or V0, value of the share today. P0 means price, fair price of the share today is equal to D divided by KE, or hence, therefore, KE is equal to what? D by P0. Are you all understanding how they arrived at this formula? Okay, next model, dividend growth model. Everything we are going to apply and see. See, very important discussion. The question may mention, see, D0, D1 is there. This you need to know. Okay, because question sometimes may mention the company pays current dividend this much. If they give you current dividend or the company pays a dividend, which means it is D0. Okay, the company is expected to pay in the next year, like this if they have given, or if the company will pay in the future this much, like this if they give, it is to be understood as D1. So you need to clearly, or paid a dividend. If the company, they mention that the company has paid a dividend of 4 rupees, what is that? D0. The company pays dividend, then also D0. The company is expected to pay, which means a future to D1. Okay, company is preparing to pay, company is expecting to pay, company will pay in the future, like this if they mention in the next year, it will be D1. Are you all understanding? There should, okay, because I'm going to discuss the dividend growth model. There we will have to clearly demark between D0, D1, you need to identify. Okay, see, dividend growth model. Now, what is the dividend growth model? Now, very simple. Okay, there are two different perpetual. This is also perpetual cash flow, but perpetual present value of perpetual cash flow you need to, growing perpetual cash flow you need to find out. Very simple. See what happens here. P0 is equal to value of the share is equal to present value of the future cash flows. Now, simply in the last model, I took D by KE. Here, I cannot take D by KE. Okay, instead, what I will do, D1 by, okay, instead, I will take D1 by KE minus G. D1 by KE minus G. This is the present value of constant perpetual growth model. Are you all understanding what is this happening now? D1 means first year cash flow. See, present value of growing perpetual cash flow where growth rate is constant. Assume the question will mention you growth rate. If the question mentions you growth rate, you should take D1 by KE minus G. Okay, derivation and all. Okay, I'm not going to discuss here, but understand that this is derived from the geometrical progression. Very simple and straightforward only. This is cash flow divided by 1. Present value of growing perpetual cash flow is nothing but cash flow 1, first year cash flow divided by R minus G. This is what you will get after applying the concept. But anyway, here the formula is given, so I'm just discussing the formula. D1 by KE minus G will be P0. Now, if P0 is D1 by KE minus G, provided the growth rate is constant, only then you can apply this formula. When can you apply this formula? When growth rate is constant. Assume, say the growth rate will be forever constant. Now, what will happen? If you rearrange it, so P0 is equal to D1 by KE minus G. Therefore, K is equal to what? D1 by P0 plus G. Are you all understanding? So, if you take the growth rate to opposite side, you will get D1 by P0 plus G. This is what is given. K is equal to D1 by P0 plus G. D1 is equal to expected dividend next year. What is D1? Expected dividend next year. D0 is equal to current dividend. Okay, for this year, whatever is the dividend paid, you should consider as D0. And D1 is equal to D0 divided by D0 into 1 plus G. This is very, very important. Are you all understanding? Which means question mentions that the company pays a current dividend of 4 rupees. Also, D0 is 4 rupees. Agreed? But the growth rate is given as 10%. Are you all understanding? This will grow forever at 10%. Like this, they have given adjustment. What will be D1? D1 is equal to 4 into 110%. How much is that? 4.4. Are you all understanding what is to be taken? Okay, so clear demarcation should be there. Sometimes what they will give you D1 directly. Then they will give you G. Again, you should not, do D1 is equal to D0 into 1 plus G now. Okay, you should not multiply again with 1 plus G. You should not compound it. Are you all understanding? So simply, if 4 rupees is D1, now 4 rupees should be taken as D1. Again, you should not multiply with 1 plus G. Are you all comfortable? G is the growth rate in earnings and dividend. Okay, provided the payout ratio is constant. All these things I don't want to confuse you. G is equal to growth rate. Assume G is equal to growth rate. The formula, for G is B into R. Sometimes directly question what they will do now. Sometimes they will give you growth rate is equal to 10% directly. Sometimes what they will do, sometimes they will give you retention ratio. R simply, I'll just show you. Okay, sometimes what they will give, sometimes they will give B. B means retention ratio. Retention ratio as say 50%. Okay, and the return earned on retained earnings, I call it as R. Or what is R? R means it may be ROI, ROE. Sometimes return on equity may be given. We will study in the dividend chapter. There I will tell you what is R. See, R means, I'll briefly tell you here. R means the rate of return earned on retained earnings. It may be ROE. Sometimes they will give you return on equity. Sometimes will give return on investment. Okay, interchangeably they use that. Most probably they will give you the internal rate of return earned on the retained portion, which means R is assumed 15%. Okay, now how to find out G? G, for what is the formula for growth? B into R. Retention is 50%, 0.5 into R is 15%, 0.15. Everything you need to convert into decimal and solve so that you get the value. Okay, 0.5 into 0.15. How much is that? 0.075. 0.075 is nothing but 7.5%, which means growth rate is 7.5%. Are you all understanding? So, one by one, what is the formula as per dividend growth model? Okay, K is equal to D1 by P0 plus G. Again, here, D1 is equal to what? D0 given. How to convert it to D1? D1 is equal to D0 into 1 plus G. Now, G is not given. Directly, either they may be giving you G or they may just give you retention ratio and the return earned on retained earnings. Then how to find out the G? G is equal to B into R, retention ratio into rate of return earned on retained earnings. Okay, this you need to compute here. Retention ratio, return earned on retained portion, G is equal to B into R. B, see, retention ratio is denoted by B. You can accepted only, every textbook will have the B. Or simply you can write retention ratio into return earned on retained earnings. Can also be given as ROE sometimes. Sometimes question they may also mention ROE. Okay, you need to find out. Then growth rate can also be calculated using this one. See, growth rate, if retention ratio given, RR given, you will calculate using that. If nothing is given like that, okay, if you have been given the future value of the share price, present value of the share price, then you will apply. I already told you CAGR in the first chapter discussion. I told you now how to compute CAGR, concept called as CAGR. If you forgot it, please go and again revise CAGR. I told you now future value is equal to present value 1 plus R raised to the power n. Hence R, the rate of growth. Okay, this rate you will consider. Suppose they say, I'll show you. Just say, see, suppose they say that the share price today is 110 and the share price, okay, is expected to grow up to 200. Now, which means presently the share price is 110 and future it will grow to 200, means you should apply the formula and find out the CAGR. Other 4 years. They gave that it is expected that in 4 years time it will grow to this much. So what you should do, nth root of 200 by 110, that is fourth root of 200 by 110 minus 1. If you solve it, you will get, see, 200 divided by 110. Okay, how much is that? 1.8. 2 times plus square root 1.16 minus 1. You get 16.12 percentage. Are you all understanding? This will be your growth rate. So growth rate can be found out either B into R you can apply and find out, or you just simply data given use this CAGR method and find out the growth rate. Are you all comfortable? 3 models are over. Last model also I will discuss. Okay, thereafter we will do some question answer. Shall we? Okay. Now we'll discuss CAPM. See, KE as per CAPM approach. CAPM approach formula is KE is equal to beta RF plus beta into RM minus RF. Now see, what is this CAPM approach? I'll briefly discuss because entire thing we'll discuss in portfolio management of CMA final. Anyway, briefly I'll discuss what it is. See, if you invest in risk-free asset, like for example, Government of India bonds, or say for example, FD, bank FD, assume it to be risk-free. Okay, you will earn risk-free rate of return. This I call it as RF return. Okay. Now, if you invest in Reliance Limited shares, share market, okay, shares are more risky now. So you require risk premium, which means the investors, the shareholders will require more return to be compensated for the risk undertaken. Are you all understanding? More risk, more return is required. Less risk, less return. Zero risk, zero return. So you should not say some return. That is called risk-free rate of return, which means without risk, you are earning some RF rate of return. Okay, if you take a higher risk, proportionately, it should be compensated by the return. For example, if Reliance Limited is also offering 7%, Bank FD is also offering 7%. Now, which instrument you will invest? Okay, obviously, I will invest in bank. Without risk, I am earning 7%. Which fool will, invest in risky asset and try to earn same risk-free rate of return? Are you understanding? So, if I invest in market, I need some premium, which I call it as RM minus RF. This is market risk premium. Are you all understanding? Now, RF is the risk-free rate of return. RM is the market return, index return, Sensex, Nifty, India's index, okay, Sensex, Nifty, RM return. And RM minus RF is market risk premium. Okay, and what is this beta? Beta times the RM minus RF, very simple. You see, if you invest in individual stock, okay, RM is return of the market, means it is Nifty. Nifty is a collegium of top 50 companies, or Sensex is top 30 companies. Are you all understanding? Which means if you invest in only Reliance Limited, okay, your return, okay, you cannot ask the entire market. If you invest in Nifty, if you invest in entire Nifty, okay, how much you will earn? RM you will earn. This, see, I'll just show you what happens. See, RF plus beta of the market is 1, so I just don't write it. R minus RF. This RF gets cancelled. If you invest in the Nifty, then you will earn RM. If you invest in entire market, you will earn market return. But if you invest in one of the shares inside the market, okay, you should see the correlation effect. That portion of the stock, that stock which is correlated to market now, which will be correlated to market, that correlation should be that correlation is captured by beta times the market. Beta links the stock with market. Are you all understanding? Now, what is the beta? Here I have given beta is nothing but change in security return. What is the delta? Change. Okay, change in security return with regards to change in market return, which means if market changes by 1%, what is the security? Reliance Limited share price will change. This is what is captured by, say, Reliance Limited shares changes by 2%. If market changes by 10%, Reliance Limited share price changes by 20%. Reliance Limited return changes by 20%, which means 2 times risky than the market. Are you all understanding? So beta captures the relationship between the sensitivity of the individual stock with regards to the market. If market changes, what is the impact in the share price? This is what is security return. That is why my formula, okay, is changes RF plus beta into RM minus RF. Where if you invest in entire market, now beta is equal to 1. Market beta is equal to 1. Are you all understanding? What is the Nifty's beta? Market's beta is 1. And with relation to that, okay, all the other stocks are captured. Are you all comfortable? Don't worry about this detailed discussion in portfolio management. Now, again, repeat the formula. What is that? K is equal to RF plus beta into RM minus RF. This is what about, what do you say, CAPM approach. Next, the cost of retained earnings also will briefly discuss. Then we will move on to solve question answers. See, cost of retained earnings, KR. Now see, why I'm discussing now, this is KR. Okay, cost of retained earnings is very closely related to cost of equity. Hence, I'm discussing. See, generally, you see, retained earnings belongs to whom? First of all, the reserves and surplus or retained earnings belongs to whom actually? Actually belongs to shareholders only, equity shareholders only, correct? So, generally, if there is no other date given regarding the personal tax or regarding the brokerage charges, if no details regarding personal tax or brokerage charges given, KE will be equal to KR. KR means retained earnings. K is equal to cost of equity will be equal to cost of retained earnings. But sometimes question will mention you, will give you the brokerage cost. Okay. And they will give you personal tax. What is this personal tax? Very simple. The difference between cost of equity and cost of retained earnings is mainly personal tax. I'll tell you what happens. If the equity shareholders, if you retain in the company, if the equity shareholders, profits, retained earnings is what? Profits, ultimately it belongs to equity shareholders. If it is retained by the company, right, the investors don't have to, incur any personal tax because the profits will be available with the company itself. Are you all understanding what I'm trying to say? Which means, to put it simply, by not, if the company pays out dividend, what will happen? If the company pays out as dividend, what will happen? The investor will have to pay his personal tax. Investor will have to pay their personal tax. So what I'm saying is, see, by not paying the dividends or by retaining, the investor's personal tax is saved. Are you all understanding what I'm trying to discuss? So, here KE generally will be KR, but if personal tax rate is given, you should adjust for it. So, what KR is equal to KE into 1 minus TP. TP means tax, personal tax, or PT, whatever you can understand it as personal tax. This is nothing but personal tax of the investor. Now, apart from that, if your brokerage cost is given, if the brokerage cost is given, very simple, if you don't pay out as dividend, the investor again has to invest and incur the personal tax. Are you understanding? So these are all the opportunity costs which is saving, the company is saving by retaining. Hence that should be adjusted. Really. By retaining, the company is saving the personal tax. The investor's personal tax is saved and the investor's brokerage cost is also saved. Are you all understanding what I'm trying to say? Because the investor have to find the new investment opportunity. In that case, brokerage cost also will be saved. So K into 1 minus TP and into 1 minus BR. BR means brokerage cost. If you do this, you will get the KR. Are you all understanding? Now, I will discuss few question answers. Then we will go on to WACC computation. Shall we see? Illustration number 13. AB Limited issue shares of 100 at a premium of 10. The issue involved underwriting commission of 5%. The rate of dividend expected by the shareholders is 20%. Determine the cost of equity. See, here, wherever in the KE question, underwriting commission, okay, issue related cost given, always remember, when you adjust the PO is the market price. Agreed. What is the formula for KE to be used? First, you need to understand which model they are using. Earnings model or dividend model? First of all, dividend model. And the dividend also, if you see, okay, rate of dividend expected by the share of holder is 12%, nothing given. Growth rate given or not given? Not given. So constant dividend model you will use. So K is equal to D by P0 you will use. This is the formula to be used. Fine. Now 12% dividend. 12% is the dividend rate. Dividend rate which will be applied on face value 100. So 12 rupees is the dividend. So D, this D is, okay, D0, D1 because everything will be same, is 12 rupees. Correct? Now 12 divided by, what is the P0? You need to take 100 and premium of 10 each, which means 110. Agreed? But this 110 should be again adjusted with underwriting commission. Are you all understanding? So 110, this 5% should be applied on 110. Okay, and you will reduce it, whatever is the amount, you will get 104.5. Okay, this should be the market price. Okay, you should take as P0. So D divided by P0. Okay, how much is the value? 11.48%. Simple and straightforward. Next, illustration number 15. Memo Limited is expected to earn 30 per share. Company follows fixed payout ratio of 40%. The market price of its share is 200. Find out the cost of existing equity. Dividend tax of 15% is imposed on the distributed earnings when current level of dividend is maintained. Dividend to the shareholder is reduced by the extent of dividend tax. See, what happens here? When, see, both the situation given, dividend taxes, see, when dividend net of tax to shareholders maintain at same level, such policy will reduce the retained earnings, which in turn reduces the growth, of course. Okay, so what happens here? Dividend tax is 15% and dividend amount. First of all, dividend fixed payout ratio 40%. The payout ratio is to be earned on, is to be applied on earnings per share or earnings of the company, which is 30 per share. Earnings per share is 30 into 40%, 12 rupees is the dividend. Agreed? Now, this is D1, D0, D1, because this is expected to earn. I told you, very, very important, futuristic, expected to earn. So, 12 rupees the D1. Are you all understanding? Now, the issue is that, what is the tax for this 12 rupees? If you see, what is the tax rate? Dividend tax rate is 50%. But 12 rupees per share into 15%. What is the dividend tax? 1.8 is the dividend tax. Now, if dividend tax is 1.8, dividend is 12 rupees, what is the retained earnings will be left out per share? So 12 rupees is the dividend. See, overall 30 rupees is the earnings per share. Minus 12 rupees you paid out dividend. Wait, one more adjustment. Minus 1.8 dividend you paid tax. How much will be left out? 16.2. So 16.2 will be retained earnings per share. Are you all understanding? Now, here, only important adjustment. You see, G is equal to B into R they have used. For all this, we need to, for all this, what is the purpose of calculating this? Now, to find out G. You need to find out G. Are you all understanding? Growth rate you need, see, you need growth rate. Growth rate is what? B into R. Okay, B is what? Retention ratio. B is retention ratio is what? Net profit after distributing dividend. After dividend, that is retained earnings divided by, what is that? Net profit, total earnings. This is total earnings denominator, numerator, after the net profits after paying out dividend. Are you all understanding? So net profit, this is nothing but retention ratio. This retention ratio only they have given like this. Net profit after dividend paid, retained earnings divided by total earnings. This is total. Net profit means total earnings. Numerator, okay, retained earnings. That is retained earnings divided by total earnings will give you B, retention ratio, into R. Okay, the retention ratio also we are going to discuss in dividend decision. Anyway, R is net profit divided by book value of capital employed. This they have taken, okay, as a little book value of equity capital employed. That should be there. It is effectively they are saying ROE. I told you it may be interchangeably they will use the ROE or here the formula is given for ROE. Net profit divided by equity share capital plus reserves and surplus. Okay, book value of capital employed, they cannot use total capital employed. In this question, there is no debt involved, hence it is to be understood as equity capital. Really speaking, it should be equity capital. It should not be total capital employed. Are you all understanding? Okay, so because net profit is profit available for equity shareholders. Anyway, now, net profit after dividend paid divided by book value of capital employed is equal to how much? Retained earnings divided by price. So 16 by 100. Here if you see what they have done, effectively they have cancelled out the net profits with net profit, and net profit after dividend payout is 16.2, that we already know, divided by book value of the capital employed is there na, that they have taken as price. Why? Because see, no other data given, they have taken the market price. That this is where there is ambiguity, because market value of equity they have taken, book value of equity is what is ROE. ROE is return on capital employed, return on equity. In that return on equity, they have taken market value of equity. That is what they have done. Are you all understanding? Ratio, we are going to discuss that. The ROE really speaking is book value of equity, but still they have taken as market value of equity. Are you all understanding? So 16.2 divided by 200 market price they have taken. What is that? 8.1%. What is this 8.1%? B into R, effectively growth rate. Are you all understanding? So we have G, found out the G as 8.1 and D1 as 12 divided by P0, market price as 200 plus 8.1, 14.8, 14.1 is the solution for the first part. Next part, if you see, dividend to the shareholders is reduced by the extent of dividend tax. So dividend itself is reduced to the extent of this much by dividend tax. In that case, what happens? Very simple. See, dividend amount is 12 rupees and the tax is reduced from dividend itself now, which means 10.2 will be the revised rate dividend. Are you all understanding? In the earlier case, 12 rupees was the dividend. See what happened in the previous case. Total dividend was 12 rupees. Okay, and that 1.8 effectively actually was reduced from the dividend itself. If you see this, 12 minus 0.8, how much you are getting? 10.2 total. Okay, if you see 30, see here, yes, 30 minus 12, how much is that? Minus 1.8 they have done here. But here what happened, you see here, dividend 12 net of tax, which means out of this dividend you reduce the tax portion. What is that revised portion? 10.2. This 10.2 is there, but retained earnings is there na, it will be same as 18. Why? See, dividend net of tax na, when dividend gross of tax to the shareholders is maintained at the same level, such policy would keep the level of retained earnings and the growth of same, but amount of dividend paid to the shareholder will reduce. Are you all understanding? What happens effectively is that dividend, if the tax is paid out, which means it will reduce the amount. If tax is not paid, see what happens, such policy would keep the level of retained earnings will be higher, which means company need not pay dividend from its pocket. Are you all understanding? So instead of this 30 minus 12, now only dividend has to be paid. Only dividend has to be paid, and that will contain the dividend distribution tax, which means separately company need not pay anything net of tax. Dividend net of tax is 12 rupees. Like this I can pay. Are you all understanding what is happening? Now, see, how much is the retained earnings value then? 30 minus 12, 18. 18 is the retained earnings value. Now what happens? See, effectively what happens now? If dividend is inclusive, the shareholders will bear the dividend distribution. If the company is bearing the dividend distribution tax, then the retained earnings will reduce. That is the point. Okay, now G is equal to B into R. Same thing again and again. They will do 18 divided by 200. You will get the same value, because 30 minus 12, 18 is the retained earnings. That will change. Numerator will change. Denominator will be same. Growth rate will be changing by 9%, and the dividend will become 10.2. Because you will reduce the tax from the dividend. That is the burden of the equity shareholders. Are you all understanding what I am trying to say? Dividend effectively reduces. Tax 1.8 will be adjusted from the dividend amount. Are you all understanding? Not from the retained portion. So what happens? 10.2 divided by 200 plus 9%, 14.1% is the solution. Next, question number 17. Dividend growth model. They have given straight away dividend growth model. So what you should do? D1 by P0 plus G you need to apply. And find out. Here equity shares this much. Earnings for 2000 is 60,000. Current market price is given. See here, what they have done is that in this question, 3 growth rate will be there. 3 growth rate, the different years they have done now. 2020, 21, 22, 23. Here what they have done, they have used D1, see here, growth rate, they have using this data, growth of the dividend they have computed. From 7 it became 8, from 8 became 10, 10 became 11. Correct? So 8 minus 7 for the first year. How to compute it? 8 minus 7 divided by 7. What is the increase in dividend Okay, 14.29%. That is the first year growth rate. Next, for second year, again from 8 it became 10 na. So 10 minus 8. 10 minus 8 divided by 8. Opening balance. Okay, how much is that? 25%. Like this, they have computed 3 years growth. Okay, and then they have taken simple average. On an average, okay, from the past 3 years, I am expecting that the past growth will continue in the future. That is what they have done like this. 16.43% is the growth rate. Thereafter, everything will be simple. See, if you have growth rate, this is the only adjustment there. Growth rate is the important adjustment. 16.43 is the growth rate given. Then you have D1. D1, how to compute here? See, D1, if you are sitting on which year, last year you need to take, because next year, earnings for 2023 is there. So you are standing on 23. Pay 24 year dividend you need to compute. Very simple. What you should do, how you should find out. See, D1 at the end of current year, see, if you are standing in, see, this is where little bit ambiguity is there. Earnings of 2023 is given, and 2023 dividend is given as 11 rupees. Okay, effectively it should be 24 anyway. So D1, they have taken 2023 as D1. Okay, conceptually if you see, the 2024 dividend only should be taken, because that is the next year dividend. D1 means if you are standing in 2023, 2024 will be D1. Anyway, they have taken 2023 as dividend. Okay, I think there is mistake in this regard. Anyway, dividend per share at the end of the current year, how can they say? Because when you stand at 2023, end of the current year, now you should not take 23 data. Okay, next year's dividend you should take effectively. Anyway, so 11 rupees they have taken as D1. I would say it should be D0. Again, you should apply the growth rate. Okay, in my view, what you should do now, this 11 is there, 1 plus G you should apply, 1 plus 16.43 you should apply and compound it. Next year's dividend you should find out, and then you will have G, P0 as 180. Okay, the current market price per share P0 is 180 plus G is 16.43. You will get 22.54. Are you all understanding? So I've just explained what is given, but anyway, my view is different here. Anyway, now illustration number 19. Take illustration number 19. The beta coefficient is 1.4. Sometimes they will give you beta coefficient. Sometimes they will give you what is the sensitivity of the stock with regards to market. Anyway, it is to be understood as beta only. So beta is given as 1.4, maintaining a growth rate of 8%. What has been maintaining 8% growth in dividends and earning. The last dividend was paid at 4 per share. Very, very important. What is this last dividend paid? D0. So D0 is 4 per share, and G is how much? 8%. So what is the formula? First you need to apply. Okay, here, see, first you need to apply dividend growth model. That is there. Return on government security, this is RF. And while the return on market portfolio is RM. So RM is 15%, RF is given as 10%. Okay, and the current market price of one share is 36. Why, sir? Current market price is given for comparison, under or over valuation. Okay, they have given the classic question. Very, very important question. Okay, this may be asked with regards to CAPM. See what I'm saying. First, you need to apply dividend growth model. What is the dividend growth model? D1 by KE minus G. D1, how to find out D1? D0 into 1 plus G. D0 given, yes. What is that? 4 into 1 plus G into 1.08. Okay, how many years? Only 1 year, Okay, yes. So what you should do? Take your calculator. 4 into 1.08. 0.32. So 4.32 will be the numerator. Denominator K, you know why you don't know? You don't know. What you should do? That is why they have given the CAPM. So K, you should use the CAPM. Find out the K. What is that? RF plus beta into RM minus RF. So RM minus RF is 5%. RF is 10%. So 10 plus beta is how much? 1.4 into 5. So what is that? 1.4 into 5 plus 10%. Beta comes to 17%. So 4.32. Okay, 4.32 divided by 17%, which is KE minus G. G growth rate is how much? 8%. Are you all understanding? So 4.3 divided by 9%, 48 rupees. Are you all understanding? So this you find out now. This is the equilibrium price or fair price. This is called as fair price. This should have been the price, theoretical price. But the current share price is 36. You tell me. The fair price is 48. 48 rupees should have been the price, but currently trading in the market at 36 rupees. Undervalued or overvalued? Undervalued or overvalued? Undervalued, which is 48 worth of share. Really trading at 36 rupees, cheap price. What you should do? Buy the share. The share of Target Limited is worth buying as it is undervalued. You are understanding? Next, question number 23. Okay, is about cost of retained earnings. A firm's KE, return available to shareholders, is 10%. KE is equal to 10% given. Average tax rate of the shareholders is personal tax. Okay, the TP given as 30%. Expected that brokerage cost BR is equal to how much? 2% is given. Apply the formula. Simply find out. Okay, nothing given na. KE is equal to KR. But these details given na. So how to find out? Very simple. KE is equal to 10% into 1 minus personal tax rate into 1 minus 0.02, 2%. Okay, you will get the 6.86 as the cost of retained earnings. Are you all comfortable? This is how we need to find out the cost of retained earnings. Shall we discuss the WACC and then do 2 or 3 questions? Okay, then we will finish off the cost of capital. Before going on to WACC computation, see what happens. WACC is nothing but weighted average cost of capital. Weighted average cost of capital. Company will only take debt, preference shares or equity, or it will be mostly combination of all these capital, which means I need to find out what is the overall cost of the company. Yes, individually cost of debt you found out, cost of preference shares, cost of equity you found out, but you need to find out what is the overall cost of capital. This is also called as WACC, weighted average cost of capital. This is only required. Here, for this, okay, there are 3 methods here for computing WACC. Okay. See, broadly you can classify it into 2, historical KO and marginal KO. What is historical KO? Na? KO, see, WACC KO is, WACC is denoted by KO. Anyway, historical KO means using the past data. Okay, you are analyzing using the past data, then finding out the weights which you are considering. It is historical weights. Very simple. The weights capital you will consider. Okay, I will describe it at the appropriate time. I will discuss it, don't worry. But this is historical means what? Already pre-existing. Okay, past data you are taking and then you are trying to find out the weighted average. See, what is WACC? Weighted average cost of capital. You are taking weights now. Weight, what weight you will take? Weight of the capital. Very simple. Yeah, you have 100 rupees of debt in the capital. 200 rupees preference shares. 300 rupees equity share. 3 capital are available now. Total is what? 300 plus 200 plus 100. 600. In this 600, what is the weight of debt? This is debt, this is preference, this is equity. Assume. What is the weight of debt? 1 by 6. 100 divided by 600. What is the weight of preference shares? 200 divided by 600. What is the weight of equity shares? 300 divided by 600. Are you understanding how weight is computed? No. In this case, the weight which you are taking, the value which you are taking for weights, the 600, 100, 200, 300, the value. Okay, this is historical value. This is historical value. Historical value. Which means in the historical value, again, there are 2 weights possible. Book value weights, market value weights. Okay, even market value weights is historical. I'll explain it in the appropriate time. Okay, don't worry. Book value weights, what? Book value available in the balance sheet accounting number you will take as a value. This is book value weights. Market value weights, see, if you have debt, you won't consider book value of debt, you will consider the market value of debt. Equity share capital is 10 lakh. Okay, out of this 1 lakh shares is there at 10 rupees each. 10 rupees each. This is book value 10 lakh. But market price of the share is not 10. This is the face value and recorded in the books of accounts. Market value assume is 50 rupees per share. So 10 lakh into 50, 50 lakhs will be the market value equity. So while computing taking value, you should take 50 lakhs. This is as per market value weights. But this also is the opening market value. Are you all understanding what I'm trying to say? Which means all these things already happened, historical. This is not expected. This is not nothing new. We are not considering the futuristic value. Are you all understanding? That's why it is called as historical KO. Then there is marginal KO, means you are going to undertake a new project. Okay, you are trying to finance a new project whereby you are going to take a loan. You are going to raise the equity capital. This is all futuristic for the project we are considering now, this is called as marginal KO, which means additional capital only you are computing now. For the additional capital, whatever the earlier existing capital, you are not computing the weights. For additional capital, you are trying to find out the KO, WACC. This is called as marginal KO. Using marginal weights, you will compute the KO. Are you all comfortable? Now, I will explain this everything later. Don't worry with question. I will just link it. Just understand the brief discussion. Thereafter, while doing the question, I will link it to the concept. Shall we move on? See, WACC table. How to find out WACC now? You have to prepare a table. In this table, very simple and straightforward. What you should do, 5 columns will be there. Source, value, proportion, cost, weighted cost. What are the 5 columns? Simple. Source, value, proportion, cost, weighted cost. Okay, what you should do? You should see the question and find out what are all the source of capital available. What is the possible source of capital? What are all the possible source of capital? Equity, debt, preference share, if any, retained earnings, if any, given in the question. All the sources I have written. Mostly 4 sources will be given. Now, see what happens. You take the value. You take the value. What value you will take? If question mentions something, take book value, not take the book value. As per the balance sheet value, you will consider. Okay. If question asks us to compute market value, you will take the market value. Whatever given the question, you will do as per that. So value, you will take either book value or market value or marginal weights. If given regarding marginal weights, that also you will consider. If question asks you, whatever question asks, you will consider. That is that. Then proportion. Proportion is nothing but this value, equity value divided by total value. This total you are getting. Equity suppose is 100. This is 200. Now I just now told you, 100 divided by total is assumed 1000. Up 100 divided by 1000, this will be 10%. Are you understanding? This is the proportion. Proportion of individual capital with respect to total capital. You have to find out. Okay, this is XX1 divided by total of this. Again, XX2 divided by total. XX3 divided by total. Like this, you need to find out for each proportion of each capital to the total capital. Next is cost. This cost is nothing but individual cost of capital, which you work it out. Already you would have worked out as individual working notes. Okay, are you all understanding? Which means, first, if WACC question is given, if details regarding individual cost of capital is given, find out first step in individual cost of capital. KD, KE, KP. Just now we discussed above, you find out all the individual source of capital. KD, KE, KB, KR, everything you find out. After that, you use that. This KE, you will simply substitute here. Equity capital. KD alone, what you should do? After tax cost of debt, you will consider if cost of debt directly given as before tax. Are you all understanding? KD alone for WACC computation, you should remember. After tax cost of debt should be considered. Are you all understanding? Now, if they have given the interest into 1 minus T, all those things they have given, already you would have computed the after tax cost of debt. You will take directly after tax cost of debt. If question specifically mentions that the cost of debt, nothing mentioned or specifically mentioned that is before tax, what you should do? Convert into after tax cost of debt. Are you all comfortable? So KD should be after tax. That we will see in the adjustment. All the other things will remain same. KP will be same. KR will be same. You find out this is the cost column. Last column, weighted cost. What you should do now? Simply, this is first column, second, third, fourth, 5. The fifth column is nothing but, okay, third column into fourth column. Are you all understanding? So this proportion into KE. This proportion into KD, this proportion into KP. Like this, you will find out the weighted cost of all the individual security. Then add it. That summation of all this will give you KO. Are you all understanding? Very, very simple and straightforward. Okay, note I have given few adjustments. If they ask, use this note. See, for book value weights computation, use book value of capital. While computing market value, reserves and surplus or retained earnings vanishes. Generally, what happens? See, if book value weights is given, retained earnings given, it will be specifically there. Equity capital, retained earnings, everything will be there. You will use it. But if computing market value, if market value data given, what you should do? Generally, what will happen? The retained earnings will vanish. Retained earnings will vanish. But sometimes question has been solved using the retained earnings as well, without using retained earnings as well. What you should do, I'll tell you. Okay, if you can also write without retained earnings, it is perfectly fine. But institute, some questions what they have done, that is why there is, there is no, uniformity in this case. Okay, they have also taken some question, they have considered retained earnings, some considered they not given retained earnings. But if you consider retained earnings, what you should do now? You should apportion the equity, market value of equity in the same proportion as the book value and write it as equity share capital and retained earnings. Like this, you need to differentiate, demark, and see, very simple. I'll give you an example. 10 lakh is the equity share capital, book value of the capital. This is book value. 50 lakh is the market value. Either book value of equity, see, this is book value of not only equity share capital. I told you book value of equity is what? Equity share capital plus reserves and surplus. If I say equity always will mean equity share capital plus reserves and surplus, even if you consider the book value. Now, book value of equity is given as 10 lakh. In the 10 lakhs, 5 lakh is the equity share capital as per the books of accounts. Another 5 lakh is the reserves and surplus or the retained earnings. Okay, assume it is retained earnings. In this case, what is the proportion? 50-50 na? This 50-50 you need to use and allocate the market value also. So 50 lakhs is market value na? This 50 lakh market value, equity share capital, you show it as 25 lakhs. The reserves and surplus or retained earnings, you show it as 25 lakhs. Are you all understanding? This also you will show ultimately while presenting this you will consider. Are you all clear with this? Shall I proceed? Now, see the next point. Okay. While computing market value, reserves and surplus or retained earnings vanish and it will be shown in equity. In some questions, they have shown breakup of the market value of equity. But while showing this separately, you should split it using the same proportion as it was in books, which means book value proportion you should consider for market value. Okay. Next, flotation cost. While computing flotation cost of capital, see, flotation cost adjustment very, very important. In the earlier discussion, while computing individual cost of capital, we reduced the flotation cost from the denominator. Agreed? But while computing the market value weights, okay, or the value for the weight computation, you should not reduce the flotation cost from the market value. Are you all understanding? Very simple terms, I'll tell you. Share price is 50 rupees they have given, 1 lakh share outstanding. So market 50 rupees into 50 lakh will be the market value you will consider. But assume out of this 52% flotation cost is given. Are you understanding? For computing KE or the respective cost of capital, you will reduce the flotation cost. That is fine. But while computing the value to compute the WACC, you will write 50 lakhs as the value and not 50 minus 2%. 48 lakhs, you should not consider the value. Are you all understanding? Very, very confusing area. While writing, you will get the confusion. Okay, flotation cost. While computing cost of capital, reduce flotation cost from the market price. But while computing proportions that should not be considered, okay, arriving at market value should not be deducted. Flotation cost should not be deducted while computing the value for computing proportion of the capital. Are you all understanding? Now, with this background, we will do some questions and then move on. See, take question number 26. Illustration number 26 we will discuss. Illustration number 26. A company has the following capital structure. Equity share capital 10 lakh shares given 100. Okay. And 12% preference share capital 10,000 shares 10 lakhs. Okay. Retained earnings given as 120. I think yes, this is retained earnings given as 120 and 14% debenture 70,000 debentures 70 lakhs. 14% term loan. Okay. Given as 100 lakhs. Now these are all the various source of capital. Okay. Total comes to 400 lakhs. There is a book value. Now, market price per equity share is 25. The next expected dividend per share is 2 and is expected to grow at 8%. Why they have given? To find out the K. The dividend is given. This growth rate is given. This is to find out the K. The preference shares are redeemable after 7 years as at par. This is not per, at par. Okay. And are currently quoted as 75 per share. Debentures are redeemable after 6 years at par. And their current market quotation is 90 per debenture. So, which means market value of debenture also given, equity shares also given, preference shares also given. Now, the tax rate applicable of the firm is 50%. Most probably they will ask the market value weights. Okay. Now they have asked us to compute cost of capital. They have given nothing. I think they have solved it. Okay, no issue. Under book value method, under market value method. So we will compute WACC under book value and market value. Okay, see. First, individual cost of capital you need to compute now. So first KE, now how will you compute KE? D1 by K, see here growth rate is given now, D1 by P0 plus G. You need to find out now. So what is the D1? Very simple. Here if you see, the next expected dividend they have given. Are you all seeing this? Okay. And let me just highlight. The next expected dividend per share is 2. What is this? D1 or D0 or D1? Okay, I told you. So D1 straight away you can use 2. So 2 divided by 25 market price per share into 100 plus 8%. Okay, this is actually what you should do now. You have 2 divided by 100 plus 8% you can do, or 2 by 25 plus in decimal terms you can write it fully. Thereafter you can put it at 100. Now 8% of 0.08. Are you understanding? Okay, this into 100 you can do totally. So 2 divided by 25 divided by 25 plus 0.0, that 16%. Are you all into 100? 16%. Are you all comfortable? Next, cost of preference shares. See, don't mistake. I'm just discussing from question answers. So no time to solve all this. This is not a workout session. Okay, I'm just discussing the question answers so that how you apply the concept, how you find out. Okay, we are revising and not the regular batch or workout batch wherein we do all the questions fully here. Okay, so I hope you can understand that. So KP, how to find out KP? Cost of preference shares, preference dividend plus RV minus NP divided by N, the whole divided by RV plus NP divided by 2. Because this is redeemable preference shares, now they've given all the details. 12%, 100 minus 75. Okay, redemption value face. If nothing given in the question, anything given, preference shares are redeemable after 78 at par. Yes, redemption value given and quoted as 75. Market value is given. Net proceeds will take as 75. I told you now. Simply apply. I don't want to discuss again and again. Individual cost of preference shares already given. Okay, use that. You find out the KP. Cost of debenture also individually you find out 9.13%. Are you understanding? Cost of term loan. Okay, very interesting concept. See here what happens. In case of cost of term loan, you tell me whether the term loan is, okay, see, cost of debt, how will you find out? Interest into 1 minus T divided by, okay, net proceeds, etc. you found out. Agreed? Here, in the cost of term loan, okay, you just simply apply the interest into 1 minus T, that's enough. Interest rate into 1 minus T, that is enough, because term loan, the loan, okay, there will be no redemption value on issue, etc. Are you all understanding? Which means if you have taken 100 rupees loan now, okay, from the bank, now you have to pay 100 rupees. You cannot say I will pay 1 or 2. If you have taken 100 lakhs now, can you pay 1 or 2 lakhs or 98 lakhs? You will not pay. You cannot pay. Are you all understanding? So term loan, the denominator net profit, there is no variation. Hence the numerator itself is sufficient. Are you all understanding? So interest into 1 minus T, 14 into 1 minus T, after tax KD. This is already tax is adjusted 7%. Are you all comfortable? Now here you need to see that where the calculation of KD or term loan, okay, already adjust for tax. Now you again need not adjust, because this 7% is after tax or before tax or after tax. Before tax is 14%. Now tax 50% into 50%. You adjust it, you got 7%. Are you all understanding? There also cost of debt, like interest into 1 minus T, you already adjusted. So when you are calculating this individual KD, most probably you will take the tax effect, it will be adjusted. Are you all understanding? But when question directly gives you KD is equal to this much, 10%, and you will assume that it is before tax cost of debt. Why? Because unless specifically they have not stated now after tax, then you should adjust that it is before tax. Are you all understanding that? Or specifically given as before tax, now you will take before tax. Understanding? Now, as per the data given in the question, you will consider. So now, see, this is all after tax cost of capital. Okay, AE, KD, term loan, cost of term loan given like this, you will find out retained earnings. Okay, retained earnings also same as KE. Why? There is no personal tax given in the question. There is no personal tax given in the question. Listen to me, friends. Here you have source, okay, value, the book value. Book value weight you are computing WACC under book value. So value will be book value. The 100, 10, 120, 70 and 100, total 400. Same as given in balance sheet you will consider. Then weight, proportion. Weights of proportion. How to compute the proportion? Okay, how to compute the proportion? Very simple. 100 is the proportion of equity. 100 divided by total 400. 100 divided by 400, how much? 25% or 0.25. Are you all understanding how to find out the proportion? Okay, this is how you did it. So individual cost, individual value divided by total value of the capital. You will find out the proportion. Cost of capital, you have already found out the working note. You have found out KE, okay, KP, KR, and then KD and term loan, cost of term loan. You multiply with, so 0.25 into 16%, you will get 4%, 0.25 into 17.8, 0.446. Total of this will get 12.86% as WACC, weighted average cost of capital. Are you all comfortable? The WACC is 12.63. Very simple and straightforward. Hence, I'm not discussing in detail. Okay, next, market value weight. Here only I want your attention. See, book value weights, na, simply copy paste. This value is there, na. The value 100, 10, 120, 70, 100 is nothing but copied from the question itself. You see 100, 10, 120, 70, 100 is a balance sheet value. When you compute the market value, see, for example, mainly market value of equity will be the main thing. Okay, it will change. Most probably other will be same. Otherwise, they will give the question, give in the question. In this question, if you see, there are 3 market values given, if I'm not wrong. Yes, market value of equity given. Okay, then debt also market value given. Then there is debenture. Yes, then preference shares also market value given. For 3 sources of capital, market value is given. Are you all understanding? Now, what happens? Market value, now first 10 lakh shares is there, 100 is there. This is book value. Upper 10 lakh into face value of 10 I did and got 100 lakhs. Agreed? But when you do market value, multiply with market price per share. So 10 lakh shares outstanding into what is the market price per share? 25. Into 25 you do and get how much? 250 lakhs. Are you all understanding? In this 250 lakhs, retained earnings separately will be there. It will be inside this 250 lakhs. It will be inside this two, because book value of equity is not only 100 lakhs plus retained earnings 120. So total book value of equity is 120 plus 100, which is 220 lakhs. Are you all understanding? This 220 lakhs only became market value of 250 lakhs, which will include the book value of the retained earnings. Are you all understanding? Now, sometimes what is the proportion here? 100 plus 120. Now, 220 is their total. In the 220, 100 is equity share capital and 120 is reserves and surplus. What is the proportion of this? 100 by 220 is the proportion of equity share capital. 120 by 220 is proportion of reserves and surplus. In the same proportion you should allocate. Okay, are you all understanding? If at all you allocate. Okay, we will see how they have presented. Sometimes they have presented this way, sometimes that way. Anyway, see, here they have computed retained earnings separately. Here they have computed retained earnings separately. How they have done? In the same proportion. First of all, find out the market value of equity. What is that? 10 lakhs into 25 per share. What is the total value? 250 lakhs. This 250 lakhs, what you should do? You should allocate in the same proportion. Equity share capital, retained earnings. Equity share capital, how it will be there? Computation, tell me. 250 lakhs into 100 by 220. Already we discussed now, into 100 by 220. Here I can just show you. 1 second. See here. I'll just use this space. 220 lakh, 250 lakhs is there now, total market value. This is nothing but market value of equity. Allocate in the same proportion. What is to be done? 250 lakhs into 100 by 220. This is the equity share capital portion. This is equity share capital portion. How much is that? Please tell me. 250 into 100 divided by, what is that? 113.63 lakhs. So 113.63 636. Are you all understanding? Can you see this? Market value of equity na share capital proportion. What is the proportion of share capital? 113.63 631. So balance, you can also do 250 lakhs minus 113.61 or 250 lakhs into 120 divided by 220. Are you all understanding? The same proportion in the book value proportion. What is the amount? Reserves or retained earnings. What is the amount you will get? Okay, 136 lakhs 36,363. Are you all understanding the distribution? That is what they have done here. So value, they have segregated and shown separately equity share capital, retained earnings. If you combine it both and you show it equity value as 250 lakhs, that also is fine. But you should write only equity value and not equity share capital as 250 lakhs. That you should not make mistake. Are you all understanding? Market value of equity. Simply write market value of equity 250 lakhs. Then also the answer will tally. The ultimate, okay, the WACC will be same. There is no change because the cost of equity share capital and cost of retained earnings mostly will be same now, so there is no issue there. Okay, mostly it will be same, the value will be same. Now here you need to segregate because the institute does this, that's why I showed you how to segregate. Are you all understanding? Now all the other things will remain same. Source, preference shares, debentures, term loan, everything will be same. Only thing is market value, it will get replaced by market value. Preference shares, how many shares are there? See, what is the second? Has some issue regarding scrolling. That's why I'm having issue. See the question. How many preference shares are there? 10,000 preference shares are there. Okay, you should not take into 12. If you see 10,000, 120 lakhs, 10,000. Okay, into 12, you got it as 1,20,000. What is that? 120 lakhs. Okay, so 120, 10,000 into 120, you got 12, what is that? 10,000 shares. So 120 lakhs, 120 lakhs divided by 10,000. How much is that? 1,200. So face value of the preference shares, it seems to be, 120 is a retained earnings. Sorry. Preference shares is 10. Okay, this 10 lakhs is there. So 10 lakhs divided by 10,000. So 100 is the face value of the preference shares. But what is the market value they are given now? Currently quoted at a discounted price of 75 rupees. So 10,000 into 75. What will be that? 7,50,000. Okay, then this is 7,50,000 market value. Debentures, we have how many debentures? 70,000 debentures. What is the market value of debenture per debenture? 90. 70,000 into 90. How much is that? 63 lakhs. Are you all comfortable? So here 7,50,000 preference shares market value. Where they have given preference share. Oh, this is book value. Again, market value 7,50,000. Then there is 63 lakhs. Are you all comfortable? How to compute market value? Just replace it. Number of shares into market value per share. Term loan, again, book value and market value will be same. This is the total. Now proportion, revised proportion. The proportion will change. Of course, it will change. How to compute the proportion? 113 lakhs 63,631 divided by 420 lakhs 50,000. 7,50,000 divided by 420 lakhs 50,000. Okay, like this 136 lakh 36,363 divided by 420 50. Like this, you will find out the weights. The weight total should be 1. Proportion should be 100%. Okay, then after tax cost of capital, multiply the proportion with tax, you will get the WACC. Total it, you will get the WACC of the company. Are you all understanding how to compute WACC under market value weights? Okay. One more question is there regarding this question I wanted to discuss because of the marginal weights, I believe. Yes, marginal weights. Yes, thereafter we will move on to very important chapter, that is capital structure theories. Last question we'll do. This is a big question. I don't want to discuss everything because usual all the discussion will remain same. Only that here in this question, marginal cost of marginal weights, the cost of capital using marginal weights, we will find out. That is why I have given this question. Okay, very important. Mark it as important. XYZ Limited is the following book value, capital structure, equity capital in share of 10 each, fully paid up at par 30 crore, then 10% preference shares, fully paid up at par 2 crore, retained earnings given as 40 crore, 10% debenture of 100 given as 20 crores, 15% term loan given as 25 crore. This is all the book value given. Next, expected dividend. By reading itself, you should know that this is D1. Okay, so 3.6. The dividend per share is expected to grow at 5%. So D1 given, growth rate is given. Which model you should use? Dividend growth model. You should find out KE as well. Dividend growth model. Market price is also given. No flotation cost. Simply apply 3.6 D1 by P0. What is that? 30 plus 5%, 0.05. If you solve it, you will get the KE. Are you all understanding? So working note number 1, KE you will find out. Then preference stock is redeemable. So redeemable preference shares, the formula you should apply. Okay. So preference dividend selling at 80 per stock after 10 years. Nothing given na. So we will assume it is redeemed at par. So what is the issue price? Issue also at par. Yes, selling at 80 per preference stock. Anyway, that is the net proceeds you will consider as 80 because you see net proceeds you should consider as 80. Okay, see here. Yes, first working note. Let me just quickly move on to the working note. KE, just now we found out 3.6 divided by 30.5%, 17%. Then cost of preference shares, Okay, here, see here, 80 will be the net proceeds. Current market price is given now. So 80 will be net proceeds, 100 will be redemption value. Preference dividend 10%, 10 you will consider. Okay, you will find out preference cost is 13.33%. Are you all understanding working note number 2? Okay, 2 cost of capital individually we found out. Next, debentures. Debentures also renewable debentures. Again, you should find out working note number 3. Find out debentures. Here 90 per debenture. Now RV minus SV. Redemption value, okay, will be 100, nothing given. So assume to be redeemed at par. 100 minus 90, RV minus SV divided by N, 6 years you will do and find out the either. Okay, tax rate is given. Yes. Interest into 1 minus T, tax rate is given in the question. Yes. Corporate tax rate is 30%. So interest into 1 minus T, you will apply. Now, this you will find out the KD also, working note number 3. What is the question? Required to calculate the current weighted average cost of capital, which means historical KO. Are you all understanding? I will show you what is this. See, we just discussed this. If you see historical KO, this is current cost of capital is what currently cost KO. Currently, what is the KO? This is historical. Under it, 2 methods are there: book value weight, market value weight. Just don't get confused. If I say market value weights, it is something futuristic. No, it is the using current market value you are finding the KO. That is current KO only. This is marginal KO, not futuristic KO. Are you understanding? Future KO, if you require funds for the KO, what should be the KO? What would be the KO for the future fund capital you are going to raise? Are you all understanding this question? First part, they are asking historical KO, book value weights, market value weights. Then they will be giving some data regarding marginal weights to compute the additional capital weight. Are you all understanding? Additional cost of capital. Okay, here see, required to calculate the current KO using book value weights, market value weights. Then in the next part, they are asking determine the weighted marginal cost of capital, futuristic cost of capital scheduled for the company. If it raises 20 crore next year, what is the financing done 20 crore next year? The futuristic. For that, the amount will be raised by equity, debt, a separate proportion will be given with respect to only this 20 crore. So only for this 20 crore, what is the marginal KO? That you will find out. Are you all understanding? I will come back to the marginal KO later. First, we will find out the book value and market value. Quickly, we will brush through the book value and market value. Individually, you have found out the KO individually. Thereafter, okay, book value proportion, equity, preference shares, retained earnings, 14% debenture, term loan. Everything you have. And working note, I don't want to discuss the first part quickly. Okay, we will move on because amount book value 30, 2, 40, 20, 25, 117 already given in the question itself. 30, 2, 40, 20, 25. Term loan 25 given. Okay, yes, 25 total comes to 117. Book value weight, respective cost of capital you apply. Okay, working note already we have computed total weighted average cost of capital as per book value weight. We don't want to waste time. Already we computed. Already we discussed it. Now, come to the next market value. Market value, what you do? Equity share capital 90 crore. Why 30 share price given? 3 crore shares outstanding. In this question, directly number of shares given, you need to find out. If you see equity share capital, total value is 30 crore. 10 the share, which means 3 crore share. 3 crore into face value 10. Understood? So 3 crore is the outstanding number of shares. Now this 3 crore shares are there. Into market value, you will apply. Market price per share is how much? Equity share price is 30. So 3 crore into 30, 90 crore will be the market price per share. Okay, give me 1 second. I'll be back. Now, see here, what happened? 90 crores market value. Like this preference shares, you have market value 80 per stock. So how many shares outstanding? 100. So 2 crore divided by 100, 200 lakhs divided by 100. How much is that? 2 lakhs. So this 2 lakhs into 80 per stock. How much is the value? 160 lakhs, which is 160 lakhs, 1.6 crore. What they have done, this is book value, market value 1.6. Are you understanding? They are putting in crores. So you got 1.6 crore or 160 lakhs. Okay, you can also present it fully or in lakhs also you can present. No way, no issue. You can take in loan. So 14% debenture, term loan, it will not change. Book value will be same. Debenture 90, 20 lakh debentures outstanding into market value of the debenture, you will consider. Okay, weight will change. Why? Because the revised total will be 134.6. Are you understanding? Total value, market value will be of all these instruments will be how much? 134.6 crore. So proportion will also change and then this proportion multiplied with cost. Cost will not change. Already you computed. That cost will remain same. Are you all understanding? Just because you change the value, market value, cost of capital will not change. Are you all understanding? Now, cost of individual capital will not change. Overall cost of capital will change because of the market value. Are you all understanding? So 15.085%. Already we discussed nothing new. Till now, we already discussed all these things. See here, the beauty here they have, removed the retained earnings, giving note also. See what they have given. Since retained earnings are treated as equity capital for purpose of calculation of cost of specific source of finance, the market value of the ordinary shares may be taken to represent the combined market value of equity and retained earnings. The separate market value of retained earnings and ordinary shares may also be worked out, allocating to each of the percentage of market value using their percentage of total value book value. Can you see this book value? Using book value proportion, you can allocate the market value of equity. But okay, so which means they have taken both stand. Alternatively, they have given, which means you can either completely remove it or you can again calculate the proportion, then calculate the cost as well. Anyway, whichever is comfortable, I believe this is sufficient. This is the correct way. You don't need to show retained earnings separately. Why to compute the retained earnings separately, proportion, again calculation, again 10 minutes will be wasted. If this is accepted solution, institute has accepted it. So what you should do, use the shortcut, directly use the market value of the equity. Shall we proceed? Okay. Now, we'll move on to the main thing, marginal cost of capital. Now, I'll come back to the marginal cost of capital here. See what happens. First, I'll read out the question. I've not discussed the question itself now. What they're asking, okay, weighted average cost of the capital for the additional cost, futuristic cost, 20 crore I needed for the for finance the next project, assume next year. This 20 crore, what will be the cost of capital specifically for this 20 crore funds? This also, I don't raise only through debt or equity. I raise through a various combination of amount. Are you all understanding? So for this 20 crore, what will be the cost of capital? What will be my cost? Are you all understanding? This is what is called as marginal cost of capital. This 20 crore, out of this 20 crore, the amount will be raised of equity and debt in equal proportion, which means the 20 crore I will raise using 10 crore equity and 10 crore debt. Agreed? Out of this, okay. The company expect to retain 3 crore earnings next year, which means, yes, I need this 20 crore, but out of this retained earnings, I will have 3 crore. I will have retained earnings of 3 crore. Additional issue of equity shares will result in the net price per share fixed at 25. If I do the additional issue, this can be raised at 25 rupees. Okay, the debt capital raised by way of term loans will cost 15% for the first 5 crore and 16% for the next 5 crores. You are understanding? So 20 crore I require. Out of this 10 crore is, see what is happening. I'll give you a background here. Just use these spaces. Okay, 20 crore is the additional fund required. Agreed? 10 crore is equity. 10 crore is debt. Okay, in the debt also there are two debts here. One is debt up to 5 crore. Up to 5 crore, you will have how much interest rate? 15%. Beyond 5 crore, balance 5 crore. Balance 5 crore. You will have 16% interest rate. Are you all understanding the structure? Then 10 crore equity is there. There also, if you see, already I expect to retain 3 crore. 3 crore will be funded through retained earnings. Balance 7 crore I need for fresh issue. Fresh, okay, issue of capital. Which means 7 crore, 3 crore is their total type. Are you all understanding? For this 7 crore fresh issue only, the share price I need to take as 25. At 25, I will raise the capital. 3 crore already I will have the retained earnings. Shall we compute now? See, now what happens, you see. Now you see, working note. Again, you need to compute the K. Why we compute the K? This K is only attributable to the new capital of 20 crore. Are you understanding? Existing K will not work here. Revised K we need to find out. What is that? See, D1, again, D1 I will use a 3.6 same dividend, but the P0 will change. Since the P0 is changing, growth rate 5%, nothing given. Now you will assume the same growth rate will continue. Are you understanding? Dividend and the growth rate will not change. So D1 and G will not change. but P0 will be 25. Are you understanding? So I will find out D1 3.6 divided by 25, D1 by P0 plus 0.05, 5%. If I solve this, I'll get 19.4% as KE. This is revised KE. Revised KE. I'll get this revised KE. Yeah. Next working note, cost of debt. Again, I need to find out the cost of debt for the new capital. Okay, to be raised. How to find out the cost of debt? Interest I need to find out. Nah. So there are two debts. Working note number 6 la, I have two debts. One is 15% debt, 16% debt. Why? So for 15% debt, first 5 crores. Second 5 crores, I will have 16% debt. Are you all understanding? So for 15%, interest into 1 minus T. Why? There is no redemption, okay, other things. So simply 1 minus T. Term loan. This is term loan, I just told you. So the redemption will not be there. So interest into 1 minus T. So 15% into 1 minus T, 30% is tax rate. 10.5% after tax cost of debt for the first debt, 5 crore. Next 5 crore, 16 into 1 minus 0.3. How much is that? 11.2%. Are you all comfortable? So which means this is after tax debt 1, KD1. This is after tax KD2. Are you all understanding? What is the cost of retained earnings? So 3 crore retained earnings is there. Now what is the cost? Or KE will be there. Personal tax rate is not given. So KE will be KR. No issues with regards to that. Are you all understanding? So cost of capital 19.4 and here also 19.4. Both are one and same. Okay, cost equity capital 7, retained earnings 3, debt, first debt 5 crores, second debt 5 crores, total comes to 20 crore. This is only the additional capital, marginal capital which I require now. For that only I am computing KO separately, WACC separately. So weight is 35%. How I got 35%? 7 divided by 20, 3 divided by 20 I got 15%. 5 divided by 20, I got 25%. Again, 5 divided by 20, 25%. Are you all comfortable? Weight, multiply the weight into weight with the KE, the cost, you will get the weighted cost. Total it, you will get 15.125%. Are you all understanding this? 15.125% is the nothing but marginal cost of capital. Marginal cost of capital. Okay, with this we are through with the chapter of the day. Cost of capital. Fully everything I have discussed. Okay, nothing to be discussed. Very, very important chapter from the exam perspective. Every attempt they ask at least for 7 marks in this regard. Yes, one small segment is there which I put it under cost of capital. Brief discussion within 5 or 10 minutes I will discuss and move on. Valuation of securities. This I put it under cost of capital segment. Okay, in CA final or CMA final, we'll have elaborate discussion regarding valuation of security. But at inter level, they have given some brief discussion. They have given some brief notes regarding valuation. And then they have not given specifically questions, but then they have moved on. Are you all understanding? So I'll also discuss briefly and then move on. Shall we discuss this? Okay, see. What is happening? Again, I told you the cost of equity, the cost of specific capital when we discussed, I told you actually I discussed under cost of equity. While discussing cost of equity, I told you there are 4 models, etc. I told you dividend discount, dividend model, okay, constant dividend model, constant earnings model, dividend growth model, CAPM, like this I told you. Really speaking, the cost of equity is actually derived from the valuation formula. Are you all understanding? So what is the value of security? Now, value of any asset, okay, equity shares, maybe equity shares, it may be debentures, any asset. As per there are so many methods of valuing a share or valuing any instrument. Okay, very common and frequently used method, discounted cash flow method. What is this method called? Discounted cash flow method. So value of any asset as per this discounted cash flow method is nothing but present value of future cash flows discounted at required rate of return of the investors. Which means if I'm investing in debt, what is the cash flow which is derived from the debt? What will the debt instrument give? Assume I'm investing in debenture. What will debenture give? Debenture will give me interest every year. Debenture will give me redemption. So interest and the redemption will be there. This is all the cash flow which is given by the debt or debentures. This, if I discount using the my required rate, debt provider's required rate of return, okay, I will get the value of debt, value of debenture, okay, fair value of debenture. This is what I have discussed here. So value of debenture is nothing but present value of future interest and redemption discounted at required rate of return of the debenture holders. Required rate of return is also called as YTM or cost of debt. Simply understand that is KD. So which means, very simple terms, interest, irredeemable debenture. That is why if you notice, cost of debt, how we found out? Cost of debt is nothing but interest into 1 minus T divided by what is that? Value, that is, net proceeds. Okay, let's assume this be irredeemable debenture. You got net proceeds. This net proceeds is nothing but value. Value of debenture is nothing but, when you rewrite it, value of debenture is nothing but interest divided by KD. Interest into 1 minus T. Okay, after tax, now this value from the investor's angle. So investors will not have tax benefit. Hence, I am removing the 1 minus T. Are you all understanding? Profound discussion is involved. I don't want to complicate things. I just want to summarize and then move on. Are you all understanding? So anyway, we are going to discuss in the capital structure theories. So this is the cash flow received from, interest is the cash flow received from the debt instrument, debentures. Correct? This interest, if you discount using KD, I'll get the value of debentures. Are you all understanding? Okay. The next, value of preference shares. What do you get by preference shares? Preference dividend. If you discount the preference cash flows, preference dividend using KP, preference cost of preference shares, you will get value of preference shares. Are you all understanding? Okay, value of preference shares is nothing but present value of future dividend, preference dividend, present value of dividend. How to discount it? How to find out present value of dividend? PD divided by KP. Okay, you will find out the value of debenture. Next, value of equity shares is what? Dividend based model. You have two models: constant dividend model, dividend growth model. Already I discussed now. Constant model. What is P0? P0 is nothing but value. P0 or V0 is nothing but D by KE. Therefore, KE become what? D by P0. Really speaking, okay, I told you now, there itself P0 is equal to D by A. Present value of the future cash flows. Dividend will remain constant. D divided by KE, discounted using cost of equity, required rate of return of equity. See, cost of equity is also called as required rate of return of equity. Some adjustment has to be done. Predominantly that is that, because cost, the equity cost will be from the company's angle. For investors, it will be return. For whatever is the return for the investors will become cost for the company. Assume I am investing in Reliance Limited debentures. Okay, I require 10% return. They have to pay me 10% now, that will become the cost. But there 1 minus T is to be adjusted because they will get the tax benefit, because that is for expenditure for them. Anyway, all these things detailedly regular lecture. Here I just want to discuss the formula. See, so P0 is equal to D by K. This is constant dividend model, the value of debenture, value of equity. If you find out the value of equity based on dividend growth model, what is the formula? P0 is equal to K D1 by K minus G. This only became later KE, rearrange it, you will get KE as, so KE minus G is equal to D1 by P0, or K is equal to D1 by P0 plus G. Are you all understanding? Now, this is all about the valuation of security. I have given a brief, okay, the value and the cost are interlinked. Okay, that is how I told you. In the capital structure theory, we will discuss anyway. Shall we move on to the next chapter? So, we'll start with the new segment, that is capital structure theory. See, very important theories. Broadly, we have 4 theories to be discussed in this segment: NI approach, NOI approach, traditional approach, and Modigliani Miller approach. What is this chapter all about? What is this segment all about? Whether financing decision will affect the shareholders' wealth. Question to be answered. See, what is the issue now? Whether the company's decision to raise the funds, okay, whether through equity or debt or preference share, these are called as financing decisions. This is called as financing decision. From where to get the money, it's called as financing decision. Whether this decision will affect the shareholders' wealth, or put it simply, whether the capital structure, okay, will affect the shareholders' wealth, which means if your EBIT is same, operating profit and all the other details are same, capital structure changes. We discussed in capital structure planning now. EBIT will be same. Okay, debt equity ratio will be different. Interest will be different. Equity shares will be different, right? So capital structure will be different. Whether changing my capital structure will affect the shareholders' wealth through share price, which means whether the ultimate value of the company will get affected due to this financing decision. The question to be answered. So we have predominantly 2 sets of theories. Okay, one set of theory says yes, it will affect shareholders' wealth, and no, it won't affect the shareholders' wealth. Yes, it will affect the theory of relevance. This is called as theory of relevance, and this is called as theory of irrelevance. Under theory of relevance, yes, financing decision will surely affect the shareholders' wealth. 2 theories come under this segment. That is NI approach and traditional approach. Net income. What is NI? Net income approach. Then there is traditional approach. No, Okay, it is irrelevant. Financing decision, whether you raise capital through equity, whether you raise through debt, different debt equity ratio, it doesn't matter. Okay, it doesn't change the value of the company. Value of the company will ever get affected through the different capital structure of the company. So NOI approach says that, and approach, NOI, not net operating income approach, and Modigliani Miller approach. So 4 theories are there to be studied. Before we move on to theory, some common assumptions is there. Very, very important to understand these assumptions, because to prove any theory, you need some basic assumptions. You can't question the assumption, because assumption to remove a lot of impracticability. Okay, they bring in some assumptions. So here, what are the assumptions? Point number 1 is all the broad assumptions. Okay, just a summary of all the assumptions. Only 4 assumptions. There are many assumptions, but only 4 I have given to summarize. Okay. Only 2 sources of finance are available: debt and equity. There is no preference. So in this chapter, you will not come across any preference share capital. Are you all understanding? So these 4 approaches, you will never come across preference share capital or retained earnings. Nothing will be there. Are you all understanding? So debt and equity will be the only portions. Yes, of course, equity includes the retained earnings portion also, which means the other things will not be there. Only debt and equity will be there. 2 sources of finance. And debt is irredeemable debt. Debt always will be irredeemable debt. You don't have to think about the redeemable debt here. Only irredeemable debt. Assume to be irredeemable debt. Then 100% dividend payout ratio. Whatever is the profit earned by the company, the earnings earned by the company, it will be distributed as dividend. 100% payout ratio means assume net profit is 100 now. Dividend payout ratio 100% means what? The entire net profit is equal to dividend. Are you all understanding? Which means PAT will be equal to dividend. Are you all having the clarity? Next, no taxes, later relaxed. See, initially when they came up with this, they did not include any taxes. The assumption was there is no tax, without tax. But later they understood that debt is having tax shield. Therefore, it will be very vague to conclude a theory based on no tax assumption. So later this got relaxed after so many years. They got relaxed. This theory got relaxed, which means this part of the assumption got relaxed, and which means we have in our syllabus with tax, without tax. That is it. They relaxed it. Now we have without tax questions, with tax questions. How to deal with all the situations I will discuss. No issue. Okay. So these are all the broad assumptions. Now, some important formulas you need to understand in this segment, capital structure theories. You need to remember. What is the formula? Very simple. Value of the firm. Value of the firm is nothing but total. V means value of the firm here. B means total value of the borrowings plus value of the share. S means share. B means borrowings. That is what they have given there. It is to be understood as value of debt plus value of equity. So value of entire company is nothing but value of all its equity shares plus value of all its debentures or debt instruments. Are you all understanding? Why only value of these two? There are only 2 sources of capital. Already we know the assumption. Are you all understanding? So value of the total firm is nothing but total value of the borrowings plus value of the equity shares. This is very simple. Next, value of borrowing. Sir, what? See, you told that value of the company is value of the borrowing plus value of the shares. But what is value of borrowing? Value of borrowing is nothing but interest divided by KD. Are you all understanding? Now, what is interest divided by KD? Now, very simple. Value of any asset, you already know this. Present value of future cash flows discounted at required rate of return. That's why I discussed under valuation. Briefly, I discussed. That is actually derived from that. So, present value of the future cash flows. Now, if I am investing in debentures, what I will get? Interest I will get. So, interest is the cash flows received from debenture divided by KDE. Cost of debt is the required rate of return of the debt providers. Okay, so it is when the debenture cash flows interest discounted using KD, you will arrive at value of the debt, or it is something value of the borrowing. Are you understanding? Now, you may ask, sir, here there is no I divided by KD, but there is no RV plus RV minus SV divided by N, the whole divided by RV, SV, where that is gone? Okay, it is not there now, don't worry. See, the debenture we are discussing here is irredeemable. It is assumed to be irredeemable. Therefore, no. RV minus SV divided by N, all these things will not be there. Only I divided by KD. Sir, interest into 1 minus T we studied now. That also will not be there because no taxes assumption. Are you understanding? No tax assumption. So there will be no interest into 1 minus T also. Okay, simply I divided by KD. The cash flows which you receive from debt instruments divided by cost of debt divided by KD, discounted using KD. The KD is for capitalization. Discount and bring it to present value terms. You will get the value of the debt. Are you all understanding? And this is the present value of perpetual interest. Why? Because the debenture is irredeemable. Na? Only interest we will receive. There will be no capital redemption. Are you all understanding? Next formula, two formulas. Point number 3, third formula. What is value of S? You already studied value of B. Now value of equity share. S means value of equity share. What is value of equity share? EBIT minus I divided by KE. EBIT minus I divided by KE. Sir, what is this? I don't understand. I'll just explain very simple. See what happens here. See, you already know the income statement. Let me write it. EBIT minus I, okay, will give you EBT. Then if you reduce the taxes, you will get PAT or EAT. Agreed? Now, if you this you are getting yes. Now, if you pay out the dividend, you will get retained earnings. Na? Are you all understanding what I'm trying to say? Here, what they say is that, see, now, see, here they say EBIT minus I already is the numerator. No issue. Are you all understanding? Now, what is the value of share? Value of share is nothing but equity cash flows you discount using KE, you will get the value of the share. No, sir, EBIT minus I is not equity cash flow. Only PAT is what is equity holders will earn, right? That is why, see, EBIT is equal to I is EBT. EBT is equal to PAT because no tax assumption. Are you understanding? We have no tax in this in this theory. Okay, capital structure theory. No tax. Later it was relaxed, tax was there. If tax is there, what the formula will undergo a change. I will tell you how it will change. Are you understanding? So if there is no tax, this is the logic for the first formula. EBIT minus I will become EBT. EBT will become PAT because there is no tax. Directly it will become PAT. Now, sir, what is this? I don't understand. EBIT minus I divided by K is nothing but D by KE. We already know constant dividend model. Constant dividend model. Okay, we use that and find out this. Are you all understanding? This is as per constant dividend model. Now, see how we got D by KE. Very simple. See, EBIT minus I, no tax is there, it will become PAT. Then PAT also will be dividend. PAT is equal to dividend. Sir, how you are saying PAT, entire PAT is equal to dividend? Because, okay, 100% dividend payout ratio. 100% dividend payout ratio. No retention is there. Okay, so entire PAT will be dividend. So dividend divided by KE will be there. Sir, okay, I studied growth model. D1 by P0 plus G, this is D1 by KE minus G. D1 by, see here, 1 second. I'll just write it here. I know formula called D1 by KE minus G, dividend growth model. Why there is no growth model used? Very simple. There is no retention. What is growth? B is, see, what is growth? G is equal to B into R. Retention ratio into retained earnings. If the company retains, then only it will grow. If the company pays out 100% dividend, 100% payout ratio is the assumption for this model. If you pay out 100%, okay, everything will be paid out as dividend. Then there will be no growth. Zero growth rate will be zero. Are you all understanding? Hence, constant model to be applied. D by K, D by KE. That will give you, okay, shareholders value. Are you all understanding? So equity value. What is the value of S? S is equal to nothing but D by KE. Are you all having the clarity? Shall I proceed? Okay. Now, next, we know this. Now, fourth formula. So, value of the firm is EBIT divided by K. Before that, without tax, I discussed. With tax, there is formula. This formula can say and be applied like this. EBIT minus I. Okay, if there is tax, you consider the tax. Make it after tax. Are you all understanding? If there is tax given, like Modigliani-Miller theory or NOI approach with the tax given, you apply the tax rate and then discount it using KE. Are you all understanding? Which means EBIT minus I is there. Then you reduce the tax. You will get the earnings available for shareholders. This EBIT minus I into 1 minus T is nothing but EAS. This is called as EAS, earnings available for shareholders. Divided by, from here only you distribute dividend, divided by KE. Okay, you will get the value. Are you all understanding? With tax, what is the value of the share? Next, value of the company. Yes, there is two formula. Value of debt plus value of share. But sometimes what will happen, we are going to explain. Okay, NI approach, NOI approach. One of the approaches, okay, okay, see, in under NI approach, you will find out the value of the debt, value of the share, you will add it. But under NOI approach, you will find out first value of the firm, and then reduce the value of the debt, you will arrive at the value of equity as balancing number. In that case, okay, value of the firm, how I need to find out? Now you need to understand the basics. Very simple. See, value of equity, I will write here, value of equity is equal to equity cash flow, which is nothing but EBIT minus I divided by K. Divided by K. Value of equity is nothing but EBIT minus I divided by K, which means the cash flow available for equity holders discounted using K divided by K. Value of debt is equal to what? Okay, the cash flow available for debt holders, which is interest divided by KD. Okay, when value of firm you are calculating, when value of the total firm, okay, which means the cash flow available for, which means the profit available for all the fund providers, which we call it as EBIT, operating profit, EBIT divided by KO. Okay, if there is no tax, this will be the value of the firm. Are you all understanding why EBIT is the profit available for all the fund providers? From here only, from EBIT, okay, from here only I pay interest. From EBIT only I pay, what is that? Preference dividend, equity dividend, and tax. Everything I pay from EBIT. So EBIT, okay, is the profit available for all the fund providers divided by KO. Are you all understanding? Okay, very simple terms. I will tell you. See, now, see, I'll just tell you, if this is without tax, if there is no tax, this to be understood. This is to be understood. Value of the firm is EBIT divided by KO. Overall cost of the capital. If you discount the profit which is available for all the fund providers using all the overall cost of capital, weighted average cost of capital, you will arrive at value of the firm. Now, when there is tax given, what you will do? EBIT into 1 minus T, net operating profit after tax, because see, EBIT belongs to 4%. 1 second. EBIT belongs to 4%. Interest, okay, I pay debt holders interest, then government I will pay tax, then preference dividend and equity dividend. Are you all understanding? So 4 things I'll pay. Here if you see, the tax doesn't belong to us, it is belong to government. Yeah, so anyway you have to pay tax. So when tax is given, you have to adjust the EBIT, bring it to after tax. Are you all understanding? Interest you should not reduce, only tax you should reduce. Directly you should reduce from the tax. So EBIT into 1 minus T divided by KO. If you do, you will get the value of the firm. Are you all understanding? Now this is the formula, 4th formula. The last formula is a Modigliani formula, approach formula, formula. Okay, and NOI approach also with tax. This formula will be used. What is the formula? Okay, value of the levered company is equal to value of unlevered company plus borrowings into tax. Are you all understanding? So levered company means very simple. What is levered company? Levered company where with the company in which there is debt in the capital structure is called as levered company. Okay, the company in which there is no debt involved in the capital structure, okay, that is called as unlevered company or all equity company. Unlevered company is also called as all equity company. There is no debt involved. So levered company value will always be more than unlevered company value is what is the formula suggests. Value of levered company is equal to value of unlevered company plus borrowings into tax rate. Tax rate will be given, if assume 5 lakhs is the borrowings, into 30% is the tax rate. Now 1,50,000 you should add to the levered unlevered company to arrive at the value of levered company. Value of levered company is equal to value of unlevered company plus borrowings into taxation. Are you all comfortable with all the formula? Logic also briefly I discussed. Okay, elaborate discussion in the regular lecture. Here I cannot do everything. Now, shall we move on to each and every approach? So what I will do is that in the first segment, I will discuss the NI approach concept, NOI approach. Both the concept I will discuss, and we will cumulatively do questions related to NI approach and NOI approach because these two are interrelated. Both are found by same person, Duran. Okay, so we'll discuss that. Thereafter, we will move on to traditional approach and Modigliani Miller approach. Shall we see? First, NI approach. What this approach says, now I'll tell you briefly. The crux of the discussion, see, is debt is a cheaper source of capital. What they say, debt is the cheaper source of capital, and that is true. That is universal. Everyone accepts that debt is a cheaper source of capital. For example, I'll give you one example. Okay, you want to raise the capital through equity shares. You see, we assume I'm an investor. I'm going to invest in FD. There is another person who is going to invest in Reliance Limited share market. Yeah, share. You tell me which is risky. Share market is risky. Yeah. The FD or the government of India bonds is risky. Yeah. the name is risk-free rate of risk-free asset, correct? So risky share is always called as risky asset. Why? You don't know, the return will not be fixed. Sometimes it may give you 20% return, bumper profit, lottery. Next year they may give you negative return of 20%. Capital will be lost. Possible? Yes. So share is risky instrument, then the equity instrument is risky. That's an equity instrument. Equity instrument is generally risky. So it will demand a higher cost of capital. Why? Because for a company, if you raise equity, you have to pay them more for compensation, as a compensation for the risk undertaken. Are you understanding? Debt, if you borrow, you can borrow cheap at 7%, 8% borrow. Happens now, right? So owner's fund is always costly. So debt is a cheaper source of capital. In a cost of capital chapter also, if you see, KD will be always less than KE. Are you all understanding? This I already know that. So debt is a cheaper source of capital. When we keep on injecting debt into the capital structure, what does NOE says? NI approach na net income approach. Net income means, okay, PAT is called as net income. Profit after tax is called as net income. The bottom line, okay, that is called as net income. Net operating income means EBIT. I'll come back to that later. Are you all understanding this net income approach? What they say, debt is the cheaper source of capital. KD will be less than KE. Agreed? Now, if we keep on, see, we are first 100% equity capital. We have 100% equity, all equity company. I keep on adding debt into the capital structure. First I borrow 10%, then I borrow 20%, then I borrow 30%. Like that I keep on injecting debt into my capital structure, keep on increasing the borrowing. What will happen? Debt being a cheaper source of capital, my WACC will reduce. Overall cost of capital will reduce. Are you all understanding? See, KO, in the cost of capital chapter, we saw that KD will be less than KE. Up KE say is 20%. KD is 10%. You tell me WACC 50-50 ratio. Now WACC will be something like 15%. 10 into 5, 5%. 20 into 5, 10%. 10 plus 5, 15%. Like that. Remember that KO will be always in between KE and KD. Are you all understanding what I'm trying to say? See, in all equity company, if your company only has equity shares, then KE will be equal to KO. Agreed? Why? Because only equity shares are there. Cost of equity will be the overall cost of capital. No weight, proportion, source, only one source of capital. Agreed? Now, when you keep on increasing debt into the capital structure, all equity company, my KO will decrease or increase or decrease. Why? Because K is equal to KO. Now assume your KO is 20%. K is 20%. Therefore, KO is 20%. If you keep on adding 10% of cheaper source of capital into the capital structure, the KO will reduce. The KO will reduce. Are you all understanding? If the KO is reducing, ultimately the value of the company will increase. Why it will increase? What is value of the company? Value of the company is nothing but EBIT divided by KO. Up KO, okay, this is a discounting rate. When you divide it by a lower percentage, okay, if the KO assumed 20%, 5 lakh divided by 20% you do, and 5 lakh, same 5 lakh divided by 10% you do. What is this value? 5 lakh divided by 20%. 5 lakh divided by 20% is how much? 25 lakhs. This is 25 lakhs. And 5 lakh divided by 10% is how much? 50 lakhs. Are you all understanding? What is the understanding? If you keep on increasing the denominator, if you keep on decreasing the denominator, KO, if decreases, it will increase the value. These are inversely proportionate. Are you all understanding? Increase the KO, it will reduce the value. Okay, decrease the KO, it will increase the value. Now what happens? Okay, due to the additional debt in the capital structure, I keep on adding debt now. My KO is getting pulled down, my KO is reduced. If KO is reduced, value of the company will increase. Hence, as per NOI approach, more debt, more valuable. Higher the debt amount in the capital structure, value will increase. Therefore, financing decision will surely affect the value of the company. This is what NI approach says. Net income approach says. Are you all understanding, my dear friends? See, here, debt is a cheaper source of capital. When we keep injecting debt into capital structure, KO will reduce. Hence, value of the company will increase. Agreed? Next point, sir. So, what is the maximum? What is the optimum ratio, optimum proportion capital structure as per this theory, NI theory? They say that 100% debt, only run the business through borrowing. Don't put your own money, only keep on borrowing and do the business, you will earn maximum value. Are you all understanding? This is the proposition of the Durand. Are you all understanding? Maximum value will be 100% debt, 0% equity. Optimum capital structure is 100% debt, 0% equity. Why? 100% debt, KO will be KO will be KD 10%, maximum value will be 50 lakhs. Are you all understanding like that to be understood? Just for example, I gave you, understood the point? Okay, maximum debt, 100% debt, maximum value will be realized because at that point only KO will be minimum, value will be maximum. That is what they say. Okay. What happens? I've just put this in graphical representation so that you will understand the crux of the discussion. See what happens. This is the percentage, okay, and this is the borrowing divided by equity, not the proportion of the debt in the capital structure. You keep on increasing the debt. If you keep on increasing the debt more and more, what happens? You see, KD will be constant. KD will be same. Anyway, KD will not change. As per this method, KE also will not change. As per this method, KE will also not change. But as and when you keep on injecting the KD into the capital structure, KO, this line is what? KO. Can you see this KO? KO will keep on reducing. KO will keep on reducing. Initially, all equity company, this point was KO. KE is equal to KO. But later on, when you keep on adding KD, the KO will keep on reducing. And at this point, maximum point, when the point of interception, when touches, KO will become KD at 100% 100% debt equity. What is that? Debt ratio. Are you all understanding? Entire companies of debt. This is the proposition by NI net income approach. Durand proposed this model. Are you all having the clarity? I will discuss NOI approach also cumulatively. Thereafter, I'll tell you what is the steps to be taken. So, as per NI approach, first you need to understand that as per NI approach, KE and KD will be constant. KO will keep on changing. KO will keep on reducing. Agreed? KO will keep on reducing as and when we keep on increasing the debt into the capital structure. Therefore, as per this model, what will happen really? First, you will find out value of debt. Okay. Then you will find out value of equity. Okay. The first you will find out value of equity. Then you will just add value of debt. Then you will get value of the firm. Are you all understanding? Total value of the firm you will get. So, first value of equity is known as S. And then value of borrowing will be given in the question. You will add and arrive at the value of the firm. This is how you will do NI approach. NI approach. Okay, this is what you should do. Are you all understanding, my dear friends? When tax is given, you will 1 minus T you will do. Are you all understanding? Okay, you will take 1 minus T and then you will find out the value of equity. Thereafter, you will add the borrowings. You will get the value of the firm. Is this fine? Next, NOI approach. NOI approach also same Durand proposed. Durand only research this NOI approach also. Sir, what is this? He told NI approach. He is only telling NOI approach. Now both are same argument, or different argument by the same person. See, if you see the comedy, NI approach Durand gave and NOI approach also Durand gave, but both are different proposition, which means one approach, one theory, he says that it will not affect the value of the company. It will affect the value of the company. NI approach. NOI approach says it will not affect the value of the company. That also proposed by him. Okay, anyway, this is a theory now. Anyway, now, in this theory, what happens? As per the NOI approach, same discussion, only one change. KDS will reduce KO. I agree that debt is a cheaper source of capital. KD will reduce the KO. Fine. But apart from that, one more thing will happen. When you keep on increasing the debt, when you keep on increasing the debt in the capital structure, KE will not be constant. Are you all understanding? KE, the equity share, KE represents equity shareholders' risk, which means that is required rate of return of the equity holders, which is actually a compensation for the risk undertaken for the equity holders. What happens is that the equity holders will feel risky. See, the companies keep on borrowing. Equity shareholders will be patiently just seeing the picture. What is happening? No. They will be selling out their share. They will be feeling the agitation. Are you all understanding? They will not be keeping quiet. Okay, so when you keep on adding KD, yes, it is cheaper source of capital. It will decrease KO, but simultaneously it will also increase KE. So what happens now? One thing, KD will pull down the KO. This is point number 1. Increase in KD will also increase the KE. Two things will simultaneously happen. And because of the two things, what happens? KO will be like, okay, frog inside the mouth of the snake will be struggling. Okay, have you seen sometimes what happens? Small, okay, the snakes are there. If you see in the pond and all, the snakes, okay, for it is very, it is very fond of catching the frog. But sometimes whatever, snake will be smaller. Okay, snake mouth will not be enough to capture the big frog. But it will be very, very much, very likely to eat the big frog. So what will happen? It will catch the frog, but it cannot fully eat. So in that case, what will happen? Okay, frog will also shout, okay, let me die. Okay, and the snake will also try to swallow, but both things will not happen. Okay, it makes a struggle, and therefore for so many prolonged period, okay, snake will also be trying to swallow, and frog will also try to, okay, shout and get out of its mouth, right? The point is here, KD, increase in KD pulls the KO down, but KE also simultaneously increasing. This pulls the KO upwards. Are you all understanding? So KE will be pulling KO upward. Increase in KE will be pulling KO upward. Decrease in KD will be pulling the KO. Increase in KD will be pulling the KO downward, leaving KO unchanged. Are you all understanding? One horse cart is there. This side one horse is there. That side one horse is tied. And both the horses are pulling the cart in the opposite direction. And at the same strength or the same equal strength, the cart remains unchanged, unmoved. Are you all understanding? Like that, this NOI approach says KO will never change. KE will increase, but KO will not change. Are you all understanding? This is the beauty of the theory. See what happens. KD will reduce KO, being cheaper source of capital. I agree that. But when debt increases, it also increases equity shareholders' risk. Thereby, KE will increase. Are you all listening? Okay, so KE upward pull. Okay, KD downward pull. And both this keep KO constant, which means one is pulling upward, other is pulling downward. KO will become constant. It will never move. This is what NOI approach says. Traditional approach, like we will see that the upward and downward pull will not be same. Therefore, KO will undergo a change. Are you all understanding? This is what traditional approach. Difference between NOI and traditional. Anyway, I will discuss there. But understand that this is having profound discussion. Okay, see now a profound implication. I mean, see. This is the table I have given, this is the chart I have given for understanding NOI approach. What is the beauty here? KD will be constant. KD will be constant. If you keep on adding debt into capital structure, what happens? It will increase the KE. Can you see the graph? The KE is keep on increasing in a linear manner. Correct? When KE is keep on increasing, KD also you are adding, leaving KO unchanged. The KO remains same. Are you all understanding? Under NI approach, KE will not have any impact, hence KO will reduce. But here, KO will try to reduce because of debt, but it will also increase because of equity, keeping the KO unchanged. Okay, this is what NOI approach says. So, as per this approach, what you should do here? First, okay, KO will be unchanged, Okay, EBIT divided by KO, you will use this formula and find out the overall value of the firm first. Thereafter, reduce the value of the borrowing or value of the debt or borrowing simply. Okay, value of the borrowing, you will get value of the share or just a value of the share. Are you all understanding? S or V or S, anything you can write. Okay, S means value of the share. So, value of the equity, you will get it as balancing number. Value of equity, balancing number. There, NI approach, what we did? Value of equity first we found out, then add debt, you will get value of the firm. Here, first to find out value of the firm using EBIT. EBIT is also called as net operating income. Income. That is why this approach is called as NOI approach, net operating income approach. There it is called as net income approach. By net income means PAT. PAT divided by KE, you found out first what? Value of equity. First value of equity, then residual value is the value of the firm. Here, value of the firm you find out, then reduce the value of the debt, you will find out value of equity as a residual value. Are you all having the clarity? As per NOI, KO will be constant irrespective of the capital structure. KO will be constant. See here, one second. Why I cannot? KO will be constant irrespective of the capital structure, and hence value of the firm will remain same at all times. KO will be constant. In this approach, KO is constant. When KO is constant, you tell me whatever EBIT will be any number. KO if doesn't change, at all times value of the firm will be EBIT with KO will be same. Are you all understanding? And this is what is the NOI says. Hence, financing decision will never affect the value of the firm because KO is unchanged. Now, NOI approach, while solving the question, you need to remember two things. It can be solved without tax and with tax. If without tax is there, what will you do? Simple formula, EBIT divided by KO. Already I told you. Because NOI approach, the first step is to find out value of the firm minus value of the borrowing, you will find out value of equity. Correct? So, value of the firm, EBIT divided by KO, no tax involved. Correct? But when you use with the tax, okay, when you use with tax, you should not, okay, when you use with tax, it will be treated on par with Modigliani-Miller approach. He will give you a formula, approach, this formula. Okay, this also used in NOI approach when tax rate is given. When tax rate is given, NOI approach, okay, will be same as approach, not conceptually, but to find value of the firm, you will find out under this approach method. Are you all understanding? So value of levered firm, the fifth formula which I discussed now, value of levered firm is equal to value of unlevered firm plus borrowings into tax rate. Are you all understanding? See here. EBIT, find the value of the company, and equity value will be residual value, which I already discussed. First, EBIT divided by KO you will do. See, while doing question answer, everything will be adequately clear. I'm just discussing the concept. EBIT divided by KO will be value of the firm. From this value of the firm, remove the borrowing, you will get value of equity, or simply S. S is the, okay, the so value of equity is also denoted by S. So then K is equal to EAS by value of equity. Now after finding value of the firm, value of equity shareholder, if you remove the borrowing, you will get balancing number equity shareholder. Equity shareholder value you will get now. This value, see, value of equity is equal to what? Value of equity is equal to earnings available for shareholders divided by K. Then K is equal to what? EAS, earnings available for shareholders, divided by value of equity. This value of equity you would have already found out here. Value of firm minus value of borrowing. Okay, you will get the KE. Are you all understanding? If at all asked in the question, you will find out KE. Otherwise, you will find out, okay, value of the equity, that is sufficient value. Okay, KE. If asked in question, you will do. Now, come to the with the tax approach. With tax, what you will do first? With the tax, you will find out value of levered company is equal to value of unlevered into plus borrowings into tax. This you will use. You will find out the total value of the company, value of the levered firm, minus borrowing. You remove the value of the borrowing, you will get value of the equity. Okay. From this equity, now again, equity shareholders, this EAS is there, divided by this value of equity. This value of equity and this value of equity will not be same. Why? This is without tax, that is with tax. We are going to see one beautiful question in your study mat which covers both the angle. Of course, if you see the CMA, has better questions regarding these models in the study mat than CA. Even in CA material, I have taken questions from CMA and incorporated into my CA material because the questions are so superior in CMA material in this capital structure theories. Very, very beautifully coined. Now, shall I move on to the next stage? Okay. Now, there are these differences. I'll come back, okay, and discuss this after doing one question. Okay, 1 or 3 questions we'll do. Then only you will, actually appreciate the differences between NI and NOI properly. I have put it here, how to solve everything. I have put, okay, summarized here. But we will do 2, 3 questions. Thereafter, we'll come back and discuss this. Okay, take illustration number 1 here. The expected annual net operating income of a company EBIT is 50,000. The company has 2 lakhs, 10% debenture. The equity capitalization rate, KE, okay, this is KE, equity capitalization rate of the company is 12.5%. Sometimes they will use randomly capitalization rate simply. We have to contextually understand whether it is KE or KO. Okay, simply put value of the capitalization rate, it is KO. It can be also interpreted as KO. Depends on the situation. Okay, find the value of the firm and overall cost of capital under net income approach. Okay, the solution. See, under net income approach, they have given what I told you. First of all, under net income approach, what is to be done? First, you will find out value of equity. How to find out value of equity? In this question, tax rate is given or not given? Not at all given. So, EBIT minus I, the first formula without tax, I told you, 4 formulas left. Share, value of share. EBIT minus I divided by KE will give you value of equity. S is equal to EBIT minus I divided by KE. Tax rate is not given, so you will find out. So, okay, in a tabular manner, they have presented. Okay, value of the firm as per NI approach is what? First value of equity you will find out, then value of the debt you will add, on value of the firm you will find out. Value of equity, how to find out? EBIT 50,000 minus interest, 2 lakh into 10%, 20,000 is the interest. So, what is the earnings available for shareholders? Net income 30,000. So, EBIT minus I is how much? 30,000. 50,000 minus 20,000 divided by KE. 12.5%. What is the value of equity? Value of equity, market value of equity is 2,40,000. Are you all understanding the first step? 2,40,000 is the value of equity. Agreed? Now, what is the next step? As per NI approach, add a value of the borrowings. What is the value of debt here? How much is the borrowing? Nothing given. Book value will be market value. Okay, if details is not given. Okay, all in this chapter, most probably book value will be given. Market value is to be traded as market value. So, company debt alone I am discussing. So, debt has 2 lakh now. So, 2 lakh is the market value. Are you all understanding? So, this is value of equity. This is value of debt. Total value of firm is how much? 4,40,000. Are you all having the clarity? This value of equity, if you see, is also this value of equity is also called as S, and this is called as B. Are you all understanding? This is V. Like this also you can write, or simply you can write VE in a value of equity. Okay, accepted denote only in finance, so you can use that also. So 4,40,000 you got it overall. Now, see, you have KE 12.5. Yeah. Now what they ask, see, find out the value of the firm, first step, and then overall cost of the capital. By NI approach, KO will keep on changing, right? So first find out the value. Thereafter, you need to find out the overall KO. You need to find out. KO will be the balancing number. Are you understanding? Whatever, that is why I gave you the graph. Whatever number is changing, that only you will need to find out. Others will be given. Are you understanding? For example, this is NI approach. NI approach graph, if you remember, this is KD. What is stable? KE. And KO will be moving like this downwards. Okay? KO. Now you need to find out KO under NI approach. Are you all understanding? By KO, KE constant given in the question, KD given in the question, you need to find out KO. How to find out KO? See, what is KO? Before finding KO, we know that value of shares is equal to value of overall firm. Value of overall firm. Fourth formula. I gave you the fourth formula. Now, what is that? EBIT divided by KO. Without tax, na EBIT divided by KO. You know what is EBIT? So, from this, KO is equal to what? EBIT divided by value of the firm. EBIT divided by value of the firm. So what is EBIT here in this question? Here they have given. Are you seeing this? KO is equal to EBIT divided by value. Value of the firm is equal to EBIT by KO. Hence KO is equal to EBIT divided by value of the firm. How much is that? Okay. EBIT is how much? 2 lakh. See, EBIT 50,000. 50,000 divided by value of the firm is how much? 4,40,000. Please calculate how much you are getting. 50,000 divided by 4,40,000. You are getting 11.36. Okay, 11.36 is the solution. Are you all understanding NI approach? So you need to identify which approach, without tax or with tax, everything you need to have the clarity. So this is NI approach without tax. NI approach without tax. Next question. See. Assuming no taxes, so this is also no tax. Net income approach. NI approach without tax. Same type of question. NI approach without tax. Okay. Assuming no taxes and given the earnings before interest tax, EBIT, interest at 10% and equity capital, KE given. Again, KE will be given, KD will be given, EBIT is also given for different rate. What you should find out? First, you will find out what is the NI first stage. What is the first stage? Find out the value of equity or simply value of share. How will you find out? EBIT minus I divided by KE. Like this, you apply the formula, you find out the KE. Now, 4 firms are given. Because don't think KE is not equal. These are different firms having different EBIT. Are you all understanding? Hence, KE will not be same. Yeah, don't question that EBIT, KE is not same. Don't ask. Okay, because firm, different firm, also different EBIT. Agreed? That's why KE changes. Now, see what happens. So, independently, X, Y, Z, W. 4 firms are given a detail. So, 4 column you open. And then particulars, 4 different columns. X, Y, Z. First, EBIT, they have done it in tabular method. You can also use the shortcut, but shortcut, it is better to do this way. Okay, but conceptually understand what is happening. So, EBIT is given 2 lakh, 3 lakh, respective EBIT, then reduce the interest. What is this? This amount is EBIT minus I. Are you all understanding? For all these firms, you get EBIT minus I. Now, divided by KE. Write down the KE for all these firms. EBIT, so this is 1, 2, 3, 4. Upper 3 divided by 4. Equity earnings divided by KE. You will get value of equity. Value of equity is how much? 15 lakhs, 15 lakhs, 20 lakhs, 20 lakhs. Are you all understanding? Now, next, add market value of debt. Why NI approach? I told you now. value of the firm will be residual value. First equity value you will compute. Thereafter you will arrive at the value of the firm. What you will do? Market value of debt you will add. You will get the value of firm. Are you all understanding? Thereafter you will find out KO. What is KO? EBIT. This first number EBIT. Okay, divided by value of the firm, because there is no taxation given, hence you will not consider. Are you all understanding? Simply EBIT divided by KO, divided by value of the firm will give you KO. 11.76, 14.79, like this you will find out KO for each and every scenario. Here they have given note value of debt is equal to interest by KD. Okay, this we already know. The KO is equal to EBIT by value of the firm. Shall we move on to question number 7? Very, very important question. Comparative study of NI approach and NOI approach. Both the approaches we are going to do in this question. But the question will give you tax with the tax question. NI and NOI. NOI with tax. This is what we are going to discuss in this illustration number 7. Shall we? The company X and company Y are in the same risk class and are identical in every fashion, except that company X uses debt. So company X is a levered company and company Y is an unlevered company, all equity company. The levered firm has 9 lakh debentures carrying 10% rate of interest. Both the firms earn 20% before interest and taxes on their total assets of 15 lakhs. Total assets is 50 lakhs on 20%. This see, return on the total assets is nothing but the EBIT. Return on investment is nothing but EBIT. What they are saying is 15 lakhs into 20%. How much is that? Okay, 3 lakhs. Great. So 3 lakhs is the EBIT amount. Okay, for both the firms, which will be same. Both are identical in all nature except the capital structure, which means EBIT will be 3 lakhs. From there, you need to prepare income statement. Understanding? Assume perfect capital market, rational investor, and so on. All the assumptions will be applicable. A tax rate of 50% and the capitalization rate of 50% for an all equity company. All equity company KE given as 15% and tax rate is given as 50%. Okay, made simple, life made simple. 50% is easy. Now, compute the value of firms X and Y using the net income approach. One by one, step by step, we will compute. This is with tax, not without tax. So, with considering that in mind, we will compute what are all the steps. Shall we? Oh, see, simple. NOI approach. First, find the value of NOI approach. NOI approach, what is the procedure? First, to find out the value of equity. First, find out value of equity. What is the value of equity? Earnings available for equity shareholders divided by, okay, what is that? K. This you will do and find out the value of equity. What is earnings available for equity shareholders? EBIT minus I. But if tax is given, minus tax, okay, minus tax or into 1 minus T, both will be same. Are you all understanding? Minus tax amount in terms of rupee, if you want to reduce the amount, you will get the EBIT minus I minus tax amount, or EBIT minus I into directly 1 minus tax rate, 50% directly you get after tax number. Are you all understanding? This is nothing but profit after tax, earnings available for equity shareholders divided by K. If you do, you will find the value of equity, first step. Then value of debt you will add, you will find the value of firm. Are you all understanding what is the procedure under NI approach? Shall we do? Okay. Now, they have prepared value of the firm is nothing but value of equity plus market value of debt. First, value of equity you need to find out, because NI approach, KE will be constant. Find out value of equity, then value of the firm, because KO will change. Agreed? So, EBIT, what is the EBIT level? 3 lakhs, 3 lakh, both same under, both the firms will have same EBIT. Now, take unlevered first, unlevered company. I'll come back to the, anyway, they have given levered and see here. If you see, X is the levered company. What is that? Yes, X uses debt while Y does not uses debt. No issue. They have put levered company first, then unlevered company. Anyway, no issue. Minus interest. Interest how much? 90,000. Okay, what is the interest rate given in the question? Yes, 10% rate of interest on 9 lakh debentures. So before tax interest, what is that? 90,000. Next, what is that? PBT. Then reduce the 50% tax. You will get earnings available for equity shareholders. This is nothing but earnings for equity holders. This is, I told you, by EAS. Divided by K. K 15. See, if you see, all equity company, KE will be KO. If you see the company company Y, KE will be KO. Both will be same because all equity company, no debt involved. But here KO will change. Anyway, we will compute later. So equity, the KE will be 15%. Value of equity is what? 1,05,000 divided by 15,000. Here 1,50,000 divided by 15,000. 7 lakh and 10,000. 10 lakhs. Are you all understanding? This is value of equity. Add market value of debt. Market value of debt. How much given? 9 lakh given. Okay, book value will consider. So 7 plus 9, 16 lakhs is the value of the firm. For X limited, for Y limited, 10 lakh is the value of the firm. Are you all understanding NI approach? Next, what they have asked, one by one, we will try to solve. Compute the value of each firm using net operating income. Again, you tell me, a net operating income approach, how should we find out? We'll find out first value of equity, value of overall company, overall value of the company, which means value of the firm you will find out. So there also, first you will find out what I told you, NOI approach with tax will be equivalent to approach, the formula you should apply. Approach formula is what? Value of levered company is equal to value of unlevered company plus, okay, borrowings into tax rate. Now, value of unlevered company is the all equity company. From there only you need to start. Why? Because see, if you see the question, KO given, KE given, KE given. So, in value of when you find out value of unlevered company, KE will be equal to KO. Unlevered company KE will be equal to KO. Therefore, okay, you will discount using this KO. EBIT divided by KO if you do. Okay, again, 1 minus T because tax rate is given. EBIT into 1 minus T divided by KO, you will get overall value of the firm. This is value of the unlevered firm. If you get this, you will add the borrowings into tax rate. You will get the value of levered firm. Are you all understanding? So first value of Y limited unlevered firm you will find out using this formula. EBIT into 1 minus T, Y tax rate is given, divided by KE is equal to KO. Actually, it should not be written as KE. Are you all understanding? It is not to be understood as KE. Since it is all equity, KE will be equal to KO. KO you will use to discount the after tax EBIT. So EBIT 3 lakhs into 1 minus 50%. So 1,50,000 divided by 15%. Value of all equity company comes to 10 lakhs. Already we computed under NI approach. That will be same. So 10 lakh value of the equity here of unlevered company. Now value of levered firm, formula you will use, value of unlevered company plus borrowings. What is the borrowings? 9 lakh into tax rate 50%. So 4,50,000, 10 lakh plus 4.5 lakhs, 14.5 lakhs. Are you all understanding? This is value of the levered firm X limited. Now you got the value of unlevered firm 10 lakhs, 14 lakhs, 50,000. Correct? Next step, what they are asking us to compute now. Using NOI approach, calculate the overall cost of company for X and Y. X limited, Y limited. X is levered company, we need to compute. Y limited, unlevered company, no need to compute. Why? KE will be KO, 15% will be the KO. Are you all understanding? Why KO? Okay, it will not change because of the lever rate. I told you now, because all equity company, see here, for Y limited, KE will be KO is equal to 15% as there is no debt. Are you all understanding? For firm X, you will have the, see what happens, firm X, you have levered company. What is the value of the firm? 14.5 lakhs. Agreed? This is total overall value of the levered firm minus what I told you, NOI approach, you find the total overall value of the firm. Reduce value of the debt, value of the equity will be residual value, balancing number. Are you all understanding? Minus value of debt. How much is the debt value? 9 lakhs. So 9 lakhs, if you reduce it, 5.5 lakhs, 5,50,000 will be value of equity. Are you all understanding? Now you have value of equity, you need to find out KO. What is KO? See, value of equity, yes, value of, okay, overall company, then thereafter you will reduce value of firm, value of equity is 5,50,000. Now, you have value of equity, Now find out value of KE. You should find out value of KE. What is KE? KE is equal to, I told you earnings available for shareholders, equity shareholders divided by value of equity. Now, earnings available for equity shareholders, which you already discussed now. What is that? Earnings available for equity shareholders, 1,05,000, 1,05,000. Why? EBIT is 3 lakhs minus interest. Interest should be reduced. What is that interest? 9 lakhs into 90,000. How much? It will be 2,10,000 into 1 minus T. Are you all understanding? 1,05,000 will be at 1,05,000 after tax. Okay. Now, what is that? Divided by value of equity. Just now we found out now 5,50,000 should be considered. Balancing number, value of equity as per NOI approach, 5,50,000. So 1,05,000 divided by 5,50,000. What is the KE amount? 19%. Are you all understanding what I am trying to discuss? So you have KE as 19%. KD. What is KD? KD, very simple. You need to find out KD. You say after tax KD. WACC computation will do that. KD you will find out after tax. So KD before tax is 10%, tax rate is 50%. Up 10 into 50%, how much is that? 5%. Are you all understanding? Now 19% is the KE, 5% is the after tax KD. Now you find out WACC computation. You already know that. What is that? Source, proportion, okay, cost, weighted cost. A value, value you can write it value also. I'll just write the value also. Anyway, source, value, proportion. Same way the column WACC column you will open. Source, what is that? Debt, equity. What is the value of debt? Please tell me. What is the value of debt? 9 lakhs, yes, 9 lakhs. What is the value of equity? 5 lakh 50,000. What is the total value of the firm? 14 lakhs 50,000. Correct? Now, proportion. Tell me 9 lakh divided by 14.9 divided by 14.5. How much is that? 62.06. Okay, 62.0867. 68, no? 7%. 62.07%. Here, 100 minus 62.07. How much is that? 37.73%. Are you all understanding? Next, cost. What is the cost of debt? After tax cost of debt should be considered for WACC computation. I told you now 5%. Here, what is KE? How much? 19%. Already we computed. So 5 into 62.5. 5 into 62.07. 3.10. 3.10%. Okay, here 19 into 37.73%. How much is that? 7.16 total. What is the total? 10.1. The value 10.26% I'm getting. Okay, 10.26% I'm getting. Okay, it is a rounding off issue. If you see this, okay, they have done this 19 into 5. It is rounding up. That's nothing great. Now rounding off. I have got 62.07, some rounding up now 37.73. Instead of that, they have done directly this 5 lakh. See, if you see, notice 5 lakh 50 divided by 1450. 5 lakh 50 divided by 14. How much is that? 37.93. Okay, I have taken 7.3. Yeah, this should have been 9.3. Okay, this should have been 9.3. Sorry, small mistake is there. 6. This is correct. This one, a slight change is required. Okay, this is not 7.37.19 into 37.93%. I did 7.3. That is why we had some variation. 7.206. What is the total? Plus 3.1. I'm getting 10.3%. Are you all understanding? 30 rounding off 31%. That is why you get. Are you all understanding? This is nothing but WACC computation. They have given in a different manner. Okay, you can use the tabular method and find out the WACC. Next, last, what is that? Last point or third? Okay, last point. Which of these two firms has an optimum capital structure according to the NI approach? See, here the mistake is again solution is wrong. Anyway, we know that obviously. Which of the two firms? See, when there is tax, NOI approach will strengthen the MM approach. Okay, see, the levered company will be more valuable. The levered company will be more valuable when there is tax. Obviously, levered company will be more valuable. Even in case of MM approach, you see a value of levered will be value of unlevered plus borrowings into tax. Now, which one will be more? Yeah, okay. Value of levered company will be obviously more. In this question, if you see 16 lakhs is more than, sorry, this is NI approach. Come to NOI approach. NOI approach also, see, value of the total firm is 19 lakh 50,000. This is levered firm. Unlevered company value was 10 lakhs. So, levered versus unlevered. Now, which one was more valuable? 14 lakh 50,000. Levered company. X's was more valuable. Okay, and KO is 10.37. See, X, Y. Value of firm. How much X value? 14 lakh 50,000. What was the value here? Y, unlevered firm, 10 lakhs. What is KO? Overall cost of capital. In case of X Limited, KO was how much? Please tell me, what is the KO? X Limited, levered company. Just now we found out 10.31%. Here, what is the KO? 15%. K is equal to KO. KO. Are you all understanding? Value will be more in case where KO is least and okay, this X Limited is more valuable. But look at the solution they have given. Out of a firm Y seems to have optimum capital structure as it has lower cost of capital, higher value of the firm. Obviously, okay, it's a printing mistake or some error. Okay, blunder they have done in the module. Anyway, you have to change it. Are you all understanding? Because they are saying that lower cost of capital will have higher value, but they have selected a different firm. Yeah, firm X is the levered company which has a more value. Anyway, I'll leave it to you. You can change it. Now, now we'll move on to the traditional approach. Seventh question is regarding traditional approach. June 2025 or Yes, June 2025 attempt, there was this traditional approach. Very good question. That's why I have included. This is the exam question, not from your study module, material, study mat. So I have included this and I have solved this using hand. Okay, traditional approach, and I will solve this and I will show you. Okay, no issue. Let's now compare the NI and NOI. Then we will move on to traditional and marginally. Both will discuss briefly. Then we will do two questions regarding traditional and marginally Miller approach. I proceed. Okay, see. Here, one second, let me try to move this. Can you see? Oh. See, NI versus NOI approach. The first step, okay, see. First to find value of equity. Under NI approach, what you should do? First to find out value of equity. Earnings available for equity shareholders divided by K. When tax is given, see, when tax is given, you will consider the tax effect, then find out. Just now we did one question, their tax was given. In the first question, NI approach, remember illustration number 1, there was no tax. So what we did? EBIT minus I divided by, what is that? K. Like this we found out value of the equity. Okay. Then add value of the debt, value of equity plus value of the debt, value of the total firm you will find out. Okay. Value of the company, where we see value of the VF and VC are same. Okay. Value of the company. Then you need to find out KO. KO is equal to EBIT divided by value of firm. Find out the KO. Are you all understanding? Now, if tax rate is given, okay, KO is equal to EBIT into 1 minus T divided by value of the firm. Like that you will find out under NI approach. Come to NOI approach. NOI approach, first what you should do? Find out the value of the firm, because this is net operating income approach, which means EBIT. Find out EBIT divided by KO. Find out value of the firm. If tax rate is given, okay, we will see differently what is to be done. If tax rate is given, use the formula. Use the formula. Okay, value of levered company is equal to value of unlevered into B minus T. So if tax rate is not, first to find the value of the firm. If tax rate is not given, use the formula and find out the value of the firm. If tax rate is given, use this formula, formula. If tax rate is given, use the formula and find out value of the levered company, unlevered company plus weighted. The value of the unlevered company, not at all an issue. EBIT into 1 minus T divided by KE, if you do, you'll find out the value of the unlevered. Thereafter, you'll do. But first step is what? Under NOI approach, first step is to calculate the value of the firm, overall firm. Then you will reduce the value of the debt. You'll find out the value of the equity. Are you all understanding? Then reduce the value of the debt to arrive at value of equity. Then KE. Now you have value of equity. What is KE? KE is nothing but earnings available for equity shareholders divided by value of equity. Now, when there is tax, what you will do? This earnings available for equity shareholders will be EBIT minus I minus tax. If there is tax, you will reduce the tax. If there is no tax, simply EBIT minus I divided by value of equity. Are you all understanding difference between NI and NOI? Step by step, everything available. Okay, this I will publish freely. This PDF will be freely available in my website. You can go and freely download and okay, use it. This I have meticulously prepared so that on the last day before the examination, or even on the day of examination, you can quickly glance through within 1 hour time. You can revise everything quickly, the concept alone and formula, most important formulas alone. Are you all understanding? Efforts has been taken, make use of it. Okay, next we'll move on to traditional approach. See, as per the traditional approach, very simple. This is an extension of NOI approach. If you see the NOI approach, what I told you, okay, I told you that if you remember, if at all you remember, okay, you can rewind and see KD. See, this is KO. This is KD. KD will pull down. See, debt will be cheaper source of capital. Obviously, everyone agrees that KO will be pulled down by KD. KD, increasing KD will increase the KE. KE, okay, if increased now, it will pull KO upwards. Are you all understanding? KO will be pulled upwards by KE and KO will be pulled downwards by KD, leaving KE unchanged. I told you in NOI approach. Are you all understanding? Under NOI approach, KO was remaining unchanged. But under traditional approach, what they say, you are correct. I agree that, okay, KD will pull KO and KE will also increase due to increased KD and KE will pull KO upwards. All these things I agree. But what I don't agree, the downward pull of KD will not be same as upward pull of KE. Are you all understanding? Hence, KD, okay, will remain unchanged, no issue. But KE will also change and KO will also change. Are you all understanding? Upward pull of KE and downward pull of KO will not make the KO stable. Both the strength of these, okay, opposite direction pull will not be equal, they are saying. Are you all understanding? So KO will be changing. So manually you need to find out for every option, you need to find out KO. Okay, you need to apply the WACC source proportion. Like this, you will find out KO for different capital structure. For each capital structure, you will have different KO. Hence, the value of the company will also change. Hence, financing decision will surely affect the value of the company. Are you all understanding? Theory of relevance, the two theory, NI approach, traditional approach. NI approach and traditional approach say that value of the firm will be affected due to capital structure of the company. This is the reason. Are you all understanding? And now read the summary, you will understand everything properly. As per this approach, debt will reduce and debt will reduce KO and more debt will increase KE, but the increase and decrease will not exactly offset each other. Hence, KO will change. Are you understanding? Best capital structure. So what we should do now? We should select best capital structure. Select best. Sir, what is the best capital structure? The capital structure in which the KO will be lowest. Okay, so that the value will be higher. I told you inversely proportional. The option in which KO will be least, value of the company will be highest. Are you understanding? Best capital structure has to be manually found out where KO is least and value will be highest at that mix. KD and KE will be given using WACC table. Find out KO. KE and KD will be given in the question. You should use the WACC methodology and compute KO and then find out the value where KO is lowest. Their value of the firm will be highest. Okay, I will discuss again. December 25, question number 7A. Okay, reference I have given. I will discuss anyway this question. Are you all understanding the traditional approach? Under traditional approach, KO will change under different capital structure. You should select that capital structure, whichever is having lowest KO. Okay, at that point, value of the company will be highest. Are you all understanding? Thus, financing decision, changing capital structure will affect the value of the company because it will change the KO. Hence, it will affect the value of the company. Are you all understanding the traditional approach theory? Now, I will also discuss the approach briefly. Okay, then we will discuss the question answers regarding traditional as well as Shall we see? Approach, what they say. Okay, approach says that, see, what they say, value of the firm will never change due to the capital structure of the company, which means capital structure of the company will never affect value of the company. Why? Because, see, what they say, their theory, I'll tell you, there will be obviously initially change in value, which means levered company, unlevered company. This is, see, there is levered company, there is unlevered company. Both the companies need not be having the same value. Are you all understanding? Initially. But whenever investors see that in the market, levered company, unlevered company are of different value, investors will always buy undervalued company and sell the overvalued company. Okay, it may be levered sometimes, what they say, sometimes levered company may be more valuable, sometimes unlevered company may be more valuable. Investors are not fools. Investors will always, buy the unlevered, buy the undervalued company and sell the overvalued company. In which case, there is a process called as arbitrage. Due to arbitrage, at some point in the future, the value will be same. The value will come to the equilibrium value. Are you all understanding what they say? This is what, Modigliani Miller says. See here. Okay, let me give you an example to visualize the fact. Okay, I usually use this example. See, I am in Chennai. Assume I go to Kerala for some classes and I see that Nendraga chips, very famous in Kerala, which is available. Here in Chennai, it is 100 rupees per packet. And in Kerala, it is available for 50 rupees per packet. Are you all understanding? Since production is so high, supply is so high there, and the cost is changed. You see, therefore the value will be different initially. But I go there to take classes, but incidentally, when I come back, I take large packet of, I take 4 or 5 bags full of chips. I purchase there at 50 rupees and I come here to Chennai and sell it at 100 rupees. Are you all understanding what is happening? So, which means I do it again and again. Every attempt I go there, take class, again, I pack more bags. I buy from, Kerala market, 50 rupees and sell it here. At some point, people will realize that there exists a valuation difference. Like this, same, if you see in my street, there are so many people, they see that, I'm doing business with that. They also open shop. They also started buying, going to Kerala, started buying at 50. okay, and come here and sell at 100. What happened? It's very simple. Two things will happen. Either Kerala, supply was high, na? Right? Understand? Their demand will increase. Their demand will increase. So the 50 rupees price will slowly increase to 75. Are you all understanding? Here, since so many people are keep on selling, they are buying from here, this market and selling. Here, supply will increase. Because of that, price will come down. Demand, okay, supply will meet the demand. So the price from 100 will become 75. At some point, okay, it will reach the equilibrium price. This is called as, okay, arbitrage process. Are you all understanding? Deep discussions, okay, in CMA level, okay, inter level, they are not asking the arbitrage process as such, how leverage will take place, how arbitrage will take place, how the equilibrium price will be achieved. These processes are not tested. At CA level, they are testing. Hence, I discuss there, but I don't want to increase the burden. So I'm not discussing about primary arbitrage and secondary arbitrage. Two arbitrage processes I've explained, where levered company is more valuable than unlevered company. Okay, primary arbitrage will be there, where unlevered company will be more valuable than levered company. Okay, there secondary arbitrage will be there. All these things I discussed in the CA inter. Anyway, this is not required for your level. That is why I'm not discussing. Shall I proceed? So, as per MM, sometimes value will be higher. That is fine. What is the formula you need to understand? Value of the levered firm will always be higher than value of unlevered firm initial. So, value of levered firm is equal to value of unlevered plus P into T. This is the formula you should use to arrive at the value of unlevered firm. Are you all understanding? See here. MM says that value difference may be there for firms, but this is purely temporary, and through a process called as primary and secondary arbitrage, both levered and unlevered firms have the same value. Value of levered company is equal to value of unlevered plus B into T. This is the steps involved. Then reduce value of debt. What is the step? So first to find out value of unlevered company. Value of unlevered company. Anyway, you will find out value of the unlevered company. First step is to value of find out value of unlevered company. All equity company KE will be given in the question. Use that. Find out the value of the unlevered company. Then borrowings amount will be given. Tax rate will be given. Find out value of the levered company. Are you all understanding? From levered company, okay, you will find out the total levered company value. Na? One question, NOI approach with tax we did, correct? 14 lakhs 50,000 we found out total value of the firm. Minus value of the debt, 9 lakhs we did. Value of equity, 5 lakh 50,000 we did. Reduce the value of debt. Value of equity will be the balancing amount. Find out K. After that, the K will be changing. Why? Obviously, okay, since this with tax, Modigliani Miller approach with tax. Okay, MM approach without tax is also there. Without tax, no issue. EBIT divided by KO, like this you will do and find out. That is not an issue. Value of the firm minus value of the equity. Fine. But when tax is given, KE again will undergo a change. WACC approach you should use. WACC approach you will use. So find out KE. Then find KO. Why? If KE changes, again KO will change. Okay, using WACC approach, you should find out KO. And because due to the tax effect, KO will change. Are you all understanding? This is how you should predominantly, this formula you remember, that is sufficient. All other things you can just work it out. It will tally. Are you all understanding? Shall I proceed? Two questions we will do. One regarding traditional, one regarding Modigliani Miller approach. That is sufficient for your examination, I believe. Next. See, question number 7A. Take question number 7A. Apex Limited provides you the following information. Net operating income of 75,000. Net investment of, what is this net investment? Total investment. Okay, this total capital, total investment, which is 5 lakhs is the total investment required. Now, this is the total capital required. I will, okay, see, I have three options. I'll just discuss the question, then I'll come back to this. Net operating income means what? EBIT. EBIT, I told you. EBIT is a net operating income. Now, if firm uses no debt, 15% is the cost of equity. Now, in the traditional approach, I told you, KE will also change. I told you, KD will be there. KE will also change. Because of change in KE, okay, there will be even change in KO. KO will not be same even after changing KE, unlike NOI approach. This I told you. So what they say, traditional approach, how we can find out is traditional approach? Very simple. If firm uses no debt, all equity company, KE is 50%. KE is equal to KO at 15%. No issue. If the firm uses 2 lakh debentures, KE will change. This is cost of equity, not cost of debt. Are you all seeing this? This is cost of equity, not cost of debt. Are you all understanding? So KE will change. How much is the KE? Okay, 18%. Next, if firm uses 3 lakh debentures, KE will be 20%. Are you all understanding? Assume 2 lakh debentures can be raised at 10% rate of interest, whereas 3 lakh debentures can be raised at 12% interest. You are required to calculate the market value of the firm and overall cost of the capital under a traditional approach. Which debt equity mix should be selected? Are you all understanding? Here, 3 plans are available. I have put it like this. Okay, even though plan 2 and plan 3, even if you solve, that is sufficient. But then I put it all the 3 plans. Plan 1, all equity plan. Are you all understanding? Which means how much is the amount required? 5 lakhs. That is why I told you, I will later discuss. No? This 5 lakhs is the amount required. If there is no debt, entire 5 lakh will be raised by equity. So all equity option. Plan 2, what is the plan 2? Only raise 2 lakh through debt, balance 3 lakh to equity. Agreed? Why? At that point, 10% will be your rate of interest. They have given themselves the option. Okay, next. Plan 3, 3 lakh should be the debt, 2 lakh should be the equity. Are you all comfortable? Okay, so 5 lakh is required. Here 3 lakh debt, 2 lakh equity, which means interest will change. Why? I'll tell you what happens. EBIT given as 75,000 will remain same under all the options. 75,000, 75,000, 75,000. Agreed? We are preparing income statement. Step by step, you will understand. See, minus I. Interest you need to reduce. All equity company, no interest, 0 interest. Come to second plan. Plan 2, how much is debt? 2 lakh is debt. If 2 lakh is debt, now 2 lakh into 10%. Because if you borrow 2 lakh, now debt rate will be 10%. If you borrow 3 lakhs, now debt can be only raised by 12%. They have given in the question. So in case 1, if you borrow through 2 lakh, what happens? 2 lakh into 10%. Now what will happen? Tell me, children. 2 lakh into 10%, 20,000 will be the interest portion. Are you all understanding? Next, plan 3 lakh, you have 3 lakhs debt, 2 lakh equity. EBIT is 75,000, 3 lakh is debt, 3 lakh into 12%, interest will be 12%, 3 lakh into 12, 36,000. Like this, you will reduce the interest, you will get the EBT 75, 55 and 39. Are you all understanding? This is earnings available for equity shareholders. Now, what is the step you need to use? First, EBIT, this is like NI approach only. What you should do? You should first find out value of equity. 75,000 divided by KE, you will find value of equity. Are you all understanding? 75,000 divided by 15%, 5 lakh. Tax is not given. So this earnings available for equity shareholders because no tax. If tax is given, reduce it. Otherwise, just simply divided by KE. How much it is there? 58,000 divided by 18%, 39,000 divided by 20%. You will get all these values. 5 lakhs, 3 lakh 5,000, 555, 1 lakh 95,000. Are you all understanding? First step, value of equity. Then value of debt you will add. What is the value of debt? First case no debt, 0. So total will be 5 lakh. Next case 2 lakh is debt, 3 lakh is debt. So 2 lakh plus 3 lakh 5,555, 5 lakh 5,555. Then 3 lakh plus 1 lakh 95,000. Total comes to 4 lakh 95,000. Are you all having this clarity? Next, KO. Next step is KO. KO, okay, see, EBIT divided by value of the firm. Directly you can find out. Why? There is no tax rate involved. NI approach. Just like NI approach, you can calculate. What is that? EBIT divided by value of the firm. What is that? 15%. Okay, how I got 75,000 divided by 5 lakh? 15%. See, if you notice, this 15% KO and KE is same. Why? All equity company. Yeah, KE will be equal to KO. No need to verify. Are you all understanding? Next, KE is 18%. Okay, next KO you need to find out. EBIT divided by value of firm. 75,000 divided by what is the value of the firm? 5 lakh 5,555. It has changed. Okay, it is not 5 lakh, it is 5 lakh 5,555. You get 14.83%. Again, here, what is the value of the firm? 4 lakh 95,000. So 75,000 divided by 4 lakh 95,000, you will get 15.15. Are you all understanding KO? Alternatively, KO also can be computed. Why I computed KO? Na? Because they have asked, see, they have asked in this question, calculate market value of the firm. First step we found out 5 lakh, 3 lakh, 5 lakh, 5,000. 555, 4 lakh 95,000. Next, what they are asking, and cost of capital, overall cost of capital of the company, overall cost of capital of the company, KO, that also we found out. Okay, alternatively, this KO can also be found out using WACC technique. Just I'm saying, plan 2 I'll take because plan all equity plan, like KV will be KO, no issue. Plan 2 and 3 only you need to compute using WACC method. See what happens. Debt to equity, debt is 2 lakh value. Equity value, residual value 3 lakh 5,555, residual which we computed. Are you all understanding? Now, this equity value total comes to 5 lakh 5,555. Proportion, cost 10%, 18%. Are you all understanding? No tax, so hence KD I'll simply take as 10%. If tax is given, after tax cost of debt should be considered. Now, weighted average cost 14.84, roughly same as this number 14.83, rounding of 14.83 and 14. Are you all understanding both the methods we can solve? Fine. Now here, conclusion, how you should give. Which plan is superior? You need to give now. Tell me, children, which plan will be superior? The plan whichever is having lowest KO. The plan whichever is having lowest KO. Which plan? Plan 2. 2 lakh debt, 3 lakh equity. Why? Because which debt equity mix should you select? Should select na? Debt 2 lakhs, equity 3 lakhs. This plan should be selected. So 5 lakh na, other debt should be 2 lakh. Equity should be 3 lakh. This plan is superior. Are you understanding why KO is lowest, value will be highest? We can also verify now. KO is 14.83 lowest. At this point, value is 5,05,555 highest. Are you all having the clarity? Shall I proceed? Okay, next we will do illustration number 5 regarding MM approach. Then we will close the capital structure theories. Okay, now. From the following data, find out the value of each firm and value of the equity share as per Modigliani Miller approach. 3 firms given, simply EBIT given, number of shares given, 12% debentures given 9 lakhs and 10 lakhs, which means this X company or equity company. Why? There is no debentures, you can understand. So you should start with value of the unlevered firm. Unlevered firm. Okay, every firm expect 12% rate return on investment, which means return on investment is 12%. Very simple. EBIT is 13 lakhs. They have given straight away 13, 13, 13. No issue. Now, return on investment, KO is given. Why? See, very simple. Return on investment is nothing but, okay, return on investment. See, return on investment is 12%, which is nothing but your KO, which is nothing but to be understood as KO. Why? Overall, okay, EBIT, in one of the question we studied, total return of assets, this much they are earning, which means nothing but KO. Are you all understanding? Overall cost of the capital. Say, okay, your investment means, what is the meaning of investment? Total capital. Return on investment mean EBIT, I told you, this is the return 13 lakhs. Are you all understanding? Which is nothing but, see, EBIT is equal to invested capital or total capital into KO. This is return on investment. Are you all understanding? This is the return in terms of rupees. This is return on percentage. This you apply in total capital, you will get the EBIT. Are you all understanding? So 12%, moral of the story, the 12% is nothing but KO. 12% is KO. Now, sir, you have KO. Now, you need to find out value of the firm. Now, see, this question, okay, you found out KO, now see, what is happening? I told you value of the levered firm is equal to unlevered into borrowing into tax rate. But point is, here there is no tax given. This is without tax. MM approach, without tax. With tax, you should use that formula. Okay, that kind of questions will be there. I have seen the questions. You can go through the past examination question. You will find out with tax. This is without tax question. Why I am explaining now? With tax will be equal to NOI approach. That's why I did not discuss here. I have put it here specifically because MM approach without tax, how you should do, you need to understand. Very simple. If there is no tax, what is the formula to be used to find out the overall value of the company? EBIT divided by KO. Same formula you will use. So EBIT 13 lakhs is same. And KO, okay, is given as 12%. You will apply that and all the firm will have same value. Are you all understanding? Because KO is same 12%. If you divide it, you will get the same value. Are you all understanding? Now, value of the firm, you will get the same. Just like, what is this? This is something like NOI approach. I told you now, if there is no tax, it's something like NOI approach. Okay, which means first you will find out the overall value of the company. Then you will reduce the value of the debt. You will find out the value of the equity. Then divided by number of shares, you will get value per share. Value per share. Now, value of the firm is given 1,08,000, 1,08,000, 108 lakhs. Yes, 108 lakhs, 108 lakhs and 108 lakhs. Debt, you reduce 9 lakh, 10 lakh, you reduce from it. Okay, which means here, my value of equity will be this much. Value of equity, I'll get as residual value divided by number of shares. Okay, market price per share. Value of equity per share. Value of, value of, per share basis, what is the value of this? Okay, 36.11, 39.73, 14.173. The value of value per share. Are you understanding? With this, we are through with the capital structure theory. Is very, very important. I have covered fully. Okay, you can go through. Now, we will move on to the next chapter. These are all dividend based chapter. So, we'll move on to dividend decision chapter. Okay, a small chapter is there, which we will cover and then we will move on to investment decision, and then lastly working capital management. Now we'll start with dividend chapter. See, dividend decisions. There are three models: Walter model, Gordon model, and Modigliani-Miller approach. If we study these three models, that is sufficient for examination. See, there's other model, Graham and Dodd model, the other given, but predominantly these three only are getting tested. So I'm discussing these three. See, what do you mean by dividend decision? First of all, see, there is for debt instrument. Okay, if the company takes debentures or raises capitals through debt, it has to pay interest. There is a legal obligation to pay interest for the company. But if it is in case of dividend, equity shares. In case of equity shares, if the company is financed through equity for equity shareholders, whether there is any legal obligation to pay dividend, no, there is no legal obligation. So the board may decide whether to pay dividend or not. So first of all, what do you mean by dividend decision? Now, two questions is to be answered: whether to pay dividend or not, whether to pay dividend or not. And if at all I decide to pay dividend, now how much of percentage of my earnings, which means what should be my payout ratio, how much of my earnings I should distribute as dividend. Company earns net profits. What is the percentage of net profit I should pay out as dividend? How much I should pay? So whether I should pay, if at all I need to pay, how much I need to pay? These are all the two decisions. These two questions should be answered. This is collectively called as dividend decision. Are you understanding? When dividend decision, will dividend decision affect the shareholders' wealth? Is the question to be answered in this segment. In this chapter, what we are going to see, whether this dividend decision will affect the shareholders' wealth or not. Shareholders' wealth means through the share price, which means will the share price get affected due to the dividend decision, dividend policy of the company. Are you understanding? Yes, there is two model, that is Walter model and Gordon model. They say that dividend decision will surely affect the shareholders' wealth. No, says again theory of irrelevance. Already we saw that under financing capital structure theories, said that financing decision will also not affect the shareholders' wealth. Now he is saying dividend decision will also not affect the shareholders' wealth. Only relevant decision, which will affect the shareholders' wealth is investment decision, capital budgeting decision as per the model. Anyway, that we are going to discuss now. Take Walter's model for discussion. Walter says, see, if R is greater than K, what is K? Required rate of return of the equity holders. What is R? The company earns, company retains the profit. If the company retains the profit, what is the rate of return earned on the retained profits? You need to see. Question may mention you simply R, the rate of return, or simply it will mention you IRR, IRR of the project. If the company retains the shareholders' funds, it will invest in project, it will undertake new project. From that, it will earn some return. This is called as R or IRR. Sometimes they may give IRR. Sometimes they may also give return on equity. Return on equity, interchangeably used. Both are not same. R and return on equity is not same. But still, in dividend decision related questions, sometimes they may interchangeably use the three things. Are you understanding? You should understand. It is nothing but return earned on the retained earnings. Return earned on retained earnings. What they say, if the company, if after generating net profits, it has two options, whether to pay out dividend or retain. If company, if what you should do now, if the return earned on retained earnings, if the R is greater than what is required by K, which means K is what is required return of the equity shareholders. If your company's rate of return, the investment return is more than what is required for by the equity shareholders, then retain. Then better to retain. If R is less than K, which means the project return is less than what is required by the shareholders, then better to pay out because you are producing nothing. Just give it to the shareholders. Let them invest on their own. You don't retain. This is what Walter says. Are you all understanding? If R is greater than KE, better to retain. If R is less than KE, better to pay it out. But R is equal to KE. Any payout ratio is better. Any payout ratio is fine. Optimum payout ratio is what? 100% is the optimum payout ratio. Very simple. Now you need to retain and pay out this. So if R is greater than KE, you better retain. If R is less than KE, you better retain. But how much I should pay out or how much I should retain? Walter says retain 100% or pay out also 100%. He takes extreme position. Are you understanding? If R is greater than KE, Okay, retain 100%, nothing give as a dividend. You don't give anything as dividend. And if R is less than KE, everything you pay out as dividend, nothing you should retain. Are you all understanding? This is what Walter says. And the share valuation formula as per Walter model, is, okay, this D plus R by K into E minus D divided by the whole divided by K. Here, E minus D is nothing but what? E is EPS. E means EPS. D means dividend per share. EPS minus dividend is what? Retained earnings per share. Retention per share. Retention per share. Are you all understanding what it means? So, R is what R here means. R is return earned on retained portion. That is what I told you. R may be given. IRR may be given in the question. ROE may be given. Whatever it is, you should take. So, D plus R by K into E minus D, the whole divided by K. This is the formula to apply to solve the Walters model question. Okay, can we quickly go through the Walters model question? See here. Okay, see. Question number 19, I think. Yes, question number, illustration number 19. From the following data, calculate the value of equity share of each the following three companies according to Walters model when dividend payout ratio is nil, 25, 50, 75, 100%. 5 different option is given, 3 companies given, okay, and this is internal rate of return that is given in bracket R. Sometimes they may give you return on equity, that is to be understood as return earned on retained portion. So 15%, 5%, 0. So cost of equity, this is KN they have given, but this is not overall cost of the KE. It is not KO, it is KE. Okay, equity, cost of capital. Earnings per share is given 10. Okay, what conclusion you draw? Dividend payout ratio is given. See, what dividend payout ratio 25% mean you apply the 25% to 10 rupees. Up EPS 10 and dividend payout ratio is 25%. Now, what is the dividend per share? Dividend per share 2.5 per share and retention per share is 7.5 per share. Are you all understanding? 10 rupees is the earnings. EPS is how much? 10 rupees. If 25% is dividend payout ratio, 25% dividend payout ratio 2.5 na, balance 75% will be, okay, retention ratio 7.5 per share. Are you all understanding what is happening? Now, like this, you apply the formula for all the 3 companies. Valuation formula. Simply apply the formula, you will get the value. See, different dividend payout ratio is given. Okay, different dividend payout ratio is given. When dividend payout ratio is nil, what will happen? Dividend is equal to E into dividend payout ratio, 10 into nil na. Everything will be retained. So dividend will be nil. D will be nil. That is what given as nil. Plus 10 minus 10 is EPS minus dividend is nil. Now entire amount will be retained into 1.5. Okay, into 1.5 is nothing but, see, this 1.5 is nothing but R by K. R is 15% divided by K is 10%. Are you all understanding? Hence they got 1.5. How they got 1.5? See, R is 15%, cost of capital is 10%. See, what is happening? For 3 companies they have given. Here for this company, what happens? R is greater than K. Are you all understanding? Let us come to the conclusion later. First, we will compute the value. So we got dividend payout ratio when it is nil. For this company, for which company? There's 3 different companies are given. Correct? This is X Limited, this is Y Limited, and this is Z Limited. Okay, so much complicated. They will not ask you this big question for these many companies, these many table. This is illustrative question whereby they gave you various scenario just to confuse you. Okay, only one company is enough. Varying payout ratio, 5 different payout ratio is given. Okay, I don't know why they've given. 3 is enough to illustrate. Anyway, see, I will move on to next company later. First, 25% payout ratio, just apply the formula. D is 2.5. 1.5 is nothing but R by K into E minus D. E is 10 and D is 2.5. Retention will be 7.5. Apply the formula, you will get the value 137.5, 125, 112.5, 100, everything. Okay, you can just simply apply the formula. What is the formula? D plus, okay, R by K into E minus D, the whole divided by K. If you apply this formula, you will get all the value. Just apply the dividend payout ratio to the EPS. You will find out the dividend amount. Balance EPS minus dividend amount will give you retention amount. E minus D is nothing but retention. E minus D is nothing but retained portion. D is dividend. Okay, R by K. Anyway, you need to verify that. You can find out divided by the whole divided by K. Okay, you will get the value per share. Now, come to the interpretation part. That is the main important thing here. Calculating the number is not important. See, in case of X Limited, first observation, R is greater than KE. Why? R is equal to 15% for X Limited. KE is equal to how much? 10%. R is greater than KE. Now, which should be the better position as per Walter? What he says, if R is greater than KE, retain 100%. Retain 100%, which means the best payout ratio is 0% payout ratio, which means nothing payout as dividend. Everything you retain at only if you do this, the share price will be maximum. The share price will be maximum at 0% payout ratio. If you observe for X Limited, since R is greater than KE, what is should be the optimum see, when dividend payout is nil, when you retain 100%, the share price is 150. That is the best share price. If you observe, this is the highest share price. When you keep on retaining, less or keep on paying out more and more, the share price keeps on reducing. From 150, it became 137.5. Again, it became 125. Again, it became 112 and it reached 100. When 100% you paid out dividend. Wrong decision. Fully wrong decision. R is greater than K. Now, you should have retained 100%. 150 was the value and now became 100 because, of your stupidity, you paid everything as dividend. Are you all understanding? Next case 2, if you see the second company where, R is less than KE, where R is less than KE, if you see the share price, 50 rupees, if you increase the payout, what is the decision here? R is less than KE. Now, you should actually pay out as dividend. If you pay out as dividend, R is less than KE, what you should do? You should ideally pay out as dividend maximum. When you pay less, you pay nothing as dividend, only the value will be 50. Then slowly the value increase when you increase the payout ratio and maximum value will be 100 when you pay out 100%. When you pay out 100%, are you all understanding? When R is equal to exactly KE, value will never change. Any payout ratio is good. So all the payout ratio will give you the 100 value. Are you all understanding? 100 at all point. The value of the share will remain unchanged because R is equal to KE. Comment. In case of X Limited, the IRR is more than the cost of capital. In this case, the value of the share increasing alongside decreasing the dividend payout ratio. Whatever I explained, they have put it as notes. Shall we proceed to a Gordon's model? See. So what does Gordon model says? See, very simple. Gordon says, I agree that retention will propel growth. More the company retains, the growth will be more. Are you all understanding? So retention will propel growth. I agree with that. If R is greater than K, generally you should retain. That is fine. But the problem is, if you keep on retaining, if you keep on increasing the retention ratio, what happens is, it propels growth, but increases the risk of the shareholders, which means if you keep on retaining, shareholders will not get dividend. So they will feel that the share is risky. Are you understanding? So retention ratio, increases the growth, but also increases the K. So what is the optimum ratio as per the optimum payout ratio as per Gordon's model? Now, what he says? We should not take extreme position like Walter. Walter says if R is greater than KE, 100% you should retain. This is what Walter says. Correct? When R is less than KE, 100% payout ratio like this Walter told. 100% you should pay out as dividend. But where Gordon differs, Gordon says that you should not take the extreme view of retaining or paying out 100% dividend. But what you should do? Carefully you should take decision, because if you retain 100%, then KE will also increase. It will be maximum. KE will be maximum. Are you all understanding? So which means if you keep on retaining, the KE will also increase. Shareholders risk. If KE is increasing, the share price will come down. Are you all understanding? KE is a discounting rate. If you increase the discounting rate, the share price will come down. Inversely related, I already told you. So what is the best payout ratio as per Gordon then? Then the best payout ratio, is nothing but at payout at which the share price will be highest. How to find out? Question will mention you different payout ratio, and at that point different KE will also be given at varying retention ratio. You should apply the formula as per Gordon. This formula is given as per Gordon, and you should apply the formula, then find out the KE. Now what is the formula? P0 is equal to E into 1 minus B divided by KE minus BR. if you notice carefully, this is nothing but dividend growth model. You already learned na, D1 by KE minus G. This formula only, okay, rewritten like this. Actually, this formula is also called as Gordon's growth formula. Okay, really speaking, see what is E? E means earnings. B means retention ratio. So 1 minus B is what? Dividend payout ratio. Earnings into dividend payout ratio is nothing but effectively dividend. Are you all understanding? This is the numerator D1. Okay, the small change D1 and D. What is the difference? Okay, all these things you need not worry. You apply the formula E into 1 minus B divided by KE minus BR. Here KE minus BR is there na? BR is nothing but G. Okay, G is equal to, I already told you, retention ratio into R. Where I told you KE discussion, cost of capital, already I told you na. This only rewritten as B into R. Effectively B into R. Effectively this is nothing but growth. So KE minus G, D1 by K minus G only, okay, become this formula. E into 1 minus B divided by K minus G. B is retention ratio, E is EPS, and B into R is nothing but growth. Okay, shall we do one question regarding this? See. The following information is available in respect of the rate of return on investments, the capitalization rate, and earnings per share of hypothetical limited. R is equal to 12%. What is that? Okay, the rate, return earned on retained earnings. Okay, that is 12%. E is 20%. Now, E is EPS. Okay, situation 1, 2, 3, 4, 5, 7 situation given. Different retention ratio given. Can you all see 10% retention ratio, 20%, 30%. If 10% is the retention ratio, what is the payout ratio? 1 minus retention ratio, 90%, which means 10% company retains. Now, balance 90% it will pay out dividend. Are you all understanding? So this is 20, 80, 30, 70, 40, 60, 50, 50, 50, different proportion of retention as well as dividend payout ratio. And this is capitalization rate given, but it is to be understood as equity capitalization, right? Nothing but K. If you carefully observe, the K is keep on increasing. 7, 7.58, 8.59, 10 and 11. Why? Because as you increase the retention, the K is also increasing. Retention is 10%, 20%, 30%, 40, 50, 70, and okay, 50, 60, 70. Because as per the Gordon's model, he told, if you keep on retaining, okay, that will also increase the KE. Shareholders' risk will increase. Correct? Now, this is what is given. Next, see here solution. So first, what you should do, you should apply the formula. Before that, you have to find out the different proportional serial number. I have put 1 to 7. B is nothing but retention ratio. 0.1, 10% is written as 0.1, 0.2, 0.3, 0.4 and 0.5. 1 minus B means effectively dividend payout ratio. It is nothing but DPR, dividend payout ratio. This is retention RR ratio. Now 1 minus B is 90%, 10, 90%, 20 and 80. Like this you can write. Next, D is equal to E into 1 minus B. The numerator, this column is nothing but the numerator. Okay, what is that? E into 1 minus B, the formula which you apply in the Gordon's model, that we have found out, which means E into 1 minus B. Now 1 minus B is what? Here this column is regarding 1 minus B. So 90% into 20. EPS is how much? 20. So apply this on 20. 90% into 20, you will get 18. 80% into 20, 16. Like this, you will find out the numerator. Are you all understanding? KE minus G, denominator is there, that you can apply straight away here. Okay, B is given, R is given. First, you can find out G, or you can simply substitute the formula. You will get the value. 310, 313, 318, 324, 333. In the green highlighted, this is the, okay, point at which the share price is highest. Under all the option, you will independently assess which option gives you highest share price. That option you should select. Apply the formula, that's it. So this is the best option. Case number 5, which way the option number 5, 50-50, which means the dividend payout ratio should not cross 50%. Pay 50% as dividend, which means earnings per share is 20. Maximum dividend per share should be 20. Okay, beyond which, okay, the shareholders will increase, value will reduce. So it should not be beyond this. So this is the best payout ratio. Best payout ratio is how much? 50%. As per the Gordon's model, 50% payout is best since it's a payout ratio at which price is maximum. This is being given here. Okay, next question is regarding Modigliani-Miller approach. See, now we will see the last approach, that is Modigliani-Miller approach. See. Okay. What does MM say? See, Gordon and Walters agree that the share price will be impacted because of the dividend decision. But Modigliani-Miller says Dividend decision is just a residual decision. Share price will never get affected. Okay, value of the company, neither the value of the company nor the value of the shareholder, wealth of the shareholder will never get affected due to the what is that, dividend decision. Already in the financing decision we saw, there also an approach came, Modigle and Miller. Remember, he also argued that financing decision will also never affect the shareholders' wealth, which means the only decision which affect the shareholders' wealth is what? Investment decision. Capital budgeting decision, long-term investment decision will only affect the shareholders' wealth. All other decisions are residual, not an issue. Okay, how to prove this and all we discussed detailedly in the regular lecture. No time for that. But I'll give you brief understanding of how he tries to say that dividend decision will never affect the shareholders' wealth. I'll give you an example. What happens? Okay, let's take an example here. I'll just discuss briefly. See what he says. Okay, Modigle and Miller says, assume this is a balance sheet of a company. Assume this is a balance sheet of a company. This is, you have assumed equity, only equity, debt. Okay, zero debt company, only equity capital of say 10,000. Assume 10,000 is equity share capital, where fixed assets, assume fixed assets is 9,000 and cash balance you have in balance sheet of 1,000. Okay, this is what you have in balance sheet. This is a rough, just to make you understand the concept. Don't think, okay, don't question the numbers, just believe me, this is the sample or example. You just understand the concept through the example. What happens really is that, assume you have cash of 1,000 rupees. Now, dividend should be paid out as cash. Now, this 1,000 rupees is paid out as an investment opportunity. Investment opportunity is, say, up to the extent of 1,000 rupees, which means 1,000 rupees you have a project to invest in. Okay. Now, either you have two options. Either you can pay out as dividend and you can retain. Agreed. If you retain, which means if you pay out as dividend, 1,000 cash will in your balance sheet will go away as dividend, which means 1,000 rupees investment opportunity is there now. What should be done to actually undertake the project? You will raise fresh capital. You will raise fresh capital since you are a debt-free company. Assume you are not taking debt. You will be raising fresh capital. Are you all understanding? When you pay out dividend, you have to raise a fresh capital. Okay, one second. You have to raise fresh capital. In this case, if you are retaining, in the second case you are retaining now, then what do? You retain the cash, you don't pay dividend, use the cash to raise the fresh capital. Use the cash to raise fresh capital. Are you all understanding? To invest in the project, to raise fresh capital, not to raise fresh capital, to invest in the new capital. See. Yes, to invest in new project, I should say new project. Now, these are all the options we have now. Now, when you pay out as dividend, you need to pay fresh capital. But today, share price is how much? Here, if you notice, the share price today will be like, what is the total value of assets? 10,000. Assume equity share price is 10 rupees. Price is 10 rupees. How you got 10 rupees? Very simple, yeah. Okay, 1,000 shares outstanding at 10 rupees. Equity share capital is 10,000. Assume the face value, market value. I should say actually market value. All these things you will learn in detail. Regular lecture I cover. But here, don't get confused. Assume the share price is 10. Just assume that the share price is 10. 1,000 shares are available and the share price is 10. So share price, each share costs 10 now. Now, if you pay out as dividend, the balance sheet 1,000 will go away. Agreed? So what is the balance total assets? 9,000. So it will be shared. Okay, the total value of assets is only 9,000. Are you all understanding what I'm trying to say? When that is the case, the 1,000 shares, okay, the 9,000 will be shared by 1,000 shareholders. 9,000 divided by 1,000. What is the share price? The share price will drop to 9. From 10 rupees per share, the share price will drop to 9 rupees. Are you all understanding? But when it will happen? If you pay out as dividend. If you pay out as dividend, at what price you can raise the fresh capital? 9 rupees, which means how many new shares is to be issued? 1,000 rupees you want for investment divided by 9. What is the 0.11? Are you all understanding? This is the new number of shares. When you retain and invest, no fresh capital is to be raised. So existing capital 1,000 will be there. But the share price will be what if you retain? it will become 10. Are you all understanding? Now, if you pay out as dividend, the share price will become 9. And if you, retain, the share price will become 10. And if you pay out the total number of shares, existing 1000 number of shares and new 1,111.11, so total 1,111.11 shares will be there. The total wealth will be 9 rupees per share. Are you all understanding? The total wealth will be still 10,000. And here, the 1000 number of shares will not change and the 10 rupees will also not change. That is also 10,000. Are you all understanding? Which means effectively, the nature of the asset gets converted, which means the cash gets converted into fixed assets. If you pay out as dividend, the cash get converted to fixed assets. And if you pay out as dividend, the cash goes out. The fresh capital comes in and that gets converted. So wealth of the company will remain same, but it will be shared among increased number of shareholders. That's what happens if you pay out as dividend. If you don't pay out as dividend, nothing will happen. The wealth will still remain same. So either case, the value of the company will never change. Are you all understanding? This is what Modigliani Miller says. In this case, you have 3 formulas to be understood. Can be solved logically also. One formula is important, other 2 are logically also can be understood. But anyway, we will try to by heart all the formulas because examination you need to remember these formulas. So we will discuss briefly what are all the formulas to be used for value. Now, see, formula number 1 is that P0 is equal to D1 plus P1 divided by 1 minus K. This is nothing but share valuation as per single period holding period. Single period holding assumption. Single holding period assumption. What is that? Very simple. If you buy a share today, and hold a share for 1 year, what will you get? At the end of the period, D1 you will get plus P1. P1 a market price at the end of the year, because you will sell the share at the end of the year, which means you will hold only for 1 year. You will receive dividends from the company. After 1 year, you will sell in the open market. So what is the cash flow which you will receive after 1 year? D1 plus P1. This cash flow you will receive today, after 1 year, discount and bring it to present value terms. If you want to find out fair value today, discount for 1 year, how to do? 1 plus R. The R in equity valuation will get replaced by KE, in the equity base segment. So what is that? Required rate of return of equity, you are valuing share, so equity only, so discount it using KE. So D1 plus P1 divided by 1 plus KE, you will get P0. Are you understanding the first formula logic? Now 1 year holding period formula I told you. Next, formula number 2 is that NP0 is equal to P1 into N plus M minus I plus E, the whole divided by 1 plus KE. Are you all understanding? This is another formula of the wealth of the company. How to calculate the wealth of the company? Wealth of the company remains unchanged. You need to show that is how it is computed. Very simple. Here also, if you notice, see, the N is what? Existing number of shares, and this is new number of shares is M. So N and M means total number of shares outstanding. This will be at the end of the period, and the price of the share will be there at the end of the period. So what is this? Price of the share at the end of the period. N and M, total shares outstanding. If you pay out dividend, you need to raise fresh capital, then this will become 1111 shares. In case you don't pay dividend, this total will become 1000 as per our example. I'm saying. Minus I means how much investment amount. That is, in our example, I gave you 1000 as investment amount. Plus this, already you have earnings, which means already you have earnings. Now, what is the retained, whichever earnings you have, that you need to adjust as well. Are you all understanding? For example, the company, why you are, reducing the investment amount and adding the earnings? Very simple. The company has already retained earnings of 1000 rupees, and the company newly available project is 5000, which means you will reduce this 1000 rupees from 5000. And balance 4000 only you need to raise fresh capital. Are you all understanding? When you are raising fresh capital, existing retained earnings, you will use it, then only you will raise for external funds. You will not, you have retained surplus of reserves of this much amount, 5000. Will you raise capital? No. So this is there. This is I means new investment amount, E means earnings available, divided by 1 plus KE. This is the second formula. Third formula, I will tell you how to apply the formula, or even if you don't remember the formula, how to use logic and then solve the question. I'll tell you only one type of question is being asked in Modigliani Miller. I'll just discuss that. Now, third formula you need to remember, new number of shares. Sir, in this formula, I need to use the M is the new number of shares. Okay, N, don't get confused. N means new number of shares. In, okay, abbreviation, M here they have used new number of shares. Here N means existing number of shares. Anyway, so here what they have done is that the new number of shares formula is MP1. MP1. P1 is that price of the share is nothing but C. What is the new number of shares? 1 second. Yes, this new number of shares you will find out. But that is P1 means, okay, the price, new shares price actually is, if you see here, M is new number of shares. This M, how will you find out? The P1 will be there if you see M P1. If you, divide it. If this P1 goes that side, opposite side, this will be P1. Are you all understanding what I am trying to say? So M is equal to effectively I minus E minus ND1 divided by P1. But okay, P1 means nothing but the price at which the new shares is being raised. The price at which new shares is very simple. In our example, new number of shares at 111.11. At what price? At rupees 9. The total will come to 1000. Are you all understanding? So effectively the MP1 will become the 1000 rupees. But you don't know how many shares are to be raised. So effectively I minus E minus ND1 if you do and divided by P1, you will get the number of shares. Are you all understanding? We will do the question answer. Then you will be having absolute clarity. Okay, shall we see here? Take question number, this question, Modiglani Miller. What is that question number? 21. Illustration number 21 you can consider. I'll just rub it off. See. Bangabasi Limited belongs to a risk class for which the appropriate capitalization rate is 10%. It currently has, okay, I just zoom it a little bit more. Okay. It currently has outstanding 2000 equity shares and of 100 each. The firm is contemplating the declaration of dividend 8 per share at the end of the current financial year. It expects to have net earnings of 20,000 and has a proposal for making new investment of 24,000. Show that under Modiglani Miller assumption, the payment of dividend does not affect the value of the firm. They want to show under both the options, value remains same. I already gave you that example. 9,000, 10,000, how 10,000 doesn't change, number of shares changes here, their number of shares do not change, right? So we need to show this, right? Now in this question, P0 is given as 100, market price P1 you need to find out. Okay, D1 is given as 8 rupees. Next year the company will pay dividend of, contemplating, it is expected to pay next year. Okay, end of the current financial, which is D1. Are you all understanding? So what you do, you have D1, you have P0 given, KE given as 10%. You have to find out P1. What is to be done? Apply the formula here. What is to be done? Now, first formula, P0 is equal to D1 plus P1 divided by 1 plus KE. What is the amount? D1 is what? 8 plus P1 is what? You don't know. You need to find out as balancing number. 1 plus 0.1, 1.1. P0 is 100 given. Current price is 100 given. Okay, it currently has outstanding 2000 shares of 100 each. This is current price. So apply this 110. So P1 is equal to 110 minus 8 is equal to 102. Are you all understanding? Now to be, okay, see here, what is to be understood? Now, two options are there with dividend, which means pay dividend. Okay, with dividend means pay dividend option. Do not pay dividend. Do not pay dividend. Now, under both the options, if you see, if you pay out as dividend, the share price after 1 year will be what? 102. Why 8 rupees dividend will be paid? If you don't pay dividend, what will be the share price? 110 will be the share price. Are you all understanding first of all this? Now, this is the share price. Very simple. What is the current earnings today? Earning of the company is 20,000. Earnings of the company is 20,000. Investment required is 24,000. So, if you pay out as dividend, what is the dividend amount? 8 rupees per share. How many shares outstanding? 2,000 into 8. How much dividend amount will be? 16,000 you will pay out as dividend. Are you all understanding? So, the total earning of the company will be 20,000. Minus 16,000 will be paid as dividend. Balance how much retained earnings will be? 4,000 will be the retained earnings. How much investment amount required? 24,000. So out of 24,000, 4,000 will be retained amount will be used. So how much fresh issue should be made? 20,000 only fresh capital should be raised. Are you all understanding this point? So 20,000 you need to raise fresh capital. this 20,000 from where I will raise, at what price I will raise, to be precise, 20,000. When you pay out as dividend, you need to pay at 102 rupees. How many number of shares will be required to be issued at the end of the year? 20,000 divided by 102, which comes to 196 shares. 196 shares. What is the total number of shares in this option? 2,000 plus 196, 2,196 shares. What is the share price? 102 will be the share price. Are you all understanding? Okay, into 102. Okay, 2,23,970, 2,24,000 roughly. Anyway, this I will come back later. Come to no dividend option. No dividend option, share price will be 110. Okay, now in the no dividend option, here you need to understand, no dividend option, 110 will be the share price, correct? Now, how many new shares is to be raised? Now, you need to see. If you don't pay the dividend, what is the total earnings? 20,000 will be the total earnings. E is equal to earnings 20,000. What is the investment amount? 24,000 you require. Are you all understanding? If you pay out nothing as dividend, entire retained amount can be adjusted here. Agreed? So how much you need to make fresh issue. In our example, the investment amount was 1,000 and the the cash balance was also 1,000. Hence, we don't require to raise capital in the second option. Here, still you need to raise capital. How much you need to raise? 4,000. I need to raise 4,000 now. At what price? 4,000 divided by 110 you need to raise. Okay, 4,000 divided by 110. How many new shares is to be issued? 36 new shares is to be issued. Are you all understanding? This is what they've computed here. Okay, see here, amount required to be raised from the new issue of share is change in NP1. Okay, change in N, that is to be solved. 20,000 divided by, how much is that? 102. 20,000 divided by 102. How much is that? 196. They have not put it simply. They have put 20,000 divided by 102 and proceeded. I will write it 196 shares. Okay. Now, value of the firm. Now apply the NP0 value of the firm. Why? You got the new number of shares, old number of shares. Find out the value of the share. Now, how to find out value of the share? See, very simple. What you do? 102, apply the formula. P1 is 102. N is what? Existing number of shares, 2,000. New number of shares is how much? 196. So, 102 into 190, 2196, 2,196. This is the, okay, value of the company, apart from retained earnings and other adjustments. Minus investment value. Why minus investment value? Okay, investment. See here, this is the total value. Out of it, investment value is 24,000. Minus I, you need to adjust. Plus EPS already available. How much is the EPS? 20,000 is the EPS. Are you all understanding what I am trying to say? Okay. Now, next. What is the next amount? 1.12K you discounted because this is the next year cash flow. A next year value, you bring it to present value terms, today's terms. Like what is the value of the company today? NP0 comes to how much? 2 lakhs. Are you all understanding? This is option when dividend are paid. So if dividend are paid, value of the company today is 2 lakhs. Are you all understanding? Now we will find out value of the company when dividends are not paid. When dividends are not paid, what will be the share price? I already computed 110 and 102 I showed you. After this, okay, under this option, anything to be raised in new capital or nothing to be raised? Yes, to be raised. 4,000 is to be raised. I just showed you. Okay, they have used the formula. I just logically told you because 20,000 retained earnings, 24,000 investment opportunity. You use the retained earnings. What is the balance portion you need to raise? 4,000. That 4,000 divided by 110 because share price will be 110. Without paying dividend, that you will divide. Now, how many new shares is to be raised here? 4,000 divided by 110. 36 new shares. 36 new shares. Up a total 36 into new shares. What is the 36 plus 2,000? 2,036 are? Yes, 2,036 into the new shares 110. 110 will be the share price. 2 lakh 23,960, which is roughly 2,24,000. Okay, rounding off issue. This 36.16 some number comes now. Okay, 2,24,000 minus I 24,000 plus E 20,000. Are you all understanding? This minus I and plus E is nothing but your balance amount which additionally you need to raise. What is that? 4,000. So minus 4,000 effectively 2,20,000. Again, this is 20,000. Yes, 4,000 you adjust now. 2,20,000 divided by 1.1. You will get the value of 2 lakh. Okay, the next page I put it here. Yes, they've given here. Okay, P1 plus change in the same formula you apply, but new number of shares to be raised now 4,000 divided by 110, which is nothing but what is that? 2,036. 2 lakh 24 minus 24 plus 20 divided by 1.1. They got the same 2 lakhs. Hence, the total value of the firm is also. Thus, it is clear that total value of the firm remains unchanged whether dividends are paid or not. That is what is the Modigliani-Miller approach. Are you all understanding? With this, we are through with the small segment, that is dividend based model. Shall we move on to capital budgeting? Okay, see. This is very, very important area. Capital budgeting. Okay, core chapter, one of the core chapter, investment decision. See, what is the agenda for this chapter? I'll tell you. In this chapter, we will learn conceptually all the concepts I will discuss and all. But I may not be doing a lot of questions. In this chapter, you will only gain confidence if you do a lot of questions. Okay, there are so many given questions in your module. So many questions are given in your module, which you have to practice no other way. This chapter alone, you should practice a lot to get a confidence, because every time routine computation only, through numbers only, you will get the concept will remain same. I'll explain you the concept very well, but the practice session, the question answers, you should ensure that you practice or select very important question. I have selected a few good questions that if you practice, it is sufficient. But still, if you want to get a complete grip over the topic, you need to practice a lot of questions. Are you understanding? Shall we start our session? Okay, see. So let us start with the new chapter, that is capital budgeting. See, what is this investment decision all about? Okay, it's all about long-term decision making, which means a company wants whether I should open a new factory or whether should I purchase a new plant and machinery. Okay, and all these fixed assets related decision, which has profound impact, which runs for a number of years, which means it will have an initial huge outlay, cash outlay, and which will involve a series of inflows, which means year 0 you put huge amount of funds, and then from year 1 to some number of years, okay, it will have huge inlay. Year 0 it will have huge cash outlay, then year 1 to some number of years, okay, it will have cash flows. So it will have various cash flow. So inflows will be there, series of inflows will be there, huge outlay will be there. We need to compute whether the project is beneficial to accept or reject. So this is all about the investment decision. Now, first we will try to understand, okay, few basic things regarding the capital budgeting. Thereafter, we will move on to the specific topics in the capital budgeting. Shall we? See, in this chapter, throughout the chapter, cash flows only will be considered, because that is superior number than accounting profit. So wherever profit is given, you need to convert it. Data is given, now you need to convert it. Okay, make some adjustments for depreciation, etc., non-cash item, etc. You need to adjust it and arrive at cash flows. Are you understanding? Straight away cash flows is given, you can directly compute, which means throughout our chapter, cash flows is superior. Cash flow only will be taken for decision making. That is the point number 1. Next point, okay, see, that is when accounting profit like EBIT or net profit is given, convert it to cash flow to solve the capital budgeting question. Anyway, we will see that. Now, only incremental cash flow should be considered. Point number 2, only incremental cash flow should be considered. Incremental cash flows means which are specifically incurred for that particular purpose. For example, if you have sales of 1 lakh, materials of 80,000, okay, and you have labor of 40,000, anyway, the net, assume the cash flow comes to 20,000, not cash flow, okay, the net profit comes to 20,000, assume. Now here, suppose the wages of 40,000 you paid here, now this 40,000 is paid, okay, for the existing employee who is idle, which means you run a factory, big factory, one of the department, there are employees, and the work related to that department got over. Okay, you are hiring those employees who are at present idle. You anyway have to pay them salary. Yeah? Okay, 40,000 per month, assume you have to pay salary. This month they don't have any job. What do? You invest in new project. Now, for that project, assume you are manufacturing a new product. For that product line, what do? Okay, you hire these already existing employees. You just take them into this project for this 1 month. Okay. Now, this 40,000 is specific expense. Even if you don't, okay, produce the new product, you will have to incur this 40,000. Are you understanding? Which means the 40,000 is not incremental cash flow. Is not incremental cash flow. Yes, sales 1 lakh the benefit and cost is 80,000. But this 40,000 cost is there now. This is the, okay, this is not incremental. This is not specific to this project. This is like overheads, which is, okay, which is allocated, which means this general, okay, because anyway you have to incur this amount. So irrespective of, production of this product, you will have to incur this 40,000. Now, this is not incremental. Therefore, 40,000 is not exclusively incurred for this project and not incremental. Therefore, will not be considered for making this capital budgeting decision. Are you all understanding? This is just an example. Wherever they give you, you consider the incremental effect. If at all they give you in the question, you have to understand that you should verify that whether this transaction will really affect my current transaction. Exclusively if used for this, you should consider. Otherwise, you should ignore. Next. Okay, cash flows after tax should be considered. Cash flows after tax, CFAT, will compute something called as CFAT. Net profit will be given. How to arrive at cash flows after tax? Because tax belongs to government, irrespective of what is the cash flow from the product or from the new project. Okay, that you will only consider after tax, because government you have to pay tax anyway. After tax only it's attributable to you, so you will consider cash flow after tax. Now, depreciation, what is the treatment of depreciation in capital budgeting? Very simple. Depreciation should be deducted for computing profits. Very simple. The tax is there now. The tax will not be computed on cash flows, it will be computed on accounting profits. Okay, thereafter, after even publishing the accounting profits, you have to, as per the Income Tax Act, depreciation, all that will be provided. It will be adjusted based on income tax. Few expenses will be disallowed, deductions will be allowed. After that, the profit, adjusted profit only, you have to pay tax anyway. But still, see, for computation purpose, if profits is given, you need to convert it to tax. Thereafter, you have to consider tax effect. That is fine. But the tax which you are computing, this you should, for this tax purpose, you have to consider depreciation effect. Are you all understanding? Cash flow will not have depreciation inside it. Okay, which means depreciation will not be included in cash flow. But for computing profits, you need to reduce depreciation, because after depreciation only you will compute the profit available for taxation. Profit before tax, on that only you will apply the tax rate. Are you all understanding? So, one line summary. What is the treatment of depreciation? For computing net profits of the company, you will deduct the depreciation. And after computing net profit, to arrive at the cash flow, you will add back the depreciation and tax effect will be included. Are you all understanding? Say, one or two questions you will do, will be very comfortable. Next, working capital adjustment. What is the treatment of working capital in this capital budgeting? Very simple. Working capital should be treated as additional capital in year 0, which means when your initial cash outlay is there, we are going to segregate all the cash flows and all, inflow, outflow, how it is computed, everything we are going to discuss. Just understand that working capital, very simple. You invested a new, you bought a new plant and machinery, or you just opened a new factory. Can you run the factory without having any working capital? Just factory bought now, production will start. No, you have to incur some working capital. Are you all understanding? For work, so some amount will be blocked. Say, for example, you are undertaking a project for 1 to 10 years. 10 years project you are undertaking. Say, for 50,000 rupees, assume working capital, day-to-day expenses you need to manage. We have separate chapter for that. Assume that, you will have to buy the raw material. You will have some debtor balance. Creditors will give you some time, either credit period. Like this, you will have some working capital requirement. Just say 50,000 amount is blocked throughout this 10 years period. Are you all understanding? Which means on an average 50,000 is blocked. What is this treatment of this working capital? Very simple. Year 0, you add the working capital along with the initial cash outflow. And at the end of the project, suppose this is year 1 to 10, it will have the benefit. 10th year, the project will cease to exist. It will be closing. In the 10th year, what you do, at the end of the 10th year, you will have the recovery of working capital. Working capital was blocked enough. This 50,000 is like, advance given for your EB bill. Have you seen electricity bill? If you are paying, you will give some fixed advance. It's like refundable deposit, and later on it will be recovered. Like that, after 10 years, this working capital will be recovered. Why? The fund was blocked. As soon as the project gets completed, the funds which was blocked in that project will get released. So release of working capital will be happening at the end of the period. So working capital adjustment. Working capital should be treated as outflow in the year 0, means today initially. Then it will be treated as inflow at the end of the project or last year of the project. Are you understanding? Now, sir, you told me how to we should compute cash flow, that too after tax, all that. So how to actually compute cash flow after tax? Very simple. Remember this income statement. Okay, very simple. Sales is there. First line item is sales. Net revenue, sales you consider. Thereafter, cost of goods sold. Most probably is cost of goods sold. Cash cost will be considered. Yes, general expenses other than interest. Okay, general expenses. If at all they have given, you will consider. But this general expense also, it should not be general overhead, general, okay, which belongs to all the, this is specifically attributable to project only you will consider. Are you understanding? General expenses related to that project. Okay, which is not like direct material or labor. Like that I have told you, cost of goods sold. Okay, because cost of goods sold, you already know that, manufacturing cost only you will consider, right? So here general expenses will consider that too. Cash, specifically attributable to this project will be considered. If at all given in the question, you will consider. Next, minus depreciation. Depreciation is a non-cash item. Sir, why I should reduce? Now, very simple. You need to reduce it to compute PAT, profit after tax. So I will compute this. I will find out EBIT. Okay, after earnings before, before the depreciation, this number is called as EBITDA, earnings before interest, tax, depreciation, amortization. Thereafter, you will reduce the depreciation. Okay, remove the depreciation and amortization. You will get what? EBIT. EBIT is nothing but operating profit. Operating profit. Now, you got EBIT. Yeah? From EBIT, what you should do very carefully. Generally, what you will do, minus interest is there. You will get PAT. Like that, you will get the PAT. Anyway, no issue. Now there are two steps. This is one of the method. I am just clarifying. I will show you both the methods, how to compute everything. I will clarify. Are you all understanding? Understanding the income statement is very, very important. Now, you got operating profit at EBIT. Directly reduce the tax, you will get no PAT. This is no PAT, no PAT, no PAT. That is not a meaning. Net operating profit after tax. What is this called? Net operating profit after tax. Net operating profit after tax. Now, in the next step, what do you do? Reduce the tax. See, in our the module, what I have taken, I have written the notes and taken the PDF printout. So the last some 2 lines will be repeated again here. Okay, for every page. Can you see this? See here. Can you see this ARR payback? This again is repeated. So don't mistake. That is okay. The system prints out like this. Or comes okay like this. But you have to understand that I have not written 2 times. This is I've just taken the printout from my own notes and I've converted into PDF. See here. So you have depreciation. You got EBA no PAT na. So no PAT you got. From this no PAT you add back depreciation. Depreciation which you reduced for computing EBIT. Thereafter, after tax, so for tax effect, you computed depreciation. Tax number you need to reduce now. For that, you computed depreciation so that you will have reduced the tax effect. Thereafter, you will add back the depreciation to arrive at the cash flow after tax. Are you all understanding? So, first, again, tell me this is one of the method how to do it. First, net revenue, sales is there, minus cost of goods sold, and minus general expenses, if any given. Then, okay, then what you will do? Then you will get EBITDA anyway. EBITDA minus depreciation. If you do, you will get the EBIT, earnings before interest tax. Thereafter, if you reduce the tax effect, you will get the no PAT, net operating profit after tax. Thereafter, you add back the depreciation, you will get cash flow after tax. Are you all understanding the first stage? Now the second way, okay, to get the PAT is get the cash flow after tax is very simple. You have got EBIT. Don't be okay. Thereafter, you reduce the tax. Fine. What you will get EBIT. Thereafter, you reduce the interest. Okay. Before this is one way. I told you already. Now, second way, what you do? EBIT you have. I will just show you. No issue. EBIT minus interest. What you will get? EBIT. The normal leverages method you do now. Like that you follow. Minus tax you do. You will get PAT here. Are you all understanding? You will get PAT. From here, from PAT, how to arrive at cash flow after tax? Very simple. You have the PAT na plus interest into 1 minus T. Plus interest into 1 minus T. Then add back depreciation. You will get the CFAT, cash flow after tax. Are you all understanding what I'm trying to say? So 2 ways to compute no PAT. See this here, no PAT. See, very simple. Here, the PAT. Okay, here I showed you na CFAT is equal to no PAT, net operating profit after tax, right? Plus depreciation plus depreciation. This we already know that. Now this NOPAT, the number to which we have to add depreciation, this number, how should we find out? Two ways are there. Very simple. Just now we found out. Now first method, simply EBIT minus tax or EBIT into 1 minus T. You will arrive at NOPAT. That we already know in the first step, which we did now EBIT. We skipped the interest portion. Directly jump to tax. We computed the tax on EBIT, not the EBT. Generally, we should compute the tax on EBT. But we computed tax on directly EBIT, and EBIT into 1 minus T will give you NOPAT. Added back depreciation, we got the CFAT. Are you all understanding? This is first method. Already I discussed it. Second way, just now I showed you, EBIT minus I, EBT minus tax, you will get PAT. From this PAT, add back interest. But while you add back interest, you should also add, only add back after tax interest, not pre-tax interest. Are you all understanding? I will explain you, no issue. So add back after tax interest, you will arrive at, net operating profit after tax, no PAT. From here again, you add back depreciation, you will get anyway cash flow after tax. I will show you how both the numbers will give, sir, two methods we have explained. Whether both the methods will give the same answer. Now it should give you the same answer. Are you understanding how I will show? See, I have discussed that EBIT into 1 minus T is equal to PAT, plus interest into 1 minus T. This is what we need to prove here. That is what I am going to prove. This LHS will be equal to RHS. Both are same number only. Using numbers you will understand. See what happens. Assume there is an example. EBIT is 100. Minus interest rate 20. What is the EBT? 80. Tax is how much? Assume 30% is the tax rate. We will get 24 rupees as tax. What is the PAT? 50. See, not negative. PAT is 56. Are you all understanding? So EBIT 100. PAT is 56. Now, what is EBIT? This first method, method number 1, EBIT into 1 minus T. So EBIT is 100 minus T tax. Apply tax on EBIT. 30% into 100. How much is the balance? 70 rupees. Are you all understanding? So this is no PAT. No PAT. This is one method. Come to this side. What is the PAT? From PAT also you can move on to find out the EBIT, the no PAT. What is PAT? 56. Add back interest. But interest, after tax interest, you should add back. So what is the interest? 20%. See here. Here can you see interest is 20 rupees. So interest is 20 rupees. What is the tax rate? Minus tax on 20. So 20 into 30%, 6 rupees. Reduce it. After tax interest is, this is before tax interest, this is after tax interest. This is called as I into 1 minus T. How much is that? 14. So 14 you add. 56 plus 14 will give you the same 70. Are you all understanding? So compute cash flow after tax. What is the understanding? No PAT plus depreciation will give you cash flow after tax. No PAT, how to compute no PAT? Two methods are available. EBIT into 1 minus T directly you can do. When they have not given any other data, directly you can apply the tax rate on EBIT and find out, or question will mention no PAT. In that case, simply add depreciation, you will get the cash flow after tax. Are you all understanding? Step method number 2 to get no PAT. What is the method? Very simple. PAT plus interest into 1 minus T plus depreciation. Interest into 1 minus T will give you no PAT. Add again depreciation. You will get the cash flow after tax. Are you all comfortable with this computation? One illustration we will see. Thereafter we will proceed. In your module itself, one beautiful illustration is given. We will consider that and move ahead. See, when interest is specifically given in the question, this is very, very important adjustment. Why? Very simple. When interest is specifically given in the question, what do you do? Use PAT, add back interest plus 1 minus T, and arrive at no PAT. Thereafter add back depreciation. So when interest rate is given specifically and PAT is given, PAT plus interest into 1 minus T. You add it. You will get what? No PAT. After getting no PAT, you add back depreciation. You will get cash flow after tax, CFAT. Are you understanding? Now, sometimes what happens in capital budgeting question, they will never mention. Already the question would have excluded the interest portion, or they might not just mention what is the interest amount. Are you all understanding what I am trying to say? Because see, the NPV which you are going to find, there you have to discount the cash flows using WACC. WACC means KO, overall cost of capital, overall cost of the company, which means interest also should ideally be included there. Then only you can discount it, right? Using WACC. So here question doesn't mentions you interest now. How to do it? Are you all understanding? Genuine question will be there. Question may mention you interest amount. It may not give you interest amount. In that case, what you should do? PAT is given and no EBIT. From there you can't compute. What can you do? Now very simple. PAT is given. Consider that. Interest into 1 minus T, not possible to calculate because data is insufficient. Data is not given regarding interest. Now what you should do? PAT you have assumed that it is, you have done that. You have added interest plus into 1 minus T, which means when there is no interest given in the question, ignore that, just a PAT given and depreciation given. Now, simply assume PAT to be no PAT. Simply assume PAT to be no PAT and add back depreciation. Are you all understanding what I'm trying to say? Okay, see, when interest is specifically given in the question, use PAT plus interest into 1 minus T. Otherwise, if not given in the question, PAT is given. Since there is lack of data, simply add PAT plus depreciation to arrive at CFAT. See illustration for both. Are you all understanding? We are going to see, okay, the illustration under both the methods. Shall we? Quickly, we will brush through the illustration and move ahead. Say illustration number 1 here. From the following information, calculate net cash inflow after tax. CFAT they are asking us to find. No, net sales revenue given, cost of goods sold, operating profit, depreciation given, whatever is the number, 8 lakhs is given. Are you all understanding? This is just an illustration. Thereafter, EBIT given, interest specifically given. When interest is given, you can calculate cash flow after tax under both the methods. Are you all understanding? When interest is given, if you calculate under both the methods, the answer will tally. If interest is not specifically given, okay, you should only add back depreciation from PAT. That is what I told you to follow. Are you all understanding? It aligns with all the questions. That is why I don't want to complicate at this time. Understand like this, okay? PBT na 1,50,000 here. Tax rate is 45,000 and PAT is 1,05,000. Are you all understanding? Now, let us see the solution. First, take EBIT, first method. This is method 1. Okay, EBIT into 1 minus T. If you consider this, EBIT is 2 lakh, tax is 60,000. This is 1,40,000 is what? No PAT. 1,40,000 is no PAT. Are you all understanding? Add back depreciation of 1 lakh. How much you are getting? 2,40,000. This is what? CFAT. Cash flow after tax. Are you all understanding? Yeah, this is method number 1. They have also shown you alternative. This is method 2, wherein PAT we have considered 1,05,000. Add back interest, but interest, see, here they have directly added depreciation and then they have added interest, net of taxes, etc. But what you should do now, this is PAT here, then add back interest. What is the interest? 50,000 is the interest. Net of taxes, 15,000 taxes. So net of tax interest is how much? 35,000. This 35,000, add it to 1,05,000, you will get 1,40,000. This is nothing but no PAT. I already discussed now. This is no PAT. And here you add back depreciation of 1 lakh, you get CFAT of 2,40,000, which is tallying. Are you all understanding what I am trying to say? This no PAT, you are getting same as 1,40,000. And method 2 also you are getting the same no PAT. Are you all comfortable? Then add back, simply add back depreciation. You will get that they have computed first depreciation added, then added interest into 1 minus T. Anyway, interest into 1 minus T you first add back. Now you will get the no PAT. Thereafter you can consider this. Are you all comfortable? Okay. Now we will move on to next topic, that is different techniques in capital budgeting. Okay, we have different techniques here in capital budgeting. Now, predominantly, see, 1 or 2 techniques more are there, but still anyway, we need to plan for the coverage. That is why whatever is given, very, very important techniques only I have covered. Okay, most probably everything covered just from MIRR. I have not MNPV. One question we will solve, but deep concepts involved. Anyway, we don't have time for discussing. It will take 1.5 hours for just discussing the concept. So I'm not able to cover those things. Don't worry. This is sufficient, I believe. So non-discounting techniques is there and discounting techniques is there. Non-discounting techniques, there are predominantly 2 techniques: ARR, payback period. Okay, this will never use time value of money. Okay, discounting compounding, it will not be used. So non-discounting technique. Discounting technique, NPV, IRR, PI ratio, discounted payback, EAB or EAC, life disparity concept, then MNPV and MIR. This MNPV and IRR only I will briefly cover. Balance all the things we need to cover anyway. Questions are being tested. MNPV and MIR also we have a question, but I'll discuss the question and brief concept, but I don't want to go into deep concept. Shall I proceed? Okay, payback period. First take payback period. What do you mean by payback period? Very simple and straightforward issue. See, Year 0, capital budgeting always will have year 0, you will have outflow. Okay, year 0, say you spend 10 lakh rupees to invest in the project. And 1, 2, 3, 4, 5, for 5 years, the project will give you every year, say, assume first year 2 lakhs, second year 4 lakh, third year 6 lakh, 5 lakhs, and 3 lakhs. Like this, the project inflows. This I call it as inflows of the project. This I call it as outflow of the project. Are you all understanding? This is what you are spending. This is what you are spending versus these are all what you are earning from the project. Are you all understanding? So to simple terms, this is your cost or outflow. These are all your inflow. What is the really capital budgeting? Now, okay, whether your inflow is more than your outflow after considering the time value of money effect. Are you all understanding? Discounted cash inflow is more than discounted cash outflow. Now, NPV will be positive. This is all the capital budgeting thing. But here what we are discussing, payback period. What do you mean by payback period? Very simple. You have spent 10 lakh rupees. This 10 lakh rupees, how much time it will take to recover through inflows, which means 10 lakh rupees you invested. In this example, let's take this example. 10 lakh rupees is your outflow. First year you are getting 2 lakhs. You are getting fully recovering the 10 lakhs. No. Your capital is recovering or not recovering yet? Not recovering. So second year 4 lakhs. So total comes to 6 lakhs. Third year 6 lakhs. 6 plus 6, 12 lakhs. Your capital is getting recovered in between second and third year, which means on the third year you are recovering, but exactly not 3 years. This is something similar to average due date in your accounts you would have studied. Okay, payback period, time taken to recover the initial investment amount by way of inflows from the project. This won't consider time value of money. Okay, if number comes in between 2 years, which means, for example, this, okay, 2 years you are recovering 6 lakhs. At the end of third year, you are recovering 12 lakhs, which means you are investing how much? 10 lakhs. 10 lakhs comes in between these two numbers. Do interpolation and find out. Sometimes it might be some 2.5 years or something. Interpolation, I will explain when I do the question answer with numbers. You will beautifully understand. Shall I proceed to the next concept? Okay, two techniques we will discuss. Thereafter, we will discuss one question regarding ARR. Then we will come back and discuss all the other process, NPV, PI ratio, and other stuffs. Then we will discuss few question answers, and then we will proceed. Okay, this is the flow of the discussion. Shall I see? What do you mean by ARR? ARR is something but simple, average rate of return or accounting rate of return, interchangeably used here. What is this now? Very simple. Average profit. This is a ratio. This is a ratio. Average profit divided by original investment. There are two types of ARR, okay, broadly used here. Either average profit divided by original investment or average profit divided by average investment. That is also used, okay. Average profit by average investment. Two ways are, you can compute the ARR. Average profit after tax. Now, assume the data given is for 5 years. Assume the data is given for 5 years. What you will do? Simple average. Year 1 profit, 2, 3, 4, 5. Add it total cumulative profit divided by 5. Simple average you do. You will get the average profit after tax. No issues at all. Divided by original investment. Whatever you initially invested to start up the project, okay, that initial investment or original investment you will take in the denominator and find out the annual rate of return, average rate of return. This is one way. There is no complication in method number 1. Method 2, what is that? Numerator also same. Average profit remains same. The denominator, average investment, only undergoes a change. Are you all understanding? What is the new formula for average investment? Average investment is nothing but original investment. You would have invested originally 10 lakhs. Assume you would have invested originally 10 lakhs. Okay, opening value minus salvage value would have been given for the project. This you reduce, you will get the net value divided by 2. So, original investment minus salvage value divided by 2. This salvage value you should add back. This salvage value to compute the average you should consider, but thereafter you should add back. So add back the salvage value plus add back the working capital plus add back the working capital if at all given in the question. Are you all understanding now? So average investment, you should add back salvage value as well as working capital. So what is the formula? Average investment formula. Okay, the original investment minus salvage value divided by 2 plus salvage value plus working capital only, or working capital even salvage value, you will consider if at all given in the question. Otherwise, if nothing is given in the question, very simple. Original investment is there, 10 lakhs divided by 2, you will get the average value. Are you all understanding? Original, see, original closing plus opening divided by 2, that also you can do. But if at all given in the question, if not given, you just ignore that. Are you all understanding? That is what. If working capital not given in the question, then ignore. Salvage value also may be given, may not be given. Simply straight away average investment value will be given. You consider that. Shall I? Okay. One question we will do in this regard. Illustration number 4. Determine the average rate of return from the following data for two machines, machine A and machine B. Cost is 56,125. What is this? Original investment. Original investment. Cost is 56,126. Next. Annual estimated income after depreciation and income tax, which means everything done, adjusted, okay, and they have given this after adjusting depreciation as well as the income tax. What is the amount? Okay, every year this is the amount they have given for machine A and this is for machine B. Total comes to 36,875. Here 36,875. Are you all understanding? Now estimated life is 5 years. Over a period of 5 years you are earning now. Upper divided by 5 you will get the average for numerator, you will get the average income. What is the average net profit after tax? How much is that? For machine A it is 7375. Okay, for machine B also is same, huh? Yes, 36,875 it is same. See, year wise it is not same, but after a period of 5 years the total value is same. So divided by 5 will give you same amount for machine A as well as machine B. 7,375 divided by 5, numerator no issue. Denominator, let's see what can you do. Now, very simple. 3,000 is the cost of 56,165 original investment. What they have done now, very simple. They have done the, see, first of all in this question any working capital given or not given? Not given, forget about it. So what is the formula? Original investment minus salvage value divided by 2 plus salvage value. That's it. Working capital you ignore. Comfortable? Now original investment, what is the cost of the machine? 56,270. What they have done now? They have done salvage value plus OI minus SV divided by 2. Both will give you same answer. Okay, that is original investment 56,125 minus 3,000. Put in a bracket divided by 2. Half into this amount, divided by 2, same. Okay, plus 3,000, you will get 29,562.5. Okay, this is ARR. How to compute? 7,375 divided by average investment. You will get the average rate of return. Are you all comfortable with question number 1? 24.9%. Are you all comfortable? This is NPV related question. So once we cover the NPV concept, we'll move on. So see. Now we will discuss the one by one all the concept. Discounted payback period. So many techniques are there now. Discounted payback, NPV, IRR, then we have PA ratio. Thereafter life disparity concept we will study EAB, AC, and we will proceed. Shall I discuss discounted payback? Okay. Now what do you mean by discounted payback? Payback, very simple. How much time taken to recover? This is payback only, nothing great, but the cash inflows which you are receiving now, for example, in our example, 10 lakh was the outflow now. Here, okay, 1, 2, 3, 4, 5. Assume the inflow was there. 2 lakh, 3 lakh, 6 lakh, 4 lakh, 5 lakh. Like this, inflows will be there now. This is, you should not just add these numbers and find out the payback period. You should discount and add the present value of this and find out the cumulative value and when it is getting recovered. For example, this 2 lakhs discounted value comes to 1,90,000, just roughly example. Okay, and this 3 lakh discounted value comes to 1,70,000. 6 lakhs discounted value comes to 4,70,000. Like that, some number comes. Now, this 1,90,000, 1,70,000, 4,70,000, you should total the column cumulative value. You should find out when 10 lakhs is getting recovered. Are you all understanding? The original investment of 10 lakhs, initial outflow of 10 lakhs is getting recovered by discounted cash flow. When it is recovered by these discounted cash flows is what you are getting by discounted payback period. How much time to recover? This is only correct actually, because payback period doesn't consider time value of money, because really speaking, the cash received at the end of year 1, assume year 2, 3 lakh is there. Will the value be 3 lakhs or less than 3 lakhs or less than 3 lakhs? Time value of money itself we are considered. Therefore, the original correct value should be less than 3 lakh. That only you should consider for computing payback period. Hence, discounted payback period. Say, how much time taken to recover the original investment by discounted cash inflows of the project? Consider time value of money. Use interpolation. Same again. If it comes between 2 and 3 years, you should do interpolation. We will see one question is there. Adequate clarity will be there. Are you all comfortable? Shall I proceed to the next concept? Now we'll discuss the core topic of that chapter, which is NP. What is NPV? Net present value. Discounted cash inflow minus discounted cash outflow. Very simple terms. Net benefit after discounting. Okay, it is net discounted benefit, which means present value of cash inflows you will take discounted cash inflow minus discounted cash outflow. Generally, okay, at interval level, if you see the discounted cash outflow, the year 0, whatever is the outflow, since it is incurred today itself, Okay, it need not be in the real life. Real life, assume sometimes the project cannot, just like that, if you pay today 300 crores, the project will not be done, right? So you may even incur 100 crores every year for next 5 years. So you need to even discount the cash outflow. But generally at intermediate level, what they will give, they will generally give you the year zero cash flow, which means discounted cash outflow will be given in the question itself. Okay, discounted cash inflow, you need to find out series of cash inflows you will consider. So DISCI minus DISCO, discounted cash inflow minus discounted cash outflow. But to compute this discounted cash inflow minus outflow, you need to understand that what happens in capital budgeting. There are, see for example, year zero, the year cash flow, year zero, there will be some outflow, say 10 lakh. Year 1, 2, 3, 4, 5, which means the inflows will be series of inflows, which is not confined to only one single year inflow, one short inflow. This will be say 2 lakh, 6 lakh, 3 lakh, like that. Inflow will continue over a period of time, and outflow will be just once. Are you all understanding? So we need to understand comprehensively how to compute the discounted cash inflow, then reduce the discounted cash outflow. Some adjustments are to be made. Okay, I'm just showing you steps to compute the NPV. Are you all understanding? Whatever might be the question, okay, if you can fit it into this format, you can solve the question easily. Shall we see? Very simple. First, you will have initial cash outlay. First, you will compute initial cash outlay, that is discounted cash outflow. That you need to compute, but there are some steps or adjustments you need to understand. See, first, cost of asset will be given. If cost of asset is given, if you are trying to invest in new plant and machinery, the cost of plant and machinery will be given. This should be considered as initial cash outlay, one of the initial cash outlay first. But apart from that, sometimes what happens, the cost which is attributable to directly this asset, for example, if you you should capitalize in PPE standard or accounting standards 10. Normally, old AS 10, you have the property, plant and equipment standard. Now, there, what do? You generally capitalize the installment, the installment charges, the installation charges, installation charges and the legal charges, etc., which is very incidental to that expenses. You will capitalize, those expenses also you will consider as cost of the asset. Are you understanding? Whatever you capitalize in the accounts, books of accounts, that these costs you will consider here also. Then increase in working capital minus decrease in working capital. This working capital adjustment I already told you, change in working capital, which means increase in working capital, you will add, because there will be more working capital involved. Now you will add to outflow. If working capital is reduced, now will require less working capital. Generally you won't see decrease in working capital, very rare. Mostly see new project, more working capital will be required. How can it reduce the working capital? But generally given, increase you add, decrease subtract. That is one point. Another point is that salvage value after tax. You should salvage value after tax of the old machine. Now, what is this old new machine? Very simple. Sometimes there may be a situation where you have an existing machine, you are upgrading to a new machine, or you are selling the old machine and replacing the old machine, new machine with old machine with new machine. For example, I'll just give you an example. Sometimes what happens? You have a machine, on which labor do work on the machine and produce goods. But you are trying to buy an automated machine or semi-automated machine, wherein the existing labor, assume 400 workers you have, it will be, the new machine will require only 100 workers. Are you all understanding? So in this case, you are buying a new machine by selling old machine. Now, when you sell the old machine, when you incur this cost, you are selling year zero. When you are selling today itself, year zero, when you are buying the new machine, you will simultaneously sell the old machine. Are you all understanding? When you sell the old machine will carry some WDV. Old machine will carry some WDV. You see that whether you are incurring or whether you are getting some profit on this sale of old machine or loss on sale of old machine. If it is profit, you will have to pay tax. What is that? Tax payable on profit of old machine. That you should adjust with salvage value of the old machine. Are you all understanding? When you are selling, assume you are selling for 10,000 rupees. This is salvage value, but this salvage value should be net of tax, after tax, salvage value after tax of the old machine. See, the salvage value of the new machine, we are going to adjust on the terminal year, last year, which I am going to discuss in the inflow side. This is outflow. Are you all understanding? So, salvage value after tax you should consider. How to compute the tax? Now, very simple. How to compute tax? You find out the salvage value and find out the closing WDV. If salvage value is more than closing WDV, you are earning profit on sale of this asset. Tax you compute, you will be having tax payable. This tax payable, if there, salvage value minus tax payable you should do. Are you all comfortable? Now, assume WDV is more than sale value. WDV is 40,000. So, 40,000 worth machine in your books, you are selling only for 10,000. You are incurring loss on sale. Yes, loss on sale. In that case, what will happen? Tax benefit will be there. Tax inflow will be there. Are you understanding? If you have profit on sale, you will have tax outflow. If you have loss on sale, you will have tax inflow, which means in that case, what will happen? Salvage value plus tax benefit, tax inflow or refund or inflow. Are you understanding? Like this, you need to consider. See here, minus salvage value of old asset in case of replacement, where you sell the old machine and buy the new machine. Minus tax savings if loss on sale of old machine. Savings means, okay, if loss on old machine means loss means savings means what you do? Add to the salvage. What is that? Yes, tax payable, I will add. See what happens here. Here I have reduced the salvage value and I have added the tax value. If you take salvage value after tax, what you should do? The net of amount you will reduce. The net of amount you will see. This is what I am telling. I will just show you. The net of amount is there now. The salvage value after tax. Okay, assume 10,000 is the salvage value, and you got assume the profit of what. Profit means you have to reduce now. So net of tax minus you have to profit tax payable, assume 3,000. So 7,000 is the salvage value after tax now. This salvage value after tax you are getting recovering from the old machine. You are recovering from the old machine. What you should do? You should reduce. Are you all understanding why? You are computing cost of the new machine. While computing cost outflow of the new machine, the salvage value after tax of the old machine will become your inflow now. That you need to adjust with the current outflow. Are you all understanding? So net amount, because you are selling the old machine, buying the new machine. This will be your initial cash outlay. Are you all having the clarity? Okay, while we do the question, you will have absolute clarity. We will see if at all there are questions available in this regard. All the adjustment need not be asked in one single question. But I am discussing all the adjustment. What is weight rated? How it is weight rated. Now, point number 2, annual cash inflow. 3 stages you have. First, initial cash outflow. You have computed how to take the discounted cash outflow. Okay, now you need to compute how to take annual cash inflow. How to consider annual cash inflow. What is to be done now? Calculate CFAT. CFAT for every year. You need to compute CFAT. Assume the project life is 5 years. Now, for 5 years, you need to compute CFAT. How to compute CFAT? I already discussed. That is why I discussed in the introduction itself how to compute CFAT. So, NOPAT plus depreciation. Okay, NOPAT computation, 2 methods possible. EBIT 1 minus T or PAT plus interest into 1 minus T. Add back depreciation, you will arrive at CFAT. Are you all comfortable? You will arrive at CFAT. This is how you need to compute CFAT. Calculate CFAT using the 2 methods which we already discussed. Now, last, terminal cash flow. Terminal cash flow, which means, see, year 0, initially you invest in 10 lakhs in the project. That is your outflow, put it in bracket. Inflow now 1, 2, 3. Assume 3-year project. Some inflow 2 lakhs, 20 lakhs, okay, 6 lakhs. Like that, some inflow is there. After the completion of the project, what all the transactions will happen, which means at the end of the 3rd year, project is getting completed, closed, what should be the treatment? What are all the adjustments you need to make? Now, very simple. What will be there? 2 things will predominantly there. Salvage value will be there, and terminal, that is the recovery of working capital. I'll just write it here. Recovery of working capital. So, working capital recovery, which means 2 things will only be predominantly there. Here only I need your attention. Salvage value will be taken after tax. So, salvage value should be adjusted. How to adjust it? I already discussed. This salvage value is of the new machine. Are you all understanding? Because old machine already sold, they are gone. This new machine, you run the project for 5 years. After 5 years or 3 years, after the project, you sell it. Which means after the life of the project, you sell the new machine also, that will be closed. It will have some salvage value, which means for 5 years, if you run the project, you will have some depreciation. You would have charged it. Okay, balance WDB will be there. That you compare with the sale value. If sale value is greater than W value, assume the salvage value is greater than closing WDV. What is this? This situation will give you profit on sale. Profit on sale. Profit on sale will give you what? Tax outflow. Tax payable will be there. This tax payable should be reduced from salvage value. Are you all understanding? So salvage value after tax should be computed. How now? Salvage value is there. Okay, minus tax payable or minus tax savings. If it is loss on sale, when the savings will be there? When WDV is of the asset is more than sale value. In that case, what you will have? Loss on sale. Okay, loss on sale. You are selling for lesser amount than the WDV. Loss on sale. Tax will be there. Tax benefit will be there. That will be added. Are you all understanding? Now, this is regarding salvage value with tax adjustment. Salvage value after tax. That I call it as salvage value after tax. SVAT. Next adjustment is working capital recovery. This I already discussed. Working capital initial year 0 you will reduce, and at the end of the period you will add back. That is right. Simply add back the working capital recovery. Total will be called as terminal cash outflow. This cash flow belongs to the last year, which means you should apply the third year's discounting rate or fifth year discounting rate, bring it to present value terms, which means you see, I will just show you what happens here summarily. Year cash flow. Okay, say year 0, 10 lakh. This is the initial cash outflow. In this cash outflow also old machine salvage value after tax and the working capital, initial working capital will be considered. Net amount is 10 lakhs. This I will consider as 3 stages are there. Second stage, initial cash inflow you will compute. The working note separately you can put 3, 4, 5. Okay, these 5 years if there now, the initial cash inflow will be say 2 lakh, 5 lakh, 6 lakh, 3 lakh, 8 lakhs is their initial inflow. And the terminal value again separately you can write it as year 5. This is the normal cash flow from the project. Then at the end of the year, salvage value after tax, working capital recovery, that separately you can put it as 3 lakhs or something. This also same discounting rate you will apply for the 5th year. All the other thing here, first year discounting rate you will apply, second year discounting factors, third year discounting rate, fourth year discounting rate. Then discounted value, all this discounted cash flow you will add up and find out the total of discounted cash inflow. Then the first 10 lakhs you reduce, discounted cash inflow minus outflow will give you the NPV. Are you all understanding this? Okay, we will solve one or two questions. Then we will be thorough. Then we will move on to PI ratio. I don't want to discuss PI ratio without discussing questions on NPV. Are you all comfortable all the steps? Now we will apply the concept in few questions and see how to solve. See, take question number 6 for discussion. Illustration number 6. Parrot Limited is a manufacturer of low-end customer durable N. In order to modernize the manufacturer, Parrot Limited wants to buy a new machine costing 10 lakhs at cash price. The annual cash flow before tax over entire lifespan is 3 lakhs per annum. This is cash flow before tax. Sir, when cash flow before tax is given, what should we see? Cash flow before tax is given. Can I directly apply the tax rate here and then find out cash flow after tax? Sir, we need to find out CFAT, cash flow after tax. Can I just simply apply the tax rate to cash flow before tax and find out? No. Before tax rate, you should not apply on tax rate, even though this is before tax cash flow. But the tax rate, you should not apply on cash flow here. Are you all understanding? So first cash flow before tax, it really means that there is no depreciation adjustment has been made, which means so cash flow before tax, what it really means, really means sales revenue we saw minus, okay, you have cost of goods sold assume this is what they mean. Are you all understanding? After deducting expenses apart from depreciation, expenses excluding depreciation, cash expenses, assume that this is what they mean by cash flow before depreciation. So from here what you should do, adjust depreciation, you will get what? Okay, profit before EBIT, profit before interest or tax, or profit before tax. Thereafter you adjust the tax rate. If interest given you will apply the interest I told you. If not given, directly you apply the tax rate, you will get the PAT amount. From this PAT you should add back the depreciation to get the cash flow after tax. Are you all comfortable? We will see. The marginal rate of tax is 30%, cost of capital is 10%. Okay, to discount the always for computing NPV, the NP project cash flow should be discounted using WACC, weighted average cost of capital. Anyway, the scrap value at the end of the useful life of the machinery is negligible, which means nil. Scrap value will be nil. The company is currently, which means the entire amount is depreciable amount. Okay, so total 10 lakhs is depreciation on a straight line basis over a period of 5 years. What is the life of the project? Life of the, and what is the life? 5 years, I think, a executive wants to buy a new machine costing at cash flow, annual cash flow after tax life of the span of the company is marginal tax. Okay, here, see, here they have not given what is the life of the machine, and a straight line machine, straight line basis, you are depreciating now. They have given anything. See, this question has mentioned, they have to mention 5 years. They have taken the solution, they have taken as 5 years and they have solved. Are you all understanding? Comfortable? And we will also, they should have given that 5 years, they should have given. Data missing. Anyway, there are many questions which has these kind of ambiguities and mistakes. Okay. Anyway, this is one of those questions. Then they are not clear with that. Okay, they are saying over the life, but what is the life? They have not mentioned. Entire lifespan they are mentioning, but we need to anyway think of it. Okay, they should have given. So 5 years they have considered while computing. They have taken 5 years, but question not mentioned. No issue. Okay, cash flow before tax is given. What I told you, this is cash flow before tax. Now directly you cannot apply tax. You need to convert the data. Okay, you need to convert into taxable profits. What you should do? Reduce the depreciation. So 3 lakh, 3 lakh, 3 lakh. Linearly will be 3 lakh. They have told you every year. This is inflow only. Outflow, anyway, given in the question, the 10 lakhs, that we will consider later. Are you all understanding? This is the outflow. This is cash flow before tax. Convert every year, depreciation you are charged. Divided by 5, they have done. Anyway, without giving the years, they have done. Anyway, with divided by 5, assume number of years is 5 years. Okay, I hope question answer will not be like that. Real exam question will give you entire data. Study matter, there are so many mistakes. Anyway, 2 lakhs, 2 lakhs, 2 lakhs, straight line method, depreciation. Taxable profit is 1 lakh. Thereafter, tax reduced to 30%. See, also, see the blunder. It should have 40%. Okay, I think 40% they have taken the amount they have taken. So change the tax rate also to 40%. How big a blunder is, I don't know. Which means tax rate is 30%. Given the question, what they given question, initially they gave the tax rate of 30%, but they solved using 40%. I don't want to convert every data and try again. Just change the question to 40% tax rate. CFAT is what? See, 1 lakh minus what they have done now, taxable profit minus tax, 40,000. So 1 lakh minus 40,000, 60,000 plus depreciation, 2 lakhs. So 2 lakhs, 60,000. Are you all understanding how they have done? Okay, you arrive at the after tax number, the moped, thereafter add back the taxable profit. Are interest given in the question or not given? Nothing given in the question. Data is not sufficient. So we'll ignore the interest, exclude the interest. Are you all comfortable? So 2 lakhs, 60,000. Discount, first year discounting rate 0.9001, 1 divided by 1.1, 10% is the discounting rate. You will get value 2,36,340. Like that, every year discounted cash inflow you will get, and the total of these inflow is 9,85,400. If you see, in this question, incidentally, the cash flow after tax for all these years, 5 years is same. Therefore, you can apply directly the present value annuity factor also to get that total present value. How much is that? 985,400 minus the 10 lakh initial investment. This is nothing but disco, discounted cash outflow. Disky minus disco. Disco is this much, 10 lakhs. If you reduce it, you will get 14,600 as a negative NPV. Are you all understanding? So this project is not viable. And the second part they have asked, what they have asked in the second part of the question, if you carefully observe, they have asked that, okay, the company has an alternative to charge the accelerated depreciation of 30%. Accelerated depreciation at 30%. Initially, they charged 30, which means first option, they charged depreciation at the same rate of 20, 20, 20, 20, 20. 5 years given, not 20, 20, 20. Second option, what they are saying, charge 30%, 30%, 30% for 3 years. Depreciable amount for the first 3 years, then 10% in the 4th year, then balance last year, nothing will be depreciable, nothing is to be taken. Are you all understanding? Last year, no depreciation will be there. Entire amount will be exhausted. Okay, in the 4th year itself. Okay, does it change your suggestion? We will see. Accelerated depreciation. Now, what is the impact on the NPV? Will be if you change the depreciation method, what is the impact of the NPV is what is the question. So 3 lakh, 3 lakh, everything will be same. This column there will be change, which means 1 lakh into that is 10 lakh into 30%, 30%, 30%. For 3 years, 3 lakh is depreciated. 4th year, 1 lakh is depreciated. 5th year, nothing is to be depreciated because 3 will be 9 plus 1, 10 lakhs. Everything depreciable amount is depreciated. Nothing is to be depreciated. Next. Profit. So 3 lakh, 3 lakh minus 0, 0, 0, no profit for first 3 years. Then you have 3 lakh minus 1 lakh, 2 lakh, okay, and 3 lakh. Thereafter, what you should do? You should reduce the tax amount. Here you will not have any tax amount. Here you will have tax amount. Then add back the depreciation effect. Okay, you will get the after tax cash flow after tax of 10 lakhs, 7,840 minus 10 lakhs. Okay, 7,840. NPV becomes positive and project becomes suddenly viable. Why this happened? Accelerated depreciation. Okay, additional depreciation charge will enable to improve the project cash flow. Are you understanding? This is all about this question. Illustration number 13, we will do after studying all the balance concept. Okay, balance concept in the sense we will discuss payback period, already we discussed. Anyway, payback period and NPV already discussed. Correct? Now we will discuss the internal rate of return on original method, rate of return on average investment method. These four we already discounted. Okay, discounted cash flow method taking cost of capital as 10%. Sorry, this is called a, see, one more thing. Discounted cash flow method, they have told us. This is nothing but NPV. Sir, what is the net present value index method? This is not net present value. This PI index, PI ratio. This is PI we are going to study. So this we have not studied, this we have not studied, and this we have not studied. So these four things we have already done. So what I will do, NPV we will study. We have already done. So IRR, then you have PI ratio. These two things we will study and then solve the question. And I told you now, modified internal rate of return. Briefly, I'll explain and solve this question and we will proceed. Are you all understanding? Now take the next concept, that is PI ratio. See, PI ratio is nothing but discounted cash inflow divided by discounted cash outflow. What is the formula? There, it was DISCI minus DISCO. NPV what? DISCI minus DISCO. PI ratio is what? DISCI divided by DISCO. Are you all understanding, sir? Why this we are doing? Very simple. For every 1 rupee of your outflow, what is the rupee inflow is what is calculated by PI ratio. This shows how much is the company earns as inflow for every 1 rupee outflow. Okay. So, for example, if you got PI ratio is 1.25. Okay, which means numerator is more than this much percentage, 25%. This is what is the understanding, because DISCI divided by DISCO na. So discounted cash inflow is more. If the decision making use PI na, if PI is more than 1, accept the project. If PA is less than 1, reject the project, because, okay, you are incurring more cost than you are benefiting. So you reject the project. Very important for capital rationing calculation. This PA ratio, where it is used, na, capital rationing, I am going to discuss in the upcoming concept. There it will be very useful. Project you should rank based on PA ratio, not NPV. This is why PA ratio. PA ratio is useful where you have limited funds, you have limited capital, number of projects are available, but which project you should select? You have only limited capital, only 100 crore you have, but there are so many projects available in the market. Which project you can undertake? Now, first rank the project based on PA ratio. Based on PA ratio only, you should select the project and not based on just a NPV. Are you understanding this? We are going to later learn. Now we are going to learn internal rate of return. Next is internal rate of return. What is this internal rate of return? Very simple. The rate at which DISCI will be equal to DISCO. DISCI will be equal to DISCO. Discounted cash inflow will be equal to discounted cash outflow. It's called as internal rate of return. Okay, IRR is the rate at which discounted cash inflow will be discounted cash outflow. Sir, first, I don't know what is the IRR. I don't know what is the discounting rate to be used. Then how can I compute the discounted cash inflow and outflow? Very simple. You have to use trial and error method. No other option for multiple and even cash flow. See, for single cash flow, I'll tell you how to find out. We already know that for single cash flow, this IRR is nothing but the R. R means you have already studied the compound interest formula. Na? I told you maturity value or future value is equal to present value, principal into 1 plus R raised to the power n. This R is equal to nothing but future value divided by present value. If you take the nth root of the future value divided by present value. This is nothing. See here, maturity value is equal to present value 1 plus R raised to the power n. So, okay, 1 plus R raised to the power n is equal to maturity value divided by present value or future value divided by present value. This n, if you transfer that side, power na, you transfer that side, it will become square. So, n, a square root, nth root of maturity value divided by PV. 1 plus R is equal to nth root of MB divided by PV. Therefore, R is equal to nth root of MB by PV minus 1. Are you understanding? This will be applicable only for single cash flow. It is nothing but already I discussed in the CAGR introduction. How to compute CAGR R na? The same thing here also applicable. Are you understanding? Internal rate of return. Fine. But for multiple and even cash flow, how to? I cannot apply the formula. You have to manually solve. But for multiple and even cash flow, IRR can be found out only by interpolation technique. Very simple. You have discounted cash inflow na? You have discounted cash outflow. What do you do? First, see, this is your DISCO. Discounted cash outflow comes to 10 lakhs. Okay. Year cash flow, discounted cash inflow, year 1, 2, 3 comes to some 3 lakhs, 6 lakhs, 9 lakhs. if you total it 3 plus 9, 9 plus 18, right? But you discount the cash flow. Next is present value factor, then discount it for 3 years, you will get some value. Assume this is also discounted cash outflow. This is a discounted cash inflow. Assume it is already discounted. Now, first discount using some rate 10%. Then discount using 12%. In your question, which asks you IRR, they will give you two rates. Do the interpolation, find out the value. Are you all understanding how to do interpolation? We are going to see the question. At that time, I will explain. Very simple. Okay, how much it is increasing, NPV will increase. And one more thing, I need to clarify that NPV is what? DISCI minus DISCO. Agreed? IRR is what? Rate at which DISCI equals to DISCO. Are you all understanding? If DISCI equals to DISCO, assume DISCI is 40, DISCO also 40. What will be the NPV? 0. Are you all understanding? When DISCI equals to DISCO, NPV at that rate will be 0. To summarize, okay, at IRR, okay, which means you have found out the IRR. Are you all understanding? At IRR, NPV of the project will be 0. Are you all understanding? Because you need to understand this. That is why I'm telling you. There's an interrelation between NPV and IRR. Okay, shall we move on to solve a few questions and then come back to EAB and DSE? This is regarding NPV IRR conflict, separate concept. So we'll do some questions, then we will get back to this area. Okay, shall we? See, take illustration number 13. A limited company is considering investing a project requiring capital outlay of 2 lakhs. Forecast for annual income after depreciation but before taxes as follows. Here 1 to 5. This number. See, in the previous question, we saw that one of the question we saw that cash flow before tax was given, which means tax effect is not considered. Hence, okay, they have not clearly given. So, which means you should consider depreciation. Thereafter, you will get the get the profit before tax. Then compute the tax effect. Then add back the depreciation. This is what we did in the previous question. Okay, they can twist and turn with the wordings. You have to be very careful. In this question, what they are saying. They are clearly saying that this is annual income after depreciation, which means profit after considering the depreciation effect. Are you all understanding? Which means you can consider directly the tax effect. This is nothing but EBT. Then you can apply the tax effect. Then you will get PAT, add back depreciation. Why interest is not given? So we'll assume it to be PAT and add back interest. If interest detail not given, now what can you do? If detail given, now you will add back interest plus 1 minus t and then add back depreciation. Anyway, here PAT plus depreciation should give you cash flow after tax. Now, depreciation, see here, one thing is there. Why they have given depreciation, sir? First, they don't need to compute depreciation. They have taken after depreciation. Why you need to compute depreciation? To add back. Are you all understanding? What is the amount to be added back? Depreciation will be added back. That is why they have given that 20% of original cost. Original cost comes to how much? 2 lakhs, not 20% of it. What is that? 40,000 is the depreciation amount. What is the amount? 50,000 they have taken. What is the depreciation? 90,000 is there. And yes, 40,000 is the amount. Yes, 2 lakhs into 20%. That is what they have taken. I just verifying what they have done. 40,000 they have added correctly. No issue. Okay. Because I have to verify the solution also correct or not. Many of the solutions are wrong now. So I have taken, see, depreciation maybe 20% on the original cost and taxation 50% on net income given. You are required, the net income means PAT. Okay, this is PAT, which means on the net income before PAT. Okay, profit after tax. You should consider, but net income before tax only you will apply the 50% tax rate. Now, you are required to evaluate the project according to each of the following methods: payback period method, rate of. Okay, now one by one we will see. First, payback method. Here they have used this and comprehensively they have prepared the table. Why they have prepared table? Each and every column I will explain. See, profit before tax for 5 years you need. Of course, this is required. From here only is the starting point. 1 lakh, 80,000, 80,000 and 40,000. Thereafter, profit after tax, directly you can apply the tax rate. Yes, why? Before depreciation already considered, directly this is EBT, you consider the product. You will get the PAT. Now, if you reduce this, how much you should get? 50,000 you should get. No space, that's why they have not shown, but 50,000. They have added this cumulative inflows after tax, PAT plus depreciation. This is the PAT 50,000 plus depreciation common 40,000. Are you all understanding? So 50, 50, 40 plus 40, 80, 40 plus 40, 80, 20 plus 40, 60,000. Are you all understanding? Next, cumulative cash inflows are similar. 90,000, 1 lakh. Why this is required na? For computing payback period, you require cumulative cash flow, which means first year end, these are all the inflows na. So first year end I recover 90,000, second year end I recover 90 plus 90, 1,80,000. What is my capital? How much is the total capital? 2 lakhs. Am I recovering the entire capital by first year? No. Second year? No. Third year? Yes. Which means at the end of second year, I recover 1,80,000. At the end of third year, I over recover 2,60,000. So my recovery period is something in between these 2 years. Between 2 and 3 years, I need to do interpolation. I told you now how to do interpolation. I will explain you here. See how to do interpolation. Very simple. See, for 2 years, how much you are recovering? By the end of 2 years, 1,80,000 you are recovering. By the end of cumulative 3 years, how much you are recovering? 2,60,000 you are recovering. Which means third year alone, how much you are recovering? The difference between this and this, 80,000 you are recovering in the third year. Agreed or not agreed? Agreed. Now see, third year you are recovering. 2 years is anyway there. Plus how many months or decimal terms you need to add, right? 2.5 years or 2.4 years we need to find out. 2 years will be there. Anyway, 1,80,000 will be recovered. Now, what is the recovery of third year? Which means if you increase the period by 1 year, if you increase it by 1 year, how much? So from 2 to 3, if you increase the time period by 1 year, how much you are recovering? Okay, how much you are recovering? 80,000 you are recovering. But you require 80,000 recovery. Yeah, only 20,000 or only 20,000. Your target is what? See, 2 lakh is your target. Why? 2 lakh is the initial cash outlay. This 2 lakh initial cash outflow is recovered already. 1,80,000 recovered at the end of second year. Which means for third year, how much I need to recover actually? Balance in a 20,000. So 20,000 I require to recover. But one full year recovers me 80,000. But I don't require 80,000. I only require 20,000 to recover. Are you understanding? So I require 20,000. I 20,000 divided by 80,000 into 1. Because 1 year. How much is this value? 25%. 20 divided by 80. 25%. Which means, okay, 2.25 years I will calculate. This is what they have computed. 2.25. 25% now? 0.25. This is not 25% means 0.25 is required. So 0.25 means 2.25. 2 plus 0.25. Are you all understanding? 2 years, 3 months. This 0.25 into 12 if you put, you can put it in months or simply write 2.25. Are you comfortable? Next, rate of return on original investment method. Okay, here also if you see average profit after tax will be considered original investment method. Now, investment simply you will consider 2 lakhs. So 40,000 average profit. How this 40,000 you got now? Average profit is that total profit comes to how much? Total profit comes to how much? Yes, this you should consider. Are you all understanding? Average profit after tax. That number you should not consider because that is profit before tax number. Okay, after tax number is that 50, 1 lakh, 1,80,000, 22 lakhs. So this total comes to 2 lakhs. This total is 2 lakhs na. So 2 lakh divided by 5 comes to 40,000. So average profit is 40,000 divided by 2 lakhs. Original investment 20%. Now, if you take average investment method na, average profit after tax, denominator also average investment you should take. Here average investment na, simple average. I told you na, where salvage value is also not given. Basically salvage value will be 0. Where salvage value is not given, which means or it is 0. Here fully depreciate. Now assume, so what happens? 2 lakh will be the amount plus salvage value nil divided by 2. What is the amount? Plus salvage value is equal to nil. So 2 lakh divided by 2 is nothing but 1 lakh. Okay, so 40,000 divided by 1 lakh is 40%. Are you all comfortable? Next, discounted cash flow method. Now NPV method. Present value of all the tax inflows. Here I have given 3,08,000. Already we computed. What is the present value of tax inflow? Present value is given as 3,08,000. This is the present value of tax inflow. Are you all understanding? These column are given for IRR. Okay, this is up to this only I discussed. I will come back later and discuss. Okay, this is 3,08,193. So present value of inflow is DISCI is how much? 3,08,193 minus outflow. You will get net present value. Next, profitability index. Okay, profitability index, present value of cash inflows divided by outflow. 3,08,193 divided by 2 lakh, you get 1.54. Last comes then, okay. Since PA is more than 1, the company can accept the project. Okay, if NPV is positive, we'll accept the project. Accept reject decision based on NPV and IRR is nothing but. If NPV is positive, we'll accept the project. If the PA ratio is more than 1, you will accept the project. Come to internal rate of return. Now, internal rate of return only, here only, okay, they have used, see the question they have given anything about the percentage? No. See, they have not given anything, any clue. So solution, the institute knows the solution. That's why what they have taken. Now they have taken 20% and discount the bond cash flow, discount the project cash flows. 30% they have again discounted. So this is 20% and this is 30% and this is 32%. Like this, they have computed three different methods. Now, what is your, see, very simple. Discounting rate and value will be inversely proportional. See, for example, if you discount the cash flows, you will get 2,46,487. But you need 2,46,000. This is your discounted cash inflow. Outflow is what? Discounted cash inflow will be matched to, should be equal to 2 lakhs, not 2,46,000. So you need to reduce the value. To reduce the value, what do you need to do? You need to increase the discounting rate. That's why they have taken 30%, substantial increase. If you take 30%, it comes to 2,03,063. Still, it is not able to match the 3 lakhs. Agreed. Therefore, they have taken, even increased value 32%. Even taken 32%. This 32% value comes to 1,95,941. Now do interpolation, exactly match. At 30%, this is the rate. At 32%, this is the rate. Do interpolation. How to do interpolation? One question I will solve. See, same method only. Here I will do the interpolation. What happens? See, if you increase it by 2%, how much is the value reducing? Actually, it is inversely proportional. How much it is reducing? What is the difference between these two numbers from 2,03,063 minus 1,95,941? What is the differential amount? 7,122. If you increase the discounting rate by 2%, value reduces to 7,122. But I want how much reduction from current value? See, my current value is 2 at 30%. My current value is how much? 2,03,063. I want it to make it to what? The discounted cash outflow, which is equal to 2 lakh. So 2,03,063 minus 2 lakh is how much? 2,063. 3,000? Yes, 3,063. Are you all comfortable? So 3,063 only I need. Okay, this I will do. So what is the value? 3,063 divided by 7,122 into 2%, because for every 2% is the change. So for every 2% into 2 you should do. What is the rate? 3,063 divided by 7,122 into 2.86, which means 0.86. You should not increase the number by 2%. You should increase the number only by 0.86, which effectively means already you had 30%. Increase not by 2%, but only 0.86%. What is the value? 30.86%. Are you all understanding? That is how they have got a 30.86 in the L, P1, P2, all this thing. No confusion. Like this, if you prepare, you will logically understand how to do it. Are you all comfortable with the interpolation? I assume. Okay, next, modified rate of return. See, modified in my IRR, MNPV and MIR. A profound concept. I don't want to discuss deep concepts and all. I will discuss briefly. See what I am saying. IRR and NPV will undergo a conflict. Okay. In mutually exclusive projects, sometimes what happens? NPV selects one project. Sometimes NPV selects another project. In that case, NPV IRR conflict will be there. I am going to discuss in the upcoming concept. But what happens is that why the conflict arises? Because of the reinvestment rate assumption. One of the reasons is that the reinvestment rate assumption of IRR and NPV. NPV assumes that, see, every year project is run for 5 years. Project is run for 5 years. For example, in the current example, if you see the cash flow, take this cash flow column, 90,000, 90,000, 80,000, 80,000, 60,000 you are receiving for 5 years now. This cash flow, you will put it in pocket, you will reinvest in the bank, you can reinvest in the bank. Are you all understanding what I am trying to say? So for 5 years the project is being run, but every year you receive some cash flow, you will assume that you go to the bank and reinvest the project. This is called as concept of reinvesting. Are you all comfortable? Now what I say, NPV and IRR, both two techniques are there. NPV assumes that the cash flows, the intermediate cash flows will be reinvested at cost of capital. IRR will assume that the intermediate cash flow will be reinvested at same rate of IRR. This is why conflict arises. How to settle the conflict? You should settle for a common rate. NPV, cost of capital, is too low a rate, but practical. Okay, sometimes it may be practical because bank will ready-made offer you cost of capital, minimum rate of return. When MIRR is asked and reinvestment rate is not given, you will assume that reinvestment rate is cost of capital. Reinvestment rate is cost of capital. Detailedly explained in the regular lecture. I don't want to Okay, this is a big discussion. I don't want to make it here. Now, IRR assumes the cash flows to be reinvested at IRR, but it is too practicable rate. Can you see, now you got a project for 5 years. At the end of year, you receive some cash flow. Can you keep on finding the new projects which can give you same IRR at 25% IRR? Which bank will offer you IRR of 25%? Banks will never offer normally. Deposits will never give you 25%. You have to find out a new business avenue, business opportunity whereby it can grow by 25%. It's rare. Okay, it will not happen every now and then, right? So what we will fairly assume that if question gives you reinvestment rate, take that reinvestment rate. If question doesn't gives you any reinvestment rate, now take cost of capital as reinvestment rate. In this question, no reinvestment rate is mentioned, hence they have taken cost of capital. So what we will do, every year cash flow after tax is there, 90, 90, 80, 80, 60. Now you should reinvest. This is at the end of first year you are receiving 90,000. Reinvest for balance 4 years. How many years pending? 4 years pending. So what you do? Compound this 90,000, 1.1 raised to the power 4. Future value factor 1 plus r raised to the power n. N, you should take it as 5 or 4. Why? At the end of year 1, you are receiving 90,000. Balance, how many years you can invest? Yeah, project life is 5 years. At the end of year, you need cash flow. What is the amount? What is the number of years? 4 years. Second year, you are receiving 90,000. How many years more pending? 3 years. You can reinvest only for 3 years. Put the bank for, okay, you can deposit the amount in the bank for 3 years. Next year, you will deposit the bank for only 2 years. 80,000 deposit the bank. At the end of 5th year, if you go 60,000 deposit, now the bank will slap you, give you the same 60,000 rupees. No future value. Are you understanding? This will add. So this future value, you will add cumulatively and find out the total future value at the end of 5th year. Are you understanding? If you undertake the project, really speaking, 90 plus 90 plus 80 plus 60 plus 60 is not your real cash flow, but the reinvestment you will make and the total cash flow will be 4,96,359. Okay, this if you discount at what rate this becomes 4,96,359. This 20% annuity table, no need for annuity table and all. Apply the compound interest formula. Present value is equal to future value is equal to present value 1 plus r raised to the power n. This is future value. Are you all understanding? Present value also, you know what is the present value. See, this is the future value. What is the present value? 2 lakh is the future present value. Yeah, 2 lakh only you deposit initially, cash. Okay, how much you put in? 2 lakhs. By using those 2 lakhs only, you keep on compounding and got 4,96,359. Are you all understanding? So 496,359 divided by 2 lakhs, 5 years project. Okay, divided by 5th root of this minus 1. If you do, you will get 20%. I have already told you how to use the calculator and find out the nth root of any number. Okay, I don't want to again and again discuss this. If you do, you will get the 20%. Or like they say, 4,96,000 divided by this 2.48 you will get, and this future value table if you see, you will get the annuity table if you see, you will get the 20%. Are you all comfortable? Okay, anyway, this is how you should do the question. Next, question number 17 is regarding NPV. We will briefly discuss and then we will move on to the next concept of EAB and ESC. Question number 17. Now, a plastic manufacturer has under consideration the proposal of production of high quality plastic glasses. The necessary equipment. See, one point I missed to discuss. This question or yes, no issue. Okay, that question I have discussed for me. Now, the glasses, the necessary, see what a plastic manufacturer is under consideration, the proposal, okay, high quality plastic glasses, the necessary equipment to manufacture glasses is called cost 1 lakh and would last 5 years. The tax relevant rate of depreciation is 20%. On written down value, depreciation will be charged on WDV this time a change. That's why I'm doing this question. There is no other asset in the block asset concept. I'll explain. The expected salvage value is 10,000. The glasses can be sold at 5 each. This is about inflow. Now you bought the equipment. Thereafter you are generating the glasses you are producing now. What is the revenue from the other? Okay. Regardless of the level of production, the manufacturer will incur cash cost of 25,000 each year if production is undertaken. The overhead cost allocated to the new line would be 5,000. Allocated, which means it's not actually incurred for this. Allocated, you will ignore. This is what I wanted to discuss. Very, very important adjustment. This is not a relevant cost. This is not the incremental cash flow. Hence, we will incur. This is not specifically incurred. Already incurred the overall overhead. That overhead cost is being put compulsorily in the current production head. Are you all understanding what I'm trying to say? So this is not actually incurred by the current line, so production line. So I will ignore it. The variable costs are estimated at 2 per class. The manufacturer estimates it will sell about 75,000 glasses per year. Tax rate is 35%. Should the proposed equipment to purchased assume 20% cost of capital, discounting for finding NPV is 20%, cost of additional working capital 20,000. First step, what I told you, 3 stages. Initial cash outlay. Here, initial cash outlay, any installation charges and other incidents not given. Cost of equipment, yes, 1 lakh. Consider it, this is the cost of it. Apart from that, working capital recovery, working capital adjustment you need to make. I told you, initially what you will do, add the working capital to the capital outlay, which means 1 lakh plus 50,000. 1 lakh will be the total initial cash outlay. Are you all comfortable? First step. Next, annual cash inflow you need to find out. For that, first, sales. Okay, I showed you the income statement now. So sales here, revenue, 75,000 into 4, 3 lakh, 3 lakh, 3 lakh for same year. Cost, variable cost first reduce. Variable cost na number of units. Okay, per unit cost, number of units will be changing in tandem with sale. So 75,000 into 2. So 1 lakh 50, 1 lakh 50 will be same. Additional 50 fixed cost 25,000. I told you it will be incurred, but the 5,000 will never be considered. Okay, allocated overheads will not be considered. Thereafter, you consider the depreciation. Depreciation non-cash item. You will reduce the depreciation. Depreciation, how to compute? Very simple. WDV method. See. WDV method 20%. Yes, 20%. So 1 lakh 20%. 1 lakh will be there into 80%. Closing WDV 80,000, right? So balance will be 80,000 into 20%. What is that? 16,000 next year. Now 80,000 is 64,000. 80,000 minus 64,000. Okay, into 20%. 64 into 20%. 12,800. Like this, you will compute. Here, everything would have been depreciated. Last year nil. Yes, there is a concept here. Why there is no depreciation for the last year? You may have a doubt. The point is very important. I will just explain. See, block of assets concept you would have studied in income tax. I don't want to elaborate there. I'll just briefly explain. Block of assets when all block of assets question is asked as per the Income Tax Act, depreciation will be charged on block to block basis. Okay, plant and machinery where the same nature of the asset and the tax rate should also be same. You will classify it as separate block. Okay, block concept is there. Here assume, say for example, all assets in the block is sold and block is empty, which means this is the last asset. If you sell this asset, entire block will become empty. This is one scenario. This is one situation. Situation number 2, block will not be empty even after selling this asset, which means block will be alive. Okay, block will be alive or block will be empty, I should say. Like this, you can classify. If block is empty, there is no asset to charge depreciation. You will never charge depreciation for that year. 5th year, you are selling the asset itself. What you will charge depreciation on what basis? You are selling the asset itself. Block itself is gone. What is to be charged? If block is alive, then you should take appropriate depreciation. You will consider and consider the depreciation effect. Here, entire asset, okay, the amount is the asset is sold, so no asset is left in the block, so depreciation will not be charged in the end of the year. This is what they've given also in the notes. As the block consists of single asset, no depreciation is to be charged in the terminal year, as the asset is also asset is already sold in this year. Now you have, yes, this amount earnings before taxation. Yes, this amount earnings before taxation you will get. Reduce the tax effect, earnings after tax you are getting. Add back the depreciation. Add back the depreciation. Where is the 68? See, they have not shown separately, but I am telling you 68,250. How they got 88,250? Add back the 20,000. Are you all understanding? So initially 16,000. 16,000 plus 78,550, 86,850, 72,930 plus 12,800, you will get 85,730. Are you all understanding? So PAT plus depreciation, no interest given, simply add back to arrive at the cash flow after tax. Are you all getting this cash flow after tax? Now, this is every year cash flow after tax. Apart from that, you have working capital recovery, but this is only applicable for the 5th year. That is why they have given in the last year. Are you all understanding? This is year 1, 2, this is years 5, year not 1, 2, 3 number. Okay, 3, 4, 5. 5th year, These are all the transactions it will happen. The 81,250 will be the 5th year cash flow. Apart from that, working capital of recovery of the working capital to the extent of 50,000 will be there. Apart from that, salvage value after tax you need to compute. What is the salvage value after tax? Very simple. Salvage value is 10 lakhs and tax benefit on short-term capital 10,836. I'll just show you. What is salvage value? Salvage value is 10 lakhs, 10,000. Minus, you have to see if there is capital tax payable, now you should reduce. Correct? Tax receivable or tax inflow, na, which means very simple. Yeah, you have loss on capital asset. Then here you tell me what is the WDV of the asset. See, you have charged depreciation for the 4-year. First, for considering the tax effect, you need to consider the WDV, closing WDV, compare with the sale value, then find out whether it is loss on tax on loss or tax on profit on. Are you all understanding? Now, what is the 4 years WDV 20% you are charged? So, what will be my balancing value? Now, very simple. How should we find out? Now, 1 lakh is the value. 1 lakh into 80%, 20% WDV into 80%, into 80%, into 80%. Like this 4 times you can do and find out the closing WDV. Are you understanding? Into 0.8, into 0.8, into 0.8, into 0.8. How much is that? 40,960 is the closing WDV. 40,960 is the closing WDV. So 40,960 worth asset you are selling for only 10,000. Are you understanding? So minus 10,000. What is the amount? 30,960. So this is 30,960. You are incurring loss. This is loss. So tax benefit will be there. Into what is the tax rate? 35%. Yes, 35% tax rate given as 35% or 30%. Just to confirm here. What is the tax rate given in the question? 35%. So 35%, 3950 into 35%. How much is that? 10,836. That's what they have given here. 10,836. Can you see this 10,836 here? This is what they have given. This 10,836 is a tax effect. So effectively salvage value is 10,000 plus 10,836. How much is the salvage? Why I added it? Because tax loss, tax benefit you will have. So 20,836. Are you all comfortable what I'm trying to do? Okay, 20,836. Effectively, this they have added 10,000 separately, 10,836. Effectively, salvage value after tax 10,000 plus 10,836, 20,836. So 50,000 here, 20,836 here. Total last year cash flow comes to how much? 81,250 plus 50,000 plus 20,836, 1,52,086. Now you have respective years cash flow. What is that? 88,250, 86,850, 85,730, 84,834 plus 1,52,836. This is not discounted yet. Discounted using respective years present value cash flow. You will get the total present value of cash inflow as 2,85,000 minus 1,50,000 initial. You will include the working capital also. What is the NPV? 1,35,453. Are you all comfortable? Comprehensive question I solved. Okay, you can go through and practice. Okay, only if you practice you will get the total grip. But anyway, this is what is to be understood. Shall I proceed to the next concept? Okay, that is EAB or EAC. Concept of EAB or EAC. Now, I'll just rub this off. See what happens. Now we are going to discuss the NPV IRR conflict. Generally, what happens if NPV is positive? If NPV is positive, okay, or discounted cash inflow is more than discounted cash outflow, generally, okay, IRR will be more than cost of capital. Generally, IRR will be more than cost of capital. Okay, generally NPV and IRR will ask us to select the same project. But sometimes what happens in case of mutually exclusive projects, see, if NPV is positive, now select the project. IRR is more than cost of capital, now accept the project. Sometimes what happens, okay, mutually exclusive project will be there. If A is undertaken, project 1 is undertaken, you cannot take project B. Okay, like that, it will be mutually exclusive. Are you all understanding? Now, if you want to get into employment, okay, you cannot do practice. Either one of these two only you can do, right? For CS I'm saying. So what happened? If this is the case, sometimes what happens, there may exist NPV IRR conflict. What is the reason for conflict? The reason may be due to life of the project or maybe the timing of the receipt of the cash flows. Are you all understanding? Now, I'm not going to discuss the timing disparity here. MNPV, MIRR, the reinvestment rate assumption, I have discussed briefly there. That is sufficient. I'm not going to discuss this timing disparity here. Predominantly, I'm going to focus on the life disparity issue. Are you all understanding? So the reason, okay, maybe due to the life of the project. For example, I'll just give you the example here. Assume there are two projects A and project A and project B. Year 0, year today you invest 50 lakhs in this project, here 50 lakhs in this project. Okay, both outflow is same for both project A and B. At the end of year 1, project A, from project A you will receive 30 lakhs and project B you will receive 90 lakhs. At the end of year 2, you will receive 90 lakhs from project A and nil from project B. Are you understanding? If I calculate the NPV, believe me, I have given the numbers, calculated the numbers, you don't have to worry, you just believe me. The number comes to 51.65 in case of project A, NPV comes to 51.65. Assume the project cost 10% cost of capital and okay, it comes to 15.65 and this here NPV of B comes to 31.82. Which project you will select based on NPV? This 51.65 only you will select based on NPV. Come to IRR. IRR, which project you will select? Now, this project is having low IRR, this project is having high IRR. What is the number and all? You don't need to worry. Okay, I've calculated and given this will be high IRR. Believe me. Are you all understanding? So, NPV selects this project, IRR selects this project. What should I do now? Very simple. First, understand the reason for the conflict. Why this is NPV selects project A and why IRR selects project B? Very simple. NPV sees the quantum of the cash flows. NPV sees the total quantum of the cash flows, which means 30 plus 90. Here total inflows is 120 lakhs. Agreed? Come to project B. Project B inflow is only 90 lakhs. Hence, NPV will be lower. Hence, NPV selects project A. Are you understanding? IRR sees the rate of return earned by the project and not the quantum, actual quantum of the amount. Are you all understanding? By investing 50 rupees, I earn 90 rupees in one shot, and the next year there is no amount, but still I earn in one single year, I'm able to recover this much of amount. Are you all understanding? This is what IRR sees. That's why IRR selects this project. Are you all understanding what is happening? Now, here in this example, there is a issue with regards to NPV and IRR because of mainly the life of the project. Because you cannot compare these two projects as such, because project A is having 2 years life, project B is having 1 year life. Are you all understanding? So comparing a two projects which is having a different life cannot be compared. So here issue is the life disparity. So what you should do now? You should bring in a parity. What you should do? This is having 2 years life and this is having 1 year life now. This 2-year project, annualize it and convert it to annualized return. Then you will compare and find out the EAB or EAC, annualized NPV. This I call it as MNPV. Are you all understanding? Modified NPV. You should find out the annualized NPV and then compare and find out. This I call it as EAB or EAC technique. Are you all comfortable? Now, I've given the how to compute and all. I'll tell you. NPV selects project A while IRR selects project B. Conflict arises due to life of the projects here. Project A is having a life of 2 years and project B is having a life of 1 year. Projects NPV should be annualized and then compare for decision making. For example, A and B, two different projects are there. This is having 7-year life. This is having a 5-year life. What you should do? You should this convert it to annualized 1 year. This you should convert into annualized 1 year and then compare and select the project whichever is having highest NPV or whatever is the benefit, equated annual benefit. So EAB or EAC. Now, why is this EAB, EAC both are same? Very simple. Benefit if you are compared. Very simple. The question, if it is predominantly cost oriented question. If question is predominantly outflow oriented question, you will choose EAC method. EAC, equated annual cost. Net cost will be there, so you will have net outflow. EAB, net benefit will be there, it will be net inflow. Are you all understanding? So that we have to understand. Now, what is the formula for this? Summation of discounted cash inflow. If it is benefit oriented question, discounted cash inflow, because ultimately it will be discounted cash inflow. Now some outflow will be there, but that can be adjusted. Net inflow will be there. Summation of net inflow divided by annuity factor. Present value annuity factor. You already know how to compute. Now, if 10% for 3 years, now what you should do in the calculator? 1 divided by 1.1 is equal to plus 3 times GT. You will get the annuity factor. Mostly given in the question itself. Take it as such and calculate. Are you all understanding? If you divide, not multiply. You should divide it by annuity factor. then only you will get the annualized number. Are you all understanding? Annualized NPV or outflow. If it is question is predominantly outflow oriented question, you will take the cost equator and how to select the project. If you are going from if your question is predominantly cost oriented, then you will select that project whichever is having a least cost outflow. Are you all understanding? Least outflow. And if it is benefit oriented question, you will select that option whichever gives you highest benefit. Are you all comfortable? See here. If question is inflow oriented, select project having highest EAV. If question is outflow dominated, select the project having least EAC. Are you all understanding? Now we will do 1 or 2 questions regarding this. One question regarding illustration 21. Okay, this question will comprehensively cover the EAB or EAC. Apart from that, also we have so many MCQs regarding EAB and EAC. You can easily solve. Now, see, this is generally used in your replacement decision, machine replacement decision, and other questions. Very famous. Okay, see here, a company has to replace one of its machine. Again, replacement decision. Now it is placed, which has become unserviceable, which means the company compulsorily has to replace one of its machine. 2 options are available to replace the machine. One is that a more expensive machine with 12-year life I can replace with a more expensive machine. Expensive machine with 12 years life. The expensive machine will cost you more initially. That's why it is expensive. But later on, you don't need to incur a lot of expenses again and again. That is what is the use of expensive machine. Less expensive machine, you have to again replace it with 6 more years. It has only life of 6 years. You have to replace it. Are you all comfortable what I'm trying to say? Now, if LM is chosen, it will be replaced at the end of 6 years by another LM. So, if less expensive machine is chosen, 2 times you have to replace. One after the 6 years, which means effectively now you will replace. Then after 6 years you will replace. Are you understanding? More expensive machine, you don't need to replace for a period of 12 years, which means, life is 12 years. Now, I won't say it cannot be replaced for till 12 years. Total life is 12 years. This has total life of 6 years. Anyway, after 6 years, we have to replace the less expensive machine because life itself is 6 years. So, 2 less expensive machine, 1, the expensive machine is there. Now, apart from that, few cost oriented things are given here. Few numbers are given. Purchase price is 20. Why? This is expensive now. This is only 14 lakhs. This is 20 lakhs. Obviously, scrap value will be same for both the machine. No issue. Overhauling is due at the end of 8th year, 4th year, which means even though the life of the expensive machine is 12 years, see what happens. See, this is the expensive machine. Year 0 to 12 is there. Okay, but the life is 12 years. But you have to incur overhaul cost, major repairs, overhauling expenses, huge, expenses, substantial cost you have to incur at the end of 8th year. Are you all understanding? This is 12 years, this is 0 years. Are you all understanding? 8th year, you will have, this is for expensive machine. But for, let's say less expensive machine, LM, what happens? This is total. If you see here, what happens? 6 years life will be finished. 6 years. Again, you have to replace. The cycle will continue. But what happens? The 4th year, you have to replace it. Overhaul expenses. Here, you have 4th year. Overhaul expense will be incurred. Which means 4th year overhaul expense. But that also will only, the maximum life is 6 years. Again, 6 to 4, the 10th year or let's say 10 years. Right? So, overhauling expenses will be due at the end of 4th year. This one is 8th year. This one is 4th year. Are you all understanding? So now every 4 years you need to incur overhaul expenses. Here I need to understand. See here, this is 12 years. Let's say now what happens, you see. We will see how they have done. I have a doubt regarding the solving of the question. We will see whether they have done conceptually or they have committed one mistake. I'm yet to see. See here, cost of capital is 14%. No issue. Discount, you will discount at 14%, and present value factor given for year 4. Present value factor 6, 8, and 12. So various years cash flow. Now you will discount using that rate. No issue. So here, if you see, this is year 1, 2, 3. Now only 1 8th year. Here, if you see, this is 4 year, 6. This is 8. This is 10. Like this they have done. Or my doubt is, they have taken this 4 years here, again 4 years. Now 8th year they have taken the overhauling. That I want to understand, but I strongly believe that 10 years should be, because at the end of 6 year, anyway you are going to replace with a new LM. When new LM comes, now again only after 4 years you have to do overhauling expenses. It's not like you buy the new LM and then suddenly second LM you will incur after 2 years itself, you will incur overhauling cost. That's my doubt. Let us see what they have done. Anyway, present value annuity factor is there here, 1 to 6 years, 1 to 12 years, no issue. Now, machine M, first step. What is this first step? I tell you. This is first you need to identify. This is cost oriented question, benefit oriented question, EAC or EAB. Purchase price 20 lakhs. Scrap value inflow. This is outflow. This is inflow. This is okay. This is again overhauling cost outflow. So predominantly annual recurring expenses outflow. So all these are outflows. This is outflow oriented question. You will never get the inflow. Inflow scrap value. You will adjust net outflow will be there. Are you all comfortable now? Now you need to find out first NPV of the outflow. Sir, what is this NPV? There is no discounted cash inflow minus outflow. Very simple. Yeah, NPV is negative. This is what NPV outflow. Total NPV outflow. Net present value is outflow. That is what they have computed. So NPV will be negative or positive. Cost oriented question. Negative NPV will be there. Are you all comfortable? How they have done? Very simple. Purchase year 0. Year 0 purchase. Now what is the discounting factor? 1. Because today certain outflow. 20 lakhs into 1. 20 lakhs value. Overhauling cost, what is that? This is cost oriented question. So cost is shown in positive and scrap value shown in negative. This should have been negative. Here they have put negative 162, 280. Are you understanding? Now what overhauling cost now? This is for machine EM. Very good machine. So only after 8 years you need to overhaul, which overhauling expenditure 4 lakhs. 8th year discounting rate 0.3506, discount and bring it to present value terms. So this is the outflow, one more outflow. Then annual repairing expenses. Again, outflow 1 to 12. This is annual. Every year it will happen. So annuity factor for 12 years you need to take 5.66. This is 11 lakh 32,000. Total just 20 plus 1.4 4 lakhs plus 11 lakhs 32 minus 62 280. This is scrap value at the end of year 12. So 12th year present value factor you will take discount and bring it to present value terms. You will get 32,960. Are you all comfortable? This is about machine EM, which has cost. This is cost. This is cost, but this is NPV. We have not yet found out EAC. Why? Because discounting factor you need to again discount divided by annuity factor you need to do. Annualized NPV you need to find out. That we will find out later. Now, come to machine LM cash flow. What they have done really is that, see, here purchase price year 0 they have considered 14 lakhs, discounting factor that is same, no issue. Overhaul cost 4. Year 4 you incur overhaul cost of how much? 2 lakhs. What is the total? 0.5921. Again, this one is considered. Are you all comfortable? Now, overhaul cost of 2 lakhs, which is given in the question, overhauling cost of 2 lakhs. But this overhauling is due at the end of 4th year. Like this, we will assume. But what they have taken, I'll just, here assumption is involved. Now, annual repairing expenses at the end of 6th year, that will be happen. Because actually, it is not only repairing expenses, it is getting recovered, it is getting replaced. So what will happen? Annual repairing expenses. Now at the end of 6th year, see, yes, annual repairing expenses, LM is 2,80,000. Here, see, this is annual, year 1 to 12. Here, you see the blunder here, it should be, yes, 1 to 12, it's 1 to 6 here. 1 to 6. What is it? Yes, 1 to 6. See, here I actually annual repairing cost 1 to 6 they need to take, and scrap value they have taken as 12. Actually, see, 3.889 they have taken. So effectively what happens? Okay, here annual repairing expenses 1 to 6 they have considered. Actually, it should be 1 to 12. Then only the scrap value can be taken as 12. That is the issue here. Anyway, annual repairing expenses they have taken only for first 6 years. Okay, and because the 2,80,000 you will incur every year, not only for first 6 years. Even if you replace it with new machine, that will again continue for 6 more years because they that is the point. Anyway, but what they have assumed here is that, see, they have taken only for 6 years project. So they have taken only for considering 6 years. So which means, see, they have not presented it properly. I have very much confusion in this regard, because overhauling cost itself, if you see, this is at the end of 4th year. Actually speaking, the 4th year overhauling cost is there for 12 years. Now, you are considering for 6 years or 12 years. That is a question. If you are considering only for 6 years, now the scrap value should not be at the end of 12. It should be end of 6. Or this may be printing mistake. Let me check it what they have taken. 6th year end present value factor. What is that? 6th year end? 4, 5. Yes. What they see. Now, that is they have done because of the year I got confused. See, that is why. Printing mistake in years is there. That is why. See, this should not be 12 year. I'll again show you what is the mistake here. I'll again show you. Yes, the entire project is done by using 6 year only. That is correct. Now what? Now correct. Now what you should be doing? What are the mistakes? I'll tell you. Here they should have written 1 to 6. This is the first mistake. Are you all understanding? Next, the scrap value 12 they have taken. That is why I got confused. Maybe they have, what I thought was they are considering 12 years period and 2 times they are, okay, for computation, ease of computation, they are doing. I was thinking because of seeing this 12, which is absolutely wrong. It should be 6. But the present value factor they have taken for 6 years. So many mistakes. So this is correct. Are you all comfortable? So this is 6 years life. That is rightly they are considering. This solution is right. Okay, this is correct. This is wrong. Because of these two, they got confused. Yeah, no issue. Year 0, this is present value factor 14 lakhs. Year 4, overhauling cost 1,18,420. 1 to 6, cost is 2,80,000 and 3.889. You will get this much. Scrap value you will receive at the end of year 6. 0.4556, that you will reduce, and total you will get 2470,660. Are you all comfortable now? Equated annual EM, I get equated annuity cost of how much? 32,09,960 divided by 5.66. What is this 5.66 for expensive machine? 5.66, 12 years life, 12 years annuity factor. 1 divided by 1.12. What is that? 10% or 14%? 1 divided by 1.14. 12 times GT, you will get the 5.66. Are you all comfortable? Then this is 6 years annuity factor 3.8899. And you will divide it. Here they will divide it. Whichever is cost oriented, whichever is lowest cost. What is this lowest cost? 567, 130. So expensive machine is better. Since annualized value of EM is less, it is suggested to replace existing machine with EM machine, expensive machine. Are you all understanding? With this, we are through with the concept called as EAB or EAC, that is NPV IRR concept. Now, moving on to the last concept, that is capital rationing. What has happened now? See, sometimes what happened, your capital will be limiting factor. Assume you have 4 projects available, A, B, C and D, 20 crore, 40 crore, 60 crore, 70 crore. Now the total comes to 60, 190 crore. If 190 crore project can be undertaken, but what is the problem now? Okay, I can undertake all the projects if I have cash. If I have this much cash, I can take up any number of projects. Yeah, are you all understanding? But I have cash, I don't have cash, I don't have cash. Assume you have the capital as the limiting issue, which means limiting factor, which means you have only 100 crore capital. So you have only 100 crore capital. How can you undertake project worth 190 crore? Can you undertake all the projects, sir? You cannot undertake all the projects, which means you have to select whichever is the best project and select those projects. So the situation where we have many projects to accept but could not accept due to the fund constraint, capital limitation. There you should rank the project. You should rank the project and select only those projects which are high yielding project. What method you will select? I will select PI ratio to rank the project. Are you all understanding why I select PI ratio? NPV simply sees the quantum of the return earned from the project. That is not relevant. PI ratio only what is PI ratio formula? DISCI divided by DISCO. DISCI divided discounted cash inflow divided by outflow. Now for every outflow denominator, how much inflow I earn? So for 100 crore, what is the best inflow? How much the best inflow I can earn? This is only possible if you rank the projects based on PA ratio and select those projects which are having highest PA ratio, which means assume project A has got 1.6, this is 1.5, this is 1.2 and this is 1.9. Select project B first. So 70 crore will be exhausted in project B. Then select project A, 20 more crores. Balance 10 crore will be there now. Balance here 100 crore will be there and 10 crore will be outstanding. Here what you should do, 90 crore I selected B and A, but balance I am having 10 more crores to invest. What should be the next step? Now I will just discuss what is that. See, very simple. Now take this example, you will easily understandable. Funds available 100 crore. Project 3 projects are available, A, B and C. Outlay 100, 50, 50, which means B project is capital is only 50 crore and here also 50 crore. But project here, if you see the NPV of this project, 50, 30, 30, which means ranking based on NPV. If you do, NPV suggests this project to select 1 and this 2. Are you all understanding? But when it comes to PA ratio, PA ranking, if you see 1.5, 1.6 and 1.6. Hence, you should select project B and C first to finish it off. You have 100 crore now. This project completely fits area. 100 crore is you can expend. But here 50 crore. Split the cash into two. Select project B and C. Do both the project. Earn a higher NPV. What is the benefit of this now? Ultimately, you will earn a higher NPV. But for selecting the project, you should rank based on PA. But ultimately, what you will earn from the project? NPV. Which means, see, there are two options. Either you take project A or you take a project B and C together. B and C together 50 plus 50 you will incur. Here cumulatively 100 you will incur. If you put 100 in project A, you will earn only 50 NPV. But 100, if you split 50-50 and put in B and C, you will even earn 30 plus 30, which is 60. Higher NPV. Are you all understanding? By having 100 crores, I can select those combinations, whichever is giving me highest NPV. But for selection of the project, you should select PI ratio. Are you all understanding? Comfortable? So rank based on PI and not based on NPV. Two situations possible in capital rationing situation. Now, this example, I've told you 50-50 exactly 100 got exhausted, no issue. But in my previous example, I told you project D you have selected 70 crore, A you have selected 20, 90, balance 10 crore is still available. Okay, two projects are still available, B and C, which is having 40 and 60. What can I do with this 10 crore? Question arises this balancing number, what can you do? First to see whether the project is two options. Project is divisible project. You can segregate. Partially you can undertake the project. Divisible project, just like highway project. Okay, you have materials for some number of kilometers. They can, if the project is divisible, you can undertake and say that, okay, I can undertake the project up to 100, 200 kilometers. That's all I have. I can contract for 100, 200 kilometers. I can lay the road. Balance you can, outsource with some other vendor. Are you all understanding? So project, if it is divisible, the project can be split into, 100 crore I am having. Next to select the project which is having next to PA ratio, and proportionate NPV you can earn. Partial NPV you can earn from the project. So what happens? Undertake the project partially and earn proportionate NPV or partial NPV. Are you all understanding? When the project is indivisible, which means either you have to take project in full or you should reject the project. For example, in our example, if you see project B, 40 crore is there, 60 crore is there. Which is having highest PA ratio? This is PA ratio 1.5 40 crores. So project B should be selected. Here also 40 crore is there. If it is divisible, you can 20% NPV you can earn. 10 by 40 is how much? 25% into, if the project is gives you total NPV of the project is 25. 25 into 25%. How much is that? 25 into 25%. Okay, you can earn how much? 6.25 NPV, partial NPV from this project. Total, and if you undertake the total project, you will earn 25 NPV. But if you earn, if you invest partially, this is 10 crore only you have of 40 crores, you can earn partial NPV. Are you all comfortable? Now, if the project is not divisible, these two projects cannot be undertaken at all. These two projects cannot be undertaken at all. But you cannot simply ignore all this. What you should do, the ranking system will also be questionable. You should prepare various combinations using the project without seeing the PA ratio. PA ratio will be irrelevant. What you should do, you say you have 100 crore, you should select A, B and C. Whether you can do A, B and C or B, C and D or A, C and D. Like this, various combinations you will put, and which manually you will find out whichever is giving me highest NPV, that project you will select. So indivisible project, either accept in full or reject. What you should do ideally, test different possible combinations, and combination of project giving highest total NPV should be selected. Which combination is giving you highest NPV, that project you will select. Are you all understanding? One more question we will do regarding this, illustration number 12, and with this we will be through with the capital budgeting chapter. See, X Limited has a capital budget of 1.5 crore for the year. From the following information related to 6 independent proposals, select the project. If project is divisible and indivisible, both the option is given. Divisible is very easy. Okay, indivisible is a little more complicated. Now, question sometime may mention you, this is the investment outflow. This is NPV. Sometimes what they will give sometimes they will give inflow. Are you all understanding? What is PA ratio? First step in capital rationing question is to find out PA ratio, rank the projects based on PA ratio. What is PA ratio? Discounted cash inflow divided by discounted cash outflow. But here discounted cash inflow given, NPV given, NPV given. What is NPV? NPV is equal to DISCI minus DISCO. DISCI minus DISCO, which means DISCO you know, this is NPV you know. What is discounted cash inflow? If outflow is 70,000, positive NPV of 30,000. What is the inflow? 1 lakh. Are you all understanding? Here inflow comes to 1 lakh, which means NPV plus outflow. So DISCI, what is DISCI? NPV, this minus DISCO goes there. NPV plus DISCO will give you DISCI, discounted cash inflow. Are you all understanding? Now you need discounted cash inflow, then only you can find out PI ratio, right? DISCI divided by DISCO. So 1 lakh is here, then 16 lakhs plus 25 lakhs plus 16 lakhs, how much is that? 41 lakhs. Then 50 plus 20 is 70 lakhs. 20 plus 10, 30 lakhs. Then you have 45 plus 55, 100 lakhs. DISCI, then this is discounted cash inflow. Okay, these are all inflows I'm computing. 25 is 100 lakhs. Are you all comfortable? Now using this data, you will compute the PA ratio. See here, present value of inflow, DISCI they have computed. DISCI they have computed 100, 41, 70, 30, 100 and yes, 100, 40, 70, 30 and 100. This how they have become 50. Again, yeah, mistake is there everywhere. This is why I'm getting comfortable. NPV plus inflow, na. So what is that? See, investment is 25. Okay, sorry. My mistake. And negative NPV here. This is my mistake. Negative NPV of 25 lakhs. Are you all comfortable? So negative NPV of 25. Now, effectively, DISCI will be less than DISCO. So DISCI will be even lesser. Negative NPV. Now, you should not at all select or rank the project itself. Are you all understanding? Why? Yeah, because you are losing the wealth. Na? So you will not at all select the project F. Leave it. Only competition is among 5 projects. Are you all comfortable? Now you will see. This you will not at all select even for computing combination. That you need to understand. So all this I will rank 1, 2, 3, 4. If projects is divisible, if project are divisible, now first step is assuming it is divisible. Which one you should select? First okay, what is the total funds outlay? You say. By reading the question, how can you understand first this capital rationing question? Very simple. What is the total investment amount? What is the total investment amount? First you say, what is the total of it? 70 plus 25, 100, 150 plus 20, 170. 170 plus 55 plus 75. How much is that? 300. Which means 300 lakhs you need 3 crore, but you have only 1.5 crore. Are you all understanding? This shows that this is a limiting factor question. If you want to undertake all the projects, you need to spend 300 lakhs. You have only 1.5 crore, which is 150 lakhs. So this is limiting factor question. So you rank na. Now what is first? PA ratio they have calculated and rank. This is the first. So E should be selected first. So 55 lakhs out of 1.5 crore, 55 lakhs selected there. Then 25 lakhs, then 20 lakhs, then 70 lakhs. What is the total till now? See here. I'll not compute C itself. C will not at all come here. Yeah, 1 second. See. You see here. Again, we will do this. See, E is there. D is second. D is third. Now you have 1.5 lakhs. See, you will not at all. Why have they have written? I don't know. Step by step, three projects you will select. What is 1.5 crore? You had 150 lakhs. So 150 lakhs minus 55. How much is the balance after first project? 75 lakhs. Then you 95 lakhs. Then you reduce 25. How much is the balance? 70. Then you reduce 20. How much is the balance? 50 lakhs. So 50 lakhs after undertaking 3 projects. I'll have balance of 50 lakhs. But project A is how much? Project A, the 4th project, if I want to undertake, this is of 70 lakhs. I have only 50 lakhs available. What I should do? I should proportionately invest and earn proportionate NPV, which means I should invest only 50 lakhs out of the 70 lakhs into this NPV. What is the total NPV from this project? This already given na NPV of the project D. Na 4th project means A. What? A. What is the NPV of project A? 30 lakhs is the NPV. Up 30 lakhs total NPV into this proportion 50 divided by 70 into 30 lakhs. How much is that? 30 into 50 divided by 70 comes to 21.42. 21.42. That is what rounding off. Okay, 20.42. If you do it full, you will get 21 lakhs 42,857. 21 lakhs 42,857. This you will earn partially. You add it to this. Are you all comfortable? Okay, so now here you have what is this 30 lakhs 92? Yes, this is proportionate NPV 2142,857, which means what you should do 45 plus 16 total NPV. You will earn from full NPV here, here also full, here also full. So 45 plus 16 plus 10 plus 71 plus 21.52, 21.42, 92.42857. Are you all understanding? Here they don't need to show this 30. Okay, this is total NPV, this is a proportionate NPV. Are you all comfortable? This is how you need to do when projects are divisible. Here, this is indivisible given, but here you have to write the solution here if projects are divisible. This, okay, I don't know whether I have copied it wrong or not, or they did not give. I just copy pasted it. Image I have copy pasted. So you have to write it. If projects are divisible, this will be the total NPV. Now, if projects are indivisible, what you should do? Various combinations of project you should make. Are you all understanding? Here also, while combining the project F, you should never consider, because negative NPV, that project you will never consider. Are you all comfortable? So what you should do? First option, EBIT-EPS. Total investment comes to 1,50,000. Okay, how much is the NPV in this project? 1,50,000. Here also, actually speaking, okay, what is the treatment of the idle fund? Sometimes you may have idle fund. For example, you select project EBIT-EPS. If you select EBIT-EPS, E, D, C and B, how much is that? 55, 50, 105, 20, 125, 25, exactly 150, no issue, exactly 150. So no issue here. E, B and A, E, B and A, E, okay, B and A, how much is that? 25, 65, 75, 80 and 70, 150. That is also exactly matching. Then you have BAC. BAC means, okay, B 25, A 70, okay, 95 and 50. Now if you see A, B and C, that is what they have done effectively. Yes, B, A and C, A, B, C, 1,45,000 only here. Actually speaking, you still have idle funds of how much? 5 lakhs. You have spent out of 150 lakhs, you have 5 lakhs idle fund. Yeah, what is the treatment of idle fund? I used to discuss separately. Okay, if question asked this long discussion, I don't want to do it here. Understand that if question mentions some more reinvestment rate, okay, you should calculate NPV of the idle fund and then adjust. It will always be negative NPV because the funds are idle now. So that is there. Anyway, here they have not given. Only if question doesn't mention you anything about reinvestment rate. Now you will ignore the idle funds adjustment. You will do directly here 1,45,000. NPV find out. NPV also you total it. Here NPV of E, B, D and C, if you total you will get 91. If you total you will get 91. What is the best option? Best option is this E, B, D and C. So select either E, B, both our options are same. So select this or this, whichever provides maximum total NPV may be undertaken after coming up to various combinations. Okay, with this we are through with the chapter that is capital budgeting, and next we will move on to the next chapter that is working capital management. See. Now let us start with the new chapter that is working capital management. See, first of all, what do you mean by working capital management? See, what do you mean by working capital? Capital required by meeting day-to-day operations of the business, which means the investment decision which we already studied in capital budgeting chapter, in a previous chapter, it was about long-term investment. Okay, long-term investment, a huge fund outlay if you want to open a new factory or if you want to buy a new plant and machinery, huge expenses involved. This is called as, okay, the capital budgeting, or what do you say, long-term investment decision. Now here in this chapter we are going to learn short-term investment decision, which is, okay, called as working capital management. Very simple. You bought a plant and machinery or you opened a new factory, but you want to run your, okay, day-to-day activities now. You want to produce the goods, you have to have the stock, you have to have the debtors. Are you all understanding? So for these, okay, working capital you need to manage now. That is only called as working capital management. Capital required for meeting day-to-day expenses requirement and smooth operations of the business. Short-term capital. See, what is the formula for working capital? Effectively, formula is nothing but, okay, current assets minus current liability, which you have studied under ratio analysis. See, I'm not covering ratio analysis. See, the segment ratio analysis and the financial statement analysis is a small area, okay, which you can even do self-study. That is not, okay, you don't require my guidance to study those topics. Very simple and straightforward. I'm only discussing the core finance chapter. Even working capital management is also not core finance chapter, but still, okay, so one of the very important areas in your CMA INTER. Hence I'm discussing. Now, see, what do you mean by working capital? Working capital is nothing but current assets minus current liability. What does this really mean? What does this really mean? Very simple. See, here assume this is a balance sheet. here you have current assets, okay, and here you have current liability. This is assume this is long-term liability, and this is a long-term as what do you say, fixed assets. Assume you have fixed assets, PPS. Now, what happens is this current assets is there now. This current assets is stock, data, all these things will come. Okay, everything will come. Now, what do you say is that this current assets, okay, will be partly funded by the current liability. Are you all understanding? Will be partly funded by the current liability. For example, debtors is there. Okay, it will be partly funded by the creditors itself, short-term creditors itself. So this will be partly funded by current liabilities. So that portion of the current assets, which means assume this is the balance sheet, current assets is 100. Current assets is 100 lakhs, assume. Okay, fixed assets is 100 lakhs. And here also, if you see, current liability is only 70 lakhs. Okay, here long-term liability is say 130 lakhs. Are you all understanding? 200, 200. Now see what happens. The current assets is 100 lakh now. It's partly funded by the current liability to the extent of 70 lakhs. So balance 30 lakhs, it is actually funded by long-term liability. It is funded by long-term liability. So that portion of the current assets which is funded by the long-term liability, we call it as working capital. Working capital is equal to current assets minus current liability. Okay, now that's what you get in this. Okay, this is about introduction. In this chapter, what we are going to learn, we are going to revise what we are going to revise. Now, stock, current assets. So what are all the current assets? Stock is there, inventory. See, inventory I'm not going to discuss. Why? Costing, though management accounting already would have studied the full chapter about materials. This is all about stock. Are you understanding? Next, debtors management we are going to cover here. Debtors management we are going to cover. In that debtors management also, we have three segments: credit appraisal decision, okay, credit period related decision, and discount related decision. Three questions, three types of questions, three types of concepts we are going to see. I'll discuss that. Creditors management. See, creditors and debtors, I can club it together. Okay, because obviously they see, if you are giving debt, if you are having debtors, it is someone else creditors, right? So it can be viewed from both the angles. So I'm not discussing both. I can club it together. I can discuss. Next comes cash. In the cash segment, we are going to study three models. Boumel model is there, okay, and miller-orr model, and then cash budget. How to prepare cash budget. At the end of the session, we are going to see the cash management segment. Then we have working capital estimation. This we will start with the current session. We will start with working capital estimation. Okay, how much the company assume. Okay, we have the how much the stock is to be kept, how much the debtors is to be kept, how much the creditors. Okay, you need to lock in. So what should be the working capital requirement for a business? On an average, what is the working capital requirement? Okay, how much cash I need to keep in for working capital budget? This is nothing but working capital budget. First segment, we are going to see how to prepare a working capital budget. Then we have small concept called as working capital cycle. Incidentally, we will discuss these two. We will discuss first, then we will discuss second. Then we'll move on to debtors management probably. Okay, then we'll finish with the debtors and creditors. Then we'll finish with the cash management. Are you all understanding? So these are all the broad areas in this segment. Shall we start quickly? See, working capital estimation. Now, what are all the things we have under working capital estimation? Now, you have stock, okay, debtors, creditors, and cash. I already told you all these things. In the stock, if you see, we have raw material stock, WIP stock, finished goods stock. We will see each and every item inside the stock, how to value this. Are you understanding? Different methodologies are available. We'll see one by one and remove all the ambiguity. See, the working capital management will feel difficult for few students. The reason being, there are so many assumptions, which means sometimes you need a sales approach. Sometimes the question will be solved under a total cost approach. Sometimes it will be cost under a cash cost approach. All these things we are going to see. So from basics, I have given few basic questions. From there, I will discuss each and everything. Okay. At the end of the session, see, first 4 or 5 questions we will have briefly. So we will have questions regarding raw material, then WDP, then finished goods. Thereafter, we will prepare one full estimation question, 5th or 6th question. Thereafter, we will proceed with the other areas. Shall we see? First, raw material stock. What do you mean by raw material stock? Very simple. See, this raw material stock, now, how much of my funds on an average will be blocked in the form of raw material for the current year? How much I should keep raw material so that I can produce it? Are you all understanding? So that I can consume for production. Are you all understanding? So raw material stock, what is the formula for it? Okay, value. How to find out value of raw material stock? Very simple. Production. which means production. What is this? Production. How many units you are going to produce this year? How many units you are going to produce? What is your production level? Assume I have an example for everything. Just understand that units produced into consumption per unit. Assume, okay, you are going to produce 6,000 unit, and every unit is going to consume 2 kgs of raw material. 2 kgs of raw material. Are you understanding? For example, if you are producing a toy, the toy will have plastic as a plastic as a raw material. Na? So assume each will have each toy, big toy, so will have 2 kg of raw material. Are you understand? 2 kg of plastic. So in that case, consumption per unit. This is per unit. Then into raw material price. Each kg, okay, each kg of raw material, if unit of raw material, how much I am going to buy, which means at what price I am going to buy. Raw material price into raw material holding period divided by 12. Raw material holding period divided by 12, which means assume what is this raw material holding period? Now, very simple. On an average, how much of my stock I need to keep for production? Very simple. If there are 12 months in a year, in that I want to keep 2 months. Okay, even if some extraordinary event came, okay, my production shut down, strike, 2 months, company COVID came, okay, the company couldn't, okay, acquire the raw material. Still, the production will not stop because I have 2 months of, okay, raw material, which is enabling my production. Are you all understanding? So this is the raw material holding period. What is that? Assume the question gives you 2 by 12. If it gives in months, you will take months. If it is giving in days, divided by 360 or 365, question will mention what to be taken. Okay, 12 or 365 or 360. Sometimes assume 360 days in a year, they will give. You will assume 360, you will take 360. Or if they give you 12 months given, 1.5 months production is there. So 1.5 divided by 12, like this you will consider. Are you understanding? Now, simple. Again, tell me the formula. What is that? Production into consumption per unit into raw material price into raw material holding period divided by raw material holding period divided by 12, as the case may be. Here, the raw, see, this I put it in the, here I just can show you here. Can you see this? The production into consumption per unit into raw material price. This is nothing but your raw material consumed. The total value of the raw material consumed. You would have studied in the cost sheet. Are you all able to understand? Okay, yeah, because production number of units into per kg per number of units produced into price per kg. This will give you raw material consumed for the year into 2 by 12, raw material holding period divided by 12. This will give you raw material stock, value of raw material stock. Are you all understanding? Now, one by one we will do. Raw material stock we discussed now. We will do one question. Question, concept. Like that we will do. You will have a better understanding of the, say, take problem number 1. Estimation of raw material stock. Calculate raw material stock in the following case. Budgeted production is 60,000 units, 60k units. Next, raw material consumption per unit is 2 kg per unit. For each unit consumes 2 kg. So how many units of raw material? Kgs of raw material total 1,20,000 kgs of raw material it is going to consume. And raw material cost is 4 per kg and not per unit of the finished goods. This unit is finished goods, budgeted production of the finished goods. And this is kgs. How many kgs inside this? 1 unit. And this is 4 per kg. So 1,20,000 kgs into 4. How much is that? 2,40,000, 2,40,000, 4,80,000. Are you all understanding? So 4,80,000 is the total consumption. 4,80,000 rupees is the total consumption, right? Into 2 by 12 into 2 by 12. So 4,80,000 into 2 divided by 12. Raw material holding period is, yes, 2 divided by 12. 80,000 is the solution. Are you understanding? Breakup I have given. Raw material stock is equal to production, which is 60,000. Then consumption per unit, 2 per unit, 2 kgs per unit into raw material price 4. You will get 80,000. Value of raw material stock. How to find it? Are you all comfortable? Shall I proceed to the next finished goods? Okay. See, question I will come back. Just I will discuss the formula. See what happens here in terms of finished goods. This we have already discussed here. Next we will move on to finished goods. See, finished goods while valuing, while valuing raw material, you will take the next step, that is consumption. So raw material stock, what is the formula? The first 3 things I can summarize into raw material consumption, which means raw material consumed into value of raw material consumed into raw material holding period divided by 12. Okay, will give you what is the average value of stock. Now, finished goods stock, now how to value it? Okay, what is that? Cost of goods sold into finished goods holding period divided by, okay, 12. Very simple. There you use the raw material consumption, which means what is the next step? Okay, after you purchase the raw material, you consume, right? So for consumption, you will acquire the raw material stock. Here, this is finished goods stock. Why you keep finished goods stock? Very simple. Finished good. Now, if you have a finished goods stock, it will have not only raw material, it will have all the other aspects also, which means raw material will be there. Inside that, WIP will be there. Inside that, overhead will be there. Are you comfortable? So, what I say is that finished goods, like I will take units sold. I will take consider units sold because how many units I am selling. For that, okay, how many units is the how much per unit is the cost, total manufacturing cost. Finished goods will be valued at what cost? Manufacturing cost. So units sold into cost per unit, okay, into finished goods holding period divided by 12. Now here only I have some variation. Okay, two methods are there where to value finished goods. Cost per unit you are taking now. There you already know that finished goods will be valued at total manufacturing cost. It will be valued at manufacturing cost. That would have studied in management costing. No issue. But the cost you are considering now, this cost manufacturing cost, yes, I appreciate. But here, assume depreciation is given. Assume one of the cost is depreciation. Depreciation is a non-cash expense. Are you all understanding? So there are two views here. One is that you take total cost. One possibility is that you take total cost. Then the question sometimes may give you consider cash cost. In that case, cash cost of manufacturing will consider, remove the depreciation. Assume 15 rupees total unit. See, we are going to see the example. There depreciation 1 rupee is there, which means 15 minus 1, only 14 is the cash cost of manufacturing. Are you all comfortable? Shall we do one question? Okay, take question number 2 here. See. Particulars, yes, estimation of finished goods stock. Here, see here, raw material 5 rupees, wages 4. Okay, then you have manufacturing overheads including depreciation of 1. So inside the manufacturing depreciation, total manufacturing overheads 3. Inside that, okay, 2 rupees is cash manufacturing overheads and 1 rupee is depreciation, non-cash manufacturing expenses. So administration and selling expenses of how much? 3 rupees. Then total cost per unit comes to rupees 15. Are you all comfortable, including the depreciation? Now, finished goods holding period is 2 months. Calculate the stock of finished goods in each of the following cases. No other information is given. Point number 1. No other information is given. How to find out now? Very simple. Okay, what do you do? Units sold you will consider. What is that? Okay, you see finished goods stock now. No other what do you say here? Yes, no other information is given. Stock to be valued at cash cost. Now, what you should do now? If no other information given, you will consider total manufacturing cost. Now, here also the beauty, very carefully you need to understand that administration and selling expense you should not consider. Are you all understanding, my dear friends, what is happening? So 15 rupees there. Now the entire 15 rupees is not manufacturing cost. So what are all the cost which will come under manufacturing cost? Raw material cost 5 rupees, then 5, then wages 4, then manufacturing overhead excluding depreciation, including because total manufacturing cost. When there is no cash cost you should do, only when specifically asked you should do in cash cost. Are you all understanding? Otherwise you ignore the cash cost and do the balance. So 3 rupees is there. Now 3 you will consider. 5 plus 4 how much? 9 plus 2. 12 is the total manufacturing cost I will consider. Are you all understanding? So total cost approach. How much I will consider? Okay, see first we will find out finished goods stocks. How many units I am selling? So units sold into finished goods holding period divided by 12. How much is the value? 10,000 units. Are you all comfortable? So 10,000 units here I will consider, which means 60,000 units into 2 divided by my closing stock. Okay, in terms of units of the finished goods should be 10,000 units. Now we need to find out the value now. If without 10,000 unit into total manufacturing cost, if nothing is given, you will take total cost approach. 10,000 into 12, 1,20,000 will be the value of the finished goods. Are you all comfortable? Next, cash cost approach. What is the, what is the value you should take? 11 rupees. Why? 1 rupee depreciation you will remove because non-cash item. We only want cash cost approach we are doing. So 10,000 units into 11. 1,10,000. Are you all comfortable? Finished goods should be valued at manufacturing cost, which means selling and administration I am ignoring because finished goods will be valued at only manufacturing cost. Are you all understanding? Now, next. Or simply you can use the formula also. Cost of goods sold into finished good holding period divided by 12. But the beauty is cost of goods sold also can be, okay, divided into two. One is the total cost of goods sold or cash cost of goods sold. How to find out total cost? 60,000 into 12 will give you total cost of goods sold into 2 by 12. Na? Finished goods holding period divided by 12. Are you all understanding? 2 months. What is the understanding? Na? 2 months sales, 2 months goods, which is going to sell. Okay, 2 months worth of finished goods, which you are going to sell. You are going to have it as finished goods stock. Are you all understanding? You are willing to keep 2 months sales as, okay, your stock. But stock should be valued at cost, not at sales value. So 1,20,000 here and 60,000 into 11. Cash cost approach 1,10,000. This will give the same answer as we computed here. Are you all comfortable? Okay, next, estimation of work in progress. This is very, very important. See what happens in case of WAP stock. Okay, now see. WAP, what is WAP? Work in progress, which means in the factory, what happens sometimes, okay, at the end of the period, say in between month or the last day of the month or last day of the year, what happens sometimes the production will be, not fully finished, which means, okay, there might be a situation where for so many units would be, work in progress, lying as work in progress in our closing balance sheet. Agreed? Now, what happens? Sometimes there might be a situation where you pour in 100% of raw material. Usually, what happens? Most of the manufacturing companies, raw material will be used completely 100% first go itself. Later on, labor will work on that. Overhead will be consumed, and it will be turned out to be finished goods. Are you understanding? So, what happens? For WAP, there will be raw material usage, there will be, what is that, labor, there will be overhead usage. Are you all agreeing? Now, what they say, for valuing entire WAP stock, inside the WAP, there is raw material, there is labor, there is overhead. What you should do? Individually, you should value all these things separately. Material, labor, overhead on a unitized base and find out the total per unit cost of WAP. Then multiply with WAP holding period divided by 12. You'll get the value of the cost. I'll give you an example. What happens? Have to be valued individually. Now, very simple. Case 1, no info is given. No info is given. Now, okay, nothing given, value of the WAP, they have given the question and they have given the details of the raw material and overhead. Now, material cost 100, material, you will assume that this is the assumption. This is assumption that material, if nothing is given in the question, you should assume that material is 100% complete. Wages and overheads is 50% complete. Are you understanding? Basic assumption. Next, case 2, if they have specifically given that WAP is 60% complete. Just they have mentioned WAP 60% complete or WAP 40% complete or 50% complete. Generally, they are giving. Even then, you will assume that material is 100% complete. Wages and overheads are only 60% completed. Are you all having the clarity? Which means, okay, see, under both the scenario, I assume material is 100% complete. What is the point? Now, when you learn the third case, you will understand it even better. Third case, what happens? They will specifically mention how much material consumed, how much percentage of material is already consumed, okay, inside the WAP, and wages and stock is 60%, 40%, they will give in the number. So, which means 80% complete as to material, 60% complete as regards to labor and overhead. Only when they, which means what is the conclusion I can draw from all the cases? Only when the materials consumption is specifically stated in the question, which means this much percentage, which means material with respect to materials, only when the question mentions you the percentage completion, you will consider it to be half complete. Otherwise, most probably, if nothing is mentioned, also if they generally mention WAP 60 or 50% nalu, material will be 100% consumed. Material will be 100% consumed. That is the assumption you need to take in the examination. And wages and labor, wages and overheads will be 50% complete or 60, whatever given in the question, you will consider. Are you all comfortable? 3 cases I have given. Approximate formula is not to be used because anyway, most probably question WAP will be the main adjustment in working capital estimation. Are you all understanding? So this is just a raw formula. Cost of production into WAP period into 12. But you cannot simply take cost of production. Every unit you have to take raw material. You have to calculate raw material per unit inside the WAP, labor and wages, percentage completion. You learned in Work in progress chapter na in the costing similar way. Are you all comfortable? Shall we do one question? You will be confidently understanding. See, next third question, estimation of working capital. All facts in the example 2 are same, which means the question given for question 3 is this same, which means raw material price is 5, 4, this is 3, and this is 3, and this is 50. Now, WAP is also a value. See, WAP I need to value now here. Yes, the WAP holding period given as half a month, which means you will consider 0.5 divided by 12. See, 1 month na 1 by 12, 12 months. So, half a month na 0.5 divided by 12. Now, calculate the value of WAP stock in the following situations. No other information is given. WAP 60% complete, WAP 80% as complete as to material, and 60% for wages and overheads. Very simple and straightforward. What do you do? 60,000 total production into 0.5 into 12, 2,500 in terms of unit you will consider. First, in terms of unit, how many units are inside stuck inside the factory? How many units are WAP? The 2,500 units are available as WAP. First, this is units of finished goods, but this is you can just simply you cannot simply apply 2,500 into the total production cost. That will not be happening because you have to apply the respective percentage completion. Agreed? So situation number 1, no info is given. Very simple. What you should do? Material cost 5, fully 5 is completed. You will assume. I told you material will be fully consumed. So 100 into 100, 5 into 100%. 5 you will consider under total approach as well as cash cost approach. Both the approaches I am saying because when you take cash cost approach, valuing WAP will be something different. Are you all comfortable what I'm trying to say? Okay. Now, we are going to see in that question, you will understand. So, this is total approach, cash cost. Well, under both the approaches, the material will be same. Material cost will be wages. What you should do? Why? No information is given. Now, material 100%, wages 50 and overhead 50. What you should do? 4 into 50%, 2. Here also 2. But in respect to overheads only, you need to adjust the depreciation factor. Very simple. What is the total overheads including depreciation? 3. 3 into 50%, you get 1.5. What is the overhead excluding the depreciation? 2. 2 into 50%, 1. Are you all understanding this 1 and 1.5? Now add it. 5 plus 2 plus 1.5, 8.5 is under total approach. I need to value WIP per unit at 8.5 under total approach and 8 rupees under cash cost approach. Are you all comfortable? Now, what is the value? 21,250. How much? How I got 2,500 units? I got as WAP into 8.5 per unit. How much is that? 21,250. Here also 2,500 into 8 per unit, 20,000. Are you all understanding? Situation number 2. If WAP is 60% given, then what is the assumption? Still you will understand that material is completed 100%. Assume that material is consumed 100% and labor and overhead as instead of 50, it is 60 now. You can try it out and you can solve. I don't want to again and again solve the same thing. Are you understanding the same thing here? Just apply 60% instead of 50%. You will get the solution. Situation C, WIP 80% of material, 60% of wages over, clearly given. What is the detail regarding material? What is labor and overheads? Apply the respective numbers. Very simple. 5 was the material total cost into 80%. Why 80% complete they have given? So 5 into 80%, 4 rupees here. Here also 4 rupees under total approach, under cash cost approach. Next. Labor total cost is 4 rupees. 60% complete into 60%, 2.4. Here also 2.4. No issues here. Overhead, you see what happens. 3 rupees total approach. 3 rupees into 60%, 1.8. 2 rupees under cash cost approach, 2 into 60%, 1.2. If you total it, okay, you will get here 8.2. Here you will get 7.6. Okay, are you all getting the value of 20,500 and 19,000? Understood? Shall I proceed? Okay, next is estimation of debtors. Estimation of debtors. See, now what happens? Debtors, how you should value? Debtors also, it's a tricky area. Why? Because see here, there are 3 approaches here with respect to debtors. What happens? Mostly, if nothing given, institute uses sales approach. Most probably in your CMA Institute material, I have seen that most of the questions, unless otherwise stated as cash cost approach or cost approach, okay, what they generally take, they take the sales approach. What is the formula for debtors as per the sales approach? Credit sales into debt collection period into 100. Are you all understanding? Credit sales into debt collection period into 100. So this is under sales approach. Very simple here. Sales approach, you will write credit sale. Always see, this is credit sales. Okay. This is not total sales, which means, sir, if question doesn't mention the breakup, how much is the cash sales, how much is the credit sales? Now assume everything has to be credit. Everything to be credit, which means if question doesn't mention you the bifurcation, what you should do? You should assume everything as credit sales. That is one thing. Next, total cost approach. Sir, what is that? I have seen that. Okay, what you should do? You can take credit sales, then you can also take cost of sales. You can also take cost of sales. This also credit cost of sales, which means how many units you are first selling for credit. Multiply with cost of sales per unit, you will get the total cost of sales. Are you all understanding? See, don't get confused. Finished goods, when you are valuing, cost of goods sold you will consider. That is a different thing. Here, cost of sales. What is the difference between cost of goods sold and cost of sales? See, cost of sales will include the admin and selling expenses. Are you all understanding? Here, cost of good, only manufacturing cost will consider. Are you all comfortable now? See here. So cost of sales into debt collection period divided by 12. This is one more approach. Last approach, cash cost approach. Simple. Remove the depreciation, balance whatever is the cash cost of sales you will consider in debt collection period into 12. All the three are possible. Only when cash cost approach they have asked in the question. Do estimation based on cash cost approach. Now then only you should consider. Otherwise, generally you will take sales approach or total cost approach. See, institute there is no clarity. What you should do in this case now? If there is no clear pathway, what you should do? Assume you solve it under sales approach. Better to solve it under sales approach and give a note and assumption. You have to give an assumption and note that debtors have been valued at sales valued under sales approach. Like this you will give, and the formula to be used is credit sales into debt collection period into 100. Are you all comfortable? Okay. Now come to the creditors. I'll discuss the creditors also, these two things. Then we will do collectively 2 or 3 questions, right? Creditors for materials. Now, so what is the formula? See, what is the value of creditors for materials? Creditors we need to segregate, because materials you will have some creditors. Thereafter, for expenses and wages, you will have creditor, which means the question will segregate credit period. The creditors have extended 2 months of credit period. Like this, it will be given, which means it is, you see whether any other adjustment given is given regarding other, labor and overheads, expenses. If not, what you should assume? This is only for material. Most probably it will only be for material. So creditors for materials, only purchases you will make for outside vendors. Agreed? So materials only you will make credit purchases. So credit purchases into credit collection period. Credit payment period, debt collection period, and here credit payment period into divided by 12. So what is the formula? Credit purchase into credit payment period divided by 12. In the absence of information, consumption is equal to production. Because if consumption given, you will assume that whatever is the consumption you have purchased and you are not under or over purchased, which you will common assumption used in the examination. Are you all understanding? Purchase is given, fine. But sometimes consumption will be given. Then, no separate stock details or other details should be given, purchases. So you will assume that consumption is equal to purchases and solve the question. Shall I proceed? Next, last, creditors for expenses. Creditors for expenses, which is wages and overhead, which means assume that wages is being paid. Current month wages is being paid at the end of the next month, they will say. Which means 1 month is the creditors for wages. Agreed? Now, expenses also, here also overhead, expenses, general overheads will be there. That is not an issue, will be given. Labor and expenses is this much. Sometimes they may give separate for labor, sometimes they may give separate for overhead, but sometimes they will mix creditors for expenses. They will give, fine. Now, the only issue is, if depreciation is given in the question, that is the villain. Depreciation is the villain in the entire working capital estimation. Whenever they give depreciation, you will understand that you should remember that why they have given depreciation. To ask you under cash cost approach also, they have given you depreciation. That is the understanding. Most probably they will ask you the cash cost approach. So, when you try to value, you also show the cash cost approach valuation, because to remove the ambiguity, so that you will communicate to the examiner that why depreciation has been given under both the approaches. This level of knowledge you need to communicate to it. It should be in the exam paper. I would recommend you to write in the exam. And why I told you depreciation villain, while computing the creditors for expenses, you have to exclude the depreciation effect. Are you all comfortable? Why I should explain? Depreciation is expenses. Why depreciation is an actual expense. Actual expense in the sense the P&L I have debited depreciation. So why are you not considered a creditors? See, it is an expense, no doubt. but it cannot have creditors for it. Where who will offer you depreciation as such? Okay, there is no creditors for it, which means depreciation while computing the creditors for expenses. Okay, the depreciation cost will be removed, which means when you compute creditors for expenses, always cash cost only you will consider, to put it simply. Are you all comfortable with this? We are through with the estimation one by one. See all the individual aspects we saw. So we will see one whole comprehensive question which covers all the aspects. Then we will proceed now. But we have left with what creditors? Yes, creditors were debtors and creditors we are left. Yes, WAP we did. Debtors and creditors will do two questions and then move on. See, estimation of debtors. Now assume that what is that? Assume that same facts in example 2. Okay, assume same. Debt collection period is 2 months. So debt collection period. What is the formula under sales approach? Credit sales into debt collection period divided by 12. So cash sales is 20% and SP is selling price is 20 rupees. Are you all understanding now? First, debtors in units you need to find out. First, debtors in units. Now, how many credits? How many number of units you are selling as credit? Okay, into debt collection period into 12. If you do, you will get the credit sales in terms of debtors in terms of units. Debtors in terms of units. Then on a per unit basis, how I will value debtors, I will find out all the different approaches. I can just work it out. Shall I proceed? Okay, debtors in units. This is credit sales into 2 by 12. Okay, credit sales in terms of units. This is credit sales in terms of units. See, tell me children, what is the total production? See, what is the total? See, 1 second. What is the 6 lakhs units? So what is the total? What was the total? 60,000. Example 2, please verify example 2. Let us, yes, problem 2. Yes, 60,000 units. What is the production? 60,000 units. So now, if nothing given in the question, what we will assume? Production is equal to sales. Production is equal to sales. No stock is given. Production is equal to sales. So what is the 60,000 units is the annual production. Annual production, out of it, annual sales. What is that? Sales. Total sales is 60,000. Out of it, 20% is cash sales, which means 80%. So 60,000 into 80%. How much is that? 48,000 units. So 48,000 units is the total number of units credit sale. Number of credit sales units. So this is how much? 48,000 units into, okay, debt collection period divided by 12. If you do, you will get the total debtors value in terms of units. How much is the debtors value? 8,000 units debtors you will get. Agreed? Now you need to value this now. Under 3 approaches, under all the 3 approaches I can do. Under sales approach, I value at what? In question number 2, if you see, selling price is 20. So credit sales, number of units sold into selling price per unit. Sales approach, I will value at 20. I'll value at 20. So 8,000 units into 20, I'll get 1,60,000 as debtors under sales approach. Next, total cost approach. What is the value will be? 15 is the total cost. I'll consider all the cost. Why? See, if they say total cost, contextually you need to understand this. You should not take manufacturing cost. This will say cost of sales per unit, 15. Why? Okay, anyway, you are valuing debtors. In that, you will have the admin and overhead expenses also you will consider. So what is that? 1,20,000. Next, cash cost approach. Only when they give you cash cost approach, you will consider this cash cost approach. Then 8,000 into 14. How much is that? 1,12,000. Are you all comfortable? Alternatively, sales approach, credit sales into debt collection divided by 12. Directly apply the formula. I don't want to confuse with the number of units and other thing. I will consider the number of units while calculating the credit sales or cost of sales. I will directly use credit sales into debt collection period divided by 12. Total cost approach. Now, cost of sales under total cost. Okay, how much will be there now? To 8,000 into this number. Okay, 15. This number will be there into debt collection period into 12. Cash cost of product, cash cost of sales into debt collection period divided by 12. I already explained. Okay, now we will move on to question number 5. Estimation of creditors for goods and services. Here, if you see, first creditors for material will be there. Then creditors for expenses we will try to understand. Question number 5. Estimation of creditors for goods and services. Assume the same facts are example 2. The additional facts are credit period allowed by supplier is 2 months. Cash purchase is 20%. Time lag in payment of other expenses is 1 month. This is given. So here in this question, this is inclusive of creditors for materials as well as the other expenses. So what you should do for material, first creditors for material while you compute. How to compute it? Material consumed is equal to 3 lakhs from there. Okay, 6,000 units into 5 per unit. Total material consumes equal to 3 lakhs. See, material consumes is 3 lakh, we know that. Absence of information, what happens? Material consumed is equal to material purchases, we will assume. So therefore, 3 lakhs is the material purchase. Now, credit purchase is equal to 20% belongs to cash purchase. Now, what is the balance? 80%. So 3 lakhs into 80% credit purchases is equal to how much? 2,40,000. Creditors for material is equal to, okay, credit purchases into credit payment period divided by 12. How much is that? 40,000. Are you all comfortable? Simple and straightforward. That is not an issue. Creditors for expenses, when you calculate, annual expenses comes to 6,000 unit into 9, excluding depreciation. Why depreciation will not be coming? I explained. Okay, depreciation will not have any creditors, so that should be removed. So 15 minus 5, material you will remove. This is the total. Minus 5 you will remove, then minus 1 depreciation. So how much is that? 9. That is what here we have computed. So 5,40,000 is the creditors for expenses into 1 by 12. So 5,40,000 into 1 by 12. How much is that? 45,000. Okay, now we will discuss the comprehensive question, which I told you we'll discuss now. Total approach versus cash cost approach. Now, suppose you are the financial director of BEST Limited. The company proposes to produce, how much is the production? 6 lakhs units in this question. Okay. Our units of its product in the next year commencing on 1st April. The estimated cost sheet of the product is as follows. Raw material 10, wages 2.5, direct wages 2.5, overheads including the depreciation of 25 by say how much is that? 7.5, which means cash cost comes to 7.25, total cost comes to overhead cost comes to 7.5. Now total cost 20, of course, inclusive of depreciation. Then you have profit of 5 and selling price of 25. The past experience of the company with regards to stock of raw material of finished goods credit has been as follows. So this is the past trend. Based on the past trend, they are trying to project or budget. Okay, now see one by one. Company holds 2 months raw material in the stock. So raw material holding period is 2 months. Half a month's 0.5 is working progress, which means, see here, half a month's production is there in working progress, but they have not mentioned anything regarding materials, percentage completion, or wages or overhead. So what you will see, 100% material, okay, 50% with regards to labor and overhead. This is what you will assume. Next, on an average, finished goods remain in stock for 1 month, finished goods holding period, supplier of materials in 1 month's credit. Okay, supplier of materials extend on 1 month credit, which means creditors payment period. Then it has been practice of a company to give 2 months credit. This is debt collection period. Okay, from our side is 2 months. The company wants to maintain 25,000 cash balance. Okay, net current assets minus current liabilities, working capital. Current assets you have stock, debtors, and the cash balance should also be computed, which is given as 25,000. Now, you are required to forecast the working capital for the company for the next year, which means this is we have to do working capital estimation. What they ask in second part, what would be the cash cost of the amount of working capital computed above? Very simple. In the first, we will take total approach and the total cost approach, which means nothing specifically told. Now we will consider total cost approach there. Here, cash cost approach we will consider. See, shall we start here? See, first working note number 1, raw material stock. How to compute 6 lakhs units the production. Okay, into 10 into 2 by 12. 10 is the raw material price. Okay, here raw material price will be taken as 10 and 6 lakhs units na, into 10 into 2 by 12. Raw material holding period value comes to 10 lakh. Are you all understanding? No issues. Next, WIP, I told you how to compute 100% with regards to material. So 10 material, we will take 100%. Then wages 2.5, 50%, and 7.5, 50%. If you notice this 7.5, the total approach 7.5 total cost they have considered, including the cost of depreciation. Because cash cost, when they ask in the second part, we will take only 7.25. Here we will take fully. So 3.75, 1.25 plus 3.75 plus 10, total comes to 15. Are you all comfortable? So WIP stock is how much? 6 lakhs units into, okay, 15 into 0.5 into 0.5 divided by 12, which gives 3,75,000. Are you all comfortable? Next, finished goods stock. Finished goods stock. Now, finished goods cost per unit we have to compute. Material, you already know 10, wages 2.5, and overhead 7.5, 20, because already there is no selling and admin expenses. Okay, cost of goods sold. How much is the cost of goods sold? This is nothing but cost of goods sold. This comes to 20. Okay, if selling and admin expenses given, now you will ignore, because this finished goods cost per unit. Now, finished goods stock is equal to what? 6 lakhs unit into 20 into 1 by 1 month. Okay, stock, finished goods stock. So how much is 10 lakh value? Next, working note number 4, data. Here only you need to understand. Data, I will consider. Okay, credit sales. Now I'm taking sales approach with regards to data. I'm taking sales approach. What is that? Credit sales into debt collection divided by 12. So 6 lakhs units is there, unit produced into 25 selling price per unit. This you need to understand. If you take selling price per unit, which means you have taken sales approach, total sales approach. Okay, here into 2 by 12, if you do this, you will get 25 lakhs. Assumed all sales to be credit. Why they have not specifically given now how much is the credit or cash? Have they given specifically with regards to sales? Nothing is given. See, don't get confused. In the previous question, they asked like that. In the previous question, I think they have, yes, cash purchases like this. In the current question, there is no segregation between cash and credit. So we will understand that everything has been done on the sales basis. So debtors also can be valued at cost of sales, i.e. 20. I already told you now, cost also it can value total cost. Cost of sales should be taken, not cost of goods sold. Cost of sales means admin and overhead expenses also. But in this question, I think there is no admin and overhead expenses. Hence, here this 20 and this 20 is same. But where admin and other expenses, selling expenses are given, this may be something different. And finished goods stock, while valuing finished goods should be valued at what? Cost of goods sold. But this should be valued at cost of sales. Are you all understanding? Give note as per the stand taken. What is the assumption? You just give a note so that it will be very clear. Next, working note number 5, credit as for material. What is see, if nothing given, so material consumed is equal to purchases, you will assume. So what happens? 6 lakhs unit consumption is there, that you will assume it as purchases. So 6 lakh unit 10 per unit now material, 60 lakhs is the purchases, I will assume. So 60 lakhs purchases now, 60 lakhs into credit payment period 1 by 12. How much is that? 5 lakhs. Are you all comfortable? Now, you will just prepare the working statement. All the other details are, you can cash balance, you can assets, you can take and prepare the statement. So part 1, estimation of working capital under total approach. Total approach in the sense, total cost approach here, what they mean, because cash cost in the next part they're asking now. So anyway, current assets is there, working note number 1, 10 lakhs, WAP 3 lakhs 75, finished goods 10 lakh, we already saw that, debtors, okay, 25 lakhs, and this is 25,000, cash balance 25,000, total comes to 49 lakhs. This is about current assets minus current liability. What is current liability? Creditors for material is there, 5 lakhs we computed. So 49 minus 5, 44 lakhs will be the net working capital, A minus B. Are you all comfortable? Now, next part, estimation of working capital under cash cost approach. Okay, first we will discuss the working note, thereafter we will move on to the specific, which will move on to the statement. See, what is the raw material stock? Raw material stock will be valued at 10 lakhs. Already that is same under cash cost and this what. Nothing will change. Only from WAP it will change. Are you all comfortable? WAP, what happens? Material will be considered as, see, the 100%, 50%, 50% will remain same. But okay, material 10, no issue. Wages, there will be, it will undergo change or no change, no change, because wages 1.25, 2.5 into 50%, 1.25 will remain same. But here, overheads, it was 7.5 divided by 2, 3 point, what is that? 3.25 or 3 point, what is that? 75, I think 3.75 we took, na? Here it will undergo change. Cash price, na? 7.5 minus 0.25, so 7.25 divided by 2. Okay, you will get 3.625 if you value at cash cost. Upper total comes to 14.875. So WAP stock is 6 lakhs units into 14.875 into, okay, WAP holding period divided by 12. How much is that? 3,71,875. Are you all understanding? Next comes to come to finished goods. Finished goods, see here also, overhead only you change. Other change, material, labor will remain same. Overhead instead of 7.5, you will take 7.25 and 19.75 will be the value instead of 20 per, okay, what do you say, 20 units. Okay, 20 per unit. It will be 19.75 per unit. So finished goods is 6 lakhs into 19.75 into finished goods holding period divided by 12, that is 1 month. Okay, they have told the holding period for finished goods, so total comes to 9,87,500. Next, working note number 3, debtors. See, cash cost of sales you will consider There you consider 20 entirely. Here 0.25 you remove, 19.75 cost of sales into 2 by 12. Again, if admin and selling expense there, you should add and do the adjustment. Are you all comfortable? So 6 lakhs into 19.75 into, okay, debt collection period divided by 12, that is 19 lakhs 75,000. Now all the details are given. Now we'll prepare the working capital estimation. Okay, this is very simple. Raw material same as 10 lakhs already computed. WIP 3,75,800, finished goods, debtors and cash total comes to 43,59,375, and creditors for material, okay, 5 lakh, no change here. Then you will get the total working capital is how much? 38 lakhs 59,375. Are you all comfortable about the estimation of working capital? Shall we move on to the next stage? Okay, now working capital cycle. What is this working capital cycle? We will briefly discuss. Thereafter we will proceed. See. Now, what do you mean by operating cycle or simply working capital cycle? See, the time gap between the money invested and money realized is called as operating cycle or cash conversion cycle. Very simple. You start with the purchase of the raw material. You have the cash in hand. You start with the purchase of raw material in order to produce the goods. If you are a manufacturing company, you will give your cash and purchase the raw material as a starting point. From there, raw material will get converted to WAP. WAP will get converted to finished goods. Finished goods, okay, if you make credit sales, it get converted to debtors. Then, okay, you will realize that debtors will convert into, okay, cash. Are you all comfortable? This is the operating cycle. This is operating cycle, which means nothing but how much time. It is also called as cash conversion cycle. How much time, okay, the cash is turned in the business. Okay, the from starting off the raw materials, okay, it gets converted to cash back. So what is the time frame? So gross operating cycle is nothing but raw material holding period plus WAP holding period plus finished goods holding period plus debt collection period. Okay, which means these are all the days. It will come in days. If given in days, not most probably it will be given in days. So raw material holding period, this 30 days of raw material holding period. Now what is the understanding? 30 days, okay, my cash is blocked in raw material. What is the understanding? Raw material holding period 30 days means what is the meaning? For 30 days, okay, my cash is blocked inside a raw material. WAP holding period assume 45 days. Another 45 days, okay, my money is blocked inside the WAP, and another 20 days is blocked inside the finished goods. Another 30 days is blocked as debtors. Are you all understanding? So total raw material holding period, WAP holding period plus finished good holding plus debt collection period will be called as gross operating cycle. Net operating cycle means the total of these amounts you will get. This is called as gross operating GOC minus creditors payment period or time lag minus time lag. This is for expenses, this is for material. Are you all understanding? So whatever is the time lag for material, what is that, the creditors for material as well as creditors for expenses, that also will reduce and get the net operating cycle. Are you all understanding? An operating cycle of 150 days means we require 150 days of expenses as working capital. What is the general understanding? See, again, total net operating cycle comes to 150 days. What does this mean? Operating cycle of 150 days means, okay, we require 150 days of expenses. Whatever is the expenses, 150 days of expenses to be kept as working capital, because it will take 150 days to initially spend the cash and then release the cash. Up, you need some balance as a buffer. You need some amount so that, okay, you will be able to do further sales and further grow the business until the cash is realized. Are you all understanding? So shall we do one question in this regard? Okay, take question number 10, working capital cycle. Question number 10, in the sense there is no, or number is not given in the same order, just for reference. Okay, I have taken these questions from various sources, hence I am discussing. Are you all comfortable now? From the following information of XYZ Limited, calculate net operating cycle period, number of operating cycles in a year. Now, see, raw material consumed during the year 6 lakhs given, average stock of raw material given as 50,000, cost of production for WAP given as 5 lakhs, average WAP progress inventory, average WAP stock given as 30,000, cost of production of finished goods 8 lakhs, average finished goods stock 40,000. Then average collection period from debtors is directly given 45 days, 30 days and 360 days. Are you all understanding? Now, here you need to understand, first of all, okay, see what happens in case of average collection period from debtors directly given. This is given. Creditor period allowed directly given. Number of days in a year to be taken 360. That is not an issue. But here problem is for raw material, for WAP, for finished goods, everything the days is not given, which means the raw material holding period is not given. Sir, when raw material holding period is not given directly like this, how to compute the raw material holding period? Now, very simple. Okay, raw material holding period, formula is nothing but raw material stock, average raw material stock divided by what? Material consumed into 360. Are you all understanding? Don't worry. This is array. Actually, this is okay. Arrived by, see, like this. Now, if you see this, what is raw material stock? In the previous segment, while valuing the raw material stock, we know that raw material stock is equal to what? Material consumed into this cross multiply. What is this? Raw material holding period into 360. Now, what you should do? Divided by 360. In the 360 is number of days given, otherwise it's 12. Whatever we learned there, so raw material stock is nothing but material consumed into raw material holding period divided by 12 or 360. If days is given in this question, number of days given, so we'll solve by using days. There in this question, then that question, previous question, we solved using months because all the holding period were given in months. Are you all comfortable? So that formula I rearrange and get the same formula, nothing new. Are you all comfortable? So raw material, average raw material stock divided by material consumed into 360. If I do this for first one, raw material 50,000 divided by 6 lakh, raw material consumed into 360. So 50,000 into 360 divided by, what is that? 6 lakhs. If I do, I get 30 days. Are you all comfortable? So 30 days here, I get it as raw material holding period. Similarly, WAP 30K divided by 5 lakhs into 360. I'll get how many days? 22 days. Like this, I've calculated. For finished goods, 80 days. Now, what is the gross operating profit? 30 plus 22 plus 18. Are you all understanding? Minus plus debtors collection period is directly given. Yes, 45 days is given. So 30 plus 22 plus 18. 30 plus 22 plus 18 plus 45. I think 45 is given. Yes, how much is that? 115. This is the gross operating cycle is 115 days. And net operating profit minus, okay, net operating, what do you say? Cycle in number of days. Yes, you will reduce the creditors payment period. How much is the days? 30 days. Yes, 30. So how many days coming? 85 days. Net operating cycle. I call it as net operating cycle. Okay, this I already explained. Raw material stock is equal to material consumed by raw material. How you arrive at this formula. Are you all comfortable with this? Okay, with this we are through with the segment, that is working capital estimation. Shall we move on to the next segment, that is see, debtors management, debtors and creditors management. Now we'll move on to debtors and creditors management. See, what happens? Debtors arises due to, see, debtors and creditors will together I will discuss because you have one or three concepts which will be applicable, because creditors angle and debtors angle, okay, different, but both are same. For example, I'll tell you that if we are giving credit to our what do you say? Our customer, we are giving credit to our customer. Okay, debtors will become debtors. Debtors will arise. How the debtors will arise? If you make credit sales, which means you are giving something for credit to your customer, right? And that customer will be your creditor, correct? Are you all understanding? So anyway, this is nothing but two sides of the same coin. So debtors arises. Why, sir, debtors arises? Now, very simple. Due to credit sales. Why debtors arises? Due to credit sales. I make a credit sales. Okay, debtors will come in the balance sheet. Now, debtors, sir, how debtors as an asset has benefit as well as cost. In the entire segment, debtors management segment, you should only do cost benefit analysis. You should only do cost benefit analysis. See, very simple. Having debtors in my balance sheet will have a cost, will have a benefit. What are the cost involved? What is the benefit involved? You tell me, children. I don't need to. Logically, you just think. What is the benefit involved? If you have debtors in your balance sheet, now you do more and more credit sales, right? You will, okay, the sales will improve. The sales will improve. Having debtors in my balance sheet, giving more credit period will, what it will do? It will increase my sales. Because very simple, yeah. I'm not doing that, but generally assume if I'm a coaching into coaching business, what I say is that See, you attend my classes for 50 days without any payment, just come. Okay, total classes, assume total hours of the lecture is, the subject is 120 hours. I say that for 60 hours you come for free and just listen to the lecture, no need to pay anything. Okay, even if you can walk out if you don't like the lecture, after 50 hours, 60 hours, you can pay the balance amount. Like this, I'm saying. Are you all understanding? Now, if this is the case, what is the benefit and cost you need to understand? This is nothing but we are extending the credit. So improve, it will substantially improve the sales. Why? Because everyone would like to, okay, freely try it. It becomes a marketing source. Everyone tries to, okay, demo lectures, what is saying, he's coming and saying something, let us, okay, without spending anything, I can listen to what he is saying. I can listen to 60 hours of lectures. Okay, if 1 or 2 chapters, 4 chapters are getting covered, now thereafter I can escape and leave. Are you all understanding? This also very possible. So generally what I'm saying, it will improve sales. More customers will come, it will improve the sales. Point number 1, this increases contribution. When sales are getting increased, variable cost will also equally increase, which means contribution will increase. When sales increases, contribution will increase. Agreed? So increase in contribution is the benefit derived by increasing debtors. Now the problem with increasing debtors is that more and more, if you do credit now, more, what is the cost for it? Main cost is bad debts. Why? Because if you make more and more credit sales, now obviously there may be the rate of bad debts, the percentage, okay, it may be higher. The rate of bad debts may get higher. So that is the issue. So bad debts will be the cost and collection cost. See, you keep on giving debt. Okay, bank gives loan to the customers, but sometimes if the customer don't repay, okay, they will use some unconventional methods. Gundas, they will send some gundas to collect the money from those customers who don't pay the money after taking the loan. Okay, in Vijay Mallya's case, what we can do anyway. So collection cost will be there. For that, these persons, agencies will be paid as a collection fees. That will be your cost. One more cost, main cost, is that interest lost on funds blocked in debtors. Very simple. If you have debtors of 30,000, say if you have debtors of 30,000, which means if you are giving 30 days credit, you will have debtors of 30,000. Assume. Now, if 30,000 is the debtors block, now what do you mean by debtors in the balance sheet? Having debtors in the balance sheet. See, 30,000, I have debtors in the balance sheet. Now, what is that? Everything is money. So amount equivalent to 30,000 rupees is blocked as debtor, or to put it simply, 30 days sales is blocked in as debtors. 30 days sales is blocked as debtors, which means I will lose the interest. If I had this 30,000 as cash, okay, I could have invested this 30,000. Okay, suppose assume interest rate is 12%. This is my opportunity cost. I will lose the interest. This is the case if I have debtors in 30,000. Sometimes what happens, if you increase the credit period, debtors balance will become 60,000. Assume doubled, right? Sales also getting doubled. Assume your debtor balance is getting doubled, 60,000. So here already you were losing only 12% on 30,000. For additional 30,000, you are losing the 12% interest. So this is called as interest lost on funds blocked in debtors. This will be your cost. Are you all considering? So what is the benefit? Increase in contribution is the benefit of having higher debtor. What is the cost of higher debt? Having a higher debtor? Bad debts is the main cost. Collection cost, if any, given in the question. Only when collection cost, only when given in the question you will consider. Otherwise, just ignore. So two main things will be bad debts and interest lost on funds blocked in debtors. Interest lost on funds blocked in debtor. Now, decisions related to debtors. What are all the decisions which I will take in this segment? Now, very simple. Only 3 types of questions may be asked most probably. Credit period decision, which means I am at present giving 30 days credit to my customers. Okay, if I extend it to 30 days, 60 days, will it be beneficial or not? This is called as credit period based decision that can be asked. Next, credit appraisal decision. To whom the credit should be given? This is what is appraisal, which means one detail regarding 2-3 customers will be given. For which customer I should give the credit, I should allow the credit, is called as credit appraisal decision based question. Last is the discount policy based question, which means which customer I should offer discount, not trade discount. This is cash discount, okay, which not flat for everyone. Specifically, I can reward those who are making payment earlier. This is I call it as cash discount. To whom cash discount is to be given? This is another, okay, the discount policy. So 3 types of questions are there. Credit period decision. Now, how many days credit should be given? Okay, credit appraisal decision, I already told you to whom credit should be given, and can cash discount be offered under discount policy. These are all the 3 areas which we are going to discuss. See here, few points here. All these problems will be solved using cost benefit analysis. All these questions in the debtors management question most probably will be solved using logical cost benefit analysis. Then debtors turnover ratio is to be understood. What do you mean by, see, in these kind of questions you will come across interchangeably various ratios. What do you mean by debtors turnover ratio? Now, very simple. Debtors turnover ratio is nothing but credit sales divided by debtors. Credit sales divided by debtors. Now, suppose, take this example to understand the turnover ratio here. Annual sales is 3,60,000, which means current year annual sales is 3,60,000. It gives 3 days credit. So company gives a 3 days credit. Compute the debtors turnover ratio. Assume 360 days a year. Debtors is equal to credit sales into debt collection period divided by 360, which you already know, correct? Debtors is equal to credit sales into debt collection period divided by 360. What is the debtors? Well, credit sales 3,60,000. Debt collection period they have given in the question as 3 days credit. Okay, what is the connection between all these? I'm just explaining. So 3 by 360, assume 360 days a year, I have told you. So 3,000 you will get. This 3,000 is what? On an average, 3,000 rupees is blocked, okay, in debtors in my balance sheet. So 360 days is nothing but debtors balance. Are you all understanding? Now, next, you have debtors. Now, what do you do? Credit sales, debtors is equal to, okay, credit sales divided by what? Okay, sorry, debtors, what is that? Debtors turnover ratio. Debtors turnover ratio is equal to credit sales divided by debtors. What is that? 3,60,000 divided by 3,120 times. Sir, what is the meaning of this? What is actually debtors turnover ratio? Now, very simple. It means debtors are turned over 120 days a year to make a credit sales, which means on an average, okay, debtors, the credit sales will be 120 times the debtors. 120 times the debtors. Are you all having the clarity? So, credit sales is 120 times the debtors balance. This is what is to be understood. Now, debt collection period is equal to 360. So one line summary, debt collection period is nothing but 360 divided by debtors turnover ratio. I can easily find out debt collection period is equal to 360 days divided by debtors turnover ratio, or simply debtors is equal to, okay, credit sales. This is, you need to remember, credit sales divided by, what is that? Okay, debtors turnover ratio. Sorry, again, debtors turnover ratio is equal to credit sales divided by debtors. Debtors. Are you all comfortable? Now, with this background, okay, discount policy. Next, we will discount. So, with this background, we will discuss question number 4. We will discuss question number 4. This is regarding credit. Okay, credit appraisal question. Then we have one more question, I think. Okay, credit. Okay, that is credit period question. This is credit appraisal. So these 2 questions we will solve first. Thereafter, we will move on to discount policy. Okay, and then we will be left out only with cash. Yes, cash segment, that we will do anyway. Boumel model, miller-orr model, and cash budget. Okay. Take question number 4 for discussion. Change in credit period, accounts receivable turnover question. RST Limited is considering relaxing its credit policy and is in the process of evaluating 2 proposed policies. Okay. Now, credit period, change in credit period based question. Okay. Currently, the firm has annual credit of 225 lakhs and account receivable turnover of 5 times a year. The current level of loss due to bad debts is 7,50,000. The firm is required to give a return of 20% on the investment in new accounts receivable. Okay, this is the interest. You will take the opportunity cost. Okay, the company's variable cost are 60% on the selling price. Given the following information, which is a better option? Annual sales, okay, 22.5, 275 and 350. And here, accounts receivable 543. I think number is in lakhs. Okay. Let's take, see, 1 second. What is that? 225 lakhs. So they have taken us 22.5, 225 lakhs. How is that they have taken 225? 225. Okay, so that is what I was thinking. Why there's a wide gap of 22.5 and 275? There's a mistake, or there is no point there. It is actually 225 and not 22.5. Are you all understanding? Please make the change. Anyway, see this 225, 275 and 350. That's what I was wondering. Account receivable turnover 5, 4 and 3. Bad debt losses 7.5, 22.5 and 47.5. Are you all understanding? See, this is a question that is being asked. What we have to do? Simple cost benefit analysis. What they say in the question, I'll just explain you what is it. See, relaxing its current credit policy. Assume the credit is how much at present. What is the okay now? At present, the accounts receivable turnover ratio is 5 times a year. Okay, which means if you see that, okay, current, see, I'll just show you here. We have computed already, na? So, yes, see. Okay, now debt collection period. At present, what is the debt collection period? You need to understand. Okay, what is debt collection period? See here, debtors is equal to, let me just here, debtors is equal to, okay, credit sales into debt collection period divided by, in this question, 360 or 12, what is the given? Okay, 360 days, assume this is 360, or let us say 12 itself. Okay, no issue. Now this is assume 12. Now debtors value, see, credit sales into debt collection period divided by 12. Now you know debtors value, don't know, because debtors turnover ratio given. So first we need to find out debtors. Debtors is credit sales divided by turnover ratio. 225 divided by 5. What is that value? 225 divided by 5. How many lakhs? 45 lakhs is the debtor. Okay, debtors value at present is 45 lakhs. This 45 lakhs, okay, you should equate it here. 45 lakhs is equal to credit sales 225 lakhs into debt collection period. Debt collection period divided by, assume, 12. Which means, okay, if you notice, what is that? 45 lakhs into 12. 45 into 12. 540 divided by 225. Okay, at present 2.4 months. Let's say it is month now. So 2.4 month is the at present, okay, the debt collection period. Debt collection period. What is the debt collection period in case 2? What is the debt collection period in case 2? See, first you will find out debtors. What is the debtors? 275 divided by 4. How much is that? 68.75 lakhs. So 68.75 lakhs. This if you equate into 12 divided by 275. Okay, 68.75 into 12 divided by 275. What is that? 3. So this is 3 months. Are you all understanding? The months I calculated just to simply show you. So here it was 2.4 months in case 1. See, I'll just rub everything and just show you. In case 1, it is, okay, in case 1, see, in case 1, it is how much? Here, let me write this here, 2.4 months. Here it comes 3 months, which means this is the relaxing policy. They say that give more credit. Okay, I will try to give more credit. This is credit period related problem. Now, so what they say, if company is this present policy option 1 and option 2 to revise the policy options given. Now what I should do is that, okay, now I will compute this. Okay, so this is particulars option 1 and option 2. Benefit is there, increase in contribution. What is the increase in contribution? 20 lakhs and 50 lakhs. Okay, now what is that? Working out number 1, contribution. See, if you relax the credit policy, now give more credit to the customers, what will happen? Sales will increase, contribution will increase. Agreed? Now, I am not using total approach. I am using incremental approach. How to do it? I'll just show you. This is the best way to do that. Very simple. Present contribution, you will find out. At present, what is the contribution level? Very simple. They have given that VCR ratio is 60%. Now, can you see this? The company's variable cost are 60%. You already know that PVR ratio, VCR ratio. Variable cost is 60%. Now, what is the contribution ratio of 40% is the contribution ratio. So, which means out of the sales, what is the sales? 225 lakhs. At present, 225 lakhs into 40%. 90 lakhs is the current contribution. Are you all understanding? Now, contribution under option 1. Now, what is the contribution under option 1? 275 lakhs into 40%. What is the sales? Credit sales, what is the sales? 275 lakhs in case of second option number 1. 275 lakhs into 40%. How much is that? 110 lakhs. Next, option number 2. 350 lakhs into 40%, 140 lakhs. Are you all understanding? This is all about contribution and the change in contribution. This is why here I have put increase in contribution. Now, at present, what is the contribution? Now, this is the total contribution you have computed under all the option. Now, I will use incremental approach to make you understand. Are you all understanding? So, present contribution 90 lakhs. From 90 lakhs present policy, how much is the contribution increased? Up to 110 lakhs now, 20 lakhs is the contribution increased. Are you all understanding? So here I put 20 lakhs. Are you all understanding? Next, for option 2 now, which means earlier that was 90. From 90 it became 140. Then 50 lakhs is the increase in contribution. So increase in contribution by applying the option 1 as well as option 2. Are you all able to understand? Now next, second part, cost. What is the cost? Now I told you increase in bad debts will be increasing if you relax your credit policy. If you give 50 days, 3 months credit policy instead of 2.4 months, more sales will happen, more contribution will be there, but bad debts will also increase. What will happen? Okay, see, increase in bad debts. Now, at present, what is the bad debts? At present, the existing bad debts is 7,50,000. They have given yes, loss due to bad debts is 7,50,000. But revised policy, now what will happen? The bad debts will increase to 22.5 and 47.5. So increase in bad debts, simply calculate 22.5 minus 7.5, 15 lakhs. 47.5 minus 7.5, how much is that? 40 lakhs. Are you all understanding? Next, increase in interest lost on debtors. For computing interest lost on debtors, how much debtors is blocked in? First, how much funds is blocked in debtors, you need to identify. Are you all understanding? Debtors balance you need to identify. Debtors, what is the formula for debtors? I already computed in the first stage. Very simple. At present, what is the interest lost on debtor? 22 debtors is nothing but credit sales, debt turnover, debtors turnover ratio. Why I say this? This question gives you debtors turnover ratio. So first to find out debtors, now you need to apply this and find out debtors turnover debtors. So what is the value of debtors? 22 lakhs 50,000 divided by 5. How much is that? 2250 divided by 5. 4 lakh 50,000. Agreed? Okay, into 20%. Into 20%. Yes, this is 225 lakhs. It should have been not 2250. It should have been 225. 225 lakhs divided by 5 into 45 lakhs into 20%. 9 lakhs. Are you all understanding? The interest loss. 20% is the opportunity cost interest. Bank is giving me 20%. Now, okay, 9 lakhs you will get. So debtors turnover ratio. How much is that? Credit sales divided by debtors. Okay, debtors is equal to credit sales divided by debt turnover ratio. This is a working note I have given. You already know that. So credit sales divided by debtors is debtor turnover ratio. So debtors is equal to nothing but credit sales divided by debtors turnover ratio. Now, interest lost under option 1, 275 lakhs is the sales divided by 4. You will get balance debtors into 20% opportunity cost. That will be the loss amount on the interest portion. Okay, due to the debtors balance, right? Interest lost under option 3. 350 lakhs, which is sales under option 3 divided by debtors turnover ratio into 20% interest loss. How much is that? 23 lakh 33,000. Okay, are you all understanding? So this I'll put it in the working here. 4 lakh 75,000 increase from at present. What was the number? Okay, current interest loss is 9 lakhs. From 9 lakhs 30 lakh 75. Now what is the increase? 4 lakh 75. Okay, then from 9 lakhs it became 23 lakhs 33,000. Now 14 lakhs 33,000. Net benefit, if I compute, this I get net benefit. Here I get net cost. So I will select option 1. I'll select option 1. Okay, net benefit is positive. See. Next question, credit appraisal. To whom credit should be given? Are you all understanding this kind of question? That also we will do here. The company intends to produce a new product priced at 1,000 per unit with expected annual sales of 5,000 units. Variable cost amount is 750 per unit and 2 months credit is to be granted. It is estimated that 10% of customers will default, others will pay on the due date. Interest rates are 15% per annum. A credit agency has offered the company a system by which he can help identify possible bad debts. It will cost rupees 2,50,000 per annum to run and will identify 20% of the country being potential bad data. So which means 2,50,000 is there, which is cost. Okay, the company offered a system. Credit agency. This is credit agency cost. Okay, credit agency cost, agency expenses. Okay, this I call it one more expenses. I told you now it will have some cost. It is one of the cost in this question. One more adjustment is there. Apart from that, 20% bad debts anyway. 20% is the bad debts. Now percentage given. See, the company intends to produce a new product at 1,000 per unit with expected sales of 5,000. So 5,000 units into 1,000. Na? At present, what is the sales amount? See, what I will do, first working note I will compute, then I will come back here. Okay. Present bad debts. So let's take the bad debts computation cost. Then we will move on to benefit. Here, present bad debts, how much? 5,000 units additionally. Then 1,000 per unit you are selling. This is the sales. Okay. Into, see, where they have given nothing. Here they have given specifically credit sales. Simply annual sales. They have not told anything, but it is to be understood contextually unless otherwise stated. Everything is to be understood as credit sales. Okay, so now what is that? Yes, 5,000 into 1,000 into 10%. Okay, bad debts 10% at present for 5 lakhs. Okay, present bad debts 10% given given as estimated 10% of the customers will default. Nice. Next, proposed bad debts is nil. Why? Okay, it will completely reduce the bad debts. That's what they are saying. Are you all understanding? See, if these customers are rejected, this will identify as 24% as potential bad debtors. If these customers are rejected, no actual bad debts will result, which means the 20% will not be bad debts. I wrongly said 20% will not be bad debts. The 20% will be completely eroded, which means they will identify the balance portion and then that also will be eroded, which means the actual bad debts will be nil. Actual bad debts will be really nil in the proposed product. So here we don't have two other options, only one option and the current so current situation is 5 lakh bad debts and revised situation will be nil. Bad debts will be entirely gone. So what is the reduction? 5 lakh is the total reduction. Are you all comfortable? Next, working note, reduction on interest lost on debtors. At present, what is the interest loss? 5,000 unit into 1,000 into debt collection period divided by 12, into 15% opportunity cost. How much is that? 1,25,000. Proposed policy, what is the interest loss? 5,000 into 80%. Why the 20%? See, if here proposed interest loss, what is happening? Really speaking, see what they say. The 20% of the customers are there. These customers are not entire, debtors. So, which means 100% of debtors are there. In that, 20% of the debtors only will be managed by this credit agency system. Are you all understanding? They will identify only 20% of the debtor as such, which means those, the interest lost on debtor, really the funds will not be blocked there. Under new policy, what will happen? The 20% of the debtors, there will be no blockage. Are you all understanding? Entire thing will be gone. So 80% will be taken. So debtors into what is that? Where is that? Proposed interest loss. The 5,000 units which you are selling for 1,000. So actually should have been 5,000 into 1,000, then 80%. Into 2 by 12 debt collection period. What is into 15%? How much is that? This is the opportunity cost. How much is that? 1 lakh. So decrease in interest cost 25,000 is the decrease in interest cost. Saving cost of savings. Decrease in interest lost. Then savings. Next, decrease in contribution. Contribution also will decrease. How much is that? Contribution existing 250. Contribution per unit is 250. Present contribution is 12,50,000. Proposed contribution 5 lakh into 80%. By 20% debtors will be removed. So 80% will be there into 250. 10 lakh is the value. So decrease in contribution is how much? 2,50,000. So see, 2,50,000 is the cost. Here, this is a benefit. Reduction in bad debts is the benefit. Like this will be opposite. Why? Benefit is reduction in bad debts. Why? If you, if you change the policy, this is credit appraisal related question. So if you change the policy, reduction in bad debts is 5 lakh. Reduction in interest loss and debtors will be 25 lakh. Total comes to 5,25,000. This is benefit or cost? This is benefit. This is benefit. And cost is how much? Reduction in contribution. Contribution will be reduced. This cost reduction in contribution 2,50,000. So 5,25,000 minus 2,50,000. Apart from that, minus 2,50,000. Agency fees will also be there. This is 5 lakh. So total 25,000 is the net benefit. Net benefit derived from this credit appraisal. Shall I proceed to the next area? Now we are going to study the discount policy. What it is, I'll just briefly explain. See, companies offer cash discount. Companies offer cash discount, which means, cash discount, there are two types of discount: trade discount, cash discount. Trade discount will be offered to all the customers. Generally, it will flat off, like this it will be given. It is offered for everyone. But cash discount will be provided to some valuable customers, those who repay, before the scheduled time, before the credit period. Assume you have given 30 days credit period. and some customers wants to repay it, okay, the amount within say 10 days. If you repay within 10 days, I'll give you cash discount. It will be a compensation for the earlier repayment, because earlier you receive money, you can also invest in bank and earn interest, so that is there. So cash discounts are offered to customers to pay early. It is expressed as 2 by 10 net 30 days. It's just a sample. What is the understanding? 2 by 10 net 30 days. See, 30 days I'll give you as credit. How many days I'll give you as credit? 30 days I'll give you as credit. But if you pay within 10 days, 30 days credit you don't have any issue. You can pay even at the end of 30th day. But if you pay before 10 days, you will be getting 2% discount. Are you all understanding? 2 by 10 net 30 days. See, normal credit period is 30 days. But if amount paid in 10 days, then 2% discount will be offered. This is what is the understanding. So when question mentions 2 by 10 net 30 days, like this you need to understand. Sometimes it may give you 3 by 15 net 90 days. What is the understanding? Normal credit period is 90 days. But if you pay within 15 days, you will get 3% discount. Are you all understanding? Now, what is the benefit? You said in all the debtors management question, you have to do cost benefit analysis. Now here, what is the benefit, sir? Now very simple. Money received earlier on which interest can be earned. This is the benefit, correct? See, for example, normal credit period is 30 days. But if you are receiving at the end of 10 days, 20 days balance interest you can deposit in the bank and earn. That is the benefit derived from preponing. So interest earned on bank is annualized. That is, interest earned on bank is annualized. Here, this is already annualized. Okay, what is the cost? Cost is the cash discount offer. The real cash discount offered is the cost, because you are, see, what is the cost? You are receiving some benefit. What is the benefit? Earlier repayment. What is the cost? The cash discount offered is become cost. Are you understanding? So that will become cost. But the problem is that this cash discount is offered for that specific period. See, very simple. The cash discount, if I say you offer a cash discount of 1%, but this is for these specific days. For example, discount for 1% you are offering. This is for say assume 2 by 60 net 90. Let's say here 2 by 60 net 90. Like this you have offered. Correct? Here what happens? Customer has to pay at the end of 90 days, within 90 days. But if you pay within 60 days, you will get 2% discount. Assume he pays within 60 days, till the balance period 30 days are there. Are you all understanding? For the balance period only you can deposit in the bank. Are you all listening what I am trying to say? Which means this is actually given for the earlier repayment of these many days only. These 30 days only you are getting this interest portion, interest amount. Which means this is not annualized. The discount given is for the particular prepayment period and not for the whole year. But interest will be always annualized. Hence, you cannot simply compare. Assume bank interest rate is 8% per annum. 8% per annum. If you deposit the cash in the bank, you will get 8% per annum. But only you will get 8% only when you deposit for one whole year, one full year. Agreed? But cash discount, you are offering 2% just for 30 days prepayment. Are you all understanding? This is 1 month. So 8% and 2% you cannot compare and say earlier, receiving cash is beneficial. You are receiving if you receive the money earlier, you can deposit at 8%. But the problem is only for 1 year if you deposit, you will earn 8%. But here you are offering cash discount of 2% only for 30 days. Up 2 into 12 if you do, 24% really is the annual interest rate you are offering as cash discount, which means cash discount and interest rate cannot be compared as such. What you should do? You should annualize the cash discount and then compare with interest rate. Then only decide whether to offer cash discount or not. Are you understanding? This is the cash cost benefit analysis in respect of discount policy. Hence, cannot be compared as such. Therefore, has to be annualized and compare. We have a formula for it. Annualized cash discount. What is this ACD? What is this ACD? Annualized cash discount is equal to cash discount divided by 100 minus cash discount into 360 divided by credit period. See, this is CPB, credit period before discount, minus CPA. CPA means credit period after discount. Are you all understanding? So what is the formula? Annualized cash discount is equal to cash discount divided by 100 minus cash discount into 360 or 12. If months given, 12 you will consider, or days given, specifically 360 days will be given, that you will consider. Number of days in a year, to be specific. You have to analyze, you are multiplying with number of days in a year divided by credit period before discount minus credit period after discount. Why? Because see, credit period before discount 90 days, credit period after discount is 60 days. Now only for 30 days you are offering this 2% discount. Now I told you. So that is what is in this denominator. Are you all understanding? Now see. Next, okay, we will do one question and then move on to cash management. See, discount policy problem number 7. A company offers standard terms of 60 days net. Its cost of short-term borrowing is 16% per annum. Determine whether a 2.5% cash discount should be offered for payment within 70 days to customers who would normally pay after 60 days, 80 days, 105 days. What is the question? See, discount policy question. Question will be very tricky and short, but you need to understand the interpretation. That's why I told you what they say. Whether a 2.5% discount. So how you will write it? The same thing. How will you write it? 2.5 divided by, okay, if offered for payment within 7 days, 2.5 by 7, net 60 days, net 60 days. At present, this is net 60 days, or you change it to net 80 days or 105 days. They're saying all the option you compare whether giving a 2.5% discount is fair or not, whether possible, benefit, or net cost, and you need to compare and identify and find out. Shall we? Okay, now. See here what happens. Situation, computation, discount rate. Customer pays within 60 days. What is, apply the formula, very simple. What is the discount? Cash discount. What is the ACD? Annualized cash discount is equal to cash discount divided by 100 minus cash discount, 2.5 divided by 100 minus 2.5, 97.5 into 360 divided by 60 minus 7. What is that? Credit period before discount minus credit period after discount. To put it simply, what they say here, if you pay within 7 days, so 60 days is the time available. If you pay within 7 days only, you are getting discount. So what is the differential amount? 60 minus 7, 53 days. For this 53 days only, you are offering the actually discount. Agreed? So what is the amount? 17.42%. This is annualized. This you can compare with 16% bank rate. So bank, if you deposit, you will receive 16% per annum. But if you offer a discount, you have to pay 17.42. What is to be done? Deposit in the bank. Okay, you should go with giving discount. Better to go with bank. No discount should be offered. Why? Because this is the cost. This is benefit. Cost is higher than benefit. Are you understanding? So don't offer discount in case of 60 days. Net comes to 80 days. 80 days, what will happen? And first annualize the cash discount. So 2.5% you should annualize. So 2.5% divided by 100 minus 2.5 into 360 by 80 minus 7. Here only change. All the other things will remain same. This portion of the denominator will change. So 12.64 here, 16%. Compare with 16% per annum. Okay, what is the interest rate? You tell me. 12.64 is more than 16, less than 16, or less than 16. So cost is 12.4, benefit is 16%. What should I do? I should offer cash discount? Yes, because if I offer cash discount, you will lose only 12.64, but you will gain 16% net benefit. Net benefit will be there. See, now we move on to the third, that is 105 days. So if 105 days, okay, what is happening? 2.5 divided by 97.5, same, the 3.5 divided by 97 into 360 divided by 105 minus 7. How much is that? 98 days is equal to 9.42, which means cost is 9.42, benefit is 16%. Whether to offer a discount? Yes. So in these two cases, you will offer a discount. Okay, in the case number 1, you don't offer discount. Are you all comfortable? If the customer normally pays in 60 days, giving discount cost 14.424, but the interest saved, okay, but the interest saved is 16% per annum. Okay, in other two situations, discount given is less than the interest saved, hence can be given. Okay, now we'll move on to the cash policy. Now we'll discuss the cash management segment, last segment. See, we will discuss predominantly 3 models are being tested: Boumel model, miller-orr model, and cash budget. How to prepare a cash budget? See, what is a Boumel model? Boumel model, okay, formula, simple formula and application. Okay, we are not going to discuss it detailedly, just understand it is something similar to your EOQ formula in the materials chapter. Okay, optimum cash balance. In the materials, you would have studied optimum stock balance. Okay, Now inventory management. So there you would have studied this. Here it is optimum cash balance, okay, to be maintained by the company per day. So this is like square root of 2a into f divided by o. What is this? Very simple. See, here if you see, what is this? C means optimum cash balance and A means annual cash disbursement. Sometimes given monthly, na, you convert it to annualized. That is the same EOK also, you convert it to annualized, na, same way here also. Annual cash disbursement sometimes will be given as monthly in the question. If at all given monthly, na, you will convert it annualized. Are you understanding? Next, fixed cost per transaction. What is F? 2AF. What is the F? Fixed cost per transaction. What is O? Opportunity cost. Okay, opportunity cost per annum. Annualized interest rate. Opportunity cost per annum. Okay, this is all about it. One question we'll quickly go through and finish it up. See, United Industries Limited projects that the cash outlays of 3750 will occur uniformly throughout the coming year. So this is the annual cash. Okay, projected cash. How much is the 3750? United plans to meet its cash requirement by periodically selling marketable security from its portfolio. The firm's marketable securities are invested at 12%. Marketable securities can be invested at 12%. This is the opportunity cost. And the cost per transaction of converting securities to cash is how much? 40 rupees. Are you all comfortable? Now, what is the use the Boumel model to determine the optimum transaction size of marketable securities to cash, which means what is the cash balance is how much? Square root of, okay, 2FA divided by O, 2 into F, okay, fixed transaction cost of 40 rupees per transaction into 30 annual cash, okay, how much is that? 3750 divided by 12, square root it, will get 50,000. Are you all understanding? On any given day, it is prudent to keep 50,000 as cash. Next, what will be the company's average cash balance? Average cash balance is what? Now, total optimum cash balance is 50,000 divided by 2. Simple average, you do it, you will get the average cash balance. Are you all understanding? 25,000. How many transfers per year will be required? How many transfers per year? Now, very simple. Okay, number of transactions, the total value. What is the total value? 37,50,000. Annual cash disbursement divided by, what is that? 50,000, which is per day. What is the optimum cash size? Okay, which is 50,000. So 3750 divided by 50 is nothing but 75. 75 times you need to transact in a year. Are you understanding? To reach the actually to reach the 37,50,000 using this 50,000 optimum size. Next, what will be the total amount of cost maintaining cash balances? What is the total amount of cost? Which means what? Per transactions, you are, see, per transaction, what is the cost? 40 rupees is the cost. What is the total transaction to be undertaken to reach 37,50,000? 75 transactions. Just now we computed. So after computing number of transactions into 40 rupees per transaction, 75 into 40, 3,000 is the transaction cost. But apart from that, the 3,000 transaction cost is there. This is, okay, maintain. See, you have two things here. You maintain the cash balance. What is the cash balance you need to maintain? Now, there's 50,000 you need to maintain cash balance per day. That is fine. On an average, 50,000 you need to maintain. Now, what is the cost involved? You need to see. If you maintain the cash, okay, you have to, what happen? You have to incur transaction cost, because you have to incur 40 times you have to transact. To maintain this 50,000, you have to incur 40 times you have to transact. So transaction cost will be there. 3,000 will be the transaction cost. Cost number 2, what will happen? There will be also opportunity cost. Very simple, yeah. If you maintain cash balance, what it means? You are not depositing in the bank now. So by not depositing in the bank, you will lose the opportunity cost. You will lose the interest. That is what marketable security. You will lose the interest. So 50,000 into half. This is on an average. See, 50,000 is general. On an average, I will have for 25,000, because average you should consider the opportunity cost, which is, what is that? 50. What is that? 12%. Opportunity cost is 12%. So 50,000 divided by 2, which we already did now. 25,000 we did. Yes, this average cash balance 25,000 now. This 25,000 average cash balance into how much is that? Opportunity cost 12%. You have to consider. Are you all understanding? How much is the interest loss? 3,000, which means the cost of on an average keeping 25,000 throughout the year. Okay, I lose interest of 3,000 rupees. 12% interest I lose of 3,000 rupees. Are you understanding? Total cost comes to 3,000 plus 3,000, 6,000 rupees. Understanding? Yeah. Next, shall I proceed to the miller-orr model? Okay, see. There are, why miller-orr model? See, if you see the by Boumel model, it assumes that the cash balance is maintained throughout the year. That's why we computed average cash balance. Throughout the year it is maintained. But really speaking, okay, the company will have some fluctuations also, up and down, are you understanding? Cash balance will remain same for throughout the era. Sometimes expenses may be more, sometimes less expenses will be there. Okay, more amount will be invested in bank, less amount will be invested in possible. So that is why what they say, miller-orr model, it's a stochastic model. It's a stochastic model where share price fluctuates like that. Okay, they assume that fluctuates and they use this formula for that. Z value is equal to what? Z value, this is optimum cash balance. Z is equal to optimum cash balance. What is the formula? Is equal to third root of or cube root of. What is the formula? Cube root of 3 by 4 into sigma square divided by K. C sigma square divided by K. What is this? Okay, very simple. Here you will understand. Okay, now, okay, cash budget, no issue. No, we will see understand the formula. Everything we will understand through a question. That is better to discuss this after reading the question. Now, upper limit, this formula. So first tell me, what is the formula for miller-orr model? What is the formula? Z is equal to cube root of, 3 by 4 into C sigma square divided by K. Okay, upper limit is equal to, now you will have, see, the model will be like this. There will be upper limit, lower limit. Okay, why? Because the price, as the cash balance will fluctuate throughout the year. This is upper limit for upper, this is the average price, this is Z value, okay, which is on an average it is maintained. Lower balance, this lower balance, minimum balance will be given in the question itself. Minimum balance will be given in the question. That is why we are not computing lower limit. Lower limit, minimum balance you should hold in cash in bank. Okay, that will be given in the question. So not given here. Are you understanding? So you need to compute three things. One is that upper balance, upper limit, lower limit plus 3 into Z value. Lower limit plus 3 into Z. Return point is what? See, it goes up and returns to normalcy. So return point is lower limit plus Z value. Lower limit plus Z value. Average cash balance is lower limit plus 4 by 3 into Z value. 4 by 3 into Z value. So 4 formulas you need to learn. Okay, nuisance only. Anyway, okay, question is being asked 5 to 6 marks they test. That's why I'm saying. So 3 formulas. Tell me, children, what is the formula? Cube root of normal Z value. What is first you need to find out? First step to find out Z value. What is that? Cube root of 3 by 4. That is 3/4 of, C sigma square divided by K. Next formula, what is that? Upper limit. Upper limit means lower limit plus 3 into Z value. And then there you have return point. Return point now, lower limit plus Z value. And average cash balance is what? Lower limit plus 4 by 3 into Z value. Are you all understanding? Now, let us do one question. You will have absolute clarity. The Cyberglobe company has experienced a stochastic demand for its product with the result that cash balances fluctuate randomly. The standard deviation of daily cash flows is 1000. What is this? Sigma, standard deviation. This is nothing but standard deviation. Standard deviation is denoted by sigma, already discussed in portfolio, risk and return profile. Okay, the company wants to impose upper and lower bound control limits for conversion of cash into marketable securities and vice versa. The current interest rate on marketable securities is 6%. What is this? Okay, the interest rate you will consider. Are you all understanding? Next. The fixed cost associated, this is annualized cost. Okay, you need to convert it per day. Anyway, fixed cost of associated with the cost transfer is 1000 and minimum cash balance 1000. What is this? Lower limit. Lower limit. Minimum cash balance is considered to be lower limit, and compute the upper limit, return point, average cash balance. Anyway, first step is to compute Z value. What is Z? 3 by 4 into COQ square divided by K. Third root is also, see, if you write it 1 by 3, okay, the dirty power, you can also, this is nothing but third root, cube root of this root. It will be same. Are you all comfortable? Okay, so Z value is target cash balance or optimum cash balance. C is nothing but transaction cost of 1000. K is interest rate, but 6% per annum. You need to convert, divided by 360. Daily interest rate you need to find. So 60%, 0.06 divided by 365 you need to do. Are you all understanding? Next to standard deviation of the cash flow 1000. Apply the formula, you will get 3573. Okay, and the upper control limit, lower limit plus 3Z, if you solve it, 10,000 plus 3 into this number. Okay, this is the upper limit. Return point, lower limit plus Z, 10,000 plus this. Why 10,000 lower limit? Because minimum cash balance they have told in the question. Now, what is the question? See, and the minimum cash balance to be maintained is 10,000. Are you all seeing this point? Okay, that is what is lower point. Lower limit, not given in the question. Don't understand. Don't think this is given in the question. Plus Z, 10,000 plus 3573, 13,573. Average cash balance is what? Lower limit plus 4 by 3 Z. What is that? 10,000 plus 4 by 3 into 3573. Okay, 10,000 plus 4,764, 14,764. Are you all comfortable? Shall we move on to the last segment, that is what is that? Cash budget. Okay, we don't have any concept. Prepare a cash budget on a cash basis, not on accrual basis. Cash basis, just like you prepare the cash flow statement, you prepare on a cash basis, you will prepare the budget. Are you understanding? Now, see, ABC Limited wants to arrange for overdraft facilities with its bank during the period April to June, April, May, June, 3 months, okay, for a particular year when it be manufacturing mostly for stock. So prepare a cash budget for the above period from the following data indicating the extent of bank facilities the company will require at the end of each month. Okay, now February given, sales given, purchases, wages, all these are given for February, March, April, May, June. Why these many given? Don't worry. Okay, you have to do some adjustments. Okay, on cash basis you have to do some adjustment. We'll see. 50% of the credit sales are realized in the month following the sales, and the remaining sales is the second month following. Creditors are paid in the month following the purchase. Are you all understanding what is happening? You see, you are making sales. Out of it, 50% of credit sales are realized in the month following the sales, which means if you make sales in January, credit sales, February only 50% of the sales will be realized. Are you all understanding? So 50% will be realized on the same month. Balance of 50% of the credit sales are realized in the month following the sale. Okay. So see, it will not be received on the same month. Nothing will be received on the same month. First 50% will be received on the next month. Thereafter, the balance 50% will be received on the second month following. So March, which means if you effect the sales on January, in the month of January, you will realize the sales value on 50% of it you will realize in February. Balance 50% you will receive in month. So February month, if you make some credit sales, in the month of March you will realize 50%. Balance in April you will realize 50%. Are you understanding? Now, apart from that, creditors are paid in the month following the purchase. Straightforward issue. Okay, next month I will make 1 month is the time lag. 1 month after the credit purchase, I will make the payment. Okay, cash in bank as on April estimated to be 25,000. Are you all understanding? Opening cash balance. April 1st, we need to prepare for April, May, June. Agreed? Now, see, during the month of sale, nothing will be realized. April, May, June, nothing will be realized. Agreed? During the second month, 0.5 will be realized. April month, which month's 0.5 will be realized for second month? March. Okay, it's the sales of March you will consider. What is the sales of March? March sales comes to how much? 1,92,000. February sales comes to 1,80,000. Here, see, February sales 50,000 will be realized in April 1st. Yes, that will also realize. 1,92,000 also will be realized. Are you all understanding? So April, two things will happen. 90,000, 1,80,000 divided by 2 will be realized. Thereafter, okay, you will also realize 1,92,000 sales is there now divided by 2. That will 50% will be received. See, this is month of February. 50% of February month will be realized as 90. 50% of March will be realized 96. This is 1,92,000 divided by 2, 96,000. Are you all understanding? So in the month of inflows, cash inflow collections, if you see, this is April. For April, you will get a February collection, 50% of February collection, 50% of March collection. Total collection comes to 1,86,000. Now, this is cash inflow. Come to cash outflow in April. April month, what cash outflow will be there? Purchases made for the March, which means March months, how much purchases you made? See this purchases. How much is the March? 1,92,000, 1,44,000. So 1,44,000 will be there. And what is given? Anything given in for wages? Creditors paid for the month following the purchase means okay. Now see here what happens. So what is the month of March? 1,44,000. 1,44,000. 1 month given. Anything given about wages? Nothing given. Nothing given. No adjustment given. Okay, you will assume that it is paid in the same month, which is 11,000. Are you all understanding? If there is preponement or postponement, then they will mention. Otherwise, see in this question there is no preponement. Sometimes there might be preponement also in case of some other expenses, auditors fee, or some other thing. Okay, that you should consider. Are you all understanding? Then what you will consider? May month expenses or income you will get preponed to April. Are you understanding? So 11,000 is that total comes to 1,55,000. Net cash receipt is how much? 1,86,000 minus 1,55,000. Inflow is 1,86,000. It should have been in the minus negative 1,55,000. How much is the net cash receipts or deficit? Receipts 31,000. Cash balance at the starting of the month overdraft. Why? Because cash in bank is expected to be estimated at 25,000. Okay, this is 25,000, not the overdraft. Overdraft, see, what they have done now. Cash at the start of the month means positive. If they given in bracket, it means overdraft. For the following year, it might be overdraft. In the last year, it might be overdraft. That is why they have given 25. So 25,000 is simply cash opening balance, positive. Credit balance, 25,000 plus 31,000, 56,000 is the cash balance at the end. Cash balance at the end. This, okay, you will adjust in the next year. This 55,000 will go. And this balance 47,000 negative balance will go to the next year. Are you all comfortable? Now, next month, May month again will happen. Okay, March month sales, half 50% sales will be there. April month half sales will be there. Total collection. Thereafter, okay, cash outflow now. April month's outflow will be there, and wages will be there for 10,000. Like this, you need to prepare the cash balance. Nothing to be discussed more. Okay, you can go through here alone. The 47,000 you become deficit. When it becomes deficit, not negative balance. Okay, you take the total collection and reduce the okay, you will get what? You will get 2,67,000. Reduce it, you will get further deficit. So two deficit here also deficit, here also deficit, which means what? Overdraft. Ultimately, it becomes 1,67,000. Overdraft, 1,67,000 overdraft, and okay, this is a yes, okay, this is the overdraft. Okay, this much amount is the total negative, and overdraft fertility required is how much? 1,20,000 overdraft facility is required. Are you all understanding? Okay. So with this predominantly, you can go through all the other things. Okay, with this predominantly, most of the discussions are over. If you enjoyed our marathon, please share it with your friends maximum. And we'll come up with a CA marathon also before September examination. Anyway, right? Thank you. I'm leaving you there, and all the best for your upcoming examination. All the very best. I hope I helped you to add some value to your preparation. And anyway, all the best. Thank you.